Everyone, good morning, good afternoon, good evening to all of you. Welcome once again to this लाइव एनालिसिस स्टार्ट करते हैं। आज का सेशन 12:30 हो चुका है। लंदन सेशन ऑलरेडी ओपन है। क्रूड ऑयल को देखोगे एक बड़ा गैप अप देखने के लिए मिला है। नेचुरल गैस फ्लैट ही ओपन हुआ था, कल थोड़ा बहुत सेलिंग आई थी, उसके बाद साइडवेज हो गया था। एक काफ़ी बड़ा गैप अप 3% अप हो चुका है ऑलरेडी, मोर देन 3% अप है। कल तो थोड़ा बहुत साइडवेज ही एक रेंज के अंदर घूम गया था, रेजिस्टेंस के आसपास ही। आज बड़ा गैप अप हुआ है सीधा। मेन रीजन दो तीन रीजन है। पहला, इंडिया जो रसिया से ऑयल परचेज करता था, देर इज़ अ वेरी हाई चांसेस कि अब वो थोड़ा सा कम परचेज करे बिकॉज ऑफ द न्यू सैंक्शन गिवन बाय यूएस एज वेल एज ईयू। ईयू ने भी जो रशियन एलएनजी है उस पर एक सैंक्शन, एक्स्ट्रा सैंक्शन लगा दिया, एक्स्ट्रा बैन लगा दिया है। तो दैट इज़ अ मेजर न्यूज़। इंडिया भी अगर रिकंसिडर करता है रशियन ऑयल को बाई करने से, तो डिमांड और ज़्यादा बढ़ सकती है, सप्लाई कम हो जाएगी। सो दैट इज़ अ मेजर न्यूज़। कि यूएस ने भी टॉप जो रशियन ऑयल कंपनीज हैं उन पे सैंक्शन लगा दिए हैं। यू ने, जैसे मैंने बताया, एलएनजी पे बैन लगा दिया, तो देयर इज़ अ वेरी हाई चांसेस कि क्रूड ऑयल थोड़ा सा इस वजह से ऊपर है। लेट्स सी क्या प्राइस एक्शन में बिल्डअप होता है आज। 12:30 लंदन सेशन ओपन है। डेटा की बात करें, कल क्रूड ऑयल की इन्वेंट्री आ चुकी है, तो आज आपका नेचुरल गैस की इन्वेंट्री है। एंड उसके अलावा और कोई मेजर डेटा तो आज शेड्यूल है नहीं। इंडियन मार्केट भी थोड़ा सा गैप अप हुए थे, उसके बाद सेटल हो गए हैं अपर लेवल पे। ऑल टाइम हाई पर निफ्टी बैंक, निफ्टी भी ऑलमोस्ट ऑल टाइम हाई की ओर जाता हुआ। मेजर रेजिस्टेंस ऑल टाइम हाई बैंक निफ्टी 50 फ्यूचर में। लेट्स सी क्या ट्रेड बनता है। 5:30 न्यूयॉर्क सेशन की ओपनिंग हो जाएगी एंड देन 7 PM यूएस मार्केट ओपन, 8 PM नेचुरल गैस इन्वेंट्री। ठीक है, देखते हैं कुछ बनता है ट्रेड। मॉर्निंग से बुलिश ही है क्रूड ऑयल ओवरऑल। थोड़ी बहुत प्रॉफिट बुकिंग ही कह सकते हैं इसको। ये कॉन्ट्रैक्ट चेंज कर लेना, ठीक है। कल जो कॉन्ट्रैक्ट लगाया था वो कॉन्ट्रैक्ट नहीं है, उसमें चार्ट ही चल नहीं रहा था कल, तो हमने फिर चेंज कर दिया था, नेक्स्ट मंथ का चार्ट यूज़ कर रहे थे। अभी ये करंट मंथ का ही चार्ट है विच इज़, हाँ, सेंसेक्स की भी एक्सपायरी है आज, ध्यान रखना। सेंसेक्स की भी एक्सपायरी है। ठीक है, तो क्रूड ऑयल में नवंबर मंथ का ही फ्यूचर है, वही चल रहा है। प्राइस अभी 5350 के आसपास है। तो एक करंट मंथ का ही चार्ट है। ठीक है, देखते हैं कुछ ट्रेड बनता है, तो अभी तो नहीं है। ठीक है, एक 7:30 पर डेटा और है एग्जिस्टिंग होम सेल्स का, देखते हैं। बाकी 8 बजे नेचुरल गैस की इन्वेंट्री। बाकी गोल्ड और सिल्वर को भी अगर चेकआउट करोगे फॉरेक्स में, तो कल गोल्ड ने थोड़ा बहुत प्रॉफिट बुकिंग और दी थी। आज तो अभी इंट्राडे की अगर मैं बात करूं गोल्ड की, तो थोड़ा सा वॉलेटाइल या पॉज ही कह सकते हो। मॉर्निंग पे जब ओपन हुआ था इंडिया में, थोड़ी बहुत बाइंग आई, वापस उसी लेवल पे आ गया, तो सेलिंग आ गई है। बाकी फॉरेक्स का भी अगर चार्ट देखोगे, मॉर्निंग पे जब आज ओपन हुआ था अर्ली मॉर्निंग 3:30 पे, वहाँ से एक रेंज के अंदर ही चल रहा है साइडवेज, तो कंसोलिडेशन में है ओवरऑल। डे हाई पे वापस सेल का प्लान कर सकते हो वैसे गोल्ड में। बाकी नीचे एक सपोर्ट था, वो टेस्ट हो चुका है ऑलरेडी 4087 के अराउंड, दैट इज़ ऑलरेडी टेस्टेड। ब्रेक डाउन होता है तो थोड़ा सा और गिर जाएगा, तो दैट इज़ अ लास्ट सपोर्ट जोन यू कैन एक्सपेक्ट अप्रॉक्सीमेटली 4087 से 80 के बीच में। टेस्ट हो गया वैसे ही, दूसरी बार आ रहा है, देखते हैं होल्ड करता है नहीं करता है, नहीं तो इसको ब्रेक करके नीचे वाले सपोर्ट पे आ जाए तो मेरे अकॉर्डिंग वो ज़्यादा सेफ रहेगा प्राइस के लिए, विच इज़ अप्रॉक्सीमेटली 4050 से 4040 के बीच में। दैट इज़ नेक्स्ट सपोर्ट एरिया इन 15 मिनट फॉरेक्स। ठीक है, क्रूड में देख लेते हैं, क्रूड में कुछ
And this is what we've been seeing. And I think at the rate that this is growing now, they are right to pay attention to it, to look at it in the perspective of financial stability. Now, we see this mostly in the US. We see it somewhat more in the Europe and slightly less in Norway. But we still come across this in transactions that we are competing for. And sometimes we lose to private credit. Sometimes we have customers wanting to refinance a debt that they have with
And you have to be
private
careful
credit.
not to drop your lending standards, I suppose.
Well, that's
to
the
compete.
dynamics of the market, that we always need to be mindful both on profitability and also on structure. And right now there is a lot of capital in the market, so there is a pressure on both.
Kirsten, you talked a little bit about your IPO experience as well. I really want to pick your brain on this because DNB obviously operates in the Swedish market quite substantially. We have a graphic that's made up of some Bloomberg reporting that suggested the top IPO markets, the UK is no longer part of the top 20, but Sweden is very much in number 7 in that number. Just from a big picture perspective, what is Sweden doing right that maybe the UK can learn from when it comes to the capital markets? Give us your diagnosis, give us your prescription.
I think they've been very successful in building an ecosystem around their capital markets for years, driven by a market with ample private capital and also private equity. And they have facilitated for companies also of a smaller size to get listed and have attractive liquidity in their shares. So they do stand out as the market that has listed more companies in the past 10 years than what is it, France, Germany, Netherlands, and Spain altogether. One additional thing that I would mention is how they've been driving retail savings and investments and the public sort of commitment and engagement into the market, probably the most active market in Europe. This is usually what we see in the US. And this was, the start of this was driven by pension reforms done, I think now closer to 20 years ago, where they are making people aware of the value of their pensions, incentivizing them to save their money wisely, not only put them in bank accounts, but also engage into the markets. And of course, this is then again also driving liquidity and becoming a very important part of that whole ecosystem.
Well, let's marry those two concepts, the public and the private, if we can, because you also work with plenty of private equity firms, EQT as just to name one, among others. And one of the big concerns in the private markets right now is that is this the environment to explore IPOs, to explore public debt issuance when we're looking for deal exits, or to kind of keep it within the private market sphere? And I think that's where some of those private credit concerns are coming from. Your take on just the global environment when it comes to M&A, capital fundraisers, and of course, when it comes to deal exits for a lot of these private firms?
Well, I think it's well known that a lot of private equity has been sitting longer in their companies, and they've been struggling to find exits. And now markets are really opening. We're seeing that in Sweden as one example, and we are expecting a lot of activity in the coming month and years. I mean, they operate by windows, these markets, so let's see. But I think our expectancy is for them to pursue typically dual tracks, to consider both a public alternative as well as a private alternative. Some of them are repackaging parts of their companies and selling off to different categories of investors to be able to liquidate with other investors who want to exit the funds. But we had a high expectancy for activity this year, which was pushed a bit out due to all the noise around trade and tariffs. We've been curious to see as when the markets are coming back, and it really looks like that's happening as of now.
That's going to ultimately stick. And I feel like, Guy, that's one of the concerns that you've heard in all the private credit spaces and the private equity spaces, that ultimately, if the IPO markets aren't as juicy as perhaps you're seeing in New York, do you then ultimately go to credit? Do you go to the private markets that aren't as transparent, aren't as liquid? And that seems to be what's driving the momentum and the risk.
Do we start to see that sort of unwinding a little bit next year, though? That is the key question here in Europe. Do those IPO numbers start to pick up? Kirsten Broughton, DNB CEO, thank you very much indeed for joining us. Lovely to see you in London. Coming up, we're going to put some pressure on Putin, apparently. That's the message coming out of the EU. Oil surging after the US announces sanctions on Russia's biggest producers. You've also got an LNG story this morning out of Europe. Oil stocks are higher. Oil is higher. Does it stick? That's the question we're going to ask next. This is Bloomberg.
A cidade estava sitiada.
Nisso, ao começo, eu também não sabia o que fazer.
Foi a mais terrível que eu passei na minha vida.
Eu temo, né, que o Brasil se torne, num futuro próximo, um narco-estado.
Porque no final, tudo é dinheiro.
People back home, they are suffering. And someone is driving a Range Rover with their money.
Where is my money?
I think she's a scam up to now.
It's some of the world's most desperate people who are getting ripped off.
Repeat after me. I am a winner.
I didn't know how big it was. I didn't really understand what I was getting myself into.
If you tell me you have a vision of being $1 billion business, then you're going to have to do what it takes. And if you're not going to do that, everybody's going to suffer.
Una batalla a muerte.
Money can do a lot of good. It can really transform people's lives, but it can also hurt them.
Didn't really think I had a problem.
I would isolate, self-medicate.
Like 48.5 million Americans, they didn't choose addiction. Go to shatterproof.org/find treatment. Watch the film No More Secrets and find out how you can get help. That's shatterproof.org/find treatment.
Join me each week on Wall Street Week for stories of capitalism from business, markets, economics, tech, and climate.
More than what you need to know, it's what you need to think about.
Welcome back to the opening trade. We're 46 minutes into an incredibly busy session for earnings news. We have had plenty of it, and that leaves these overall indexes pretty unmoved. We have a bit of downside coming through on the German market this morning, but elsewhere a little bit of upside, in particular over in Paris, where caring in the luxury space is all the rage, it would seem. Let's talk about what's going on in oil markets. Brent has jumped past $64 after the US slapped sanctions on Russia's largest oil producers. That's Rosneft and Lukoil. And as a result of the restrictions, major Indian refiners see flows dropping to almost zero. For more, we're joined now by Bloomberg's Stephen Carroll, who's tracking this story from Brussels, because this has a huge impact on and is being done, I suppose, to some degree in conjunction with what's happening in Europe. Stephen, good morning to you. So another change of heart on Russia then from President Donald Trump. Let's start there.
Yeah, certainly adding to the pressure on Vladimir Putin, and a significant change in the dynamics for Russian oil exporters, because, of course, what the US is doing is catching up with what the EU has been doing for some time in targeting Russian oil producers. The two companies that have been affected by this, Rosneft and Lukoil, make up around half of Russia's oil exports, so they are the key companies at the heart of this. Their revenues also make up a quarter of Russia's federal budget as well. So this is a move designed to hit a key part of what's funding Russia's war economy. Now, these sanctions are due to come into place from next month, so there is still some time for perhaps negotiations or changes that could be made to it by now, but we're already seeing the interpretation from markets of how this is going to play out in terms of supplies, and it's particularly going to hit the likes of India that you mentioned, one of the major countries, the second biggest, in fact, buyer of Russian oil at the moment. So a really big move from the United States. Now, Donald Trump has said there's still time to talk about this. The sanctions could be lifted down the line if there's progress towards peace, because, of course, the reasoning behind this is to try and get Vladimir Putin to a negotiating table in a way that Donald Trump feels that progress can be made.
Well, Stephen, what's so interesting about this, especially, and we should mention, we are also getting comments from the Chinese authorities who are already frowning on the sanctions that are coming from the United States and from the EU as well. They're making some public comments. What's so interesting about this is that the U.S. has been trying to twist India's arm for quite some time, and it took the sanctions on Rosneft to actually potentially see some action in that direction. Can you just explain why this is different than the previous rounds we've seen under both the Trump and Biden administrations?
Well, look, it's targeting the companies that are selling to the likes of India as well. And we've already heard from refiners, our own sources speaking to Bloomberg, saying that they see these sanctions as having the effect of reducing flows to almost zero. So that would mean the 36% of India's oil supplies that they're buying from Russia at the moment could drop out in a very short period of time. And that's going to lead to a scramble of India looking for supplies from elsewhere. Now, India has been ramping up how much of Russian oil that it buys since the beginning of the war in Ukraine, as it became cheaper and more available to them. So it used to not play such a large part in the country's energy mix. They used to buy more from the Middle East, and the question would be whether or not they will turn back now to those Middle East producers to try and make up the shortfall from what will be, it looks like, the turning off the taps almost completely of Russian oil into India. Interesting timing, though, for this to happen as well in terms of where oil prices are. I mean, we're looking at them before the jump today at around a 5-month low. So there is, I suppose, a position as OPEC Plus has been ramping up production for India to be able to at least buy oil from somewhere else that they may not be able to get from Russia now.
Yeah, it certainly feels like a big squeeze in the oil market this morning. Let's talk about what is happening with the EU side of things. You're in Brussels. What are we looking at there?
So the 19 sanctions package against Russia was formally adopted this morning by European countries. So this will also target some elements of the energy sector that haven't already been sanctioned by the European Union, so tightening up transaction bans against some of the big Russian oil companies. Also measures targeting more than 100 vessels involved in the shadow fleet that's been transporting Russian oil around the world. There's also provisions in this to sanction Russian liquefied natural gas from the start of 2027. There's already a deal that was agreed by energy ministers earlier this week to phase out natural gas by 2027 as well. So that's going to be another change in what has already been a pretty dramatic move away from Russian energy supplies for Europeans as well. But we have also heard from the Ukrainian President Volodymyr Zelensky, who is attending that meeting of EU leaders here in Brussels this morning. He's welcomed these two sanction packages together. He was asked whether he felt it would make a difference. He said, "We will see, but it is an important signal to not only Russia, but also to other countries that are buying Russian products as well, and perhaps that they'll want to join in on the sanctions efforts, as he sees that as being key to bringing this war to a conclusion." On the question of talks, because he was asked about that as well, he says they're open to ceasefire talks as well, but it would need to see what the arrangement or the setting for that would be as well. Of course, he's also waiting to hear about the question over Tomahawk missiles. We've been watching that very closely as well, whether the United States would be allowing Ukraine to use those missiles, and that, he said, is a sensitive subject. But given that we've seen movement on something like sanctions, he's continuing to hope that there could be some movement from the US on that front as well.
Stephen, thanks for the update. Really appreciate it. Stephen Carroll joining us out of Brussels. Let's talk about what we're going to get for the rest of the day. Stephen's just been saying EU leaders are meeting. We've got that to focus on. We've also got US state-level jobless claims. Now, they're going to be out at 1:30 p.m. This is a perfect job for the AI, isn't it? Just kind of crunch it all together. I'm sure some people have got some fantastic models to do all that and give us actually a fairly accurate look at what is happening there. US existing home sales will be out at around 3 p.m. After the bell, Intel, Ford are out with numbers. I think we've got a Jim Farley interview coming up a little bit later on here on Bloomberg Television.
OK, let's talk about some of the tech stories that are in focus today. Europe's most valuable software company, SAP, reported third-quarter cloud revenue that missed estimates. But SAP CFO Dominic Assam, we spoke to him earlier on in the programme, he says the company has strong demand for AI.
We have unabated demand here, and we are only anticipating that this will continue. I mean, half of the deals we have printed on cloud in this Q3 were, again, already including some monetization of AI.
For more on the tech space, we're joined by Matt Bloxham, analyst with Bloomberg Intelligence. So what do you make of the SAP's earnings story? We had some great conversations about big picture, stepping back, AI, the threats, the opportunities in that space. But in terms of the in-the-moment numbers that they've reported, how it's gone down with the market and the volatility it's created.
Yeah, I mean, obviously a slight miss on the revenue, but we're talking less than 1%. And, yeah, they slightly trimmed down the full-year revenue guidance. But again, probably around a percent or so really kind of negligible issues. And they talked about a cloud order backlog, which is essentially pretty much in line with what the market was looking for. And so I think the kind of slightly negative reaction to on the share price partly reflects fickle markets, but also this issue that there's a huge amount of optimism and froth, if you like, around the AI story, and what people are looking for is beats to the upside, particularly on kind of future order books. And they've got a strong order pipeline, but it's not surprising on the upside. So I think that's why you're seeing a little bit of that kind of.
And I like the way he said they don't need to have an inferiority complex about AI. That was one of the nice lines from him.
Why is STM down by over 3%?
It's kind of a similar story. They kind of had a very kind of mixed set of results, and kind of some question marks about the outlook for them too. I guess they're a bit more directly exposed to everything that's going on around tariffs, around kind of China restrictions, but also the kind of iPhone and Tesla outlook. Two very big customers for theirs. We've heard stories that Apple are trimming the iPhone Air shipments. Obviously, Tesla has had great shipments as people kind of make use of the outgoing EV credits in the US. But obviously, there's a lot of question marks around the Tesla outlook. So I think, again, it probably comes down to a similar thing about the kind of order outlook and perhaps on the margin looking a bit weaker than people were expecting.
All right. Matthew Bloxham over at Bloomberg Intelligence walking us through some of the tech stories this morning. We thank you so much. Anna, there are plenty of earnings conversations this morning. What do you have your eye on?
Yeah, I'm watching luxury because, somebody has to. Up by 8% on the Kering share price over in Paris. Sales coming in, the sales drop was less than expected. And that, if you can't work out all those words, that's better than anticipated. So half of the profits of this business come from Gucci. And at Gucci, at YSL, at Bottega Veneta, they all saw better than expected numbers. Even if those numbers weren't moving in the right direction, they were a pleasant surprise for markets in terms of the drops we saw. So the ADRs were up strongly, and as we see, the stock is up strongly here in Europe. Chrissy, you've got your eye on what's going on with oil.
I do. I mean, I'm fascinated by the conversations in Brussels and Washington this morning, and arguably New Delhi as well. They are all together driving up a lot of the energy stocks that we're seeing, and those are together moving up the entire index of both the Stock 600 and the FTSE 100 as well. But I mean, just take a look at these moves here. BP, Shell, Total, even Eni. You go down in market cap, even Repsol, for example, they are all higher this morning. The question here is this a temporary move, Guy, or do we see a more sustained move higher now that the United States has officially sanctioned Rosneft and LukoIl?
The market was short going into this, though, and that's what I think is interesting. So this feels kind of squeezy in the oil price. So is this something that sticks? Is this something that we're going to see in terms of the share price sustainability on some of these stories? Shell was up yesterday on the back of this as well. I don't know, market positioning. I think we were moving towards a position where we could go sub 60. That's not happening, so maybe a little squeeze in the market this morning. So I want to quickly focus on Airbus. Airbus, Leonardo and Thales are doing a space joint venture. All three stocks are sharply high. Oh, no, they're not sharply high. They are up this morning. The weighting that they're having in terms of the stock 600 is quite significant, and they are moving up on the back of that story. It's going to be headquartered in Toulouse, which I think is interesting. The Berlin Global Dialogue is underway today. We've got some great conversations coming out of there. Francine is going to be there, and the Pulse will focus on that. That's next. This is Bloomberg.
Used to be, one would say, what's that got to do with the price of tea in China, when they wanted to poke holes in the relevance of something? Now, though, if you're in tune with how events around the world affect each other, it becomes clear that the current going rate of tea in China has a lot to do with a lot of things, not just tea things either, but tariffs, franchises, and IPOs. How much?
Bringing you up-to-the-minute geopolitical news whenever and wherever it happens. I'm Lizzie Burden outside Windsor Castle, England, and this is Bloomberg.
Bloomberg brings you breaking news 24 hours a day. Powered by more than 3,000 journalists and analysts in more than 100 bureaus across the globe. Bloomberg Television. Context changes everything.
I'm David Weston. Join me each week on Wall Street Week for stories of capitalism from business, markets, economics, tech, and climate. We go on the road for a look at what lies behind the headlines of today and what will likely be the headlines tomorrow.
We need more transparency. Oil and gas is still important.
They said every citizen should be investing in the market.
Accelerate progress in all fields of science.
Watch Wall Street Week right here on Bloomberg. More than what you need to know, it's what you need to think about.
Why do the biggest names in business choose Bloomberg Television?
That's a great question.
It's a very good question.
Interesting question. Good question.
Great question.
I so appreciate that question. You certainly ask interesting questions.
Bloomberg Television. Top experts, great questions.
I'm Alex Rodriguez.
And I'm Jason Kelly.
And we're back with another season of The Deal.
With athletes and entrepreneurs who are changing the game on and off the field. Jerry Jones, Erica Ayers-Badon, Robin Arzón, Justin Tuck.
Stay tuned. You won't want to miss it.
Newsmakers and market movers. This is The Pulse with Francine Lacqua.
Welcome to a special edition of The Pulse, live from the Berlin Global Dialogue, uniting leaders from business, politics, and academia on the biggest issues facing the global economy. Now, first, here are the top stories making the headlines today. Donald Trump ramps up pressure on Vladimir Putin to end the war in Ukraine, slapping sanctions on Russia's two biggest oil producers, oil soaring as a result. European gas also rising as the EU adopts its own fresh package of sanctions on Russia's energy infrastructure. The bloc joins a new U.S. push to chip away at Moscow's ability to wage its war against Kyiv. Plus, Tesla's third quarter profit drops as rising costs undercut a record quarter of vehicle sales. But Elon Musk still wants his $1 trillion pay package. Now, we're going to bring you some top guests from the Berlin Global Dialogue over the coming 2 days, including the Bank of America France Chief Executive Vanessa Holtz a little bit later on in the program. Now, first thing is first, you know the drill. We start the show, we look at markets. Now, European stocks seem to be hovering near this record peak. Again, there's a lot of earnings. We're in the middle of the earnings season. Third quarter earnings continuing to flow in. The stock 600 gaining about 0.1, 0.2%. Of course, the big story is what's happening with crude jumping to a 2-week high. This is after the U.S. President Donald Trump imposed sanctions on Russia's biggest producer. And then gold. We always look at gold. That's our golden rule on the pulse because it gives us a good indication of maybe money flowing outside U.S. assets somewhere else, and gold 4,099. Again, if you look at Brent crude, look, it's up almost 4%, and then earnings definitely changing the way we look at some European indices. We have another packed agenda for you. On the earnings front, Tesla disappoints. Elon Musk, though, still wants his $1 trillion pay package. On the market news, look, gold again fluctuating after retreating from a record price surge. But first, let's begin with a U-turn from President Trump, with the U.S. stepping up pressure on Russia by targeting its biggest oil producers with sanctions.
We canceled the meeting with President Putin. It didn't feel right to me. It didn't feel like we were going to get to the place we have to get, so I canceled it. But we'll do it in the future.
Mr. President, can you tell us a little bit about why you're elevating sanctions against Russia right now?
I just felt it was time. We've waited a long time. I thought that we'd go long before the Middle East. And Mark, as you know, we did the Middle East plus 7, so we did 7 different wars.
Well, let's bring in Chad Thomas, Bloomberg's executive editor for Europe. Chad, thank you for joining us. It's great being here because we're going to have some great conversations with some of the newsmakers. But if you just followed what Donald Trump wanted to do with Russia and Ukraine, kind of got whiplash because it was a big week to try and understand whether he was friendly with Putin, wanted to meet him, and now these big sanctions.
We got huge whiplash. You and I were talking just a week ago, and we were talking about the Budapest summit. And did that make sense to do that? Should President Trump meet with President Putin for a second time, and whether that he was being played? Clearly, within the last week, things reversed significantly. We were hearing already early this week that the talks between Rubio, the Secretary of State, and Lavrov, the Russian foreign minister, weren't going well. And then Trump not only backed away from the idea of there being a second meeting, saying it would be a waste of time to do that now, but he slapped these sanctions on Russia. This is what the European Union has been asking the U.S. to do for a long time. There will be a significant impact on Russia here. These two companies are 50% of oil production out of Russia. 25% of the Russian budget comes from these two companies. So if you want to impact Vladimir Putin's ability to wage war, you just did that.
Yeah, I mean, why did it take so long? I guess is one of the questions. The other one is the ripple effects will be felt far and wide, including China. That buys still a lot of Russian oil.
Yeah, why did it take so long? People were really pushing President Trump to do something, and he's been saying for months that he would. He did say yesterday, and I think this was interesting, I've had some great talks with Vladimir Putin, but then nothing happens. He seems to have finally decided that he needed to take action. China today, we're seeing real strong reaction there. They get 20% of their oil from Russia, and so there's a real concern. They either have to abide by the sanctions or they face the consequences of secondary sanctions on them when it comes to things like access to SWIFT and so on, where Russia obviously has already been cut off from that years ago when the full-scale invasion of Ukraine took place.
So yesterday, a lot of leaders were in Europe, actually in the UK. Yeah. That's a Freudian slip. Still Europe. And today, actually, there's an EU leader summit. What can we expect from that?
Yeah, so we've already seen this morning more sanctions coming out of the European Union against Russia. It will clearly be a big topic. This, by the way, the European Union, Trump says that they love sanctions. This is the 19th sanctions package against Russia from the EU. It's really an effort by them to cut off the ways in which Russia has gone around some of their previous sanctions. So clearly that will be a big topic of discussion at the Leader Summit starting a little bit later.
later today.
Chad, thank you so much. As always, Chad Thomas there and his team with some great coverage, of course, coming all over Europe. Bloomberg's executive editor for Europe. Now on to some corporates, and Tesla profit plunged as rising costs undercut a record quarter of vehicle sales. Now shares in pre-market actually lower, with analysts saying there's just not much to inspire investors and really questioning the timeline to develop new businesses like AI and robots. Well, despite the concerns, the chief executive, Elon Musk, ended the call by pleading with investors to ratify his upcoming $1 trillion pay package.
The point is, I just like there needs to be enough voting control to give a strong influence, but not so much that I can't be fired if I go insane.
Let's go straight to Craig Trudell, Bloomberg's global autos editor in London. Our cards are. Craig, I mean, this is a pretty extraordinary end to a difficult earnings call.
It was, and I guess, I walked away from some of those comments, scratching my head, because if we really sort of have any doubt as to the amount of control that Musk has of this company, it's reinforced quarter after quarter that he's taken them in this direction of kind of sticking with, just the product that they have in terms of their actual core vehicle business. It's been years since we've seen this company bring out entirely new models. The Cybertruck was the last one added. It's also been quite a disappointment and was a product that Musk was very hands-on with. And yet, he is very much in control of this company. And this is a company that is taking his lead into these uncertain directions. Chiefly, I would sort of flag humanoid robots as being, sort of the best example there, where it's really unclear just how quickly this, business is going to be something tangible for investors to wrap their minds around.
Craig, can Elon Musk turn Tesla's fortunes around? I feel like I ask you this every quarter.
Yeah, I mean, I think there's a big debate over, this idea that the auto business is getting really difficult for everybody, right? And it's getting particularly tough for electric vehicle makers where, and particularly for U.S. companies, right? And that with the $7,500 tax credits in the U.S. going away at the federal level, real concerns about how much
India-based Mint newspaper reporting that New Delhi and Washington may be nearing a trade deal that could cut tariffs on Indian exports from around 50% to as low as 15%. Let's bring in Bloomberg's Brendan Murray for more. The teams were obviously busy, Brendan. What kind of an agreement may they have come to, given this report?
Yeah, exactly. I mean, this deal has been months in the making, and it would be a significant step. The U.S. and India have tried to make a deal in various phases, 3 and 4 phases over the next 6 months or so. But it looks like that first phase might be coming together if we can believe this report. Now, there is a lot yet to confirm with the White House and with the official Indian government. But this would come at an interesting time because the president of the U.S. is trying to meet with China's president and do a deal of their own. So you've got a bit of gamesmanship going on, playing off India and China, obviously two competing manufacturing, exporting powerhouses. So it'll be interesting to see what they say at the White House this morning. We've seen some of these reports before, though, so we have to sort of take it when we hear confirmation or not.
Obviously, you oversee the China business for the Singaporean bank, DBS.
That's right.
What is your priority this year amid, obviously, the noise geopolitically, the tumultuous nature of the Chinese economy trying to gain some footing and some confidence and end deflation? What is your priority right now?
Thank you, Stephen. Thank you for inviting me to join you here in Shanghai. Maybe I talk about some good things first, our strategic priorities. First of all, I think wealth management becomes a very important initiative for DBS China and also for the group. I think there is a permanent shift of the wealth management industry in China. The high net worth individuals are more matured and they look for safe assets and diversification of asset allocation.
So a diversification more to safety because of the uncertainty, or what?
And also because they learned a lot of lessons in the past few years because of a real estate, the trust products, and all these, right? So I feel this is a permanent shift of the mindset of the investors. So they look for safe asset, especially they look for offshore asset allocation. This creates a lot of opportunities for somebody like DBS, who has a headquarters in Singapore, and we're also very big in Hong Kong, right? So this is, I see that this trend will continue for many years to go.
So where does that lead to the inevitable question of hiring private bankers? We did see a number, about 40 new bankers by the end of this year, largely in Singapore, because you've already built up Hong Kong.
That's right.
But how about on the mainland as well?
Okay, for mainland, I think we still have a lot of opportunities because, a lot of people's wealth still in China. They can't move everything into Hong Kong and Singapore. So what we're trying to do is that we'll hire more fresh graduates, and also we'll train up our own relationship managers. In fact, 10 days ago, our group CEO just opened our new International Treasures Wealth Center in Shanghai, which means we upgrade our branch into a wealth center and also try to connect them with international asset allocation, the knowledge, the know-how, expertise of a DBS Group. So we're trying to do that for other branches in China in the coming 3 years.
Now, a lot of the mega rich, if you will, in China who are looking to diversify and looking to go overseas as well, they tend to be younger than the average billionaire, if you will, in the West, sometimes by as much as 20, 30 years even. So we're talking 30-year-olds, 40-year-olds. So how is their risk appetite different now, and given their age and their ability to have many more years of growing? So are they going into much different products, and is that what you're offering, a much different portfolio?
Those are typically, whether it's a new tech money, or they could be the second or even third generation of the entrepreneurs here in China. Those people are pretty sophisticated. Typically, they're educated in overseas, so they have a very strong mindset of how to manage the risk and how to do the allocation, compare with their fathers or grandfathers. So I feel that they look for someone who can give them advice, how to invest their money. And they're also very international, as I mentioned, that typically educated in overseas. So they will buy in someone who can provide valuable advice to them, right? So that's why I think international bank in this area will play a very important role.
What kind of assets under management are you looking at for where there's the family offices and also your overall wealth management portfolio for this part of the world? I saw a number for the family offices at about $1 billion AUM. Is that the ballpark, and where do your targets?
In fact, for China, that our starting point is not very high. It's the treasures, like in Singapore and Hong Kong. It's typically the RMB 1 million AUM as a starting point. Of course, someone will put more money with us. And in China, we offer a diversified product like funds, insurance, and even US dollar equities or Hong Kong listed equities through QD and other structured products. So this also differentiates ourselves with Chinese banks who are also very focused on wealth management. And in Singapore, Hong Kong, of course, we have a very big presence in the full range of wealth management segments, right? Treasurers, TPC, and offer private bank. So they can offer, all type of products in the global market.
Is there anything in particular that would impact your bank the most that you are watching for as the leaders gather in Beijing right now behind closed doors? They're coming up with the next 5-year plan, the 15th 5-year plan.
Yeah.
What would be the most important development coming from that would help multinational banks like you to grow their presence on the mainland that would be in line with what they have pledged, and that is more opening?
Okay, first of all, I think further opening up of the financial market is very important for a financial institution like us. We would like to have more capital flows in and out, right? We would like to have more QD quotas so that we can help the client to invest in overseas. Of course, we already get some license that because of opening up, because, for example, we set up security companies, majority owned by DBS Group back to 3 years ago, so we can do the IPOs and all the equity-related business in China. But of course, we would like to have more opening up. So, for example, give more license to international banks so that it can do more business here in China.
Well, that kind of dovetails nicely to the next question, and that is there was about 18 different deals signed, I believe, in the last week or so between Singapore and China. Some big, some tiny. One was DBS and Guotai Haitong Securities.
That's right.
But no details. So what is that? You talked about you'd like to see more of a brokerage presence here. That is a brokerage. What would this entail?
Yeah, in fact, the strategic collaboration between DBS and Guotai Haitong is to leverage on each other's strength. And I would say that mainly for DBS and Guotai Haitong to work together to support the Chinese corporate going global. Yeah. Right. This is, as I mentioned, that this is a very, very big trend that I think will support the economic growth of China. And nowadays, I see not only the industry leaders, but their so-called the whole supply chain is moving out to overseas, mainly to ASEAN, also go to Middle East, Africa, and even Latin America. So for the financial institutions like in China, they typically lack of network and expertise in overseas. So that will create a collaboration between DBS and the Chinese financial institutions.
This is Balance of Power, live from Washington, D.C.
From Bloomberg's Washington, D.C. studios to our TV and radio audiences worldwide, welcome to Balance of Power. I'm Joe Matthew alongside Julie Fine in Washington. Tonight, NATO's leader heads to Washington.
I have total confidence in President Trump, and he is the only one who can get this done. He is the leader of the most powerful nation on earth.
With fears the president could give Vladimir Putin what he wants in Ukraine, Mark Rutte rushes to meet leaders on the Hill and President Trump at the White House. That meeting between the two leaders about to begin as Trump denies reports now the U.S. has lifted a key restriction on use of long-range missiles for Ukraine, while Treasury Secretary Bessent teases an announcement on Russian sanctions as soon as today, potentially shifting the direction of the war. We'll discuss it all.
Plus, reporting tonight that Republican senators are discussing unleashing a nuclear option to bypass Democrats, why the filibuster could soon be in danger. When we speak to Republican Senator Ron Johnson and get reaction from Democratic Senator Catherine Cortez Masto up ahead.
Also this evening, Tesla's earnings out just in the last hour, why the stock is heading lower after hours, and what it means for Elon Musk's potential $1 trillion pay package.
And on the eve of the president's visit to the APEC summit, we speak with South Korean Ambassador Kangwang Cha-wa as the expectations for the summit and her pledge to strengthen the U.S.-South Korea alliance.
So we begin with the White House this evening following a meeting between NATO Secretary General Mark Rutte and the president. That meeting is actually just about to begin here after several developments in the fight to end the war in Ukraine. Let's go back to Thursday when the president spoke with Vladimir Putin for 2 hours, announcing a second meeting, this time in Hungary, as a follow-up to their Alaska summit. Then, the day later, a tense sit-down with Ukrainian President Zelensky, the president dismissing requests at the time to provide Ukraine with long-range missiles. And then yesterday, a sudden reversal from Trump. No more Putin meeting in the coming weeks. Which leads us to today, with NATO Secretary Rutte visiting the White House and a report the administration is lifting a key restriction on Ukraine's use of some long-range missiles in its fight against Russia. By the way, a report the president is now denying on social media, even as Treasury Secretary Besson again teases an increase in Russian sanctions as soon as today. Take a listen.
We are going to either announce after the close this afternoon or first thing or first thing tomorrow morning, a substantial pickup in Russia's sanctions.
We have details, none beyond that, as we bring in Bloomberg's Laura Davison here with more in Washington. Do we know what this uptick in sanctions refers to? Is this the secondary sanctions package that's already been crafted in the Senate?
This is actually a separate sanctions on Russian oil companies. The Treasury Department just announced moments ago there's kind of some second-tier gas companies, and the statement from the Treasury Department said that more could be coming. This is clearly a ratcheting up from the White House, headed into what could be a very tense moment here.
And to echo on what Joe just talked about on the missiles in Ukraine, you have this, then you have the Russia sanctions. What does this really mean for the meeting between President Trump and Vladimir Putin that the president really seemed to downplay yesterday?
It means that Rutte's visit here seems to be working in terms of getting what he wants, of kind of keeping Trump with the NATO alliance and ratcheting up the pressure on Russia in the defensive against Ukraine. You've seen the president really vacillate here on whether he was going to meet with Putin, not meet with Putin. So Rutte is really trying to continue that message. We saw that on the Hill, and that's the message I expect he'll deliver in the Oval Office in just a few minutes.
Yeah, we're going to have an ear and an eye on that meeting, of course. It follows this post from President Trump on Truth Social just about a half hour ago. He writes, the Wall Street Journal story on the USA's approval of Ukraine being allowed to use long-range missiles deep into Russia is fake news. The U.S. has nothing to do with those missiles, he writes, wherever they may come from or what Ukraine does with them. Do we read this in a literal sense here that it's fake news, or is it the way that this is being framed in this report?
This is a little bit of a non-denial denial here, and it could be that the president is not quite ready to announce this, and that's why he's denouncing this specific report from the Wall Street Journal. He's been very cautious about this long-range missile question. Remember back to last week when Zelensky was at the White House, was asking for the use of those Tomahawk missiles. Trump said, it was kind of danced around this issue, saying, I hope they never have to be used. But this has been sort of a key point in the war where you have Ukraine and Zelensky saying, look, we need some of these weapons, we need these restrictions lifted, where Trump doesn't want to go that far because he's worried it will damage his relationship with Putin.
Fascinating moment here. Bloomberg's Laura Davison, we thank you. And for fresh reaction amid these reports this evening on a potential workaround to end the government shutdown, we're joined now by Republican Senator of Wisconsin, Ron Johnson. He's with us live from Capitol Hill. And Senator, it's great to have you back on Bloomberg TV and radio. I'm looking forward to your thoughts on the shutdown here, but I'd love to ask you about this news that's coming from the White House now and whether the moment has arrived for secondary sanctions to hit the floor. I know that John Thune has said they're on pause right now out of deference to the White House, but is it time to vote?
Well, again, I really will let that up to the president. When he wants that as a backstop to put pressure on Putin, I think that's when we'll act.
Understood. Is that something that you feel like we're moving closer to as he prepares to sit down with the Secretary General at NATO? We're just trying to get a sense of which direction the president's leaning in here and how to deal with Vladimir Putin.
Well, my guess is he's getting pretty disgusted with dealing with Vladimir Putin. He's giving him every opportunity to end up with a peaceful solution here, dangled economic benefits in front of him, obviously threatened sanctions. Again, this president wants peace. I think if there's a hallmark to his administration, even his previous administration, he's not a wartime president. He wants peace. Now, he'll use and achieve peace through strength, but in the end, he wants peace, and he's doggedly pursuing it.
And you may have heard Joe just go to Truth Social post from the president. He just shot down a Wall Street Journal report that the U.S. is allowing Ukraine to use long-range missiles in Ukraine. How will that play into what is supposed to be a meeting between President Trump and Vladimir Putin, which is now looking much less likely?
Yeah, I think that meeting is canceled because Vladimir Putin keeps lobbing missiles, more than lobbing, launching missiles into Ukraine. Apparently hit a kindergarten earlier today. Again, Vladimir Putin's a war criminal. There's no reason for him to invade Ukraine. The fact of the matter is he's not going to lose this war, though. You've got to recognize that reality. The only way this war ends is through a negotiated settlement. We're not going to like the terms of that, but even worse, the bloody stalemate that we're in right now, where we're losing thousands of people on both sides a week, it's just untenable.
I want to ask you about what's happening with the shutdown here, Senator. I spoke earlier with the chairman of the House Ways and Means Committee, who kind of stopped us in our tracks when he suggested that he might be behind a full year CR. In fact, one that would get us through December of 2026. I want you to hear what he said earlier on Bloomberg. Let's listen.
December 21st, 2026 is what I've been hearing up here as a suggestion, as an opportunity of a continuing resolution. As we know, we're operating under a year-long resolution from last year. We're looking at what was appropriated when Biden was president.
That was Congressman Jason Smith earlier on Bloomberg. Senator, is this what it's come to? And would you support a full year continuing resolution?
What would be a much better idea would be just pass my Eliminate Shutdowns Act. What that does, it sets up automatic rolling 14-day continuing appropriations for whatever department or all government that hasn't been appropriated for. That would give the appropriators time to find areas of agreement, pass the bills they can pass. The ones that don't, you just continue to fund at last year's levels. That'd be a far more common sense approach than a one-year continuing resolution for all of government. Give the appropriators time. You know, the appropriators, some of the Republicans even voted against the Eliminate Shutdown Act. They said it would undermine the appropriations process. Well, here's the alternative, a CR that goes into December of 2026. So hopefully people will, come to their senses and realize Eliminate Shutdowns Act is the solution to our current fix.
Senator, it doesn't seem that bill has gone very far yet. Are you sensing you will get some more support for this?
Well, the good news is Leader Thune switched his vote to no so he can bring it up for reconsideration. Again, I was very disappointed in Republican appropriators voting no. They said it would undercut the appropriation process, but let me describe that appropriation process it supposedly undermines. I've been here 15 years. That means we should have passed 180 appropriation bills before the start of the fiscal year you're funding. We've passed 6. So this vaunted appropriation process, which is clearly broken, fails 96.7% of the time. The Eliminate Shutdown Act does not undermine that process. It just gives us all the time. We wouldn't be sitting here for the fourth week, going into the fourth week of a shutdown, doing nothing. We could have been on appropriation bills. We could have been working with each other. We could have been negotiating. But instead, we've got this shutdown showdown with literally no end in sight. Hopefully tomorrow, but hopefully today, the Democrats actually vote for the continuing resolution. Doesn't sound like they will. The next best step is let's at least pay the federal workers we're forcing to work. That's the Shutdown Fairness Act that I've offered that we'll be voting on tomorrow.
I want to ask you about that. I know you're reintroducing this. To your point, there's a vote tomorrow. Do you worry that this makes shutdowns easier, that it removes a pain point that might actually compel lawmakers to end this saga?
Clearly, the current system is utterly broken right now. We just crossed $38 trillion in debt. Again, the definition of insanity is doing the same thing over and over again, expecting different results. So again, we're in this dysfunction. Let's not make federal workers who are being forced to pay for our dysfunction. So again, this makes perfect sense. Even the National Active and Retired Federal Employees Association, generally not an association that would agree with the Republican bill, completely supports this piece of legislation. So at a minimum, we ought to pass the Shutdown Fairness Act and pay the people we are forcing to work: military, federal law enforcement, air traffic control, people who write our Social Security checks. These people deserve their paycheck. They're working. By the way, they're going to get paid anyway. We have a law that's going to provide back pay, so pay them, in time, so they don't have to go to food banks. They don't have to drive DoorDash to pay for their daughter's tuition. We're hearing stories that that's what federal employees are being forced to do. That's unconscionable.
You mentioned debt and you mentioned Argentina. Are you concerned the attention to that is making problems with Wisconsin farmers when you're dealing with a shutdown?
I don't remember mentioning Argentina. Maybe I wasn't articulating something. Listen, we've got a problem right now from a standpoint the government is shut down. Things aren't moving forward. There's a common sense solution here: either just pass the continuing appropriation or the Eliminate Shutdown Act. Simple solutions, common sense. I think the vast majority of Americans would agree with that. Right now, we're being held hostage by, quite honestly, the uniparty appropriators. This seems dysfunctional. It is dysfunctional. This is a very well-honed process. I've seen it time and time again. I've been here 15 years. You use these shutdowns to back us up against a deadline like Thanksgiving or Christmas. Drop a multi-thousand-page appropriation bill on our desk, say, take it or leave it, or you're not going to see Christmas. That has to end.
Yeah. We appreciate it, Senator, and we appreciate your time, Senator Ron Johnson, as we now want to bring you to the White House for a meeting that the president is holding with the Secretary General of NATO, Mark Rutte. This is live on Bloomberg TV and radio.
When it comes to Ukraine, basically the weapons from the U.S. being delivered to Ukraine, paid for by allies, and the Europeans coming together to discuss how can we sustain Ukraine post the peace deal. All of this is evidence of your leadership of pushing the Europeans and the Canadians to do more, to deliver, and to equalize in spending with the U.S. So on all of this, and today we will talk more on how we can really bring Ukraine to the next phase and get this terrible war, and all the bloodshed ended.
And as you know, we are going to be making a big trip next week. Some of you are going with us. We'll be going to Malaysia, South Korea, and Japan. In South Korea, I'll be meeting with President Xi of China. We'll have a pretty long meeting scheduled. We can work out a lot of our questions and our doubts and our tremendous assets together. So we look forward to that. I think something will work out. We have a very good relationship, but that'll be a big one. We canceled the meeting with President Putin. It didn't feel right to me. It didn't feel like we were going to get to the place we have to get, so I canceled it. But we'll do it in the future. But next week we'll be with many of you in those locations that I told you. Then it's back to Washington. So thank you very much, everybody. Yeah, please.
Mr. President, can you tell us a little bit about why you're elevating sanctions against Russia right now?
I just felt it was time. We've waited a long time. I thought that we'd go long before the Middle East. And Mark, as you know, we did the Middle East plus 7. So we did 7 different wars from Pakistan and India to so many.
Azerbaijan, Armenia,
which they said was impossible to do. All these wars I did, and the one that we have left, we have 1 left. It'll be 9. We have 1 left, and I think we'll get that done too. I think we're on our way to getting it done.
We have to.
Mr. President,
please.
Mr. President, do you have a timeline for when you think this war is going to be over because of your leadership?
No, I don't have a timeline. You can't have in war. It's hard to have a timeline. So many things happen in war. Go ahead.
What about Tomahawk missiles? Putin is definitely
Well, the problem with the Tomahawk that a lot of people don't know, it'll take a minimum of 6 months, usually a year, to learn how to use them. They're highly complex. So the only way a Tomahawk is going to be shot is if we shot it, and we're not going to do that. But there is a tremendous learning curve with the Tomahawk. It's a very powerful weapon, very accurate weapon, and maybe that's what makes it so complex. But it will take a year. It takes a year of intense training to learn how to use it. And we know how to use it, and we're not going to be teaching other people. It's too far out into the future.
President Trump speaking live in the Oval Office with the Secretary General of NATO, Mark Rutte. This is a conversation that will probably go on for some time, and we'll keep tabs on that for you here on Bloomberg. We'll have much more straight ahead on Balance of Power on Bloomberg TV and radio. This is Balance of Power on Bloomberg TV and radio. Alongside Julie Fine, I'm Joe Matthew. With the federal shutdown now becoming the second longest in U.S. history, signs today it could become the longest one ever, with both parties still far apart and far away from a deal.
But there are lawmakers who are reaching across the aisle, among them New Mexico Nevada Senator Catherine Cortez Masto. We spoke with Senator Cortez Masto earlier today, and we asked her about the yay vote and where the shutdown goes from here. Here's that conversation.
Well, I can tell you just in general, there's a group of us Democrats and Republicans trying to come together and help get through this impasse. There's an impasse right now. We need to open up the government, and we need to extend the health care subsidies for the Affordable Care Act. I think there's the ability to do both. And those are the conversations that are taking place with some of us right now, both R's and D's.
Well, depending on who you talk to right now, Senator, and I'm sure you know this all too well, you are either a profile in courage or you're a problem for your party. And I'm wondering what the conversations are like in the cloakroom. Are you trying to get other Democrats to join you? And are you surprised that hasn't happened yet? I think it's 12 rounds today, right?
Well, I can say this. We're all aligned in the sense that we're fighting for Americans, right? We're fighting for this country. We're fighting for health care. We're taking on what we see are the bad policies of this administration. And it is not just unique to Democrats. I can tell you right now, there were some of my Republican colleagues that want to address the Affordable Care Act and address the health care subsidies, the tax credit. They need to. Because in their states, Americans will be harmed if we do not extend these health care subsidies. And that is true across the country. I don't care whether you're a blue state, red state, purple state. It's about Americans and supporting them and helping them lower their health care costs. This is one way we can do it. And that's why both Democrats and there are some Republicans who want to extend this health care subsidy. And they should. Because if we don't, there's probably about 22 million Americans across the country that are not only going to see their health care costs go up, some of them are going to lose access to health care because they can't afford it.
Senator, you said that you believe that you can reopen the government and extend the subsidies. I'm curious, in your conversations with the other senators, do you have some guarantees from Republicans that they will vote in favor of it?
Well, those are the conversations and negotiations now, because clearly we have to do both. And I will tell you a key part of this conversation is going to be the man in the White House, Donald Trump. Because the leadership of Republicans in the Republican Party in Congress, they're only going to do what he says. So they have to be a part of this conversation. And Donald Trump has to be a part of this conversation. He can't be flying around everywhere. He needs to be here in Washington, bringing the parties together, being a constructive part of addressing the health care costs that we have in this country. If he were to engage, that would help us move through this impasse of opening up the government and addressing the Affordable Care Act subsidies so that we do not see health care insurance premiums increase for families. I can't stress this enough, and it's just not unique to Nevada. I know my family's in Nevada, a family of four. If you're making $56,000 a year, you're going to see your health care premium go up by at least $200. That's crazy. There's going to be a double-digit increase for premiums for people, and they are not going to be able to afford it. That means we're going to lose people on health care. And the only time now we will see them if they have an acute crisis and they're going to show up in emergency rooms. It's going to have a ripple effect for everybody's health care coverage in this country. And it's going to have an impact on all of our hospitals and our clinics, including in our urban and rural areas. So we really need to come together to address this issue in this country. And that requires all of us talking and get beyond this impasse and start addressing and solving the problems of the American public. This is what they want us to do.
The continuing resolution that you've been voting for, Senator, only runs through the 21st of November. So there's been a question about whether that date needs to change. There's also a question about whether this could be extended by a much greater length of time. John Thune suggested just 24 hours ago that a full year CR might be the only way out of this. The White House has suggested it, and we spoke earlier today with the chair of the House Ways and Means Committee, Congressman Jason Smith, told us he would support such a move. So you're not facing potential shutdowns every couple of months here. How about you? Through December 2026, would you vote for that?
Well, let me just say this. This is part of the problem. Instead of coming to talk, leadership talking amongst each other, Democrats and Republicans, and all of us working together like we normally should, we're hearing conversations from the press and offers coming from the press. No offense to both of you, but this is where this should happen, right here in Washington, and us coming to the table, having these conversations. That's part of the impasse, and this is my frustration, and some of my colleagues, we see the same frustration. Republican leadership, Democratic leadership, the White House, we need to all be in the same room. We need to be working like the American public expects us to do in Congress and do our jobs.
Senator, though, you are not all in the same room. So what do you believe could be the turning point here?
I think it starts with the conversations around things that you just said. We all obviously need to open up the government. We have to address an appropriations bills and still pass those. We're going to need time to get those done. And we have to fix the Affordable Care Act. All of those things are on the table. It's not going to change. And that's why we have to come together and start talking about those and how we vote on those and what our agreements are around those very areas and how we start moving those forward.
Each state is feeling this a little bit differently by way of furloughed federal workers. Senator, in your case in Nevada, among the many furloughed are nuclear staffers, inspectors who are watching the nuclear stockpile in your state. They have, in many cases, been furloughed as well by way of the energy secretary. I'm curious your reaction to sending those workers home and if this is a national security problem.
So this, most people don't know, the National Nuclear Security Agency has a number of sites across the country. One of them is the Nevada site, security site, where we actually have federal workers and contract workers overseeing our nuclear stockpile and ensuring its national security, testing the stockpile, ensuring its safety, and amongst other things. Those are essential workers. They should not be furloughed, they should not be fired, and they should continue to get paid. It's essential for our national security and for so many other reasons. Again, what I saw happen just recently with this energy secretary is more of this politics, is trying to put pressure and play political games. And at the end of the day, the only people that are suffering are these federal workers and Americans. They're constantly pawns. Federal workers and federal contracts are constantly pawns and at the whims of political agendas, and it's just outrageous to me. That's the reason why I don't support shutdowns. We can still do our jobs and get things done without using a federal worker as a pawn. This is a very example of what the impact is in Nevada, and it's not just my contractors and federal workers at that test site, out at the nuclear site. It is federal workers throughout my state. It is a tourism industry that's having an impact of the bad policies from this administration. So we're seeing a downturn in tourism across the country, including in Nevada. I'm now hearing, because I follow what's happening in my state, housing is not moving as quickly as it could because there's no federal workers to do the permitting that we need. That's crazy to me. My small businesses and businesses who rely on SBA loans are not getting those loans because there's no federal workers at the SBA to do those loans. I mean, this is part of the problem why we should never have a government shutdown. We should be doing our jobs, appropriating, making sure we're moving forward, coming together to work together. And that is my frustration. That's some of the frustration I hear from colleagues, both Democrats and Republicans, that are not in leadership. And that's why many of us have been talking and negotiating and trying to figure out a way out of this impasse.
Senator, just a short time ago, I do want to get to some quick foreign policy before we leave you. A short time ago, Scott Bessent, the Treasury Secretary, said to reporters outside of the White House, quote, "We are either going to announce after the close this afternoon or first thing tomorrow morning a substantial pickup in Russian sanctions." Just want to get your reaction to that.
Yeah, so I sit on the banking committee. I support sanctions against Russia and have in the past and will continue to do so. I think we need to put as much pressure as we can on Russia. I support Ukraine. What is going on is outrageous, this illegal war of Putin. And we have to continue using the levers that we have here. Some of those are sanctions. In my case, in the banking committee, those are financial sanctions that we have to continue to impose. And I hope we do use all the levers we can to hold Russia and Putin accountable.
All Our thanks to Senator Cortez Masto for joining us today.
And let's turn to the markets now. One of this week's most anticipated earnings just came out last hour. That's Tesla. Despite a recent sales surge, Tesla missed on earnings. That sent the stock lower in the after hours. From trading, Bloomberg Tech co-anchor Ed Ludlow is processing the earnings report from Bloomberg's San Francisco bureau. He joins us now. Ed, just not a good afternoon for Tesla.
It's not necessarily good nor bad. It just doesn't have a lot of detail in it about the future, you know, and with Tesla, that is always the story. Elon Musk wanting to keep investors looking to the horizon. A big sales surge, beating on the top line, but to be expected because they delivered almost 500,000 vehicles in the quarter gone, principally because consumers rushed before the expiry of the federal tax credit. And what Tesla's talking about in the quarter gone and looking forward is that the environment has changed for them. Tariffs are an impact to profitability. Fiscal policy is changing. It is not as supportive of EVs as once it was. They've spelled that out really clearly, and they're saying that we don't know what's going to happen. We have to react to policy accordingly. But the big overhang is the future of Tesla always, and what happens down the line with robotaxi and their ambitions in humanoid robotics.
Ed, operating expenses up 50%, as you report, underscoring the significant cost increases that automakers are dealing with. It's not just Ford and GM. What does this mean for Tesla?
Yeah, but compare and contrast. You know, General Motors, great American company and employer of Americans, gave tangible data about the future and how they were able to navigate this environment. And investors really cheered that. Tesla's basically saying we do not know. All we can tell you is that policy has changed, tariffs are impacting us. They're not telling us what the growth outlook looks like. But remember, to Elon Musk's mind and Tesla's mind, the business of building an electric vehicle and selling it to a consumer, that is a thing of the past, and that the future for them is operating a proprietary ride-hailing service through robotaxi. The one thing I would say that is of note and interesting is look at the performance of the energy storage business, which is batteries that go into your home or in commercial scale and often tied to solar. And the growth there is far outpacing that of the consumer EV business. But policy's not helping there either. They are just dominant in that market and able to move quickly where there is demand.
So when Ed Ludlow is thinking about Tesla, does he think of it as a car company, a robotics company, an AI company?
Joe Matthew knows the answer to that question, and that is, you know, robotics and AI. Look, this is just one moment in time. It is a quarterly earnings report and call. The call has started 36 seconds ago. And the question is about November 6th, when shareholders will vote on a compensation package for Elon Musk. It is not impossible that Musk is asked about that over the course of the next hour. Within the goals the board has set for him to realize a potential $1 trillion of compensation over 10 years, he has to deliver 20 million EVs to consumers, the bread and butter business, and achieve those AI-related long-term goals. And for everyone, be you Wall Street, an everyday American, somebody in DC that looks at what Elon Musk is doing, there are many more unanswered questions about that pathway and what will happen on November 6th than we have answers to right now. So I imagine that the call will be very much about, here's what happens in the future. You should vote in favor of this comp package from Tesla's point of view.
Fascinating. I know you'll be listening for us, Ed. It's great to have you, as always. Bloomberg's Ed Ludlow. You can't have Tesla earnings without Ed weighing in. Thanks for being with us, as always, on Bloomberg and Balance of Power. It's been a will they or won't they back and forth for weeks as questions swirl over the potential of a Trump-Xi meeting at the upcoming APEC summit. President Trump expecting to depart Friday. That's the plan now, as bilateral trade deals remain the top priority for the United States, with tariffs and rare earth minerals at the top of the agenda. Tonight, however, it's the South Korea-U.S. alliance that is part of our focus. More specifically, after North Korea fired ballistic missiles in advance of President Trump's summit visit. But is a potential meeting between Trump and Kim Jong-un on the horizon? Our next guest doesn't think so. Joining us now, South Korean ambassador to the U.S., Kan Kyung-hwa. Madam Ambassador, it's great to see you. Thank you for being with us on Bloomberg.
Of course.
There's so much we could talk about with a pretty wide-ranging agenda for the summit next week. We're spending so much time in America talking about whether Trump and Xi will have a productive meeting, whether they'll sit down at all, when in fact I'm curious about your relationship with the United States and the extent to which this summit will help to codify the framework trade agreement that you've already made.
Well, we're very happy that the president will be coming to Gyeongju during the APEC summit week. We very much expect the two presidents, my president and President Trump, to have a very productive second summit meeting. They had a wonderful first on October 25th here in Washington. So, you know, a lot of follow-up discussions have been taking place since then on both the security side and, of course, on the trade side, on the investment package. In fact, the two principal players on our part on the investment package are in town. I think they're talking still, if not, the talk is over with Mr. Lutnick, and you know, trying to nail down the remaining points of disagreement between the two sides. So lots of movement, but both on the trade side and on the security side. But the goal is for the 7 decades old alliance to move towards the future. I mean, so much has changed. The global security environment is changing, and we want to adapt and stay ahead of the challenges so that we grow the alliance into a future-oriented, comprehensive, and strategic partnership, not just on security, but economic alliance, but also on a technology alliance.
When you take the wide-eye view, what is the best outcome from APEC in terms of tariffs that so many nations have been struggling with when it comes to the United States, figuring out exactly how to get that right?
I think APEC is a year-long process. So, yes, it culminates with that summit week, next week, in fact. But there are a whole series of senior officials meetings, ministerial meetings. On the trade side, there was a meeting of the trade ministers of the 21 economies, and this included Mr. Greer from the U.S. side. And they've come up with a joint statement, I believe it was called, committing these economies to, you know, providing a trading and environment that is transparent, predictable, and business-friendly. So that discussion, I think, was a very encouraging one that, yes, as challenging as these tariff issues are at a bilateral level, there is a commitment to moving forward in a joint direction for the environment, for the ministers to make it more transparent, predictable, and friendly for businesses. So.
Speaking of being friendly for businesses, we recall what took place in September in Georgia at the Hyundai plant following the immigration raid there. Some 500 workers were detained, and this was obviously a very difficult spot for our relationship with South Korea. I don't know to what extent you helped to broker the exit at that time, but I wonder, when you consider the investment pledge that you're describing, has there been any guarantee that this will not take place again as part of this investment pledge?
The two sides have really quickly responded, both my government and our U.S. counterparts. And we've established a working group that have worked through these issues for some quick fixes, as well as some issues on the longer horizon. The working group has met once, and I think, in fact, just yesterday evening for the second time. We have clarified what can be done with a B1 visa, and the ESTA entry permit, and so what the Korean investors and the workers who come with these investments is clarity as to what they can do. Right. And much of the discussions have been about bringing that clarity that has now gone up on the website of the U.S. Embassy in Korea. A desk dedicated to investors and workers going to the United States will be established within the U.S. Embassy for a fast-track processing of visa requirements from these workers. So very already visible progress. Korean workers are already coming in, and we will continue these discussions. But in the longer term, for the investors, of course, they want assurances, longer-term assurances that they can send their workers and come in and do the work that's required to install, to maintain, and make sure that what's invested is up and running. Right?
Are skilled worker visas worth $100,000 for a company like Hyundai? Are you talking about that?
We're not talking about the H-1B visas.
Okay.
We're talking about, much more short-term work visas. And I think the B-1 visa, with the clarification, will go a long way in addressing that. But we very much want, there's been a legislation in Congress for many, over 12 years now, of a specific E-4 visa quota for Korean workers coming in. That would certainly be a longer-term solution and give the assurance to the investors.
Do you think that investors will be deterred at this point until they have those assurances? Mm-hmm. Do you think it'll keep them from really wanting to put more money here?
Well, I think the commitment of my government and certainly my counterparts, both in the White House and the State Department, they are very committed. We all realize that this should not have happened. And we need to move beyond this and give the investors the assurances that they can commit to the United States. I think the government can give as much assurance as we can, and we are, and my American counterparts are doing the same. In the end, it's a business decision, and working towards a $350 billion investment package. Yes, I think they have every need and right to demand that assurance and reliability of the entry procedures and the ability to work here.
To what extent has China made overtures to your government in terms of an economic relationship, in terms of maybe finding alternatives to U.S. investment?
Well, I'm not part of the discussion on that bilateral front, but the latest news has been the announcement of their sanctions on the 5 entities of a big Korean shipbuilder in the United States. And we're seeing what the implications of this mean for that company in particular, but for the overall investment. I think it's a concern, of course. Any sanctions from any significant economic power is something to be taken very seriously. So I understand that Seoul is in discussion with Beijing about the direct implications of that. And beyond that, I mean, China is a very important partner to us economically. It's a very close neighbor geographically, and we've been building close relationship with China for decades, and we intend to continue to do that. Mm-hmm. Yeah.
Ambassador Khan, it's wonderful to have you with us in our studios, and we'll be watching the APEC summit next week as we'll be traveling with the president, keeping tabs on those conversations. Thank you for being here this evening. South Korean Ambassador Khan with us on Balance of Power on Bloomberg. Coming up, the public outcry over the White House's demolition of the East Wing. It's still coming down. Now the Speaker of the House is now providing political cover for the president. That and more when we convene our political panel up ahead on Balance of Power on Bloomberg TV and radio. This is Balance of Power on Bloomberg TV and radio. Alongside Julie Fine, I'm Joe Matthew. Thanks for being with us. And we'll have more on the big news of the day with NATO Secretary General Mark Rutte rushing to Washington when we convene our political panel up ahead. First, the stories we're watching in today's Power Brief. Secretary of State Marco Rubio will reportedly meet with Israeli Prime Minister Benjamin Netanyahu on Friday to help reinforce the fragile U.S. brokered ceasefire with Hamas. Trips the latest in a string of high-profile visits from U.S. officials after violence flared last week in Gaza, casting doubt on the tentative peace accord. Earlier today, a top international court ruling that Israel must allow the UN relief agency to supply aid to Gaza following the latest Hamas ambush and Israeli airstrikes on the territory.
The Federal Reserve creating a revised plan that dramatically relaxes a Biden-era bank capital proposed for Wall Street's largest lenders. Some officials calculating the terms of the Fed's plan would lead to an increase of about 3 to 7% for most big banks, far lower than the 19% increase in the 2023 proposal, with lenders with bigger trading portfolios potentially seeing less of an increase or even a decrease. The Fed aims to unveil the new plan as soon as the first quarter of 2026.
And down the street, public outcry over the demolition of the White House East Wing. Yeah, look at this. If you're with us on Bloomberg TV, the demolition occurring in order to make way for President Trump's $230 million ballroom. With reports today, the president never filed plans for the new ballroom. Meantime, an historic preservation group is urging a pause on the demolition and construction as the president spends a good portion of his meeting with NATO Secretary General Rutte discussing the construction. This just happened. Drawn renderings and physical models sitting before them on the coffee table. Check this out. Still, the criticisms toward the president from both parties over this continues, so much that the House Speaker, Mike Johnson, defended the president on this. Take a listen.
President Trump's going to add the greatest improvement to the White House in the history of the building since it was originally constructed in 1800. The ballroom is going to be glorious. It's going to be used for everybody. And by the way, hey, Democrats, if you win the White House back, you get to use it too. This is for the American people, and he's using private funds to do it. How in the world could they oppose that?
Joining us now to discuss these stories, this evening's political panel, Sarah Chamberlain, President CEO of the Republican Main Street Partnership, is with us, and Matt Bennett, Vice President co-founder of Third Way, our Democratic strategist. It's great to see both of you. Welcome back. Your beloved White House is coming down, it looks like, at least some of it, this evening. The New York Times with an update on this. Upon further evaluation, the White House determined it was cheaper and more structurally sound to demolish the East Wing, the entire thing, to build the ballroom rather than to build an addition. Don't you have to ask permission before you start knocking the building down?
I mean, this is about number 170 on the list of things he was supposed to ask permission to do. Okay. But of course, I mean, this is insane. And doing it during a government shutdown, like they're claiming it's private money. We don't know whose money. But it is a bad look when you've got people, literally federal employees at the White House working without pay. Why are they doing this at all? Why are they doing this now?
Look at this. These are the renderings. If you're with us on Bloomberg TV or on YouTube, we actually have the architect's designs that he's showing with the NATO Secretary General. This doesn't really apply to him.
Joe and Sarah, it was interesting, as Joe just read, that they're calling for a pause. Mm-hmm. It's done.
It's done.
Like, what do you pause?
Yeah.
You can't just leave the building like that.
No, of course not. And technically, he does not have to ask permission.
Yeah.
Other presidents have done changes, and they don't ask permission. It was a little bit of a surprise, certainly, to see the East Wing. But we've all been, I'm sure, in the East Wing, and we've been in that ballroom, and it is a little too small. Let's admit to that. So here we go, and it's going to be big. And there are a lot of corporations that have funded this. They were at the dinner a couple weeks ago.
We do have a sense of where this money is coming from,
we
right?
Do have
Harold
a sense
Hamm,
of it.
it's Alphabet, it's Meta.
Exactly.
And
they're doing it on free. I mean, they're happy to support it, and he's right. Democrats will be using it as well.
I think I said $250 million, right? Does the president deserve credit for having this privately funded, not using taxpayer money?
No, the president doesn't deserve any credit for this.
You see conflict of interest?
Yes, of course. I mean, look, I'm sure these companies thought it was a good business decision to try to, butter up the president with more money. That is what they've been doing very aggressively over the course of the last 8 months. And this is just another example of that. Also, it's going to be gross. Like, this is a Versailles-like gold ballroom. That is not what the American presidency should look like. And all the gold that he's larded into the Oval Office and along the breezeway, and the changes they made to the Rose Garden, this is not what anyone voted for.
So, Sarah, let's talk optics for a moment. I mean, you do have the shutdown optics, but let's even put that aside. Now you have the president actually showing the renderings in his office during very high-level meetings on very important foreign topics. Republicans just have to keep answering questions about this when they have enough to answer questions about with the government shutdown.
They do, but they kind of keep rolling with it. They're used to it. This is the second time he's been elected. They learned from the first time. They just keep rolling and like, okay, what's next? Maybe he could have presented the drawings in a different format. Maybe not during that meeting, but it is nice to finally get to see the drawings because most people had not seen any of the architecture. So it would be done. It has to be done during government shutdown. Bad timing, I admit. But in order to have it done during his presidency, you had to start it.
They better get going.
Right, because we don't know when this shutdown's going to end.
Well, so let's talk about that. I mean, this is the story beyond the ballroom that's captivating Washington on day 22. No off-ramps. But the conversation in the last 24 hours has evolved back to, or maybe you think devolved, to the idea of a full-year CR. John Thune suggested earlier this week that might be the only way out. You know the White House is comfortable with it. And remarkable to see Jason Smith today, who chairs the House Ways and Means Committee, fall in behind this. And he says it's not his preference, but this is probably the only way to avoid rolling shutdowns for the foreseeable future. Where's the Main Street Partnership?
So the Republican Main Street Partnership members do not want to do a one-year CR. They will if they have to, but they really want to get back to work, have the Democrats come back to work, get government open, vote on ACA, because most of the Main Street members do support an ACA fix, and then go back to what's called regular order, go back to the appropriation bills, and move the agenda forward. If we sit here with a year-long CR, I think that would be a disaster. But we may have to.
You know, we had Senator Cortez Masto on earlier. She is trying to get other Democrats to get on board and, you know, call this shutdown over. She doesn't seem to be doing very well with this at all. And she seemed to say that they can do it all at the same time. They're not doing it all at the same time.
They're not. And look, if Sarah was in charge of the House Republican Conference, I think we could solve this fairly easily. Unfortunately, Mike Johnson is in charge. And they're not, the Speaker's just not going to do that. They're not going to put an ACA fix, you know, on the table in ways that Democrats can trust in any way that it's actually going to happen. So I think we are in for a lot longer of this shutdown. I don't know what happens after the premium notices go out on November 1st. That may be a moment where the Democrats just say, look, you own this now, and open up the government.
Well, what would Chuck Schumer do with the idea of a year-long CR?
I don't know. I mean, we are in such uncharted territory. I think he thinks it's appalling also, just like the rational people in the Republican conference. But it may be the only way out of this.
Do you think the only way out of this, though, also maybe you look at November, but if holiday travel is just a mess?
Yes.
I mean, because that is a bipartisan issue when people are traveling.
Right. And Thanksgiving's a big holiday that people travel. I think it will be a huge problem if it's not going smoothly. They will start to complain. They will start to call their members of Congress and say, we need to fix this. Then you'll see action. I also think November 4th could be a turning point. Let's see what happens with Virginia and the Prop 50 in California, Virginia's governor's race, and New Jersey's governor's race. If the Democrats succeed in all three, I think you may see some momentum going their way. They may be like, okay, let's negotiate. And they need a victory. That could be their victory, and then they're willing to negotiate with ACA and get the government reopened. We'll
Democrats
see.
are filibustering this legislation to pay military service members and accepted federal employees, those who have been deemed essential. What's the purpose of that when so many campaign ads are going to be focused on these votes?
It's a very tough vote.
Yeah.
But I think the Democrats' view is that is just a way around the pain of the shutdown. And the whole idea of a shutdown is to cause pain for the president. And, of course, it's horrible that our troops are going without pay. No one wants that. No Democrats want that. There's been some outrageous lies being told by Republicans about Democrats hating the troops, which is despicable and untrue. But I think inevitably pain is part of the deal when you shut the government down.
You know, the ads are going to say Democrats voted however many, 16 times to not pay the troops. That's tough politics.
I've already written that ad.
Yeah.
So
it's coming.
It's coming.
What time does it begin airing?
Exactly.
Okay.
Soon.
You know, this is also at a time where North Carolina today joined the states in redistricting. So when you talk about campaign ads, well, let's just talk about what the districts are going to be. Where does this end?
I have no idea, because Maryland's going to do it. Obviously, Prop 50 in California. Right now, it looks like they may be ahead a little bit. We'll have to see what the outcome is. I have no idea where this is going to end. If they can pick up a seat here and there, they're certainly going to do it. Both Republicans and Democrats. New York's going to try it. So
well, it's a lot of red.
It's a lot of red.
That we were just
There's
showing.
more red than blue.
Well, so yeah,
absolutely.
What did Democrats do with
question.
this? How do you outmaneuver Republicans on the map? Is it possible?
No,
not
not possible. All we can do is try to mitigate the damage. And let's be clear about who started this. You know, this was a Trump initiative starting in Texas, and that has morphed into many other states.
Yeah.
They're putting enormous pressure on Indiana, Missouri, Florida, elsewhere. Democrats had no interest in doing any of this, but it's a requirement because we desperately need to get the branch of government back.
Do you think we'll see more of this year? I mean, do you think it just goes and goes and goes?
There are some rate limiting factors. It's very hard to do it in certain places. New York is really hard because of the laws. there, but I think there's going to be a real effort to do it. Illinois is a big sticking point now between.
और गाइस ये क्रूड ऑयल में देखोगे ना, यहाँ पर ये पूरा रेजिस्टेंस जोन ही है, ध्यान रखना, थोड़ा बड़ा जोन है, बट ये रेजिस्टेंस जोन ही है, दो रेजिस्टेंस साथ साथ बने हुए हैं, तो मैंने थोड़ा सा अलग अलग लगाया हुआ है, मेरे इसमें मार्क नहीं हो रहा है, ध्यान रखना, मैं मार्क नहीं कर पा रहा हूँ शॉर्ट पोजीशन लॉन्ग पोजीशन, तो थोड़ा ध्यान रखना है यहाँ पर, अनेबल टू मार्क दोज लेवल्स, आई डोंट नो व्हाट हैपन। बाकी ओवरऑल क्रूड ऑयल देखोगे बुलिश ही है, मेजरली अभी रीजन हो रहा है मार्केट में वो है आपका रसिया पे, जो यूएस ने सैंक्शन लगा दिए हैं उनके ऑयल पर, साथ ही साथ यूएस के जो यूरोप ने जो रसिया का एलएनजी है उस पे बैन लगा दिया है, एंड रसिया ने थोड़ी देर पहले वार्न किया है कि वो भी रिटेलिएशन करेगा यूरोपियन यूनियन पर अगर ईयू ने रसिया के जो एसेट्स हैं उनको सेल करना शुरू कर दिया, सीज तो ऑलरेडी कर ही रखे हैं। सो देयर इज अ टेंशन बिटवीन रसिया एंड यूरोपियन यूनियन, जिसकी वजह से क्रूड ऑयल थोड़ा क्या ज़्यादा ही बुलिश हो गया, जैसे कल नेचुरल गैस बुलिश था 2-3 दिन से, क्रूड ऑयल हो गया बुलिश उस हिसाब से। मॉर्निंग से देखोगे एक बड़ा गैप अप हुआ, रेजिस्टेंस के सीधा ऊपर ही ओपन हुआ, तो वो सपोर्ट की तरह काम करेगा नाउ, एंड देन उसके बाद कंटिन्यूसली ऊपर ही जाते जा रहा है। ये एक रेजिस्टेंस जोन था, बट यहाँ पर देखोगे कैंडल ही ओपन इक्वल टू लो बन गई, तो थोड़ा सा मैंने यहाँ पर लगाया नहीं है, ऊपर एक रेजिस्टेंस है, लेट्स सी होल्ड करता है तो थोड़ा क्वांटिटी का ध्यान रखना। ओवरऑल बुलिश ही है, अपर सर्किट पर ही जाने वाला है, ऑलमोस्ट 5.26 5.99 पे अपर सर्किट लग जाता है क्रूड ऑयल में। इंडियन मार्केट भी क्लोजिंग पर ही पहुँच गई है। Crude oil is overall positive, super bullish. लाइक भी करते रहो गाइस, डोंट फॉरगेट टू लाइक द स्ट्रीम जिन लोगों ने लाइक नहीं किया। बाकी ये लेवल भी टेस्ट तो है वैसे, बट दैट इज़ द ओनली लेवल आई कैन सी राइट नाउ। बाकी जिस तरह से मोमेंटम आया है थोड़ा बहुत तो रुकेगा, यहाँ पर प्रॉफिट बुकिंग आनी चाहिए, क्योंकि नीचे कोई सपोर्ट भी नहीं है। इफ़ यू लुक एट द लोअर एंड देयर इज़ नो सच सपोर्ट इज़ अवेलेबल राइट नाउ। कोई नया सपोर्ट बनेगा तो बात अलग, अदरवाइज अभी नीचे कोई सपोर्ट भी नहीं है। जितने रेजिस्टेंस ब्रेक हुए हैं ऑल दोज रेजिस्टेंस नाउ एक्ट लाइक एज अ सपोर्ट, स्पेशली जो लास्ट में है 5200 के आसपास, वही एक मेजर रेजिस्टेंस था, उसके ऊपर ही गैप अप हुआ है, तो सीधा वही एक सपोर्ट की तरह काम करेगा। बाकी लग तो नहीं रहा अभी और कोई सपोर्ट बन रहा है।
News when you want it with Bloomberg News Now. I'm Caroline Hepker.
And I'm Stephen Carroll.
The United States is sanctioning Russia's oil giants Rosneft and Lukoil in a major U-turn for US President Donald Trump as he seeks to pressure Vladimir Putin to negotiate an end to the war in Ukraine. Oil prices immediately spiked in response to the sanctions, with Brent advancing as much as 3% to trade above $64 a barrel. Trump told reporters the peace process had dragged on.
We canceled the meeting with President Putin. It didn't feel right to me. It didn't feel like we were going to get to the place we have to get, so I canceled it. But we'll do it in the future.
Mr. President, can you tell us a little bit about why you're elevating sanctions against Russia right now?
I just felt it was time. We've waited a long time. I thought that we'd go long before the Middle East.
So the shift in policy signals the US president is running out of patience with the Russian leader, but it's a gamble given Trump's focus on keeping domestic gasoline prices low in the US. But foreign policy analysts warn that Russia has historically been very good at evading these kinds of sanctions. Refiners in India, which along with China is the biggest buyer of Russian crude, have told Bloomberg that the latest sanctions will mean flows from Russia to them are expected to fall to near zero.
Well, the European Union, meanwhile, is preparing to tighten its sanctions on Russian energy after agreeing on their 19th package against Moscow. The measures are set to be automatically adopted this morning by EU leaders arriving in Brussels. The package targets 45 entities that have helped Moscow evade sanctions, including 12 companies in China and Hong Kong. It will also include an import ban on Russian LNG, tighten transaction bans on 2 major Russian oil companies, and target over 100 additional shadow fleet vessels. Ireland's Europe Minister Thomas Byrne told Bloomberg Radio the EU must use its power to support Ukraine.
It is really, really important that the European Union continue to use its leverage, continue to use its unity, and indeed our power and our financial wherewithal to support Ukraine in what they're doing, which is defending themselves and legitimately under international law, making sure that they are keeping themselves alive as an independent country, which they are entitled to do.
Ireland's European Affairs Minister Thomas Byrne speaking there ahead of the EU leaders gathering getting underway this morning. One of the most controversial points on their agenda includes allowing the use of frozen Russian assets to provide loans to Ukraine.
Now, US Treasury Secretary Scott Bessent says everything is on the table when it comes to possible tech sanctions on China. The top White House official was asked if America might consider similar measures to those that it has just imposed on Russia. He told reporters that the world has to retaliate against China's policies on rare earth metals.
I will confirm that everything's on the table, that we are going into the negotiations with good intentions, with great respect. The Chinese have put these rare earth export controls not only in the U.S. but on the whole world. And if these export controls, whether it's software, engines, or other things happen, it will likely be in coordination with our G7 allies.
Bessent is one of the key negotiators in the US-China talks. The American and Chinese presidents are due to meet next week as trade tensions keep ramping up.
We've got some breaking earnings news this hour. The British bank Lloyds has reported third quarter pre-tax profits that were significantly below estimates. The figure for the 3 months to the end of September was £1.17 billion. Analysts had been expecting £1.45 billion. The bank has also revised its guidance for the full year, seeing its return on tangible equity now at about 12%. That was versus its previous estimate of around 13.5%. It's also below what analysts had been expecting there as well. This as we are watching for Lloyds continuing to provide for the cost of the motor finance scandal. The bank said last week it would need to put aside £800 million to pay compensation for missold motor finance loans.
Well, in other earnings news, the software giant SAP reported third quarter revenue from its cloud business that missed estimates as it warned of an uncertain economic backdrop. Europe's most valuable software company reported almost €5.3 billion in cloud sales for the period. Looking ahead, SAP sees cloud revenue closer to the lower end of its expected range next year, but profits at the higher end. The news comes after CEO Christian Klein pivoted the company away from selling traditional software licenses to subscription services.
Elon Musk is calling on Tesla investors to support his $1 trillion pay package. The billionaire CEO used the company's earnings call to criticise the power of shareholder advisory firms who've criticised the plan.
like I said, I just don't feel comfortable building a robot army here and then being ousted because of some asinine recommendations from ISS and Glass Lewis who have no friggin' clue. I mean, those guys are corporate terrorists.
Elon Musk speaking there on Tesla's earnings call. His pitch came as the electric vehicle maker reported a 40% plunge in operating profit as rising costs undercut a record quarter of vehicle sales. Customers had rushed to buy Teslas before a US government tax credit expired at the end of September.
Now, Europe's defence companies are making a joint space venture to compete with Elon Musk's SpaceX. Leonardo, Airbus and Thales have sealed a deal to merge their satellite operations into a $6.5 billion company. So this with a headquarters now that will be in Toulouse. The venture comes as European countries prepare to unleash trillions of euros on defence to increase the region's independence.
The UK is planning a package of emergency measures to boost house building in the capital. Bloomberg has learned that the government is planning to cut the proportion of affordable homes developers have to provide from 35% to 20%. When asked, spokespeople said plans are not yet finalised but would give the Mayor of London stronger levers to bring thousands of homes forward more quickly. Bloomberg's Freddie Fulston has more.
Stifling regulation, planning delays and stringent requirements for affordable homes. Just a few of the problems the Mayor of London and the UK's Housing Secretary are looking to relieve. Measures to boost development will look at fast-tracking planning and loosening housing design rules. One proposal sees a reduction in the number of affordable homes that providers have to build. It's a tantalising prospect for a paralysed planning system, but the government has a way to go if it wants to build 1.5 million new homes this Parliament. One forecast by Molly or London says that at the current rate, just 15 to 20,000 homes will be in active construction in London by the start of 2027. In London, Freddie Fulston, Bloomberg Radio.
So those are our top stories for you this morning. Looking at the market, so we mentioned that oil prices have jumped. Brent crude futures $64.80 now, up by 3.5%. Asian equities are down. MSCI Asia Pacific Index dropping 0.4%. The dollar is firmer. Lots of earnings out too to think about. Lloyd's, ST Micro Electronics. More news from Unilever, which says third quarter underlying sales are expected to increase by 3.9%. They did increase by 3.9% versus the estimate of 3.69%. So that's a miss in terms of the sales from Unilever out today. And then stock futures for Europe currently are up 0.2%. Those are the markets.
That's news when you want it with Bloomberg News Now. I'm Stephen Carroll.
I'm Caroline Hepker, and this is Bloomberg.
क्रूड ऑयल को देखोगे क्या बुलिश हुआ है आज, ऑलमोस्ट अपर सर्किट हो गया है। 6% पर अपर सर्किट लगता है 5.99 पे रेजिस्टेंस है, देखते हैं होल्ड करता है नहीं, क्योंकि फिर इसके ऊपर नेक्स्ट रेजिस्टेंस तो बहुत दूर है, सीधा 5600 के अप्रोक्सीमेटली। तीसरी बार आ रहा है इस रेजिस्टेंस एरिया पे प्राइस, 2 बार पहले आ चुका है, एक बार सेलिंग आई थी लो बनाया था, दूसरे बार आया था मार्केट ने लोअर लो बनाया था, दिस इज द थर्ड टाइम प्राइस हिटिंग दिस लेवल इन क्रूड ऑयल। ओवरऑल न्यूज़ की वजह से बुलिश ही है, देखते हैं थोड़ा बहुत रिवर्सल यहाँ से लेता है नहीं लेता है, फिर नया रेजिस्टेंस ही क्रिएट करेगा। क्वांटिटी का थोड़ा ध्यान रखना, न्यूज़ की वजह से बुलिश है सम कंप्लीट, क्रूड ऑयल स्पेसिफिकली बात कर रहा हूँ। बाकी 3:30 होने वाला है, लंदन सेशन इज गोइंग टू ओपन, उसके बाद न्यूयॉर्क सेशन ओपन होगा 5:30 पे, थोड़ा सा इंडियन मार्केट की क्लोजिंग के बाद एक्सपेक्ट कर सकते हैं वॉल्यूम आना चाहिए। नेचुरल गैस भी थोड़ा सा अगर ऊपर आता है तो इसमें भी एक सेलिंग का प्लान करेंगे, थोड़ा ऊपर आने का वेट करना पड़ेगा, लेकिन इसमें भी रेजिस्टेंस थोड़ा सा दूर ही है अभी भी, अप्रॉक्सीमेटली 313 टू 315 के बीच में। बाकी इस लेवल से सिर्फ एक ही बार सेलिंग आई है अभी तक, कल थोड़ा बहुत रिजेक्शन लेने आया था प्राइस, वो एक सेकेंड टाइम आप कह सकते हो, थर्ड टाइम ही आएगा यहाँ पर आता है तो, कल के हाई के अप्रोक्सीमेटली। बाकी कोई सपोर्ट तो बना नहीं है, बन जाए तो देखते हैं फ्रेश बाइंग के लिए नेचुरल गैस में। मॉर्निंग पे देखोगे तो मार्केट अपने वही एक छोटे सपोर्ट के आसपास ओपन हुआ था नेचुरल गैस में, बट वो लेवल भी अब काफ़ी दूर है। दोबारा वहां तक आने के लिए तो काफ़ी नीचे आना पड़ेगा। उसके लिए तो बेस्ट है कि नया सपोर्ट ही क्रिएट कर दे, rather देन फिर से वहां पर सपोर्ट ले, बिकॉज मोमेंटम देखोगे इतना स्लो है। ठीक है, ये मॉर्निंग पे देखोगे पहली कैंडल 9 PM की यहाँ पर ही रुका हुआ था ऑलमोस्ट। नीचे आने से बेटर कि यहाँ पर नया सपोर्ट ही बनाए मेरे अकॉर्डिंग, तो ज़्यादा सेफ रहेगा। क्योंकि यहाँ पर देखोगे तो एक रेजिस्टेंस था सीधा नेचुरल गैस में भी, कल जहाँ से थोड़ा बहुत रुक रहा था 302 के आसपास, परसों जहाँ पर रुक रहा था सॉरी, फिर कल मार्केट सीधा वहाँ पर गैप अप हुआ तो वो रिटेस्ट बन गया था। वहाँ पर मार्केट ने रिटेस्ट किया, फिर नीचे भी एक सपोर्ट था, वहाँ से सपोर्ट लिया, दोनों एक साथ ही कर दिए थे। मॉर्निंग से तो यहाँ से काफ़ी स्लोली स्टडी जा ही रहा है ऊपर की ओर, तो बेस्ट है ऊपर ही जाए, या नीचे आता है तो फिर नया सपोर्ट ही क्रिएट करे मेरे अकॉर्डिंग।
during times of economic and political and financial turbulence. You buy the dollar, you buy US Treasuries, you seek safety.
Not so much now. Now you buy gold.
What we're seeing at the moment is not like anything really that we've seen over the last couple of decades.
In October, gold extended its already furious run from last year and showed few signs of abating.
This gold rally really looks unstoppable at this time.
Excitement is evident online, on shopping streets and in capital markets.
Just gold, gold, gold the whole time.
Chinese mining company Zijin Gold recently raised $3.2 billion in one of the year's biggest IPOs. But it's not just a gold rally. Look at silver. In October, it reached its highest price per ounce in more than 4 decades.
I think it is a warning sign that people are very anxious.
Gold is the ultimate safe haven asset, a heart rate monitor, if you will, for the health of the global financial system.
And because of that, when you see a spike in the gold price, your first question should really be what's gone wrong.
Gold is the ultimate precious metal. It's been around since the beginning of time. Gold has seen it all and has survived through it all, and it probably will continue to do so.
Because it's reliable, easy to trade, and high value, despite lacking the intrinsic utility of a semiconductor or shipping container full of these things.
Gold has outperformed equities, it's outperformed almost every other asset class if you take your starting point at 2000.
It is the one asset that does very well when the typical parts of your portfolio go down.
It breached $1,000 during the global financial crisis, $2,000 during COVID, and $3,000 after the Trump administration's tariff announcements, which perhaps was a wake-up call.
The dollar for many, many years has been seen as the haven of the market because people trust the U.S. government and they trust dollar assets.
Welcome to 2025.
The dollar is the single biggest decline in 6 months in 50 years. Gold is at record highs.
And here's what that looks like. This gold line, because why would it be any other colour, shows how much the metal has increased in value since January. The green line shows the dollar's depreciation over the same period. That discrepancy reflects what's called the debasement trade.
It is the idea that faith and trust in the dollar is no longer what it once was, so you have investors looking at other assets.
People do that trade when they are losing their confidence in traditional government bonds and fiat currencies.
And in that situation, gold becomes quite appealing because there is no counterparty. It's just you and your gold.
It's independent from the government's influence as well.
Which is no longer something investors automatically say about the dollar or the US central bank.
So the Federal Reserve has long been seen as kind of a bulwark of global financial stability. It has cherished independence from the political system in the US. Now the pressure on the Fed from the White House and President Trump has thrown that whole dynamic into question.
Am I allowed to appoint myself at the Fed? I do a much better job than these people.
How sustainable is the Fed's position, given the position that President Trump is taking and given the pressure he's putting on the Fed to lower interest rates?
If the Fed is slashing interest rates all the time,
that makes gold more appealing because, unlike cash, it doesn't actually obviously yield interest.
Heavily dependent on China. Where are your Barbies made? China. Where are your hot rods made? In China. And so it shows how there are pockets of disruption that still haven't come fully to the fore. And when you see those, they are punished.
Let's talk about pockets of stress, pockets of credit stress, because elsewhere, solid earnings, Western Alliance, Capital One. If you expected to see some real credit issues, broad-based, systemic problems, you'd expect it to show up in the banks. You'd expect to see it in the credit card companies.
Yeah, so Capital One came out with blockbuster earnings on the heel of their Discovery tie-up. When it comes to Western Alliance, this is the company that always gets beaten up, right? It's the bank that always has the malfeasance, and they did have higher than expected credit charges and write-offs because of some of the fraud that they were talking about, but still, bang up earnings. So can you really look at that as your expectation of weakness, as your expectation of anxiety? people are kind of fading on that.
Those names trading firmer after the close. Two to watch going into the open. Equity futures so far this morning positive by around about 0.1%. Coming up this hour, we'll catch up with Max Kettner of HSBC with stocks sitting near all-time highs. Ed Mills of Raymond James with US-China trade talks in question. And Jason Bazinet of Citi on the mixed results from Netflix. We begin this hour with stocks holding steady with more earnings on deck. Max Kettner of HSBC writing further likely strength in US equities should be enough to prompt a broader risk-on move. Max joins us now for more. Max, good morning, sir. You've talked a lot about how the bar for growth is low enough that we can deliver some upside surprises. Can you say the same thing about earnings into next week with big tech on deck?
Yeah, good morning. Thanks for having me. Look, I do think so. I think actually the bar, when we look at X-Tech, for example, is extremely low. Look at when we headed into the earnings season, you guys were just talking about banks and about the financials. We had a sort of minus 4% quarter-over-quarter earnings growth expected from consensus. So when you exclude tech, actually consensus was saying that earnings are going to go down sequentially. And bear in mind, that's a nominal number. Whereas, all the top-down GDP proxies, GDP now, all of the stuff was trending around 3 to 4% for Q3 in real terms. So we're sort of talking maybe 6% nominal GDP growth. And consensus is saying earnings are going to go down. That really means there is a genuine risk that actually the earnings beat rate, not just in tech, but in the broader market, the earnings beat rate will be even better than in the second quarter. And that would then be the biggest earnings beat rate since COVID. So for all those people who are like, we're all just firing on one cylinder, it's just tech. No, it's not just tech. In fact, we are seeing broad-based and underestimated strength elsewhere as well.
Certainly saw that with the banks last week on Wall Street. Max, we are seeing, though, pockets of stress, pockets of credit stress, pockets of disruption. We saw that with Mattel. We saw that with some of the issues over the past month with First Brands, with Tricolor. Max, what's your approach now? You've been bullish through most of this year, through a lot of volatility. Is it still a market cap index, or are you going to be a little bit more nuanced into year-end?
No, look, I think it is a market where you have to be more nuanced. When you look at the consumer side of things, for example, probably most of the discretionary stuff is fine, but when you look at the consumer staple stuff, the consumer good stuff, most of that is imported. Most of those companies, there's a lot of companies that are struggling, that really are seeing costs rising and that are struggling to pass on those higher costs. So on the consumer staple side, I'd really be cautious. But when we look at the banks, when we look at particularly things like industrials, for example, I do think actually that is still an area where I would focus on. Aside from tech for me still remains that core holding, because I do think heading into 2026, what people are underestimating really is the ability through the One Big Beautiful Bill, the ability to expense CapEx straight away. That does apply then to AI CapEx as well. And that, of course, means that any kind of AI CapEx that you plan for perhaps the next 2-3 years, you've got every incentive to pull that CapEx forward. And that should mean that those CapEx expectations on the AI, on the hyperscaler side, perhaps are still too conservative for 2026. And that heading into the earnings season for tech companies is another potential upside catalyst.
So how much, Max, do you look at this and say, I don't care about the circularity of this? The idea that Amazon and Alphabet are increasingly hedged to Anthropic. OpenAI is absolutely central to every single company because they seem to be making deals with everyone. The fact that they're all interconnected, one bad report could send the whole sector down. You just dismissed that as sort of not feasible given the likely investment trajectory. Is that right?
Yeah, I might be oversimplifying things here, but when I read this the first time a couple of weeks ago with the OpenAI with the 100 billion investment, I thought to myself, I read the story twice, and I thought to myself, isn't that just normal B2B? Wouldn't we, we look at sort of, let's say Walmart, Target, some of the grocers, they've got their suppliers. The suppliers then are invested in other suppliers. That they're getting their supplies from the other suppliers and all this sort of stuff. So I'm not really particularly convinced about that. To me, that sounds just like an ecosystem, a fairly closed ecosystem. But of course, you're not going to go, let's use the grocers. You're not going to go, NVIDIA or OpenAI is not going to go to Walmart and like, oh yeah, you know what? We need 100 billion of sandwiches. No, we're not going to get that yet. So I don't think it's a particularly spectacularly bearish thing or dangerous thing that it is a fairly closed ecosystem and they're sort of feeding off each other. That's just normal B2B, I would say. Is there a risk for AI CapEx, for the AI hyperscalers? Yes, I do think so, but I think not in the next 6 to 12 months. The next 6 to 12 months, again, with that ability to expense CapEx straight away, that actually introduces even more upside risk on the CapEx side. The risk, I think, then comes maybe into 2027 that maybe we've seen so much capex pulled forward that then actually the delta going into 2027 in terms of AI capex might not even be lower, but it actually might be turning negative. But that, of course, that is minimum 6, if not even 12 months too early to play.
How much is the ongoing rally that we've seen really bolstered by what we've seen in the bond market? We've seen 10-year yields in the U.S. fall to the lowest levels going back to October of 2024 on this expectation that the Fed will cut, on this expectation that the economy is softening. How much is that underpinning your optimism and the optimism in markets?
Yeah, it depends. I think it depends when you look at, obviously, stuff like non-profitable tech, when you look at stuff like small caps, that very much, I think, is underpinned by the idea that we're not heading quite into a recession, that growth overall is actually fine, but there are these pockets of weakness, there are these pockets of labor market weakness and labor market cracks, and that renders, rate cuts justified. And that, of course, then spurs strength in some of the, let's say, some of the more niche kind of corners of the market. The overall market, I think it's not really underpinning a lot of our opinion because, let's face it, we've got a terminal rate price then of around 285 for the beginning of 2027. If we were to move, let's say, if we were to cut a price one cut out from 285 to 310, that is barely above the long run dot. If that is then coming because of better growth, perhaps because of better payrolls or better earnings, if that is a result of better fundamentals, that is still a very, very dovish number where the market thinks we eventually end up, and the higher number is driven by better growth. So it much more then is a case of, well, we need to rotate perhaps away from the Russell, from non-profitable tech, more towards large cap cyclicals, but it's not really something that's underpinning our view overall.
Max, do you need to rethink the whole AI trade at some point when these robots and the whole AI industry starts taking jobs? A report yesterday in the New York Times that Amazon plans to replace more than 500,000 jobs with robots. Isn't that going to impact growth and the macroeconomics of the United States?
Yeah, look, I mean, there are two things that I want to say. The first one is, I think people are at the moment looking at AI only as a bearish thing. The first one, of course, is, which I'm sure you guys have talked about at length, is AI is a bubble. It's just like 2000. So you kind of have to go through, well, actually, look at Amazon. You just mentioned Amazon. AWS makes more revenue in the last 12 months than 468 other companies in the S&P. So it is not like 2000. They are printing hard cash as if there is no tomorrow. That's number one. Number two is, I feel like with AI, there is, mostly for bearish people, there's this narrative that basically either return on investment assumptions are way too rosy, that's never going to be fulfilled, so therefore AI is bound to disappoint, or if those return on investment assumptions are fulfilled, if the productivity gains come, well, then AI is going to come for your jobs, and then it's also bad. So I'm kind of sit there, I'm like, oh, great, so we're all buying AI and tech stocks, but actually the whole market is wrong because whatever happens, it's going to be bad. I'm not really sold on that. And the third thing on that is when we look at job cuts so far, again, the narrative is, well, AI is already coming for your job. Look at job cuts. Look at challenger job cuts. If you look at job cuts by reason, actually, there is barely more than 1% of job cuts year to date that are due to AI. Last year, it was also about 1.1%. So in fact, you've got about 99% of job cuts at the moment because of different reasons than AI. So I feel the narrative doesn't really stack up with the data at the moment, at least.
But Max, there is something to all this. I think we should discuss it, at least so far this year. If I told someone all the payrolls data for the year ahead at the start of the year, they would have been hopelessly bearish for 2025 and would have missed out a massive rally. And Max, I think that raises the question just how relevant jobs data is to the broader equity market at the moment and whether that dichotomy can persist into 26.
Yeah, I think that's a very good point, because going into next year, bear in mind, yes, if you had told someone the payroll data, they probably would have freaked out, right, in hindsight. But if you had told them the payroll numbers and on top of that, then the break-even payroll numbers, how the break-even payroll numbers have gone from almost 250,000 just about 2.5 years ago to pretty much probably zero by the end of this year, then, that puts lower payroll numbers very much into perspective. So we've got to be careful about that. Where I do think there is some danger, really, particularly in the first half of the year, what happens if we get a sort of a 40, 50K number on payroll? So nothing really spectacular. In fact, just like you said, a number that, 6-9 months ago would have made us freak out. If we do get that, but actually the break-even payroll number is already close to zero. That might be enough to not just keep the unemployment rate stable, but in fact make the unemployment rate decline. And that, to me, is a real hawkish risk. That is a risk to all the steepeners that people have on, because it would see really the front end bear flatten it. It's a risk to the EM trade. It's a risk to the short dollar trade. It's a lot of that. That really is one of the key risks, I think, for the first half. Not for the next 3 months, because we have seen one factor go up and all this. The next 3 months, still a bit more weakness. But I think for the first half, that is certainly a risk to watch.
That would send heads spinning. That's for sure, Max. Thank you, sir. Max Kettner of HSBC. Need some jobs data first. That'd be nice. Gone a few months without it already.
Which is the reason why things like the Philadelphia manufacturing yesterday sent the market into a tailspin, because we don't have anything else. It's true. We're talking about these big picture shifts, trying to look into the dark that suddenly is even darker. And this is the really difficulty right now. Do you just ignore it? Because a lot of people are just ignoring it and bidding prices up on stocks. And that sort of is the conclusion in markets.
Paid to ignore it,
Exactly.
At least so far. That can change quickly. Equity futures on the S&P positive by 0.1%. With an update on stories worldwide with your Bloomberg brief, let's cross over to Yahara Anand. Hey, Yahara.
Hi, John. President Donald Trump says the upcoming meeting with Chinese President Xi would yield a good deal on trade. Still, Trump said the possibility remains that the meeting could fail to materialize. Treasury Secretary Scott Bessent is expected to meet with his Chinese counterparts to discuss a de-escalation of trade tensions later this week ahead of the Trump-Xi talks. Meanwhile, peace talks between Russia and Ukraine are showing signs of stalling after White House sources said there are no plans for a meeting between President Trump and President Putin. The leaders had been scheduled to meet in Budapest within the coming weeks. The Kremlin on Tuesday maintained that Russia is sticking to its original demands, including Ukraine cede full control of the Donetsk region. And Netflix shares falling 6% in the pre-market after the company reported third quarter earnings that were hurt by a tax dispute with Brazil. The company had to pay over $600 million to settle a multi-year tax dispute, but said it would have beaten forecasts if not for the expense. Netflix's outlook for the current quarter is largely in line with Wall Street estimates. That's your Bloomberg Brief. John?
Yahara, thank you. And that appears to be the disappointment there. The outlook in line. The stock is down by about 6%. Up next on the program, President Trump looking for leverage.
Right now, as of November 1st, China will have about 155% tariff put on it. And I don't think it's sustainable for them.
So either it's going to be a good deal or 155% tariffs. Ed Mills of Raymond James joins us next, live from New York City this morning. Good morning. Three days, no losses on the S&P 500, within 1% of all-time highs. Futures up this morning by 0.1%. Under surveillance this morning, President Trump looking for leverage.
Right now, as of November 1st, China will have about 155% tariff put on it. And I don't think it's sustainable for them, so I want to be nice to China. But China's been very rough with us over the years because we had presidents that weren't smart from a business standpoint. Some were good politicians, some weren't even good politicians, but they allowed China to take advantage of us and every other country.
So here's the latest this morning. Trade tensions between the United States and China remaining high. President Trump saying he expects to reach a good trade deal with China, but his meeting with President Xi Jinping in South Korea next week may not happen. Tyler Kendall joins us now for more. Good morning, Tyler. So I think all of our heads are spinning here. Is this meeting happening or not?
Yeah. Hey, John. Good morning. Well, President Trump cautioned that the highly anticipated meeting with Chinese President Xi Jinping could still fall apart. Now, to be sure, the White House has not confirmed a specific date or time for the potential meeting. But as you mentioned, it is widely expected to take place on the sidelines of the APEC summit in South Korea next week. Now, one meeting that we are banking on happening is that the Treasury Secretary Scott Bessent is set to meet face-to-face with his Chinese counterparts in Malaysia over the weekend. That is widely seen as the precursor closer and could give us some clues heading into next week and whether or not President Trump does sit down with Xi Jinping. Now, if the leaders do meet, our analysts at Bloomberg Economics say their base case here is that we're likely looking at another 30-day extension to the trade truce set to expire on November 10th instead of a tangible deal. Now, that doesn't mean that we wouldn't get some sort of update or movement when it comes to the top friction points. Of course, we're watching closely what happens with export controls, whether or not there's a loosening from either side. And also, of course, U.S. agricultural purchases, whether China makes any sort of commitments as soybean farmers are set to receive a round of economic assistance later this week. But that's really just the tip of the spear here. Of course, there are a lot of different issues on the table, everything from investment to potential Boeing purchases, fentanyl, Taiwan, even TikTok. And of course, President Trump's threat looming over all of this that there could be a 155% tariff if he's unhappy with the deal. Now, John, despite the tariffs in place and the threat of more tariffs, new data is showing us that China's export market to the U.S. is proving resilient, at least in the short term. Exports to the U.S. are down 17% this year, but firms still report spending more than $317 billion worth of goods to the U.S. through the third quarter.
Tyler Kendall with the latest. Tyler, thank you. Down in Washington, D.C., Ed Mills of Raymond James writes the following. The big question is how much beyond the status quo can get negotiated? And is previously banned U.S. technology about to get the green light for the Chinese market? Ed joins us now for more. Ed, I think you're right on the money. What is and isn't on the table in these negotiations? What is and isn't going to be part of any potential deal?
Yeah, John, I think everything is on the table. I think what we're seeing is that if China went into this with the status quo, China would come out with the status quo. So you're seeing a playbook we've seen time and time again. And Trump is moving the goalpost, ramping up the pressure. Xi is doing the same. Xi in China has come to Trump 2.0 much more prepared. They are sending a message. We're willing to do things that could be mutually assured economic destruction. So come to the table and talk. I do think the number one thing that Xi cares about in these conversations are these tech controls, the semiconductors and semicap equipment that has been banned going into China. The U.S. policy is shifting here, John, and it is now the default kind of desire of the U.S. government to have the U.S. technology be the default full stack globally, and they don't think they can kind of shut out the Chinese market. So there's more room for negotiation here than I think most investors realize.
Ed, is China basically taking this hardline strategy, and there's been some reporting about this, because they think Trump will fold?
I think it's they think Trump will fold, or they will think that Trump will give them more if they push for more. Anne-Marie, you go back to earlier this year, it was their restrictions on rare earths that got Trump to walk back those 145% tariffs. We were dangerously close to having real negative impact on our industrial production here in the United States. And while we're signing these different critical mineral deals, rare earth deals, it's going to be 5+ years before we're able to get most of these. So China does have some cards that they can play. And as they play them, Trump has been willing to negotiate more. They view Trump as a transactor. And so to get him to transact, you got to push him in that right direction.
Do you find it suspect that China hasn't confirmed any meeting?
It's been the way things have happened all year long. What we have seen is the U.S. delegation comes out and they give a readout, and then China confirms nothing. And then what we've seen is that everything that the U.S. side has said has actually followed through. I do think this meeting happens. I do think part of this is that Xi does not want to appear to be weak. Some of the calculus that China has had is that what Trump wanted the most was to have this meeting. So they gave him a meeting. I'm also okay with the fact that we've already set up a home and away after this. Trump is supposed to go to Beijing. Xi is supposed to come to the United States. So that takes away a little bit of the pressure here. That hasn't been confirmed necessarily by the Chinese side either. But we can get some flourish, big announcements coming out, but really working on these details to be determined later on, which has happened on every other trade deal so far this year.
And it seems like they're both buying time, both the Chinese and the United States, in trying to rearrange some of the supply chains and the technological backdrop in the meantime. I just wonder what the negotiating chips are going to be to buy time, how much Taiwan's going to come into play, how much the Russia-Ukraine war is going to come into play. Do you have a sense of how much that's on the table if there is some sort of meeting?
Yeah, so Trump has said that he expects there to be some level of conversation about Taiwan. I do think that this is obviously the big focus of a lot of investors, and I get a ton of questions about that at Raymond James. Trump has said that they don't have a plan to invade. I think trying to bring down a little bit of those tensions. The last meeting between a U.S. president and Xi occurred at the last APEC summit, and Xi supportedly said that there was no kind of need for a military intervention as long as a peaceful reunification occurs. I do think that a lot of folks look at that Trump as a transactor to say, is Taiwan more on the table than we could normally see? Beyond that, Trump has also been very concerned about the agricultural purchases of China. So can China make some kind of agricultural purchases, make that commitment for $1 trillion of investment in the United States, and therefore we can send them those semiconductors and that semi-cap equipment, especially if we're moving to this idea that U.S. technology needs to be the default technology. Those are the things that I'm watching here in these negotiations, Lisa.
Ed, appreciate your time. Ed Mills of Raymond James. I think we also have to tackle the underlying premise here as well, the sustainability of the current tariffs. China's on course to run a record trade surplus in 2025, even with these tariffs.
And it's largely because of exports to the rest of the world. But even in the United States, you see, yes, exports to the U.S. from China are down 17%. They're still at the same levels as 2020. They're higher than 2017 and 2016. So you start looking at what we're actually seeing. It is not a decoupling by any means.
Equity futures so far this morning positive by about 0.1%, around 1/4%, away from record highs that are closed just yesterday. Up next on the programme, we'll catch up with Stephen Cook of the Council on Foreign Relations with a fragile ceasefire holding in the Middle East. Plus, Danny has your morning movers. Google jumping on news of a massive cloud deal. Equity futures on the S&P very close to all-time highs. We're positive by around about 0.1%. The equity picture looks a little something like this. The Nasdaq 100 down by not even a tenth. We'll talk about Netflix in just a moment. In the bond market, 2s, 10s, 30s, waiting patiently for inflation data on Friday, and seemingly everyone's preparing to ignore it because this Federal Reserve is on course to cut interest rates a week today. Your 2-year bond yield at 3.4487, and maybe the Bank of England might join the party. 4 days of sterling weakness. The UK delivering inflation data a little bit earlier on this morning. Guess when that dropped? You can see it on the chart. 133 on cable. Inflation in the UK coming in softer than expected. That currency pair down this morning by 0.5%. That's the cross-asset picture this morning in the market. Let's get you some single names, some morning movers. Let's cross over to Danny for more. Hey, Danny.
John, you promised Netflix. Let's start there, dragging the overall index down. Shares down 6.2%. A couple problems here. One, they cited a tax dispute with Brazil that's going to cost them over $600 million. To be fair, they said that won't extend into the future. So why are we down 6%? Maybe expectations were just higher for Netflix. They mostly reported in line, slight beats in some areas, but investors were expecting more with shows like K-pop Demon Hunter, that seemingly would have boosted them even more. So a tough morning for Netflix in the pre-market. Also, in terms of disappointing earnings, there was Texas Instruments. Those shares down nearly 8%. It was a lackluster forecast. Does it mean that the chip industry, the outlook for their analog chips is sputtering? The CEO talked about on the call the fact that industrial clients are in wait-and-see mode because of government policy around tariffs. So that's really pressuring them. Tech that is doing well today. Google certainly up there. Bloomberg sources saying that they are in talks to ink a deal with Anthropic to give Anthropic access to more cloud computing power, and Google's own specific chip shares are up 2%. Should also be noted that Google is already an investor in Anthropic, as is Amazon. John.
Danny, thank you. We'll come back to that story in just a moment. On our radar this morning, President Donald Trump saying tariffs on Chinese goods could rise to 155% next month if no trade deal is reached. President Trump adding a meeting with Chinese leader Xi Jinping slated for next week may not happen. Elsewhere, regional banks provided more relief over credit concerns. Western Alliance posting a double earnings beat for the third quarter. Capital One reporting an 80% surge in net income while announcing a $16 billion stock buyback. And finally, to build on the story that Danny mentioned, AI startup Anthropic looking to strike a multi-billion-dollar deal with Google. Sources telling us here at Bloomberg that Google will provide cloud computing services to Anthropic to accelerate machine learning. Both sides declining to comment.
And this raises a question about, again, the sort of circularity of some of the industry. And going back to what Max Kettner was saying, look, you don't expect them to go to Walmart to buy sandwiches. They're going to go to each other to buy the equipment that they need. At the same time, if you do hinge a lot of the valuations on the need for computing power that currently is the case, how vulnerable are we to another DeepSeek moment? DeepSeek seems so far away, but what if there is more efficiency? What if there is a new technology and all of a sudden you have all of this investment in very specific labor-intensive, energy-intensive endeavors? These are some of the questions that people have, but they're looking past it because so far it's been a bonanza.
Well, we moved past that shock pretty quickly and got back to spend. Alphabet, by the way, whipsawed in the last 24 hours. Yesterday got hammered. Some real worries about OpenAI and a new search engine being a direct competitor to that company. That's the existential risk that some of these companies at the moment are confronting.
It's hard to imagine this, but OpenAI and ChatGPT only came to the fore in 2022. It launched this incredible rush toward the idea of artificial intelligence and machine learning in a way that has been absolutely transformational, at least in the stock market. And it raises a question, is there someone else who could come in and do the same thing, especially given how competitive the field is getting?
Alphabet bouncing back. Their stock is higher by about 2%. Let's turn to politics and regional politics. In the Middle East, Vice President J.D. Vance meeting the Israeli Prime Minister in Jerusalem after saying he remains optimistic about the future of a ceasefire between Israel and Hamas. Joining us now from Tel Aviv is Bloomberg's Ethan Broner. Ethan, welcome to the programme and thanks for making some time for us. How hopeful are people in the region? How fragile is this truce?
Well, it's very fragile. What's interesting is how invested the Trump administration is in holding on to it and making it work. So, as you said, the vice president has been here. He's just finished his meeting with Prime Minister Netanyahu. Earlier, we had Jared Kushner, Trump's son-in-law, and Steve Witkoff, his special envoy. And later this week, we expect Secretary of State Marco Rubio to come. So this is a surprising parade of very senior U.S. officials who are basically babysitting this thing, trying to make sure that the Israelis don't overstep in retaliating against Hamas, and also sending a message to Hamas and the region that this is not a one-off, that they're very serious about it. Will that be enough? We don't know.
Ethan, do you and the team get the sense that regional partners are equally as invested as the United States in maintaining this truce?
Difficult to tell. I think that we have the Crown Prince of Saudi Arabia is going to Washington to see the president quite soon. That's a very interesting development. We know that the Emiratis are very interested. We know that Qatar is interested. You know, as invested, it's hard to say, but invested, and certainly via their links with the president and his sons and all of their business interests playing a role as well. So I do think that the president has done a pretty good job of getting everybody focused on it. It's just we're looking at, Hamas is a pretty complicated and unpredictable organization, and Israel has been traumatized for 2 years. So these two players are difficult to predict.
We're in a period of intense diplomacy and it continues. Ethan, thanks for jumping on. Thank you, sir. Ethan Broner there of Bloomberg. Stephen Cook of the Council on Foreign Relations joins us now for more. Stephen, good morning.
Good morning.
You've described this as continuous diplomacy. What's the importance of that in a moment like this?
Well, look, the president, the Secretary of State, the Vice President, Steve Witkoff, everybody is there continuously to hold the Israelis' feet to the fire on this. President Biden tried this, but Prime Minister Netanyahu just wasn't afraid of Secretary of State Tony Blinken at the time. Well, he's afraid of Donald Trump, and Donald Trump is insistent that this 20-point plan get implemented, and the way to do it is to keep sending senior American officials speaking on behalf of the President of the United States to ensure that Netanyahu and his coalition partners don't wiggle out of this thing.
But on that point, isn't it because of how the president has spoken to Bibi behind the scenes in a way that Biden would never?
Oh, absolutely. I mean, I think there's some benefit here to the fact that President Trump is purely transactional and doesn't have the kind of ideological commitment to Israel that President Biden had. So when he says everybody's going to be treated fairly, you're going to give me and I'm going to do for you, that's really important because Netanyahu hasn't been treated like that by any president before. And I think he's concerned that if he crosses President Trump, which he has done and paid for it, the Qatar strike was one of them, but that Qatar strike actually helped get to the point where we are. But if he crosses President Trump, there'll be consequences for Israel.
Who is running the Gaza Strip right now?
The IDF is running the Gaza Strip right now, and there are atomized groups of Hamas terrorists who are also running the Gaza Strip. We've seen terrible video of Hamas taking it out on its opponents in the Gaza Strip. Many, many Palestinian opponents, tribesmen, have been killed by Hamas since this ceasefire. They are patrolling the streets, and Israel, of course, continues to control 53% of the Gaza Strip.
Does anybody else want to send troops? Any other country?
This is a very, very important question. We have heard that the Egyptians are volunteering to lead this force. We've heard some about Azeri troops. We've heard something about Indonesian troops. None of this has materialized, however. And there are all kinds of questions about what are the rules of engagement for such a force? Are they going to be the ones to actually disarm Hamas? What happens when Hamas militants fire on an Indonesian soldier and kills that Indonesian soldier? None of these questions have been worked out. All we know about this international stabilization force is that there are 200 U.S. soldiers and officers outside the Gaza Strip who are there to coordinate a force that doesn't yet exist.
Why is J.D. Vance the person who's over there right now?
It's a really interesting question. I think J.D. Vance has, at times, raised questions about Israel's conduct, not just in Gaza, but around the region. I think this is another effort on the part of the president to show that everybody's going to be treated fairly. So despite all the smiles and J.D. Vance saying this is going to be a durable peace and the ceasefire is working, I think behind the scenes, Vance is there to apply pressure on Netanyahu to make sure that the Israeli government sticks to its obligations.
You mentioned the strike from September in Doha. There's some debate about the importance of that strike. Why was that pivotal in your mind?
Oh, I think it was very, very important. One, it didn't succeed. I think had it succeeded, we would be in a different place right now. But the president claims he was very unhappy about it. And Prime Minister Netanyahu took a ton of criticism, even from his Arab allies. So he was really on the defensive. At the same time, it really scared the Qataris. And so the president took both of those things and made something out of it. A softened up Netanyahu was vulnerable to Trump's pressure, and the Qataris needed something from the president. He said, okay, I'll give you a security guarantee, albeit in the form of an executive order, which could quickly be repealed, but you have to perform for me and you have to deliver Hamas.
I was there that day in the White House after they had that call with the emir, and it was embarrassing for Netanyahu to have to make that call, someone who was excited that they were potentially going to get these Hamas individuals with this strike. Trump was successful in phase one. How do you even bridge to phase two?
Well, that's, I think, the big question here. Every point on this 20-point plan beyond point one, with the exchange of hostages for a ceasefire, is subject to long negotiations. All the questions I just asked about the International Stabilization Force. There's lots of questions about who is a technocratic, non-Hamas governing body in the Gaza Strip after 18 years of being in power there. Any bureaucrat has got to be associated with Hamas. Where do you draw the line and say, okay, these are terrorists and these are people who know how to keep the lights on? The Israelis aren't going to want anybody who's affiliated with Hamas. That leaves them without really a technocratic government.
If you can't get to phase two, does this mean normalization between Israel and some other Arab states is off the table?
I think normalization has been off the table, given the fact that the Saudis, who are the big fish here, have said there needs to be a two-state solution for there to be normalization. And I think only 21% of the Israeli public supports a two-state solution. Maybe the Saudi price will go down 3, 5, 10 years. But I think we're back to the status quo where the Saudis and the Israelis are doing business, coordinating security under the table, rather than 3 years ago when Saudi officials were talking about it's not a question of if, but when we'll normalize.
Stephen, important perspective and appreciate your time.
Thanks for having me.
Thank you for being here. Thank you, sir. Stephen Cook there of the Council on Foreign Relations. Let's give an update on stories worldwide with your Bloomberg Brief. Let's cross over to Yahara Anand for more. Hey, Yahara.
Hi, John. AT&T shares are rising 2.6% in the pre-market. The wireless provider added more mobile phone and home internet subscribers than expected after a heavy promotional push. AT&T did miss slightly on revenue, but added full-year EPS should land in the upper range of previous guidance. The company is the first of the major wireless providers to report results. Meanwhile, India's Mint News is reporting the country is nearing a trade deal with the U.S. that could lower tariffs on Indian exports to 15 to 16% from current levels, which sit around 50%. The report follows comments from President Trump, who said India's President Modi assured him the country would pull back on purchases of Russian oil. The two leaders are scheduled to meet next week. And Amazon reportedly has plans to replace more than 500,000 jobs with robots in the coming years. Documents viewed by the New York Times show Amazon's plan to automate its workforce, allowing executives to double sales without hiring new U.S. workers. The Times also reports Amazon is so convinced this is nearing, it has started developing plans to mitigate the fallout in communities that may lose jobs. That's your Bloomberg Brief. John?
Politicians are going to need to do the same thing, that's for sure. Yahara, thank you. Up next on the program, Netflix stumbles.
We had a good Q3. We had revenue in line with expectations. Our operating income would have exceeded our forecast absent the Brazilian tax matter.
We compete with the biggest players in the world, tech and media. And as you see, we keep growing engagement, revenue, and profit.
That conversation up next with Jason Bazinet of Citi from New York City this morning. Good morning. You're watching Bloomberg TV. Stories like this might not matter to the broader equity market. It's a $6 billion company, but it certainly matters for the broader economy. Check out Mattel in the pre-market, down by 6%, sales declining. They miss estimates, and they flag that toy stores and US retailers are not buying product because they don't have the certainty around the tariff story. That's a big, big issue for the US economy.
Their argument is that they just pushed some of the orders back from the third quarter to the fourth quarter. And just hold on a second because it's going to be really big. In the meantime, they're trying to wean themselves off China imports to the United States of things like Barbies. Hot Wheels are made more in the U.S. One other interesting thing, they also said, we're also partnering with OpenAI for things like the Magic 8 Ball. So, I mean, they're trying to sort of say, look, we're related to AI too.
Tried to get the algos to bite in after-hours trading. Mattel down by close to 6%. This is a challenge. The retailers are important, of course. It's often said the American economy is the consumer. Things are changing, I know, but ultimately the holiday shopping season is massively important. And I think it puts additional weight on these negotiations between the US and China in the next few weeks.
Absolutely. And what we've seen from the president yesterday in his remarks is he wants maximum flexibility. He's talking about on November 1st, this new deadline he has. It could be north of 100% tariff on China if there's no agreement. And at the same time, he's saying, I think there'll be a good agreement if the meeting goes through. The meeting is not set in stone, is how the president is approaching this. He wants maximum flexibility before this potential sit down.
People want maximum certainty, and that's not available at the moment. Equity futures more broadly doing okay, positive by 0.1%. Under surveillance this morning, one other stock in focus, Netflix stumbles.
We had a good Q3. We had revenue in line with expectations. Our operating income would have exceeded our forecast absent the Brazilian tax matter. We recorded our best ad sales quarter ever.
We compete with the biggest players in the world, tech and media. And as you see, we keep growing engagement, revenue, and profit. When it comes to M&A opportunities, we look at all of them, and we apply the same framework and lens that we look at when we look to invest in a build.
So here's the latest this morning. Netflix falling in the pre-market after the streaming company reported Q3 results bruised by a tax dispute with Brazil. Jason Bazinet of Citi keeping a neutral rating on the stock with a price target of $12.80. Jason joins us now for more. Jason, welcome back to the show. Always good to catch up with you, particularly after these numbers. Jason, when you strip out Brazil, what's left? What have you got?
Well, I would agree with the company. I mean, ex the Brazil issue, I would say it was a solid quarter. The area where I think the street is going to focus is the divergence in the growth rates. So what we're seeing on an FX neutral basis is the United States and Canada is hanging in there with good growth. But in all of the other regions, which is about 60% of Netflix's revenue, we're seeing revenue growth rates decelerate. And so that's important because if you're not going to get a beat and raise, and you're looking at 60% of the world or of Netflix's revenues decelerating revenue, you know, that doesn't augur for multiple expansion.
Jason, do you see a content slate in the pipeline that turns that story around?
Well, the content slate is sort of a super leading indicator, and then you get the engagement, and then after that you get the price hike. And I would say that the engagement was actually record levels in the quarter. But I think they will end up taking pricing because of that. But even with that, you're probably still going to see decelerating growth. And I would say there's an issue that I'm more focused on strategically for Netflix, which is if I roll the clock back 5 years, Netflix had more engagement than YouTube. If you look at it today, YouTube has about 50% more engagement than Netflix does in the United States. That is a huge sea change that I think poses strategic questions for Netflix. They push back on this notion, but I think it's a big issue.
Well, Jason, just to build on what John is talking about, it seems like the excuse about Brazil is part of it, but really not the full story in terms of the reaction in the shares. It has to do with where the growth is going to come from. The growth so far has come from U.S. and Canada, which did beat, as well as Europe. But in Latin America and APAC, it missed some of the expectations. And it just raises a question. What's their growth strategy?
Well, I think it's going to have to come from pricing, and that's going to be easier to do in the United States than it is going to be in the rest of the world. They're also talking a lot about advertising being a big issue. That's also going to be much easier to do in the United States than it is in the rest of the world, just given the size of the ad market. And the third vector is gaming. The company's been working on gaming for a number of years, and they think it's going to be one of their major growth vectors.
How much do they need to do M&A in order to really gain in some of these areas, whether it's gaming or just in order to boost eyeballs and boost engagement enough to raise prices substantially?
I don't think that they need to do anything on the M&A front inside the traditional video ecosystem. There's a lot of talk about Warner Brothers potentially being for sale. I think that's very unlikely. In the video game space, I would say it's probably more likely. That is a very difficult business to enter into organically.
When you talk about their concern in terms of Netflix's biggest competition, you talk about YouTube. YouTube, you can get a free version of. How does Netflix compete with that?
Well, we're seeing a lot of fast services, the free ad-supported TV, other than YouTube, things like Tubi and others. Maybe there's a free version of Netflix, down the pike once they get this, ad tech stack stood up. Once they get aggregate demand, I wouldn't rule out a free ad-supported TV from Netflix either.
When could we see something like that? Are they actually in discussions about rolling something like that out?
No, not at all. But in the fullness of time, if the question is, how do they compete if this keeps going, that would be the logical response.
Jason, you also cover Warner Brothers, I believe. You mentioned the name, so let's talk about it. The previous strategy was pretty clear. The company wanted to split cable TV and then streaming and studios. Now they're open to a sale. Based on the conversations of the last 24 hours, are they looking to sell the company whole or looking to split off individual pieces?
Well, I guess my narrative would be when the original purported buyer was Comcast didn't want the linear cable nets that were declining. That's why Comcast is spinning off Versant. And so Warner Brothers was trying to, align themselves with Comcast narrative. I think when Paramount showed up into the mix and said, hey, potentially we'll buy the whole thing, that's going to put pressure under Comcast to see whether they want to buy the whole thing or let the asset go.
So, Jason, do you think the last 24 hours is the start of a period of flirting with other players to get the original buyer to come back to the table with a better price?
Well, I think Warner Brothers is just there to maximize shareholder value. I would say where we are in the process right now is someone's going to probably have to buy all of Warner Brothers, and then if they don't want the linear cable net, subsequently spin them out. But I think the likelihood of a split of Warner Brothers into two pieces is pretty unlikely at this point.
Jason, where are we in this process of sort of the disaggregation of media and now the reaggregation of media, where we can get basically the bundling that so many people have looked for? How far along in that process are we?
I think we're pretty far along. The way I describe it is, Netflix is the undisputed champ. Disney's sort of in the middle, and then you have these sort of three tier 3 streaming apps, which is Paramount, Peacock, and Max. And that's where we really need to see the consolidation among those three. The interesting dynamic, and this accrues to the benefit of Warner Brothers, is 3 is an odd number. So if we end up seeing 2 of those companies merge, someone's going to be left, holding the bag with really no cogent strategy for the future of video delivery, which is over the web.
And this raises a question also how we can view some of their earnings reports in terms of, are these utilities? Are these discretionary spending at this point? Can this give us a sense of how able consumers are to absorb price hikes? How much did you get the sense so far, based on what Netflix had to say, that the consumer is resilient, is buying, and is willing to keep spending and sort of ignore how high the bill is getting?
Well, I just go back. We at one point in this country, we had 85% of American households were paying $100 a month for video. We're nowhere near that point yet. So we're going to continue to see these apps go up. And so I'm not nervous about the resiliency of the consumer. I think the question is that we have sort of a lopsided landscape where you need to have enough content on your app to keep the churn down, to keep the consumer engaged. And as we sit here today, Netflix is the only one with the depth and diversity of content to do that, and the others don't have that.
They're just making it harder to cancel things. I was getting excited about cancelling Apple, and then what did they do? They got the rights to Formula One, didn't they? Of course, so now I can't get rid of that next year.
It was specifically for you. They're still trying to get you to upgrade.
They're out to get me. Jason, thank you, sir. Jason Bazinet of Citi. That kind of underlines the importance of sports content, though. That's what keeps this so sticky. These subscriptions just stay because people want to stick with the sports they love.
And it's the pay-to-view kind of aspect of this as well. I do wonder, though, what it means for the adoption for younger people. If they have to pay a lot in order to see the sports, whether they're going to subscribe to see every single baseball game. I'm serious. Like, I actually think this is actually a serious thing.
I don't think it's good for the sports.
I think it's actually pretty negative in terms of gathering younger people. So drop your prices so that people can be avid Mets fans.
We got a better deal in the 90s, didn't we?
We did.
It's got a much better deal in the 90s.
We still pay $100 a month for content. What is that?
And more.
Exactly. Yeah.
Horrendous. Up next on the programme, Phil Camporelli of JP Morgan Asset Management, the Virginia Governor, Glenn Youngkin, Jane Foley of Rabobank, and Russ Brownback of BlackRock from New York City. You're watching Bloomberg TV.
Going to see the balance of risk shift back a little bit towards the inflation.
There's definitely inflation hazard risk.
We don't really see inflation momentum moving back down to 2%.
That sets us up for an environment where inflation certainly won't go back to target, but it might even accelerate.
You still have a very resilient and robust economy.
This is Bloomberg Surveillance with Jonathan Farrow, Lisa Abramowitz, and Anne-Marie Hordern.
Live from New York City this morning. Good morning for our audience worldwide. The second hour of Bloomberg Surveillance starts right now, and your scores look like this. Equity futures on the S&P positive by 0.1% following 3 days without losses on the S&P 500 and very close to all-time highs. The main event of the pre-market, this name right here. Thank you, Brazil, or not. Netflix down by about 6.5%. The outlook in line, though, and I think that's where the disappointment lies for that stock this morning. This one was better. Capital One. And I think this plays into the broader credit story at the moment. Yes, there are flashy headlines. Yes, we should pay attention. But Capital One at 4%, I think, alleviates some concerns about broader credit problems.
Especially because Capital One is more highly leveraged to some of the consumer lending that would signify that there is still strength in the underlying consumer, even in cohorts like the auto lending sector, in the credit card sector. They just purchased Discover. A real question here, how you can see a downturn in the economy if you see this type of activity right now and the Fed is cutting rates in the near future. This, I think, is what a lot of people are getting their heads around, which is why yields are lower and stocks are up.
We saw it with the banks last week. The banks were just stellar, upside surprise after upside surprise, beat after beat, and we've seen it in the last week as well. Looking ahead to next week, things get even more interesting. The Fed's on deck, decision a week today. Tech earnings, the big players kick off a week today. And a week away, we're going to have a conversation between the US and China at the very top level. The President of the United States should be sitting down with the Chinese leader. Might change.
Exactly. Should is the operative word. The president yesterday basically said both things. One, they think they're going to get a good deal, and he wants to see a good deal with China, but China needs to be fair. This is his words. And at the same time, he said, well, there's a chance the meeting won't happen, giving himself maximum flexibility, or maybe giving his Treasury Secretary maximum flexibility, as Scott Bessent will be going into this meeting really deciding on what these two countries could agree if it comes to the leader level. I think most people are expecting, at bare minimum, this is a punt down the road. You at least get an extension of where tariff levels there are right now. Maybe China loosens up some of the restrictions on rare earths, but this is all going to bleed into 2026.
Is there a price to pay for all this uncertainty? Are we starting to see pockets of that come to the surface?
You're talking about Mattel in particular, the idea that they came out. How much is it an excuse, though? Well, the reason why deliveries were a little bit low is because China, and we're not sure what we're going to do with the holiday shopping season. Look, there's got to be some truth to that in the sense that how much do you order toys that could be more expensive when you could redirect to domestically produced toys that aren't going to necessarily have the uncertainty of some sort of tariff extra cost. At the same time, it highlights how quickly the market is to punish any company that even raises the specter of tariff-related disruptions.
That name is getting punished. Mattel is down by more than 6%. 6% in the pre-market. Broader equities doing okay, just about positive on the S&P 500. Coming up this hour, we'll catch up with Phil Camporelli of JP Morgan, with investors looking to extend a record-breaking rally. Virginia Governor Glenn Youngkin, as President Trump pledges to revive American manufacturing, and Jane Foley of Rabobank on gold following a steep sell-off. We begin this hour with stocks holding near record highs, driven by strong earnings. Phil Camporelli of JP Morgan writing the following: earnings are off to a great start. We continue to expect heavy lifting from the Mag 7, driving 42% of earnings growth. Phil joins us now for more. Phil, good morning.
Good morning. How are you?
You said it a few times through the summer. I'm good, and it's good to see you, that we're moving from a period of uncertainty to certainty.
Right.
Has that story played out now?
Yeah, we truly believe that on both sides of the 60-40, John. So as an asset allocator, when am I ever able to come in late in the year, in the fourth quarter, and tell you that a globally diversified portfolio is up about 15 and the S&P is up about 15. Obviously, much less volatility on the asset allocation side. So both sides, again, certainty. One of the certainties here. The first one is my mark-to-market is 4.1% on the Federal Reserve on the 10-year Treasury rate. That's where it was on September 17th when they cut rates. And this morning it's at 3.95. Mark that as a win, because last year, oh my goodness, Fed cut by 100 bips. Everybody thought they were easing into a no recession, environment, go long stocks. And then in December, a bunch of coal was dropped in everybody's stocking because the 10-year note shot up. So the things that I'm looking at this year, John, particularly around the certainty is easing really easing financial conditions? And the only financial condition that matters to me is the 10-year Treasury rate, because of how much sentiment that drives around things like mortgage and bonds.
So let's sit on that. I think it's really important. So you compared this story now and how it's playing out to what happened last year.
Yeah.
Again, I would say there are similarities. People think the Fed is cutting into an acceleration next year. That's what the equity market is priced for. The only difference is yields have dropped. They're not spiked. Right. And I think the conversation we've got to have is why are bond yields lower into potentially a hot inflation print on Friday and into another rate cut a week today?
Yeah, so I think growth is slower, right, in general. So last year, John, we were growing at about 3% in GDP. This year, about 2%. Into next year, about 2%. So that particular period, that particular kind of boost or just kind of thrust in the U.S. economy isn't as strong as where we were last year. And then I also think owner's equivalent rent is a big deal here within CPI. So goods prices, sure. Mattel could talk about, their spiking prices on goods. But that owner's equivalent rent story that makes up roughly 60% of CPI continues a trend lower. And that is something that I think, goes into next year. And it's not just inflation. It's inflation plus growth. So nominal growth drives earnings. So we have a double-digit earnings forecast for next year. PEs can go sideways. You can get the double-digit earnings growth, and that could lead to double-digit returns on the S&P. So if you have about a 2% GDP story and a 2.5% to 3% inflation story, that's 4.5% to 5% nominal growth, which should be pretty good for taking risk.
The only thing that you said in there that some people might disagree with is that this is a soft economy. How can you say this is a soft economy with the blockbuster earnings that we have seen after one company after another, including in many retail sectors?
Yeah, so it's, again, I want to characterize that as we were going to 3 last year, 2 this year. So the 2% into next year is still above trend. So I wouldn't characterize that as soft, Lisa. I would just consider that as, characterize that as steady, resilient, consumer-driven growth. And I don't think that the multiple story should expand. I think it's more the earnings story, as you said, and the earnings look really good. I love the financial sector. People love to talk about tech. And you mentioned with Capital One, the financial story. Hearing CEOs like Goldman CEO talking about, okay, we now know what this environment is. Deal making, we think, can continue. You realize that deal making coming into this year, so M&A as a percent of GDP was the lowest since the dot-com era coming into this year. So now I think you have, kind of an administration that's going to say yes, but also going back to the story around rates. I think you have certainty on the rate story. If the older and wiser sage of the VIX, which is the MOVE index, is saying that this is the lowest rate volatility since 2021, I think CEOs realize that and can move forward to capital market activity.
Not to be overly cynical, but let's just say somebody wanted to buy banks at a better valuation, and they say, ooh, credit worries, and all of a sudden those stocks tank. Are you on the other side of that, just buying them up as quickly as you possibly can?
Yeah, so apparently there were cockroaches crawling around.
Who said that? Who said that?
We have a big, beautiful building, and there are no cockroaches, trust me.
And you're buying the cockroaches.
Exactly. So we saw those headlines last week. And I think when you have things like high yield spreads, Lisa, trading inside of 300, that's a lot of good news priced in, right? So if you have this event, I call it event risk, not fundamental risk. So if you have this event or headline risk hitting, yeah, I mean, you're gonna release some of that pressure in high yield spreads because they're trading so tight. But we would be buyers, right, on that backup because it's not fundamental risk. Think about Silicon Valley. Silicon Valley in March of 2023, most people were saying we're in a recession already. Right? And then you go to even August of last year, the Japanese yen carry trade, early August, SOM rule triggered, Federal Reserve wants to cut rates, fundamental or recession risk was elevated. That is very different than this time. I don't think that we have only a 20% probability of recession over the next 12 months. Nobody's really talking about recession. We have a fiscal policy hitting in January. So at least you add all that up, we would be buyers on backups of financials because we consider this more headline risk than fundamental risk.
But are you on high alert? That's how Capital One put it.
High alert is not how we would put it. No, I think a trademark of this cycle, Anne-Marie, has been the corporate balance sheet health and consumer balance sheet health. And, those are slow-moving signals. I mean, the consumer is paying 4.1% on their mortgage right now. The kind of wall of worry or the wall of maturity on credit really hits in a couple of years, not this year or next. So we are not on high alert when it comes to credit spread.
You say uncertainty is moving to certainty.
Yeah.
How exactly? The two biggest economies might sit down. The president go waivers almost back and forth every single day. We're in the middle of a government shutdown. What is so certain right now?
Yeah. So what matters to us was the fear of tariffs from earlier in the year that would raise probability of recession and or prevent the Federal Reserve from cutting rates. So now we have the certainty of we only have a 20% probability of recession. Federal Reserve is engaged in an easing policy. Anne-Marie, I don't know what's going to happen in 2026.
Well, what if we have a 155% tariff on China? Does that not lead to a recession?
That could change the calculus, Anne-Marie, for sure. So, but with the information that we know now, we are not penciling that in. And also, emerging markets are not pricing that in. So emerging markets are the number one performing asset class right now, year to date.
Phil, appreciate it.
Good
Thank
to
you,
see you
sir.
guys.
Always constructive and optimistic. We appreciate it. Thank you, sir. Phil Camporetti there of JP Morgan. Equity futures slightly negative, just rolling over, just a touch. We're down by almost 1/10%. With an update on stories worldwide with your Bloomberg brief, here's Yahira. Hey, Yahira.
Hi, John. President Donald Trump says the upcoming meeting with Chinese President Xi would yield a good deal on trade. Still, Trump said the possibility remains that the meeting could fail to materialize. Treasury Secretary Scott Bessent is expected to meet with his Chinese counterparts to discuss the de-escalation of trade tensions later this week, ahead of the Trump-Xi talks. Meanwhile, President Trump is demanding the Justice Department pay him about $230 million in compensation for the federal investigations into him. The Times reported earlier that Trump alleged these were a violation of his rights. Any settlement might ultimately be approved by senior Justice Department officials who were once defense lawyers for the president. And AI firm Anthropic is in talks with Google for a massive cloud computing deal, potentially valued in the high tens of billions of dollars. The deal would provide Anthropic access to Google's powerful tensor processing units to accelerate its machine learning development. Both companies have declined to comment, with talks still in the early stages. That's your Bloomberg Brief. John?
Hey, Yahira, thank you. Appreciate it. More from Yahira in about 30 minutes' time. Up next on the program, Make America Manufacture Again.
We have record business. We're going to be, I think, by the time I hit month number 12, I think we're going to have $20 trillion of investment.
Up next on the program, the Virginia governor, Glenn Youngkin, joined us from New York City this morning. Good morning. The build-up into next week continues. A week today, a Federal Reserve decision in the afternoon, and after the close, we'll get numbers from the likes of Microsoft, Meta, Alphabet, the big players that make up a big chunk of this equity market. Equity futures just about unchanged this morning on the S&P 500. Very, very close to all-time highs on the S&P. On the Nasdaq, down by around about 0.2%. Mid-October, a lot still to play for into month end.
Yeah, and this is the reason why people maybe are taking some chips off the table, are trying to figure out exactly how to de-risk. But every earnings report has just reconfirmed this idea. Nothing's going that wrong. So if you want to find pockets of stress, you're not really finding it from the AI space. You're not really finding it from the consumer space. What are you going to worry about now?
That's the earnings so far. You can worry about China, I guess. The US and China sitting down, the President of the United States alongside the leader of the Chinese economy. And Anne-Marie, the negotiating doesn't start next week. It's already started. You see it play out in public. Every time the president speaks, he's negotiating.
And every time you get some sort of statement from the Chinese Commerce Ministry, most recently in the past 2 weeks regarding rare earths and the fact that they are making it harder to have rare earths being exported out of China. And that's really what started the hot rhetoric between these two economies. Also, the fact that China's not buying any soybeans. Now, that is a huge issue for the president domestically when he sits down with Xi Jinping. We think he sits down with Xi Jinping.
I think a lot of people hope. Let's talk about trade and domestic manufacturing. Under surveillance this morning, Make America Manufacture Again.
We have record business. We're going to be, I think, by the time I hit month number 12, I think we're going to have $20 trillion of investment. A lot of it's because of tariffs, because they're coming in because they don't want to pay tariffs. In other words, they make their product in a certain country and they used to just send it in here and there was no charge. Absolutely. Now, if they have to pay a tariff, they say, well, it's better if I build my plant in the United States.
So here's the latest this morning. President Trump reiterating his pledge to revive American manufacturing. The Commonwealth of Virginia securing $13 billion in new domestic investments between July and October of this year alone. I'm very pleased to say that joining the program now is the Republican Governor, Glenn Youngkin of Virginia. He joins us now for more. Governor, welcome to the program, sir. Always good to catch up with you.
Yeah, good morning, Jonathan. And it has been a very, very busy few months for us as we have welcomed a lot of manufacturing into Virginia, particularly from the pharmaceutical sector. And I think it demonstrates that we're leading not just in Virginia, but in America in reshoring this critical supply chain.
So, Governor, there's certainly a consensus we need to do more of that, produce more, manufacture more domestically here in the United States. Can you share with us what you've done in Virginia to attract more of that investment from overseas and bring it back home, and perhaps use Merck as a good example of that?
Yeah, we identified 3 years ago that pharmaceutical manufacturing had to come back to the United States. It's a national security imperative where all of the active pharmaceutical ingredients were being manufactured overseas, and a lot of them in China, and we needed to bring it back. But on top of that, we saw big investments coming from the pharmaceutical manufacturers, and so we prepared a great workforce development program. We lessened all of our regulations. We've cut almost 30% of our regulations in Virginia. And then finally, we made sure that we had sites ready for them. We're a business-friendly state ready to go. And then we went and recruited them. And you combine that with President Trump's strong push against the pharmaceutical industry to bring manufacturing to America. And we've just seen a huge drive of reshoring and investment. And yes, it's been $13 billion. Merck was our latest big announcement this week with a $3 billion facility to set up their active pharmaceutical and small molecule manufacturing center of excellence here in Virginia. They're gonna hire 500 people direct, and there's going to be thousands of indirect jobs plus construction jobs. And it's just another big step of bringing manufacturing home. I like to say made in America means made in Virginia.
Governor, we've also seen a lot of tech companies invest in Virginia. There's a lot of data centers in Northern Virginia. We've also seen, though, the cost of electricity prices go up. How are you balancing the two?
Well, we first start with an imperative to have an all-of-the-above, all-American energy plan. And that means that, yeah, we have to embrace natural gas and nuclear and, yes, of course, the renewables that we already have. But we've got to build a lot more power on top of that, because Virginia is the data center capital of the world and we're seeing investment all over the state now. We also are driving bring your own power initiatives. And so power goes behind the meter. That actually keeps ratepayers whole so they don't get charged with a disproportionate amount of the cost of the infrastructure build necessary to support the data center industry. And again, this is a national security imperative that we're so pleased is happening in Virginia. You know, since I became governor, we've had $140 billion of commitments from businesses to expand here or come here, and that's manufacturing and distribution and research and development. And I think it just goes to show that when you create a business-friendly environment, we're a right-to-work state, we have deregulated, we have made sure we have the best workforce in the country, businesses will come and invest, and that creates opportunity for not just Virginians, but I think to supply in all of these critical needs that once were manufactured overseas, then they're all coming home.
You talk about an all of energy approach. The Trump administration has canceled federal funding for things like offshore wind and some renewable projects. Has that become a problem for you as you are dealing with higher electricity prices?
Well, it hasn't for us in Virginia. We, of course, have been really pushing to build new natural gas plants, and we hope to lead the nation in the development of small modular reactors, and we do have wind and solar projects underway. The reality is the previous Democrat administration in Virginia so underestimated the growth prospects of Virginia that we're behind, and that's why we're massively building in order to catch back up. On top of that, I do believe it's one of the great challenges for our nation, and that's why President Trump's initiative for energy dominance has to be a top imperative, because we're finding that, yes, when we're building data centers and advanced manufacturing and, of course, electrifying just about everything, power demand goes up substantially. We've seen China developing gas plants, nuclear plants like crazy, and we're behind. And so we have to build in America, and we need to do that fast so that we can not just catch up, but we can supply all of the reshoring of American manufacturing that is going to secure our future.
Governor, you really are at the vanguard in Virginia of a lot of trends around the nation, particularly when it comes to the labor market. You are bringing jobs back. You also have a heavy investment from the likes of Amazon, which just is supposedly on the way to replacing a lot of roles with robots. And I'm just wondering what role you see in terms of job training to try to adapt to a rapidly shifting backdrop in terms of technology.
Yeah, we have been out in front here because, of course, artificial intelligence particularly is now part of every aspect of the business supply chain. Of course, from design and engineering all the way through to manufacturing, marketing, everything is being fundamentally changed. And so we initiated in partnership with Google 10,000 AI credentials that allow folks free to come in and build their capabilities. And I think as we see technology rapidly transforming the way we do business, we have to rapidly transform the way we prepare our workforce to thrive in that environment. Listen, we got a lot of jobs in Virginia. We have 277,000 more people working today than when we started, 220,000 open and available jobs, and the $140 billion of capital investment underpins another 85,000 jobs and nearly 40,000 construction jobs. So we've got a lot of work to do here to prepare a workforce to take advantage of that opportunity. And I think making sure that workforce is AI ready is really important. And that's why we've been way out in front to make sure that that workforce is prepared for it.
Governor, I remember talking to you when you used to be at Carlisle, and you've had this incredible dual hat where you've been investing on one side in infrastructure, and then you are responsible for helping to plan and bring jobs in. I'm just wondering, does it concern you, some of the private investments that we've seen in some of the infrastructure spending and some of the speculation that maybe things could be getting a little bit frothy in that space?
Listen, the big difference that we're seeing now is the capital investments, particularly around data centers and AI and machine learning, are tied to business commitments in order to drive forward this transformation. And therefore, it needs to get invested behind. We need to see the power investment. And we're competing against China day in and day out. Listen, this is a race. We need to make sure that we have the appropriate stopgaps, and just in case that the application of AI begins to overwhelm the interface between humans and decisions. And my artificial intelligence executive order that I wrote last year said that we are going to incorporate artificial intelligence in what we're doing in government, but we're also going to make sure that we have people between advice and decisions. And I think that's one of our big steps. But with regards to the investment that we are seeing, I firmly believe that this investment will grow great capabilities, and those capabilities will be put to work. And that's why it's so important that we win the artificial intelligence race and not allow China to win it.
Governor Youngkin, just quickly, have you spoken to the Trump administration, Speaker Johnson, Leader Thune, about reopening the government? Because your constituents, hundreds of thousands of them, are not getting paid right now.
Yeah, the Schumer shutdown is such a tragedy because they're holding America and Virginia hostage at a time when they need to be doing their jobs, which is, of course, funding government. The Schumer Democrats voted in support of a clean CR 13 times during the Biden administration. There's a clean CR sitting on their desks, and they just need to vote and open up the government. I will tell you, we're starting to see some real pressures. I applaud the Trump administration for making sure that the military and law enforcement are getting paid. I know they're working hard to try to lessen the pain on the American people, but at the end of the day, we're starting to worry about SNAP benefits next month. And to say that the Schumer shutdown is going to hold hostage Americans who need support for food insecurity is absolutely crazy. And so we need to tell all the Senate Democrats, just go in, open up the government, and let's get going.
The opening about 2 hours away. Equity futures on the S&P 500 just a little bit softer. We're down on the Nasdaq 100 by 0.2%. The small caps negative by 0.4. The Russell just a little bit lighter so far this morning. As we count you down to the opening bell, let's get you some morning movers and cross over to Danny Berger for more. Hey, Danny.
Hey, John. Here perhaps is the reason for Nasdaq underperformance. It is Netflix down sharply in the pre-market. They reported earnings after the bell yesterday. For one, they had a tax charge related to Brazil that was over $600 million. So that was a black mark on their earnings. They did beat expectations in some areas, but maybe the expectation was even higher. The whisper number was maybe even higher considering they had hits like K-pop Demon Hunter. They had a live boxing match that was really popular. So shares off 7% this morning. Of course, their name continues to swirl around a Warner Brothers Discovery potential deal. We also had some earnings this morning to work through in the past hour. We heard from AT&T, those shares up 1.33%, beating
price
on
more
those
aggressively, or whether they are beginning to worry about their jobs a little bit more. I suspect it's a combination of both.
Where are you seeing this in particular? And I say this as we were looking at airline earnings, for example, and a lot of people are shelling out for those premium cabins.
They shell out for the premium cabins, but those premium cabins cost more. And so they're actually seeing their lifestyle requires a much more expensive payment structure now. And so then they have to give in other areas. And so what we're actually seeing is when you look at spending, for example, goods versus services, people are beginning to actually cut back on spending on services. And those are the things that you never cut back on. And so typically, if you're not buying a cup of coffee in the morning, you're not going to go out and buy a car in the afternoon. It just takes a little while for that to catch up across the income spectrum. And what we're beginning to see now is that upper income tier is beginning to feel pressure. They can still keep spending, but the pressure builds, and it means probably that you'll see the savings rate begin to decline, even though it probably should be rising based on where interest rates are.
And maybe we'll get a holistic look at this when we get retail sales. Oh, wait, we don't have any data coming out of the government. There is this feeling right now. You need to parse through the earnings to get a better sense of it. Has there been anything in the earnings so far that has ratified the view you have, or are there a couple of earnings reports that you're really keyed into to give you the ultimate sense of whether this really is the reality? This weakening in even the upper echelons of income earners.
I mean, to be frank, no. But I mean, that's why I get to do what I do, is because I have to make decisions based on kind of the limited amount of information that I have. What we are paying very close attention to are Federal Reserve surveys. You have to pay attention to the Beige Book. You have to pay attention to the earnings reports. But even the earnings reports can see people transiting from one kind of product to another, right? From beef to chicken, or from, who knows what people like anymore. I don't understand actually what people. I am not the average consumer, and I am readily willing to admit it. And my tastes are not everyone's tastes, so it's hard to kind of figure out which direction everyone's heading. But I do know that people are shifting from what they're used to doing, and when people are shifting from what they're used to doing, that's happening because of a reason, and that reason typically isn't good. People are creatures of habit. They like to do what they did yesterday.
If the high-end consumer is under pressure, what kind of economy are you describing? Because everyone continuously says we're in a K-shaped economy, but what you're describing does not sound like a K-shaped economy.
So when you do economics for long enough, what you realize is the top 10% spends no matter what. The bottom 10% spends no matter what. And there's the cohort in the middle is actually the one that moves around their spending because they've got some potential for savings. And so you really have to watch the movement into and out of the savings rate and whether or not people are feeling like they can spend money. Now, it gets complicated when inflation's present because oftentimes the way people make up for the increase in prices, at least initially, is by cutting back on their savings rate, even if they were feeling a lot of pressure or worries about their job. And so things begin to break down, those relationships begin to break down. And so, all the people using, AI to model the economy right now, it's the big new thing. Those models are incredibly complicated. And what you're going to see is that the coefficients on the front of each variable that you can use are probably shifting around and they might be canceling each other out. And so your whole model might be breaking down and you're probably not going to recognize it if you're using models that are too advanced rather than looking at individual components of what's happening and the relationships between, for example, savings and interest rates.
What are you most looking at this week, next week, when it comes to earnings season to really understand how much that high-end consumer is under pressure?
Well, as I said, it's difficult for us to kind of look at an individual company and figure out what's going on. Upper income consumers are going to continue to spend on things like airfare. They're going to continue to go on vacation. The question is, are they going on vacation and instead of going to Europe, they're going to California? Or instead of going to, they're taking the slightly less expensive option. There are everyone's got a lifestyle and certain things are downgrades for certain people. And it's easy for us to all kind of laugh about it. But for these people, it's actually a serious change in their lifestyle. And it affects their perception of what it means to be rich, for example. What's it mean to be rich when you actually have to think about the airfare? Right? These are people who are not used to thinking about how much they spend on airfare. They're not used to thinking about, gee, I really like that hotel. It's in the center of the city and it's my favorite hotel because they have a favorite hotel in Europe, right? And now they're thinking, well, I can't afford my favorite hotel in Europe. I have to downgrade. It actually comes with a social cost. You don't have to cry for these people. Their lives are still really good and probably better than a lot of people's. But, it doesn't mean that they feel as good as they used to.
Drew, banks aren't feeling as good as they used to after last week. Let's talk about the financials. Zion in the pre-market is up by 2.5%. It was the focal point of a lot of people last week, coming out and basically revealing some losses tied to potential fraud. This isn't the first time we've seen this kind of thing. We've seen some other credit issues as well. You've got the credit issues on the one side and then really robust earnings on the other side. And we saw that from Zion overnight. How are you and what is your perspective on what is happening right now in this sector? Well, so people are nervous. If you look at credit markets, spreads are incredibly tight. So you're in this weird world where all-in yields are okay. Right, the amount you can get paid for is okay, but the actual premium you're getting paid to take risk is actually maybe a little too low. And so I think what you're seeing is just the nervousness around the economy, that we don't really understand that everything's okay. We're waiting for that next shoe to drop. Jamie Dimon, put it famously. What he's really expressing is not that he sees anything, but that he's expecting something. It's kind of like you live in an apartment in New York City, and you might never see a roach, but they're there. They're in the walls. You know it, right? And so you don't leave food out. You do a whole bunch of different things when you live in New York. There's things that you can do in suburban New Jersey where I live that are okay because you're not going to attract animals that quickly. But if you do it in New York City, you're basically stunk. And I think the risk is that people are really focused on
what they're not seeing. And the fact of the matter is with no economic data and with, earnings kind of, being okay for the most part, they're nervous that they're missing something, but they don't know what they're missing.
So, Drew, where are we? Are we in a grad house on Murray Hill, infested with cockroaches? Or are we in a nice Soho apartment? What is this?
We might be trading down from a Soho apartment to something on the Upper East Side.
Okay. Does that mean you're de-risking?
We've been de-risked for a while now. I mean, to be honest with you, since COVID, there's been kind of one risk after another. And, to the extent that we've been able to kind of go up in credit, we've been going up in credit. I don't think that's a surprise to anyone. And I think, everyone who's able to has been doing that. Or you've been looking to things like privates where you're taking maybe more liquidity risk, which you can more easily define, but getting less credit risk on most sides of it if you're doing your underwriting properly.
Drew, good to see you. This was a trip. Thanks. Thank you, sir. Drew Mattis there of MetLife. Equity futures this morning doing okay, just pulling back from close to all-time highs on the S&P 500, negative by close to 0.1% with an update on stories worldwide this morning with your Bloomberg Brief. Here's Lizzie Burden. Hey, Lizzie.
Hey, John. President Donald Trump signed an agreement with Australian Prime Minister Anthony Albanese to boost access to critical minerals and rare earths. The deal is part of efforts to secure stable supply of critical minerals, with Australia positioning itself as a viable alternative to China. Elsewhere, Sanai Takaichi won the parliamentary vote to become Japan's first female prime minister. Takaichi has appointed a cabinet, including the country's first female finance minister. She's now preparing for diplomatic events, including a visit to Japan by US President Donald Trump next week. And Amazon Web Services says that operations are back to normal after a widespread outage that hit a broad spectrum of customers for around 15 hours. The episode disrupted hundreds of websites and apps, including the likes of Venmo, Robinhood and Apple TV. The outage was caused by a database network issue and highlights just how much of the internet is dependent on the operations of the company. And that's your Bloomberg Brief. John.
Hey, Lizzie, thank you. More from Lizzie in about 30 minutes' time. I'm next on the programme, expecting a fair deal.
I expect we'll probably work out a very fair deal with President Xi of China. I want them to do great. I want them to thrive. But we have to thrive together. It's a two-way street.
In just a moment, we'll catch up with the former White House trade official Kate Kalukowicz from New York City this morning. Good morning.
Around the late 70s, Vietnam was actually the poorest country in the world by GDP per capita. See where it is right now.
New Vietnam is all about youthful energy, it's about reinvention, and it's about determination.
The private sector is going to be the key driver. There will be a lot of startups come into the market to seek for new funding.
The best thing is to feel it and see it.
Live from New York City this morning. Good morning. Check out this stock in the pre-market. Zions Bancorp positive by 2.5%. A notable credit loss just last week. Good earnings delivered after the close yesterday. That's been a story more broadly for the sector. These flashy headlines around credit, but ultimately the earnings story's been okay. That stock at 53.31. Thursday's close, following all that mess, 46.93. We've rallied since then. Friday, Monday, and again so far this morning. The broader market this morning looks like this. Equity futures on the S&P 500 pulling back from yesterday's gains. We're down by not even 0.1% after closing very, very close to all-time highs. Under surveillance this morning, expecting a fair deal.
If they don't do business with us, I think China's in big trouble, I'll be honest with you. I don't know that they even make it. I really do. I believe that they're in big trouble, and I don't want them to be in big trouble. I want them to do great. I want them to thrive. But we have to thrive together. It's a two-way street. I expect we'll probably work out a very fair deal with President Xi of China. So most of you will be with us. It's going to be very exciting. And I think we're going to work out something that's good for both countries.
So here's the latest this morning. President Trump optimistic about reaching a trade deal with China, but maintaining he'll hike tariffs if a deal isn't reached by the November deadline. Joining us now is Bloomberg's Tyler Kendall. Tyler, good morning. We heard that word fair. What's a fair deal with China?
Yeah, hey, John, good morning. Well, it could look like a few different things. We know that the U.S. wants to see China in particular drop those export curbs that it unveiled on critical and rare earth minerals, which is why that November 1st date is so interesting when you hear President Trump reiterate his threat that higher levies could go into effect then, because November is also that timeline that Beijing has unveiled for its own enforcement actions when it comes to those export controls. We're going to have to wait and see what's going to ultimately be on the table here. We heard President Trump over the weekend outline those top demands when it comes to fentanyl, soybeans, but also worth mentioning that he did mention yesterday that he also expects Taiwan to now potentially come into these talks, though he did downplay the idea that there could be military conflict in the region and declined to say whether or not he felt that China was going to propose trade concessions in exchange for greater control of the island. We're going to be watching a few different things, but it's clear that this White House ahead of the meeting is bolstering up its position, particularly when it comes to rare earths. We know it was a key focus yesterday at the White House as the U.S. and Australia inked that $8.5 billion cooperation deal, largely seen as a way to bolster against China's grip on the critical mineral market. John, I'll also put on your radar that we got some pretty stark words from the USTR Jamieson Greer yesterday as well, threatening China, saying that it should not retaliate against any foreign companies looking to help the U.S. bolster its position in these critical industries, even beyond rare earths. The USTR threatening action after Beijing moved last week to sanction 5 U.S. units of a South Korean shipping giant amid this ongoing dispute when it comes to the maritime sector between the U.S. and Beijing. John, it's just another thread to pull on as we head into this critical meeting.
Some good cop, bad cop going into negotiations. Tyler, thank you. Building on this conversation, the former White House trade official, Kate Kalukowicz. Kate, welcome back to the programme. We've talked lots about the president's asks going into these conversations, these negotiations. What do we know about what China wants in return?
Well, I think China wants lower tariffs. You know, it seems that they have been dealing with the pressure of tariffs, but that pressure is increasing from other trading partners as well. China's economy is slowing. They're dependent on trade, and I think they are struggling a bit to find some leverage in these discussions, which is why they keep going to this familiar threat to restrict rare earths.
Besides tariff levels, what is the equivalent the U.S. can use that matches China's use of rare earths in the negotiation?
It's a really great question, and I think it's why we keep finding ourselves back in this position where the U.S. threatens tariffs, China threatens rare earth controls, and we end up with a deal that resets us back at the status quo. Both sides are struggling to find leverage outside of these two areas, and I think it's why we now see both of them, particularly the United States, moving to encourage our trading partners to join the fray. We need to bring a bit more pressure from outside because we're struggling to do it ourselves.
Kate, what about barring Chinese companies that are listed on U.S. stock exchanges? Is that a third rail that the U.S. could float out there in these negotiations?
You know, it could be. The United States is increasingly looking at these so-called entity lists, these ways in which they target U.S. companies and their affiliates. So certainly that would be one possible option for them to consider. What's happened, however, is that these actions are really bringing other companies from other countries into the fray. You heard the issue related to the South Korean shipping company. We have a Dutch semiconductor caught in the middle of this. This is creating a very uncomfortable position for companies around the world, but also their sovereign nations.
Meanwhile, there was this deal overnight between the United States and Australia to secure some rare earth minerals, and this idea that maybe the U.S. can source it from elsewhere. How does that fit in some of the discussions that are ongoing with China and the U.S.?
I think it's critically important. The United States, as I mentioned, is struggling a bit in these talks because the reality is we are heavily dependent on rare earths. So you all know how our car and defense and aerospace sectors cannot operate without the rare earths from China. So in the meantime, while President Trump continues to try to reset this status quo with China, he is also ensuring that this is not something that persists. He needs to find other sources of rare earths. The deal with Australia was a really important step forward in securing rare earths from a source other than China, but of course it will take time.
It feels like the administration and actually both sides are trying to buy time to insulate one another from some of the trade partnerships that they have ongoing. And I wonder how much Taiwan is increasingly going to be used as a chip in buying time. I mean, how much could you actually see the U.S. take a step back from protection of Taiwan or some other type of outreach to China, which is something that they would desire?
Well, I think you're exactly right that both sides are seeking to buy time. I think the United States, President Trump made those comments about Taiwan yesterday. That was the first time we've heard that really publicly entered back into this discussion. He's been quite clear, that he does not support any sort of military intervention into Taiwan, but I think he's going to try to dance around and not anger China. But remember, what else is important in bringing allies to our side is in South Asia Sea, and what the president is hoping to achieve with the new Japanese prime minister, I think will be very focused on Japan offering some support in the military arena.
Kate, if you're China, do you just want to wait and keep the status quo until the Supreme Court rules on whether or not IPA is legal or not?
Well, perhaps, although I don't think that's the wisest strategy. I mean, even if President Trump loses the Supreme Court decision, and that's not a guarantee, he has many other authorities to bring tariff pain on the Chinese. And not least of that, he has all of these export restrictions that he can continue to place. So IPA or not, the president certainly is not going to change his approach toward China. And I don't think the Supreme Court is going to be any sort of victory lap for the Chinese in the near term. Having worked under Trump 1.0, could you see a scenario where he does show up for oral arguments at the Supreme Court? Anything's possible. And when he says he's going to do something, it means he's really considering doing it. So it certainly would not be a shock to me if he shows up there.
Kate, appreciate your time as always. Kate Kalukowicz there, the former White House trade official, with the latest on these talks. Lots has been talked about what the president would like to see: soybeans, rare earths, all of those things. We all understand why. Ultimately, what do the Chinese want in return? Is it tariff relief? I think that's easy to give, given where tariffs are currently, super high. Or is it something else? Does it include an attitude, a shift towards Taiwan?
Potentially, and the president was clear that that would be part of the discussion, but then he stopped there. He didn't want to continue on actually what the United States would be willing maybe to discuss with China when it comes to Taiwan. When it comes to the tariff levels, though, if that's really what China wants, that's why the president continues that even though he says he thinks it's going to be a good deal, he always says, but we have the threat. We could bring it up north of 100% if we have to.
Can we just get some clarity on deadlines? November, it feels like there's two. November 10th, November 1. Which one's which?
November 10th is when the current truce, that 90-day rolling period we have where tariff levels are pretty much frozen back in Geneva in May that they agreed upon, the U.S. and Beijing. That's November 10th. That's the deadline. But they're going to meet before November 10th. So the market will have a lot to adjust, knowing whether or not an agreement was made or not. November 1st is what the president said he can bring the tariffs north of 100%. So he kind of puts two of the deadlines at loggerheads with each other and doesn't exactly make sense, but keep both in mind.
Mike Wilson of Morgan Stanley, Lisa, had this to say yesterday. It's important to see clearer trade de-escalation from both sides before declaring the all clear on the risk of a further near-term correction. This spat has once again become the story in this market over the last few weeks.
The story, though, has changed from, oh my gosh, this is going to be a decoupling that's going to lead to some sort of Armageddon in markets, to do we get a dip that we can buy and then profit on the other side? So that really has been the feeling, and that is a market shift from April 2nd.
The dips are small and they don't last long. Here's another one. We're down by not even 1/10% on the S&P 500 after closing very close to record highs in yesterday's session. Up next on the programme, we've got some earnings for you. The numbers from General Motors. This is a tough industry. Breaking down the figures in just a moment. Bloomberg's Craig Trudell. Plus, we'll catch up with you higher with your morning movers. Sunrun soaring on an upgrade from Citi. That stock is up by more than 7%. From New York City, you're watching Bloomberg TV.
As I reach a milestone in my life, I'm humbled by my good fortune, yet well aware that I still have much to learn. And if I stay true to myself and follow my instincts, my legacy will be looked on kindly by my friends, my family, and hopefully generations to come.
Two-day winning streak on the S&P 500, the best two-day rally since June. Equity futures this morning pulling back just a little bit. We're down 0.1% on the S&P, on the Nasdaq down by 0.12. For the regional banks, up 4% in just 2 sessions. The bounce continued through yesterday and continues through this morning. More on that in just a moment. On the Russell 2000, equity futures there negative by 0.24%. Let's get you some morning movers 3 hours away from the cash open. Here's Yahira. Hey, Yahira.
Hi, John. We start with Core Scientific. Those shares are rising nearly 3% in the pre-market after proxy advisor ISS said CoreWeave's $9 billion takeover offer undervalues the company. Now, the deal would help CoreWeave expand its AI computing capacity, but this new recommendation adds to a chorus of worries around the deal and injects fresh uncertainty since institutional investors typically follow the advice of ISS. Moving on to Zions. This, of course, was the bank at the center of last week's credit jitters. Shares are now up 2.5%. I know you all will discuss it. So just to check on shares, up again 2.5% after the lender topped profit and margin estimates, even after swallowing that $50 million hit from alleged loan loss. And we end on the residential solar company Sunrun. Shares are up 6.5% after Citi upgraded the stock to a buy and upped its price target to $26. The call comes as the solar sector tries to regain its footing under a Trump administration that has rolled back green incentives and made a renewed push for fossil fuels. John?
Yahira, thank you. Thanks for the update. More from Yahira in the next hour. On our radar this morning, credit fears easing on Wall Street following positive results from Zions. The company reporting third quarter results that topped estimates despite a $50 million loss from an alleged fraud. Elsewhere, President Donald Trump expecting to make a fair and great trade deal with China's Xi Jinping when the two meet in South Korea just next week. Trump warning new tariffs will go into effect. No agreement is reached by his November 1st deadline. Elsewhere, General Motors shares higher. Those numbers just dropped in moments ago. GM with a beat and a raise.
Pretty much across the board coming out with expectations for the full year adjusted earnings per share at the upper range from $9.75 to $10.50 from the high range of $10. Full year auto free cash flow above expectations. You can go through. It was a really clean read across the board. What's interesting is the tenor of this letter to shareholders. I also want to thank the president and his team for the important tariff updates they made on Friday, talking about making more than 2 million vehicles per year in the United States. A big discussion here, clearly in here, focused on the political backdrop and talking about how tariffs came in lower than expected and allowed them to more effectively mitigate any of the potential ramifications.
The automakers, or rather the lobbyists for the automakers, did their job and got a reprieve. Longer lag time, longer lead time in terms of how low the tariff could be for these imported parts. And you're seeing it right here. They're talking about full year gross tariff impact improved to $3.5 to $4.5 billion from $4 to $5 billion. Not a ton, but they are working on these mitigation efforts. On top of that, the CEO also talking about the evolving regulatory framework and the end of federal consumer incentives. Now clear that near-term EV adoption will be lower than planned. So they are dealing with a number of policy issues in Washington that are impacting their everyday decisions, whether it's EVs, tariffs, or fuel emissions.
Getting a bounce this morning in the pre-market. The stock is higher by 6%. Joining us now from London with more is Bloomberg's Craig Trudell. Craig, welcome to the program. How agile do these automakers need to be when they're getting whipsawed by political cycle after political cycle?
I mean, it's hard to sort of overstate, just how significant that whipsawing has been when you go from, from the Obama administration to Trump to Biden to Trump again. We've seen fuel economy regulations and emissions rules really sort of wax and wane to this really significant degree. And you saw, Mary Barr really sort of answer the call under the Biden administration, building an awful lot of battery supply in the U.S., building also, reworking assembly lines to make electric vehicles. a lot of that is now being undone, to the tune of, this quarter they're taking a $1.6 billion charge related to undoing some of that investment. And they've warned that there may be more to come there. On the other hand, all of that investment in electric vehicles and in batteries has been costing this company money. And they've gone from, prior sort of forecasting that they would lose less, but that's, that was still going to be a drag, to now they can do away with that. They can make more full-size SUVs and pickups that, all along have been what really sort of is their, money-making product. And, oh, by the way, they don't have to pay for, compliance costs to regulatory credit revenue that flows right to Tesla's, bottom line. So this is a significant amount of relief for them, even as they have real sort of headwinds from the tariff perspective.
Craig, it's worth pointing out Anne-Marie's done the same thing. There are positives and negatives for the auto industry. Just on the negatives, Craig, what's been the bigger challenge for this company? Has it been the tariffs or the issues and regulations around EVs?
I think, it's going to be, difficult for them to sell as many EVs as they expected. And yet, again, that may not be as big of a problem for them, at least in the near term. Longer term, that's a big question if this industry really goes electric outside of the U.S. and the U.S. becomes this sort of laggard market. I think in terms of the near term, far and away, the bigger issue is tariffs, and you're seeing Mary Barra sort of trying to mitigate that quickly by investing a heck of a lot in U.S. factories and trying to, sort of rework some of that capacity that had been dedicated to EVs to products like SUVs and pickups, and really banking on the ability that demand is going to be there, where the EV demand that everybody was hoping for didn't necessarily materialize.
Craig, on that tariff point, Anne-Marie was talking about this, that the company said that tariff mitigation actions are expected to offset about 35% of the costs due to a lower tariff base. Do we have a sense of what type of tariff mitigation actions they're taking? Is this a code for increasing prices? Is it code for laying people off?
I think, some of it is investment. I mean, just in the last few months, this company has announced $4 billion of investment in U.S. factories. And some of this is going to be incremental shifting of production from Mexico to the U.S. I think, that will cost the company some real, CapEx. And also, I think there's probably a fairly good likelihood of, the need to perhaps consider raising prices to take into account for the fact that production in the U.S. is going to be costlier for GM than making in Mexico. And yet there's also, I think, sort of an argument to be made that, maybe this is for the best for the company going forward, and that, even in an age after Trump, when you're thinking about, sort of the political risk of just how much, manufacturing has been hollowed out in the U.S. and the fact that Trump has proved this is good politics to sort of saber rattle over how much companies are making in America. Maybe it's for the best that GM sort of takes heed here and sort of undoes some of this offshoring that has been taking place over decades.
And we certainly saw that in Mary Barra's letter, where she's talking about $4 billion of investments in onshoring production plants in Tennessee, Kansas, and Michigan, talking about jobs created in New York. I'm just wondering, on the other side of the GM equation, the idea that this is an incredible company to look at because it both is at the crosshairs of a lot of domestic policy, but also can get a read on consumer demand. Do we have a sense of how much consumers are absorbing higher prices, are continuing to buy cars? Do we have a sense of how much that beat as well?
It's a great question because, on one hand, you do see really strong sales of high-end vehicles, particularly, I would say, the big SUVs that GM and Ford make. We're seeing, some of the strongest sales of bigger vehicles, like, say, the Chevy Tahoe, the Ford Expedition, than we've seen, in 20 years. And yet we're also, on the other hand, seeing, higher rates of delinquencies, signs of strain from a credit perspective. And so you do have to kind of wonder to what degree, we're seeing a bifurcation of sort of the best off consumers being able to afford going out and buying a new vehicle. And yet, under the surface is that incremental new car buyer now coming under greater strain than ever, now that we're coming off a month, by the way, which, the average price of a new vehicle sold in the U.S. just hit a record of more than $50,000 for the first time. That's a lot of money for a lot of consumers, and that's likely going to cost us, some incremental new vehicle sales where the consumer says, you know what, I'm just going to buy a lightly used vehicle instead.
Greg, when it comes to their policy out of Washington, what you hear from a lot of auto lobbyists were that at one point, given the president was striking all these deals with Asian companies, you can get a Japanese-made car at a lower tariff level than an American-made car. Given the latest reprieve some of the auto sector industry companies have gotten, are they now on par to compete globally?
It's really hard to answer that question. I think, to what degree, this is a bit of gamesmanship in Washington. You talked about the lobbyists really doing their job here. I think it is still the case that if you're a Toyota or a Honda, that, even if you've gotten some relief in terms of, the cars that you're continuing to import from Japan, I don't think anyone who's, sort of managing, operations for Toyota, Honda, or Nissan is feeling at all comfortable about any capacity that they're relying on from outside of the U.S. And so we're also seeing a lot of incremental investment on those companies to sort of go from any slack that they have in their U.S. Plants, filling that slack, addressing that with investment, localizing more production. And, to the degree that there's some relief being offered by this administration, it is still costing you more than it did, before Trump was in office to ship cars from Japan into the U.S. It's a question of how much sort of competitive dynamics are, wash out. It's really difficult to get to the bottom of, whether this is, good messaging on the part of GM and Ford in Washington as opposed to legitimately, it's you're better off shipping from Japan into the U.S.
Stock is up this morning in the pre-market by 6.5%. Just a final question, Craig. Slightly provocative one. But on EVs and the strategy on EVs from GM, this predates this presidency. And I think we have to bring that up. It's important to highlight. And here's the provocative question, Craig. Do you think in some ways the administration has done this company a favor to get them to focus on the one thing over the other when investors have been asking that question for a long time?
Yeah, I mean, I think it is a question of long term versus short term. I think in the short term, absolutely, this is going to be better off for the company in terms of investment that they're not going to have to make, spending that they've had to make in the past that they no longer will have to. The question will be for me is long term, if this is still the case that we are going to get to a place where electric vehicles are what dominates the global industry. Have we sort of benefited U.S. manufacturers for now, but sort of lost sight of the fact that for the long term, we've only made them, less competitive 10 years, 15 years from now?
Really important framing. Craig, thank you, sir. Appreciate it. Fantastic work. Craig Trudeau there of Bloomberg, out of London. Don't miss our conversation later on this morning. The GM CFO in just under 1 hour's time. We're going to catch up with him at 7:30. Paul Jacobson knows a lot about working in volatile industries in his time in the airline business over at Delta and now at a big automaker heavyweight, General Motors, and they have got to be super agile because things have been incredibly volatile.
Super agile and super political. I mean, you can see that for the letter to shareholders. It talks a lot about Washington, D.C. and investments in the United States. A key question, especially given the fact that they are in these crosshairs of changing policies, how they also face off with a consumer that seems to be somewhat, shifty or difficult to really pin down. And I'm curious about both of those things, policy and the consumer.
Shifty's like shady, right?
Okay,
I know
maybe,
what you meant.
yeah, okay, baby, just I don't know, K-shaped, U-shaped, Y-shaped.
Just throw out a letter.
X.
You know how this works on Wall Street.
That's kind of what we were doing this morning.
Basically. Odd start to the programme today. General Motors up by 6.5% in the pre-market. Decent numbers from that company. Let's get you an update on stories worldwide with your Bloomberg Brief. Here's Lizzie Burden. Hey, Lizzie.
Hey, John. Shares of GE Aerospace higher after the company raised its full-year outlook for the second quarter in a row, thanks to the strong rebound in global air travel. The jet engine manufacturer boosted its forecast for revenue growth, operating profit and free cash flow. GE Aerospace shares have soared more than 80% this year, driven by rising demand for maintenance and new engines. And as you were discussing, shares of GM soaring after the automaker raised its full-year outlook and posted third-quarter results that topped analyst expectations on better-than-expected pickup truck sales and fresh relief from the Trump administration's tariffs on auto parts. GM will also be reducing its EV investment. In a letter to shareholders, the CEO, Mary Barra, says it is now clear that near-term EV adoption will be lower than planned. And Apple shares hit their first record this year after Loop Capital upgraded the stock to buy from hold, citing positive iPhone demand trends. Shares rose about 4%, surpassing an all-time high that had stood since December. Apple now closing in on a $4 trillion market cap. And that should be brief, John.
Lizzie, thank you. More from Lizzie in about 30 minutes' time. This from Loop Capital's Ananda Buraha, saying we are now at the front end of Apple's long-anticipated adoption cycle. Dan Ives of Wedbush has been waiting for this one for a long time.
iPhone 17, have you gotten it?
Getting closer.
Really? Well,
Getting
this
closer.
is, I mean, listen, this is the indicator. I checked out something in his phone yesterday and I was like, it's cooked. You got to get a phone.
Yeah, it wasn't working properly yesterday, was it? I know. All right. Up next on the programme, the Fed's easing regime.
Right now, they're almost getting a little bit of a free pass on this October meeting because both are in good shape, consumer spending and corporate credit. But this will help, I think, lower rates would help prevent maybe that next shoe to drop in terms of weakness.
That conversation up next with Earl Davis of BMO, live from New York City. You're watching Bloomberg TV. GM this morning in the pre-market higher by 8%. Really, really decent numbers from that company this morning. A beat and a raise, even though they've been whipsawed all year. We've talked about mitigation strategies. Seems like something's working over at General Motors.
Yeah, and you can see that actually rebound into Ford shares also up, not as much, but you can see there's a positive tone that maybe the costs aren't as great, the mitigation tactics are effective, and the consumers are still buying cars. And that actually is the key kind of aspect of all of this.
The CFO, Paul Jacobson, joining the programme a little bit later this morning, 40 minutes from now. For the broader market, welcome to the programme. Pretty snoozy so far. Unchanged on the S&P 500, negative by only 0.1% on the Nasdaq. Under surveillance this morning, the Fed's easing regime.
Ultimately, they are telegraphing that they're expecting to be lower over the next few quarters. Right now, they're almost getting a little bit of a free pass on this October meeting because it's going to be more cockroaches, right? There is going to be more credit stress. Both are in good shape, consumer spending and corporate credit. But this will help, I think, lower rates would help prevent maybe that next shoe to drop in terms of weakness.
So here's the latest this morning. Traders locking in bets. The Fed continues its easing cycle at next week's rate decision. Earl Davis of BMO seeing an increasing chance of a 50 basis point rate cut in December, saying the opaqueness and lack of transparency in private credit could be used to accelerate eases. Earl joins us now for more. Earl, welcome to the programme, buddy. So let's skip October. That's done, dusted. What's on the table for December?
Well, December, our base case is still 25 basis points. We just see the chance of a 50 has increased dramatically. And the reason why it's increased dramatically is because we've moved our possible terminal rate. We saw a terminal around 3%, slightly higher than the market, to 250. And the reason why we see it, we've lowered it so dramatically is because of, your Tricolor, your True Rand, basically private credit in general. We believe that the private credit, where the opaqueness comes in from and the ownership of it, it's usually real money, pension plans and like. So it's going to be a slow seeping credit move wider, like things wider. So it's binary whether they go 50, but we see an increasing chance of 50 in December.
Do you believe then, based on the credit risk that you described, do you think it could lead to a broader tightening of financial conditions?
Temporarily, yes, we do believe it can. We don't believe it's systemic. And the reason why we don't believe it's systemic is, as I said, most of the holders of private credit are real money. So they could take the losses. Liabilities, they still have the liabilities to deal with. So it does have an impact on the economy, but they could take the losses. Having said that, why we see it as a possible increasing chance of 50 is they basically took the safety off the gun of 50 eases. And the thing about 50s is central banks just don't do 150. Otherwise, they wouldn't do it. So that's why we lowered our expectation for terminal to 250 by the end of 2026.
So I hate talking about cockroaches this early in the morning, but there is sort of this irony that the reason why there are these fears of credit problems is because of the prolific Fed policy that has enabled this, and the fact that monetary conditions used to be a lot lower to allow a lot of credit creation that may have overlooked a number of different underwriting standards. I'm just wondering if there's a bit of moral hazard here. The idea that the economy isn't cracking and that the Fed could respond to concerns in credit that were done in pretty easy financing conditions.
Yeah, no, we do believe, I don't know if I'd use the word moral hazard, but there's definitely inflation hazard risk because, it hasn't, our growth, despite what's going on in credit, our growth expectations have not changed for 2026. And it's because, big, beautiful bill, everything people are hearing. We think it's very supportive of growth, and growth will still be good. So then you're going to be in a very easy financial conditions market. And we think there's a big risk for inflation, but the market's not focused on that. We're not focused on that right now. We think that's a late 2026 story. One of the interesting things about inflation, though, we do get a print Friday. And if we do get a higher than expected print, the market, credit will widen, duration will go higher. We think that's temporary. We would use that as an opportunity to go longer duration and to go longer credit because we think the 50 basis point eases are very much on the table.
So if inflation is still a concern, Earl, how do you get conviction to go into long-term rates on Fed cuts that affect the front end of the yield curve?
Yeah, it's very easy. As I said, I've been in this market for 30 years. And one of the things with the market is it only focuses on one thing at a time. And right now, inflation is not the focus. So it's determining what is the catalyst to get inflation back on the radar. And there's basically two catalysts. One is employment. Employment starts improving. We don't expect to see that until 2026. And, there's no data or tier one data coming out on employment. And the second thing is geopolitical. And what I mean geopolitical is an oil price spike. That we'll see coming. And we'll be able to adjust positions accordingly. And the reason why I say we'll be able to adjust positions accordingly, in a higher yield bear market, you don't get, yields higher by 2 or 3 or 4 or 5 basis points a day. You get yields higher by 15 or 20. Once you start getting a sense of that, with the catalyst either being oil or employment, when that starts coming out, that's when you adjust duration to reflect that. Right now, it's an easing environment. There's no catalyst for that to turn. And our terminal, as I said before, has gone lower, which changes our view on duration right now.
Earl, will the government shutdown force the market just to focus on inflation? That's the data we're going to get. And what you hear from Washington is that they're expecting a prolonged shutdown, even potentially having congressmen and women come back to extend the date on the continuing resolution because they're hunkering down for a long shutdown.
Yeah, the market will focus on inflation. I think that's fair, but it won't be persistently focused on that because you'll get central banks speak once they're out of the blackout period or at the FOMC meeting, and you'll get people focusing back on employment. And that's why we see it as a buying opportunity because that focus will be very short-lived, very temporary. So yes, it will focus on inflation, but everyone's made clear that employment is the thing that the central bankers are looking at.
Earl Davis of BMO.
Could I say one more thing?
In about 20 seconds, sir, you can, absolutely.
Yeah. Go Blue Jays, go. Thank you.
Oh my God!
Nice.
Good luck
well
good luck with Ohtani, Earl. Good luck. It's
Is he
showtime, baby.
Is he allowed back?
Yeah.
No.
Yeah, absolutely.
I thought I was going to be more
interesting.
piercing insight on markets, but it was just shade for Anne-Marie.
Evidently, although honestly, you're right. Shohei Ohtani was just absolutely a monster. So good luck with that.
Showtime is going to destroy Toronto.
Wasn't that brutal?
That was Earl. I didn't know he had it in him.
Regular
a dagger
watcher.
like
I
that.
think it's great. You're welcome back.
Killing AMH.
Oh, yeah.
Coming up on the program, Evan Brown of UBS Asset Management, Monica Guerra of Morgan Stanley, GM CFO, Paul Jacobson, and Michael Reed of RBC.
you still have a very resilient and robust economy.
Profitability is still strong. Financial conditions aren't pulling back.
I think we should be very careful about cutting into higher inflation.
You're going to see the balance of risk shift back a little bit towards the inflation.
This is Bloomberg Surveillance with Jonathan Farrow, Lisa Abramowitz, and Anne-Marie Hordern.
Live from New York City this morning. Good morning for our audience worldwide. The second hour of Bloomberg Surveillance starts right now, and your scores look like this. Equity futures on the S&P 500 down by not even 0.1% following the biggest two-day rally since June on the S&P 500. In the bond market, 2s pretty stable, likewise on 10s. Across the curve at the moment, pretty much unchanged. 10s at 398, 2s at 346. For the day ahead, lots of earnings. The earnings season starts to build up. We had Zions before the close, or rather before the open, yesterday. After the close, we will get Western Alliance after the close today. We've just had GM, decent numbers from them, and Netflix a little bit later as well.
What's interesting is all of these companies are telling a really positive story. I mean, really, they're all coming at different angles. But whether it's Zion's putting to rest some of the worst credit fears and the idea of some sort of big credit bubble that was busting, to GM putting to side some of the concerns about tariff-related costs really coming to the fore. The consumer is still strong from Coca-Cola. You look at all of these things, and you start wondering how many people can still feel bearish on the U.S. economy and feel like it is necessary to cut rates dramatically. And yet people are saying that you can cut rates dramatically because oil prices are low. So you put this together, and it feels like that melt-up just seems poised to continue.
Bramo questioning the bear thesis is the scariest thing I've heard all morning.
That's the top.
Right?
That's the top. Well, I mean,
not
honestly,
a Gucci blazer.
All I can say is you have to wonder, where is the hole that's going to get poked in all of this narrative? I mean, really, we were talking about earlier about maybe some trade down. Is that really enough to hang your hat on?
Banks are making money. Saw that across the board in the last week. Saw it from Zions just yesterday. Will we see it with Western Alliance later on? And GM, to Bramo's point, is selling lots of cars. GM numbers are beating a race.
They're selling lots of cars, and they are doing tariff mitigation efforts. And as you said, the CEO is thanking the president in terms of the reprieve the auto industry recently gotten in terms of the high-level tariffs they were paying on auto parts coming into the United States. But still, 2025 full-year gross tariff impact improved. What is the improvement? $3.5 to $4.5 billion from $4 to $5 billion. They're still paying billions of dollars when it comes to the tariff policy out of the United States.
The stock is up this morning by close to 8% on General Motors. We'll speak to the CFO very shortly. Coming up this hour, Evan Brown of UBS as a big tech rally fizzles out. Monica Guerra of Morgan Stanley as President Trump finds a new ally in the rare earth space. And the CFO of General Motors, Paul Jacobson, with a big earnings beat for the automaker. He joins us in about 27 minutes' time. We begin this app with stocks hovering near record highs ahead of a busy week of earnings and inflation data. Evan Brown of UBS seeing resilience in the market, writing until the private sector meaningfully levers up, severe negative outcomes for the economy and market are a low probability. Evan joins us now for more. Evan, good morning.
Good morning, John.
It's good to see you. I think you've touched on something really important. We haven't had the leverage cycle yet, have we?
That's right. I mean, we came into this cycle with multi-decade lows in consumer leverage and non-financial corporate leverage. And that has kind of been our North Star, keeping us pretty glass half full throughout the cycle. It's difficult to get worried about these, systemic credit risks or the consumer absolutely falling apart when you have not had that leverage build up yet.
Even Bramo questioning the bear thesis now. So,
I have one.
I'm sure you do. Do you want to share it now or wait?
We can wait.
Okay. Do you want to share what yours is? What is the most credible case now for this bull market running out of steam?
Yeah, I mean, I think the one thing we're all wondering about is the return on investment in AI CapEx, right? And it's difficult for any of us to have an edge in this because we've never seen it before. We don't know just how transformational this technology is going to be. It could end up being an absolute game changer for humanity. It could be we're just putting out, funny videos that we've made up and sending around, and that's that. So there's a lot of money that's being spent. And there are questions to be raised about the return on that money in the data centers and on the GPUs. And it's difficult to know right now if that money is going to be worth it. But I think, we're still early enough in that cycle that it's not a major concern just yet.
Yeah, and this goes to the AWS issue yesterday and a question around, is there going to be some sort of fissure or inability to deliver on some of the promises just by some of the technical constraints that could potentially torpedo some of these valuations? How much is that part of your short U.S. dollar call?
Yeah, I mean, the U.S. dollar call is less about U.S. equities being, a major concern or an end of U.S. exceptional. And it's more just that we think U.S. rates are going to continue to catch down to the rest of the world. I think the reality is that we're going to have a new Fed chair coming in next year who is going to be structurally more dovish, right? And so that might mean that as the economy recovers, should it recover as we respect, actually it doesn't need to recover that much because it's hanging in pretty well. But if the economy is picking up, the labor market's picking up, and you're going to get wages potentially rising because labor constraints are now more in effect due to immigration policy. Is that new Fed chair going to become less dovish, thinking about not cutting rates or maybe even hiking rates next year? We think the bias is that it's going to be kind of a run-it-hot Fed. And that's an environment where real interest rates remain low and the dollar weakens.
I just wonder how much a loss of Fed independence is sort of embedded in this call. The idea of go long equities around the world, go long EM, go long Japanese equities, go long U.S. equities, short the dollar, and overweight gold. How much is this a bet that the one loser is going to be debasement and you can see everything else do okay?
Yeah, I mean, I don't think it's a binary either or. The Fed is independent. The Fed is not independent. I think, you will have a dovish Fed chair who will keep rates, potentially a bit lower than Powell would have. And so on the margin, that is going to be more supportive of the kind of trades that you're mentioning. But I think if you have a chair that has complete lack of credibility, and I think that's difficult to do given it's still a committee, the decision, then that would be something that actually is more concerning. And I don't know if all of those trades, risk asset wise, would do quite as well.
You asked me about the bear case.
Here we go.
Okay. The bear case to me has probably more to do with AI and a question not necessarily of some AI bubble in some of the hyperscalers, but a question of where else has the money gone and how much do we get some sort of constraint from whether it's energy or whether it's some of these other areas that start to not come through in the way that people previously expected. How close are we to that? Or do we have a lot more to run before we even begin to find out where the pockets of excess really are?
Yeah, I mean, like I said, in the overall economy-wide, the leverage is pretty low. The capex that we've seen, the numbers are huge, but as a share of GDP, they're actually not that big compared to the tech bubble. We're talking about less than 1% of GDP compared to, getting up to 5% of GDP that we saw in the tech bubble. We do clearly have some constraints in terms of the grid and energy and the like, but maybe that's a good thing on some level and constraining some of the overbuilding and the like. So yeah, I mean, I think this kind of AI capex cycle still has room here.
You're optimistic on China tech as a way to play the AI trade. How contingent on that trade is it that these trade talks go well?
I think it matters. We did see as soon as we had Trump's tweets on that Friday and talking about 100% tariffs that China tech, the ETFs were down 7%. So it matters for sentiment and the like over the short term. But what we have seen China do is that the more there are export controls on them, the more they kind of find their own solutions and develop their own hardware and own access to GPUs and the like. And so I think over the medium term, those kind of trade scares are an opportunity to get long China tech.
But long term, isn't the writing on the wall that these two economies, especially the technology sector, is going to be further apart from each other?
There will be a gradual strategic competition and moving away, but there can't be a complete divorce between the U.S. and China's economy. And I think Trump realizes that, and Xi realizes that there's just too much pain to be had on both sides to completely decouple. So, I think it's likely that, China gives something on the rare earths, the U.S. gives something on the export controls and the tariffs, and they all realize that the downside scenario is much more severe than either of them want to agree to.
Evan, there appears to be a difference in approach, though. It's something that's been discussed on this program. In the US, these tech firms are investing as if they're confronting existential risk. Capacity, investing loads of money, NVIDIA's really benefiting. In China, by necessary means, they have to invest as if they're facing existential risk, sure, one. But two, it seems to be about efficiency over everything else. And it's interesting to me that this year, we've moved on from DeepSeek pretty quickly. And DeepSeek was the efficiency shock. And then we moved on, and we've gone back to whatever we're doing in the US. Is there an approach that you favour at the moment, the US versus, say, China?
I think you want to be long both approaches, and I think it's absolutely fascinating that in the U.S. we're like, let's get to AGI and superintelligence as quickly as possible, whereas China, whether because they can't due to the export controls or just don't want to, they're saying, let's be as efficient as possible with what we kind of have, and then let's focus on the applications of it. And so I think, that AGI race and winner-takes-all race is something that's kind of compelling on the U.S. side, even if, it might be carried to an extreme. But I think China's approach makes a lot of sense from a kind of efficiency and monetization side. And so be long both, and that's a good diversified way to be in the AI trade.
Evan, it's good to see you. Evan Brown of UBS, thank you, sir. Breaking things down on the tech side, the US versus China. Things are so frothy out there, even France has hit a record high. CAC 40 index surpassing a May 2024 record all-time high. This is just an English France thing, that's all it is.
It's not actually anymore. Now it's kind of the world France thing, considering the recent reputation.
Yeah, not a great weekend. We were talking about that yesterday.
Terrible weekend.
No.
Yeah, I mean, look, this has been an ongoing difficult spot in the world, and it's sort of the weak child now of Europe in many ways, and for them to reach a record high.
And they lost the crown jewel.
We were talking about the French museums.
Yes, but it actually, yes, the Louvre. Where do people sell jewels that they steal where everybody knows where they're from?
Wall Street Journal has a great story on this.
What did they say?
How difficult it is, but how quickly you have to move if you want to basically isolate, chop up these jewels and then get them out to the market.
Sometimes it's targeted, like someone's got a list and these are the things they want.
Okay, so maybe that's what it was.
Their own private collection.
Yeah.
All I know is that we'll be watching Ocean's 25 for this.
The Thomas Crown Affair.
Yes, exactly.
Fantastic.
I like that too.
Yeah, love that movie.
Yeah,
the Pierce Brosnan one, though.
Yeah, that was good.
Okay, let's give an update on stories elsewhere this morning with your Bloomberg Brief. Here's Lizzie Burden. Hey, Lizzie.
Hey, John. Shares of GM soaring after the automaker raised its full-year outlook and posted third-quarter results that topped analyst expectations on better-than-expected pickup truck sales and fresh relief from the Trump administration's tariffs on auto parts. GM will also be reducing its EV investment. In a letter to shareholders, CEO Mary Barra saying it is now clear that near-term EV adoption will be lower than planned. Elsewhere, shares of Coca-Cola higher after posting third-quarter sales growth that beat Wall Street expectations, a sign that consumers aren't shying away from the company's beverages despite higher prices. Coca-Cola reported organic revenue growth of 6%, topping estimates, while adjusted earnings per share also outpaced expectations. And in sports, the Toronto Blue Jays are headed back to the World Series for the first time since 1993 after a thrilling Game 7 win over the Seattle Mariners. George Springer hit a go-ahead 3-run home run in the 7th inning on the way to the 4-3 victory. They'll be facing Shohei Ohtani and the LA Dodgers, who are looking to become the first repeat champions since the Yankees in 2000. And that's your Bloomberg Brief, John.
Touchy subject over here, Lizzie. Thank you. Thanks for the update. Up next on the programme, mining for new deals.
We are discussing critical minerals and rare earths, and we're going to be signing an agreement that's been negotiated over a period of 4 or 5 months. In about a year from now, we'll have so much critical mineral and rare earths that you won't know what to do with them.
That conversation up next with Monica Guerra of Morgan Stanley, live from New York City this morning. Good morning. Stocks just about unchanged, turning positive briefly on the S&P 500, going nowhere on the Nasdaq, on the Russell pulling back by just 0.1%. A better tone to this equity market in the last 24 hours. Last week worried about credit risk, particularly around the regional lenders. That was Thursday into Friday morning. That fear has really subsided, particularly with decent earnings coming from Zion after the close yesterday. So the tone doing a little bit better. The focus now on earnings. GM was okay, likewise on Coca-Cola. So far, so good.
And we get Western Alliance later today also that might give another read on just how much these cockroaches are real or whether they are worries that people have. Look, right now we are seeing an economy that still is strong. And it's going to be bolstered by rate cuts. And we're not necessarily having any other data. So why wouldn't the market continue to melt up on the back of this?
That's the latest on Wall Street. For the latest down in Washington, D.C., under surveillance this morning, mining for new deals.
We're here to talk about trade, submarines, lots of other military equipment. We are discussing critical minerals and rare earths, and we're going to be signing an agreement that's been negotiated over a period of 4 or 5 months. In about a year from now, we'll have so much critical mineral and rare earths that you won't know what to do with them. They'll be worth about $2. But in the meantime, we're working with Australia and other countries. They're working with us, too.
So here's the latest this morning. President Donald Trump making a deal with Australia to boost America's access to rare earths. It's an attempt to counter China's dominance over the issue. Bloomberg's Tyler Kendall joins us now from Washington with more. Tyler, what precisely has been agreed between the two countries?
Yeah, hey, John, good morning. So this is actually considered to be a landmark agreement, appearing to make Australia the U.S.'s partner of choice when it comes to mineral projects. It's an estimated $8.5 billion deal that will see the U.S. and Australia jointly invest in critical and rare earth mineral mining, but also processing projects in Australia. Australia has also pledged to invest in U.S. defense companies. There are still big questions here on how concrete the agreement is and how long it will take to implement, but it is widely seen as a win for Australia, which has been trying to ink such a deal at this point for months, because up to this point, the administration has really been focused on these domestic projects. Think MP Materials or Trilogy Metals, which is why our own analysts at Bloomberg Economics say that this really does mark the first real tangible effort by the Trump administration to partner with a credible ally for help in this sector. And while the agreement itself is between the U.S. and Australia, it also is calling for this broader coalition to come together to agree on fair standards and also pricing mechanisms, all in a bid, of course, to compete with China, because that's what's really hanging over the backdrop here as we head into next week in this critical meeting between President Trump and Chinese President Xi Jinping. John, as you well know and discuss on this program all the time, China has a major grip on the industry. It accounted for more than 70% of rare earth global supply last year alone.
Tyler Kendall with the latest down in Washington. Tyler, thank you. With us around the table, Monica Guerra of Morgan Stanley. Monica, good morning.
Good morning.
China's flexed, and it's flexed, and the whole world has listened, and arguably maybe even brought the likes of Australia and America closer together. Was that a strategic mistake going into negotiations later this month?
I think what's interesting about this deal is that China's response was actually constructive on paper, right? They were actually positive, saying, yeah, join the party on rare earths. That was really surprising to me. That tells me that they're not worried. It's going to take at least 5 to 7 years, maybe longer, to have this whole initiative ramp up. A lot can change in that time. Doesn't mean that this isn't going to be a positive for the U.S. I think more, players at the table is ultimately long-term a benefit, but this isn't a zero, end game here.
So going into this meeting, it sounds like, do you think China has the leverage?
I would say that both parties, right, need each other. When we're thinking about our combined economies, they don't want a 100% tariff on all of their goods. That's an issue for them. But they don't really need to worry about this move on rare earths. I think that they're going to be focusing on the other components. China is still in charge of 90% or more, right, of that market. So this isn't a now issue. It's going to make them have to focus on all these other factors that could impact their import-export relationship.
To Jonathan's point, China, though, flexing its muscles on rare earths, is it giving the Trump administration an excuse to continue making these deals where they take outright equity stakes in mining companies?
I'm not going to speak to that, right, to that piece. I think, we were all surprised by the other outright stakes in U.S. companies. Now, as far as the mining company component, we're going to continue to see foreign direct investment, right, directed out of the U.S. in order to make these deals happen. What's going to be interesting is as we build out our relationship with Australia and China, it's like, where do we land on that final tariff number? And I think that, again, when we go back to actually the beginning of the year, that you could see something that's in that 30 to 40% range if we're going to go back to those campaign promises.
Do you think that's where we end with China, say 2026? We're kind of there now on some products.
On some products. I think, you could see an increase on those Section 301 tariffs. You could see more on, Section 232. The other piece here, right, that we have to really appreciate is the U.S.'s reliance on that tariff revenue from a fiscal policy perspective. And the fact that we're in the middle of trying to just even determine if we can have the IEEPA tariffs in place. And once we get that, it's going to be that patchwork on Section 301, Section 232, and others, right, to try to make us whole from a fiscal policy perspective. So I would say from China's lens, yes, maybe they definitely have the advantage on rare earths. Is there something at stake for them? Big time, right, when we're thinking about that relationship. But the U.S. also has to think about their fiscal policy future and trying to find that sweet spot.
So given that concern and that hang up and that, frankly, support to the debt market, how much of a risk case is it if the Supreme Court overrules the tariffs that have been put on and forces the administration to scramble and cobble together another sort of regime of tariffs to plug that fiscal gap?
Well, they're already working on it. So, for example, Section 232 tariffs, you have to have studies put in place. Those prior to the shutdown were in the works. And so I think we need to get through this shutdown period in order to see some of those puzzle pieces come into play. I think markets are right to assume that there will be some tariff revenue coming in at the end of the day. It's just how much? And that's going to be the big question. If they get a negative ruling, there will likely be a market response, right? That's natural. That's going to be a normal course of action. But soon to be backfilled with all those other tariff pieces that they've been, working on heavily.
We got GM earnings earlier this morning, and it showed that the tariff mitigation plans have been working and have offset a great deal of any extra cost. In general, earnings have been pretty positive across the board. Is the takeaway that the tariffs are manageable and that, frankly, companies are adjusting and adapting, and it wasn't as big of a hit? Even if the tariffs go in and remain as such, it's not as big of a hit for the underlying profitability momentum of the United States as expected earlier this year?
I think that the full pull-through, right, of impact of tariffs hasn't been seen yet. So while I think that the GM reporting is a positive sign, that we're finding a sweet spot here, one of the key things we have to focus on is this patchwork, component of tariffs and what that's going to mean for the consumer in other areas. So while they might have found that sweet spot with GM and the auto industry, can they do it across the board when we're thinking about all goods and services? That's to be seen, and we'll get more information in November.
What channel are you and the team focused on, prices or through the labor market? Cost cuts?
We're focusing on labor market right now, especially as it relates to the shutdown, because this is a really interesting period. Typically, when you have a shutdown, right, people get laid off and then they get brought back. And so that furlough period, you essentially get made whole. Doesn't have a major impact long term. Now, this is different because we don't know how many employees are actually going to be brought back. And so that could have an additional drag, especially when we're thinking about those inflationary factors.
Monica, good to see you. Thanks for being here. Monica Guerra of Morgan Stanley. It is different this time. We've heard that a few times already.
And also the fact that now you see Washington preparing for maybe being in a shutdown longer than November 21st. Talk about labor market data we're not going to get. Also, the clarity of that data, given the fact that a lot of these workers are not deemed essential, so they're not out there collecting these surveys. But when you have the Senate Majority Leader saying, yeah, maybe Speaker Johnson needs to bring Republicans back, so we need to extend the date on the CR, this looks like an administration and Republicans in Congress preparing for a shutdown that maybe will go past the record we had in 2018, 2019 of 35 days.
Didn't get the jobs data for September. Probably not getting it for October anytime soon. It's going to threaten November too.
Yeah, and now we're going to get a CPI, which is probably going to come in hot. So go square that with the idea of rate cuts.
And a bond market rallying into that too.
I mean, everything about this is
some real tension out there.
I mean, market only can focus on one thing at a time.
It's true. Coming up on the programme, General Motors CFO Paul Jacobson with a big earnings beat. Plus, Yahara's got your morning movers. Coca-Cola shares rising on earnings and a resilient consumer.
Abu Dhabi is a rising global hub of business, culture, and tourism. In 2024, the Emirate welcomed 40 million visitors, generating $24.5 billion in tourism-linked GDP.
Louvre Abu Dhabi was born of two great names put together, creating the capacity to attract fantastic brands, bringing international excellence. Yes, the gift of the UAE, Louvre Abu Dhabi is telling the story of humanity.
Earnings pretty decent so far this morning. More on that in just a moment. Equity futures, your scores just about unchanged on the S&P 500. Big two-day gain on the S&P, the biggest we've seen since June. On the Nasdaq 100, just about unchanged so far this Tuesday morning. With your morning movers, let's cross over to Yahara for more. Hey, Yahara.
Hi, John. We have a slew of earnings to get through. We start with GM. Shares are rising 9% in the pre-market. It was a beat and a race for the automaker after red-hot demand for its trucks and SUVs helped offset tariff pressure. And CEO Mary Barra is giving credit to President Donald Trump because those tariffs were not as bad as expected due to some discounts. And moving on to GE Aerospace, those shares are up 1.25%. The jet engine maker just raised its outlook for a second straight quarter, and that's thanks to booming demand for air travel, which fueled demand for new engines and maintenance work. Remember, CEO Larry Culp broke up the company, and the changes are gaining traction with those shares up 80% this year. And we end on Coca-Cola, another positive earnings story. Shares are up 2.8% after it topped third quarter sales expectations as shoppers continued buying across its beverage lineup. And it was its smaller sized bottles and cans that helped lift sales, showing that consumers are still buying but choosing slightly cheaper options as the cost of living remains an issue. John?
Yahara, thank you. The stock is higher by close to 4% so far this morning. On our radar this morning, the Vice President J.D. Vance arriving in Israel today. He's set to meet with the Prime Minister Netanyahu in an effort to shore up the fragile Gaza ceasefire deal between Israel and Hamas. The Vice President will hold a news conference at 11 a.m. Eastern Time this morning. Elsewhere, a group of U.S. banks behind the $20 billion Argentina bailout is looking for collateral. The Wall Street Journal reporting the group, which includes J.P. Morgan and Bank of America, is struggling to finalize the loan without leaving themselves on the hook. And finally, Amazon Web Services resolving all issues related to Monday's 15-hour outage, the company blaming a malfunctioning digital directory for the disruption. The outage affecting hundreds of sites, including financial services and gaming companies.
This is about a third of web services around the world, and it raises this question of how fragile some of these companies could be if they rely all on one cloud computing service. It raises a question about the systemic import of some of these companies and how much companies are willing to pay extra in order to duplicate some of those efforts and maybe diversify. A real question here about how much we're hinging ourselves on something that really hasn't been fully secured.
And right on target. You have individuals in Washington, like the senator of Massachusetts, Elizabeth Warren, saying this just proves a point that big tech is monopoly and need to be broken up.
Sometimes it's very predictable in Washington, isn't it? Like we could write the letters for them sometimes based on who they are.
Yeah, but at a certain point, they have to have enough size and scope in order to be able to provide these services. We've been talking about the inability to fuel it through some of the energy sources, and then you're going to say they're too big. I mean, pick one. I mean, okay.
They've got the drafts ready to go.
Yeah. I mean, we just need to go back to
the
pad
senator
of paper.
from Massachusetts just has the draft ready to go. Something malfunctions in big tech. It's like send.
Monopoly one.
Yeah, every single time. All right, Amazon up by 0.2%. Let's turn back to earnings. Shares of General Motors jumping after the company beat earnings and raised guidance. The GM CFO, Paul Jacobson, joins us now for more. Paul, the stock is up by more than 9%. We'll spend some time talking about the numbers, but I just wanted to take a step back with you just for a brief moment. You've got real experience navigating volatile industries, experience in the airline business and experience in the automaker business too. You took over as CFO in the pandemic. Can you talk to us about this year, Paul? Just how agile have you and the team needed to be and how volatile have things been too?
Well, Jonathan, first of all, thank you very much for having us. It's a great day to be at GM and celebrate the success of all of our employees and partners worldwide. So really appreciate you being here today, having me today. So, you know, at the end of the day, it's just another change. I mean, since coming to GM in 2020, we've gone through COVID, we've gone through chip shortage, we've gone through tariffs, we've gone through EV pivots and so on. But what we've really tried to do is create a model that is resilient. And when when you look at our balance sheet, you look at our inventory discipline and the way we've gone to market, there's a lot of things that have changed that allow us to be able to react to the world around us faster. And I think that's paved the way for us to have another really strong year in the face of a lot of macro changes.
Paul, in order to increase resilience and maybe agility, do you have to sacrifice long-term planning? Is that something that becomes harder?
Well, I think what we've really done well as a team, I think, is we've kept focus on that long-term vision. So, for example, while we've taken a charge on reducing some of our EV capacity, reflecting the demand that's out there, we still believe that EVs are the future. And we think that there's an opportunity for us to take a little bit of a pause in demand growth that we've seen over the last few years, structurally improve it, right-size our capacity, and make sure that we can be successful as more and more customers adopt it. So it's just an example of how we make sure that we're managing the short term within the face of that longer term vision.
So what are the big steps, Paul, that you've taken in order to remain agile, particularly with supply chains and removing any kind of direct input from China in particular? How much have you rejiggered where you get your goods?
Well, I think we learned a lot in industry from COVID and a focused supply chain that was really susceptible to individualized shocks. And I think we've taken the effort to try to make sure that we diversify our supply chain base. We've made a number of investments, for example, in battery raw materials and other materials in the U.S., in addition to the $4 billion that we've announced this year to increase our U.S. manufacturing capacity. So I think it's been a case of making sure that that's balanced. And then when we went through the chip crisis of 2021, there were some more challenges about making sure that we expand the places where some of our chips are fabricated and our supply base that we use. So this has just been part of it. I think we've learned a lot of lessons over the last 5 years that have helped us and positioned us well to be able to thrive in ever-changing circumstances like we see right now.
All of this costs a lot of money. And I'm just trying to get my head around, we've all been trying to get our head around where it comes from, these extra costs in order to rejigger supply chains, to offset any kind of increased costs that might come along the way. How much is coming from, whether it's freezing labor forces or trimming around the edges? How much is coming from higher prices on consumer vehicles?
Well, I think if you look at what GM has done, we've saved a lot of money by rationalizing our inventory balances. So we used to keep probably about 40% more inventory on the ground at our dealerships around the country. And we've cut that down. That frees up a lot of working capital to be able to invest and redeploy back into the business. But it also makes sure that we can change much more quickly to changing demand around us. So our pricing has been stabilized, and I think that's given us a little bit more comfort to invest a little bit more than what we have historically, but still making sure that we're very disciplined with our capital allocation, because we still have opportunities to pay down debt and also return capital to shareholders. So it's that balanced approach that I think has really paved the way for our success.
Paul, you and your colleagues in the industry recently had a big win in Washington, a little bit of reprieve when it comes to the arrangement on the timeline for the tariff costs for imported auto parts. What else are you asking in terms of tariff relief from Washington?
Well, I think I want to praise the administration for really listening to the concerns of the industry and making sure that they're helping us to be positioned to be really successful as one of the largest U.S. industrial producers that are out there. And the announcements that were made Friday essentially take what had already been done by the administration in the spring and expands it a little bit to be able to use those MSRP offsets on a wider variety of parts that we're bringing into the country. And as a result of that, we were able to lower our total tariff forecast for the year by about $500 million from where we started the year. And I think it's that proactive partnership in terms of really making sure that we can remain competitive and help to drive more investment into the U.S., which we've done.
So do you expect more reprieves, especially as the U.S. goes into negotiations next year with Mexico and Canada?
Well, I think what we're looking for is a little bit of stability. Obviously, this year's been a bit of a transition year. For us, the handshake deal that we have with Korea, we're really eager to get that finalized. We do have some production of some of our lower cost models in Korea that help with some of the affordability concerns of our consumers here in the U.S. But also, obviously, Mexico and Canada are going to be really important to us. But as we look at those deals being finalized and we start to look into 2026, we think that there's actually an opportunity for us to do better in 2026 than we've done in 2025 and start to work our way back up to those 8 to 10% targeted margins that we set for ourselves before the tariffs were put in place.
Paul, just finally, can we stay in Asia and finish on China? Paul, for a long time we've said on this program, this must be the most competitive market on the planet in any industry. How difficult is it to operate in that country right now? And how much harder is it going to get in the future for US automakers like yourself?
About a year ago, Jonathan, we undertook a pretty ambitious restructuring program in China with the realization that, we were probably not going to be as big in China as we have been historically going forward with the amount of just tremendous competition that's in the country going forward. But, together with our partners, we were able to restructure that business, and we've been profitable every quarter this year and look to be able to sustain that. So it's really about making sure that we're right-sized for where we are. We've got great products over there. We've got a long legacy, and we've got a good partnership that I think has really paved the way. And with that work that the team did in China, really proud of what they accomplished and think we can be sustainable there.
Paul, appreciate your insight and your experience as always, sir. Paul Jacobson there, the General Motors CFO, a beat and a raise from that company. Stock is higher in the pre-market by around 9%. $80 million in China in the latest quarter. That's what GM made. That's a turnaround. That's important.
And it was actually better than expected. And they've been trying to right-size that team. It's sort of a difficult dance between both investing in that nation and also navigating this sort of tit for tat between the two countries at a time where both countries are really prioritizing their domestic champions.
Three completely different markets.
Completely.
Right now, you've sort of got China going one way, the US going another, Europe stuck in between, and these global players trying to work out what product sells best where.
Yeah, and exactly what the future is going to be, too. It's sort of the Craig Trudell kind of view of the world. Near term, it might make sense in one region to get out of EVs or to go into EVs. Long term, what is the ultimate goal? And that, I think, is less clear right now than it was, at least what the lip service was maybe a year ago.
GM this morning higher by around 9%. Let's get you an update on stories worldwide with your Bloomberg Brief. Let's cross over to Lizzie Burden. Hey, Lizzie.
Hey, John. President Donald Trump and Australian Prime Minister Anthony Albanese have signed an agreement to boost production of critical rare earth minerals in Australia. The two governments will invest more than $1 billion over the next 6 months for initial projects, both pledging to protect their domestic markets from unfair trade practices. Elsewhere, the US government shutdown is in its 21st day after the Senate failed for an 11th time to advance a House-passed measure to fund the government. The impact is being felt across the federal workforce. Senate staffers were told they'll no longer be paid for the rest of the shutdown, and the federal agency overseeing the US nuclear stockpile furloughing most of its workforce. And parts of the White House's East Wing have been demolished as construction begins on President Donald Trump's new ballroom. Trump announced the construction in a social media post, saying for more than 150 years, every president has dreamt about having a ballroom at the White House to accommodate people for grand parties and state visits. And that's your Bloomberg Brief, John.
Lizzie, thanks for the update. More from Lizzie in about 30 minutes' time. Up next on the programme, the last clean inflation report.
This coming CPI report, this one on Friday, is likely to be one of the better ones. What's going to be more worrisome is next month or whenever the shutdown ends, as people come back to the BLS.
The data desert. Get a drip of water on Friday. CPI. After that, I don't know what comes next and when it drops. From New York City, you're watching Bloomberg TV. Live from New York City, welcome to the program. Equity futures on the S&P 500, just about unchanged on the Nasdaq, going absolutely nowhere. Snoozy on the Russell too. We finally get some data later this week. CPI coming up on Friday. Under surveillance this morning, the last clean inflation report.
this coming CPI report, this one on Friday, is likely to be one of the better ones. These individuals were not actually on furlough for all that long, so they're not that far behind schedule. What's going to be more worrisome is next month, or whenever the shutdown ends, as people come back to the BLS. Even if the shutdown were to end today and people were to come back tomorrow, they're already going to have to ask about stuff that had happened retroactively.
It's the latest this morning. Investors looking ahead to this week's CPI report, an oasis in the data desert. And I tell you, based on this government shutdown chat with Anne-Marie and everyone down in Washington, D.C., might be a while before we ever see an employment report.
I mean, honestly, at this point, there seems like an incentive once it gets past November just to keep on going. In the meantime, the earnings have been pretty good, and yet people still have confidence that the Fed is going to cut rates. And this coming from Ed Yardeni overnight. And I thought this was interesting. He said that he thinks that 10-year treasuries could hit 3.75%. Why? Because the Fed's cutting and oil prices. And that's the key. Oil prices keep going down, and that will keep a lid on anything potentially.
When it comes to the shutdown, though, what this administration is doing is trying to mitigate all the pressure points. There's an article yesterday in Politico. They're trying to find ways to pay air traffic controllers because, remember, 2019, that was the sticking point. That was the day Trump caved because there was a ton of flight delays going into Orlando, New York City, really big airports. And it was starting to, really hurt citizens, getting curmudgeon. They're trying to find ways because they're preparing for a protracted shutdown.
The Federal Reserve, they're essential workers, apparently, we're told. We've got that confirmed. They meet this time next week, a two-day meeting with very little economic data and the prospect of a big change at the top of the Federal Reserve in May of next year. Joining us in the last week, Governor Waller, a candidate to be the next chief of the Fed. We talked to him about leadership and his view on what's happening in the economy right now. Take a listen. How's the process going? Let's start there and then we can get into all the other good stuff. How's the interview process going?
It's going well. As far as I can tell, the secretary has a very systematic way of going down the list and doing the interviews. As I said the other week, I had a great interview with Secretary Bessent. Talked a lot about economics, Fed policy, the Fed, balance sheet, just general stuff in the economy and financial markets. It went very quick. It was about an hour and 45 minutes. The next thing I knew, it was over. So it was a great conversation. Of course, I love those kind of conversations. I can do that all day long.
The Treasury Secretary's spoken about in the past, he wants almost a visionary, someone who looks forward, like an Alan Greenspan type, open-minded. Do you get a sense of what he means by that?
I think it's the idea of if you're looking at the data and it's always looking back at the data, the data is always kind of old and you have to think forward, like where are you going with this stuff? I've managed to do that a couple of times with thinking about this beverage curve argument back in May of 22, that we could have the soft landing earlier this summer with the weakness in the labor market, which turned out to be true. People doubted it at the time I said it. But so I think I don't want to, brag, but, it's that kind of being able to look at the data and see forward where things are going. And I think that's a critical thing he's looking for.
You were certainly vindicated. The president was obviously excited about the fact the Fed finally was cutting interest rates. Have you spoken to him at all?
No, I have not.
Is that on the schedule?
I don't know. That's up to Secretary Bessent.
We're going to find out soon, hopefully. We'll talk to the man himself, the Treasury Secretary, hopefully later on in a month. I want to talk about the meeting that takes place at the end of this month as well. You were pretty clear going into the last meeting. You delivered a speech, and I believe the title was "Let's Get On With It." Yep. Are you advocating for the same thing at this meeting?
Yeah, I think it's the right thing to do. Back then, there was an issue of whether you go 50 or 25, and I argued we could do 25 and see how the data comes in. Of course, we're not getting much data. And then we can think about the next 25. So in the last 6 weeks, I don't think a lot has changed. We're not getting the public data, but all the private sector data that we're getting, Beige Book yesterday, everything we're getting is telling roughly the same story. The labor market's weak. Growth seems to be on the stronger side, which is a bit of a puzzle right now because you can't have a really strong growing economy and negative job growth or zero job growth. And, people talk about productivity, but AI hasn't had that effect yet on the labor market or productivity. It will down the road, I think, but not right away. So I don't think that's the story that's driving it. So in that case, one of these things has to move, right? Either GDP numbers start coming back down or the labor market rebounds. You just can't have growing economy and, very weak labor market. They just don't go together.
In the meantime, do you just continue to reduce interest rates meeting by meeting as you wait to see what's going on? What's your overall approach and how do you think about that?
That's exactly what I've been arguing is since we don't know which way this is going to break, If the labor market rebounds, there's less of pressure for cutting rates. If the growth comes back down, there's more pressure for cutting rates. You don't want to make a mistake. So the way to avoid that is to go, cautiously or carefully and do 25, wait and see what happens, and then you can get a better idea of what to do. But if you've already started the process, you're providing whatever initial support for the labor market that you feel is necessary.
So we've had this obvious step down in payrolls growth. It's pretty clear.
Yeah.
It feels like that alone, though, might be an outlier compared to everything else that's going on in the economy. You yourself just acknowledged that. What do you think is behind that? And can that persist?
That's the thing. When I've talked to private sector CEOs about hiring, we typically get a couple things. Maybe early part of the summer, there was a lot of uncertainty about tariffs. We're just holding off on doing anything. One of the things I heard is firms were going to have to pay the tariffs. One easy way to do that is just not hire. Take all the labor savings to pay off whatever the tariffs were. So that was one thing. Then you have this AI story, which was people like, we don't know if we're going to need to hire, but we're going to wait and find out. We're not going to go out and hire a lot of people right away. So I think the tariff uncertainty, paying for tariffs, trying to sort out what AI really is going to do, has kind of put firms on their back foot. Now, that's what I mean. Either they decide the AI is not going to be in the near term the big job replacement that they thought, and they're going to have to start hiring, and it comes back, tariff uncertainty goes down. All of those things could lead to a rebound. On the other hand, if GDP starts softening, it's not as strong as we think, that somehow the data is a kind of a mirage right now. Then the labor market is telling you things are just not as good as you think. Now, the financial markets are the big puzzle. I'm not the only one. How much of this is just a big boom in AI and everything else is marginal? I've kind of been arguing there's a big difference between the financial conditions for corporate America and financial conditions for Main Street America. If you're Main Street America, you're looking at mortgages over 6%, very expensive housing, car loans over 7%, credit card interest rates in the 20s. These are not loose financial conditions for American households. So when we look at the financial markets, you're seeing a lot of when people talk about credit spreads and all that. I don't think most American households care what the credit spread between corporates and treasuries are. That doesn't really, unless it shows up in mortgages. So I think there's this is one of the things that I find kind of puzzling right now is there's just always these dichotomies between things. If you look at AI, if you take out anything data center AI related, business fixed investment is turning down. It's not widespread. All this investment is not widespread across. There's a real reallocation from kind of everything else into AI. So there's this bifurcation in so many ways that make kind of reading the economy tough right now.
How much influence do you have on one versus the other? Financial conditions on Main Street versus Wall Street. Wall Street's immediate. Wall Street's gone. It's off to the races. Yeah. Can you really influence financial conditions on Main Street?
Well, that's kind of what we hope. If you think about cutting rates, which we're doing and I think we'll continue doing, that does have a pass-through to the 10-year. And the 10-year is often the anchor for pricing mortgages. So the 10-year is down to like 4%. It's come down from 4.5%. That's about 0.5% off. If it were to continue drifting below 4%, you'll start seeing some downward pressure for certainly mortgages. Auto loans are kind of a different thing. They're trying to figure out how to deal with tariffs on the auto industry. One thing I've heard is they got rid of a lot of cheap financing that they used to subsidize for consumers. That's going to raise the cost of financing. All these things are more tightening for Main Street America. So hopefully these things, as we go on through the rest of the year, start loosening up some.
Governor Chris Waller of the Federal Reserve and potential Fed chief May of next year on the economy and what's happening. All these dichotomies, these contradictions that we've been discussing on this program, the fact you can have employment drop off the way it has, but retail sales have remained solid, the fact that people can freak out about what's happening with credit issues, but bank earnings are absolutely fantastic. We're all grappling with the same thing right now.
And it seems like the Fed doesn't have an edge on it, and they don't have the data. And yet what they are seeing is a labor market that is deteriorating, and the K-shape that some people reject, but other people see as being one that they need to cater to, and they want to ameliorate some of the issues for people on the lower end of the income spectrum.
And even if we get this hot CPI, they're going to look through it. They're going to continue to look through it, as you've been talking about really for months, Jonathan. 2026 is going to be so challenging for the Fed because you're going to have to potentially deal with hotter inflation and a brand new regime when it comes to the head of the Federal Reserve.
And a bond market's rallying into it. It's a very intriguing moment in fixed income at the moment. Coming up on the programme, we'll catch up with Judy Beale of Kane Addison Rudnick, Alicia Reese of Wedbush. We'll catch up with Lorena Urici of T. Rowe Price and the CEO of Atlas Merchant Capital, Bob Diamond.
key point for growth really is how these tech stocks are doing.
The AI momentum in the near term looks pretty solid.
If there's any slippage in earnings from the tech guys, I think you're going to see a more wobbly, more volatile market.
This is what we're calling a high risk bull market.
I'm very bullish. I think the market goes to new highs before Thanksgiving.
This is Bloomberg Surveillance with Jonathan Farrow, Lisa Abramowitz, and Anne-Marie Hordern.
The opening bound 90 minutes away, live from New York City this morning. Good morning for our audience worldwide. The third hour of Bloomberg Surveillance starts right now. Your scores look like this, just about positive on the S&P 500 following 2 days of gains on the benchmark. The biggest two-day rally since June on the S&P 500, leaving behind the credit fears for now at least. Solid earnings across the board from Zions overnight. We saw it from Coca-Cola and General Motors already this morning. Later on, we'll be catching up with Netflix, and you'll hear from Western Alliance.
Yeah, do you get the same sort of confirmation that the economy is solid, that the credit problems are less concerning than maybe some people feared, and that everything is a go? People have been looking for things to worry about, and so far the earnings have not given them that node of anxiety that they otherwise would have gotten. And what you're seeing is really resilience, both in corporate earnings, corporate expenditures, as well as in consumer spending, and that continues to be the theme.
It's a breath of fresh air as the world is trying to figure out, and investors trying to figure out what is going on with the tariff policy going into this meeting with China, as we don't have tier one data coming out of Washington except for what's going to be the CPI print. Zions is talking about that this was an incident, isolated incident, not idiosyncratic, isolated, because Jonathan hates that word. And then GM is talking about the fact that they are able to weather the storm of whipsaw changing policy in Washington, whether it's tariffs, whether it's emissions, or whether or not they're going to EV subsidies or not.
I give credit to some of these management teams. Give a ton of credit to them. Savita Subramaniam of Bank of America said it a long time ago. Never underestimate corporate America. The agility of these management teams through getting whipsawed after one political cycle to the other, from Biden to Trump, on things like EVs and tariffs, and they're still making money the way they are.
Yeah, and if you think about it, it'd be Paul Jacobson of GM in the last hour talking about how he came in during the pandemic and he had to manage supply chains during that moment, and they learned a lot from that. Look, they were also the ones, corporate America, that termed out their balance sheets in a way that the United States did not. And so they've been more resilient to the Fed rate cycle in addition to everything else. And it's the reason why people are wondering, well, even if they report earnings that are really good, does that really represent the rest of the economy? Because we have seen that split in a growing way.
Increasing agility, adaptability, are you sacrificing long-term planning? Are you at the mercy of the next political cycle? General Motors would obviously push back to some of that, but that's certainly a question we've got to ask.
We're dealing with that right now when it comes to rare earths. China has the entire control of the supply chain. They have the rare earths, they can process them, they refine them, they can ship the magnets. They doubled down the CCP when it came to rare earths decades ago. They're doing the same exact thing when it comes to EVs, which the United States is flip-flopping back and forth every 4 years. China is doubling down. At some point, China is going to say to EV car makers, GM, Tesla, who it may be, you cannot buy our battery, you have to buy our car. And they are going to become the superpower when it comes to EV car making and shipping.
General Motors this morning higher in the pre-market by more than 10%. Coming up this hour, we'll catch up with Judy Beale of Kane Anderson Rudnick with the latest market rally on pause. Alicia Reese of Wedbush ahead of earnings from Netflix later on today. And the former Barclays boss, Bob Diamond, the CEO. He's going to join us as he remains bullish on regional banking. We begin this hour with stocks flat as Wall Street awaits another round of earnings. Judy Beale of Kane Anderson Rudnick writes, investors will continue to overlook government shutdowns and geopolitical tensions as long as corporate profitability is strong. Judy joins us now for more. Judy, welcome back. You've talked about this a million times too. How impressive is the adaptability of management teams across corporate America?
I agree. I think your sentiment is exactly right. If you think of everything that has been thrown at them, it's not just tariffs, right? It's pandemics, it's supply shutdowns, it's huge swings in demand, huge swings in policy. They've really been able to put their ingenuity to good work. Imagine actually how productive they could have been if we didn't have tariffs, right? How they could have really used their ingenuity in good ways. But that's neither here nor there.
Judy, are you seeing this across market caps? Is this something that just management teams in large cap America can handle well and small caps can't? Or are you seeing this across the board?
I think we're starting to see that small caps really struggled with inflation in a way that large caps had more pricing power and they were much better able to maintain their margins. And then the bigger issue for small caps was they were not able to borrow long with, fixed rate interest. For them, they've been on variable rate debt and they've really struggled under that. I think we've reached the peak of their interest rate costs rising, and now we're in a place where they can finally start to have some earnings expansion just based off of that.
Do you think that's been priced in, or do you think that that's an upside in the months to come?
I think what's interesting, right, in this rally in small caps is that it's been very localized in super high beta stocks and stocks that don't have earnings. So that's biotech and quantum. The rest of the kind of higher quality scale really hasn't gotten to participate in this rally in small cap in the same kind of way. And so I actually don't think it's reflected everywhere in the same. But of course, I'm going to say that I'm an active small cap manager, and I'm going to say that you need to be selective.
I'm trying to square this idea that you're seeing profits reaccelerate in some small caps, that you're seeing earnings from the large caps come in better than expected, the increase in full year expectations that we're seeing pretty much across the board. And yet one manager after another is saying you have to be cautious. You have to move up in quality. You've got to be prepared for the next shoe to drop. Why? Can you square those sort of distinctions, the idea that we're seeing real optimism from the C-suite at the same time that fund managers are looking for something to get nervous about?
I think it's connected to the labor market. I think we kind of all recognize that the part of the reason why we have had such a strong economy is that we have a consumer who is so willing to go out there and spend money. And that has really propped up a lot of this economy in a really major way. If we lose that, as we're starting to see some degradation in the consumer strength at the low income, it really does ripple through this economy when so much of it is driven off the health of what the retail consumer is doing. So I think that's where people have a lot of anxiety. And look, how many articles are you going to read about a bubble in AI and not start to be a little bit worried when you have valuations as stretched as they are?
Julie, not just a bubble, you call it the AI pixie dust that is basically floating around when it comes to the stock market. What vulnerabilities are you seeing?
I was at an AI conference just this last week, and what struck me is how many panels people use the word unlimited. And the word unlimited, when you're in finance, it's a non-word, right? It doesn't really exist. Everything is limited. And if you talk to mega cap tech, they're all talking about how capacity constrained they are, how they need more GPUs, how they don't have enough power and they don't have enough data. It was strange to me hearing all of this talk about unlimited. And it reminded me, do you remember when cell phone plans went to unlimited, right? I used to call my girlfriend, put the phone down and just watch TV with pure silence, right? Because we were so excited about unlimited. I'm worried that we're not going to have the most cogent, thoughtful, capacity-constrained minds with AI and CapEx because there's this thought that if demand is unlimited, I can do whatever I want.
So, Julie, is there a side of the story you're more comfortable with? Maybe you want to buy into the constraints and maybe fade the moves where everyone's talking about investing like their lives depend on it.
I think the thing is that the place where you really want to be thoughtful of is now that we're at this stage of the capacity investment where we're using debt, I think it's really critical to have a keen eye on valuations. It's exciting to see places where there's growth and expansion and we've moved beyond the mega cap tech. But part of the reason why mega cap tech can rally with such strength is that fundamentally those names are defensive, even if you exclude their AI benefits. That's not the case for a lot of other players that are more fringe and adjacent. So that's the place where I think you see the most vulnerability. And you see that in the pullbacks that we've had recently. People really run away from those names because they know they're not as high quality.
Julie Bill with the latest. Julie, thank you. Julie Bill of Kane Anderson Rudnick, the latest on the equity market, looking ahead to tech earnings. Next week, Microsoft, Meta and Alphabet after the close on October 29th. October 29th, a week tomorrow. Fed decision in the afternoon. After the close, big tech players report.
You know what I think is going to be more important? Big tech, by far. And ultimately, this entire market hinges on growth expectations that are, to use Julie Biel's word, unlimited, given the fact that that is what we've seen, and that's the promise that people are pricing in with the multiples.
The promise without real use case. We don't see it yet. And this is why it's so uncomfortable for everyone. She calls it AI pixie dust instead of a bubble. But isn't that what is really so uncomfortable? They're spending all this money. Where's actually the use case just yet?
We keep going back to the comments of the Alphabet CEO last summer when he said the greater risk was underinvesting and not overinvesting. That really set the tone for their approach to this whole moment. Meta acting like, behaving like, investing like they're confronting existential risk. That's the psychology of the tech firms right now. That's why you're seeing them invest the way they are.
And honestly, I mean, I understand the idea of pixie dust, and I understand the idea of not necessarily seeing the profitability, but every CEO you ask, none of them think it's overstated. And they say that it's just the beginning and that they're starting to figure out exactly how they can percolate it through their staff. So it does seem like they also see the promise as unlimited, and they also are investing a lot of money. So we have to start asking the question, how long are you going to wait before seeing a use case while continuing to invest this kind of money? Is there sort of a tipping point at which you can't justify it anymore?
Why people are nervous? Their behaviour and their communication is a guarantee of a misallocation of resources. When some of the richest companies on the planet tell you that they believe the greater risk here is underinvesting, you should believe them. You should listen to them. And that's why people are nervous.
Well, and it is going to be something where people lose money. I mean, even the OpenAI CEO, Sam Altman, has come out and said, yeah, people are going to lose money big time and people are going to make the wrong bets. But this is what always has to happen during a technological innovation. It's making people nervous because why buy some sort of data center in the middle of a cornfield out somewhere in nowhere close to a big city if it's essentially there's going to be another DeepSeek moment that's going to bring the energy back close to a lot of these cities? Look, there are a lot of questions here. At the same time, people keep investing.
Next Wednesday, they'll mint money.
Exactly.
Which is what they typically do. Maybe things have changed, but that's ultimately the expectation for Wednesday's earnings reports. Equity futures on the S&P 500 just about unchanged with an update on stories worldwide with your Bloomberg brief. Let's cross over to Lizzie Burden for more. Hey, Lizzie.
Hey, John. President Donald Trump and Australian Prime Minister Anthony Albanese have signed an agreement to boost production of critical rare earth minerals in Australia. The two governments will invest more than $1 billion over the next 6 months for initial projects, both pledging to protect their domestic markets from unfair trade practices. And a US appeals court is allowing, for now, President Donald Trump's plan to send National Guard troops to Portland to counter protests against his immigration crackdown. A divided court in San Francisco lifted the order blocking deployment of 200 troops. And billionaire John Katzimatidis is urging Republican mayoral nominee Curtis Sliwa to drop out of the race to consolidate support behind Governor Andrew Cuomo. This echoes the calls from billionaire investor Bill Ackman in an effort to challenge the frontrunner Zohran Mamdani. Katzimatidis, a longtime Republican and former mayoral candidate himself, said that the move is essential for avoiding a potentially damaging outcome for the city. And that should be my brief, John.
Sort of mental gymnastics right now that I'm trying to figure out. The politics of New York City. We've got to get the Republican to drop out to help the failed Democrat defeat the Democrat that won the primary.
Yes. That's correct, yes.
Because the existential risk the city faces.
Yes, correct. You put it perfectly.
The Republicans have got to clean this up.
The Republicans...
Can you just help me out with that bit? Because that's the bit of it I'm struggling with.
Because basically they view Sliwa's not going to win, so they're basically saying they think Cuomo
Shouldn't
is
the Democrats
better than
address this mess?
Okay.
Is it really up to the Republicans?
All right.
We're still waiting for Hakeem
tweaking.
Jeffries, who apparently yesterday said he will at some point talk about it and make an endorsement.
My point precisely.
Okay.
You know?
There's a huge split in the party, and this is
Obviously.
highlighting this. And I wonder at a certain point if there starts to be more consolidation around the center.
The Republicans are like, we prefer the Democrat, not the socialist.
Right. Okay. Up next on the programme, the Morning Calls Plus. Alicia Reese of Wedbush ahead of earnings from Netflix later on today. That conversation just around the corner, live from New York City this morning. Good morning.
We were able to lower our total tariff forecast for the year by about $500 million from where we started the year. And I think it's that proactive partnership in terms of really making sure that we can remain competitive and help to drive more investment into the U.S., which we've done. We think that there's actually an opportunity for us to do better in 2026 and start to work our way back up to those 8 to 10% targeted margins that we set for ourselves before the tariffs were put in place.
That was the General Motors CFO, Paul Jacobson, with us in the last hour. This hour, that stock up in the pre-market by 11%. A beat and a raise underlining the adaptability of corporate America. GM knocking it out of the park in many ways this morning.
Yeah, and highlighting how they're able to adapt and adjust to the changing policy landscape while also continuing to sell cars. It raises a question long term how much companies can use upper income buyers to support their earnings, because it's the trucks and the more expensive cars that have bolstered things and allowed them to keep prices stable more broadly. And that, I think, is a key question. Are they benefiting from the K-shaped economy, and can that actually sustain things in a way for a longer period of time than people previously expected?
The stock is up by 11%. We'll have more on that stock in about 15 minutes' time. The broader market's doing okay, just about positive, following a big two-day run on the S&P 500, bouncing back from the credit scaries on Thursday. Equity futures this morning just about unchanged. That's the price action. Let's get to some morning calls. First up, JP Morgan raising its price target on Zions to 62, noting credit quality trends outside of Tricolor and First Brands are well contained. Your second call from Wells Fargo downgrading Cleveland Cliffs to underway, calling Monday's 22% rally excess exuberance. And finally, TD Cowen reiterating General Motors as a top pick after earnings, citing positive 2026 commentary. There's that name again. The stock is higher by more than 11%. Let's stick with earnings. Netflix reporting after the closing bell later on today. Geetha Raghunathan of Bloomberg Intelligence joins us now for more. Geetha, welcome to the program. What are you and the team focused on when they release their earnings later on this afternoon?
Yeah, thank you so much, John. So I think the big number that everybody is looking for, obviously, now that they no longer disclose subscriber metrics, is the revenue growth number. So, they've guided to about 17% revenue growth. Operating margin, of course, also upwards of 30%. They've guided to about 31% or so. The big thing I think that everybody's going to be looking for is, fourth quarter guidance. Again, we expect strong double-digit revenue growth. Consensus is at about 16%. And then whether they're going to raise their operating margin guide for the entire year. I think that's, again, something that we're looking at. Right now, they're at about 30% target for the full year, whether they take that up and then provide any forward guidance for 2026.
Geetha, can we talk about subs? I know they don't emphasize that anymore, but historically, this name would be the source of massive beats and misses. Have we smoothed that out over the last few quarters, Geetha? Is this easier now to forecast?
I'm not sure whether it's easier, John, but I think definitely there is. We've seen definitely a pattern of somewhat of smoothing. I wouldn't say it's a very smooth story, but I think what Netflix is really trying to get investors to focus on right now, instead of subscribers, is really engagement. And we saw a huge bump in engagement in the third quarter. Think of K-pop Demon Hunters. That was a monster hit for Netflix in the third quarter. By the metrics that we're tracking, it led to about, maybe about a 20% increase in engagement through the third quarter. And we expect that to be extremely strong through the fourth quarter as well. So that is really the new metric that they're trying to get everybody to focus on.
Geetha, thank you. Thanks for jumping on. Geetha Raghunathan there of Bloomberg Intelligence. Alicia Reese of Wedbush Securities has an outperform rating on Netflix and a target of 1,500, writing the following: as Netflix continues to enhance its ads business, its aim of doubling ads revenue this year is entirely achievable. Alicia joins us now for more. Alicia, welcome to the show. We talked to Geetha about it briefly. Can you just offer us your thoughts? What are you laser focused on later on this afternoon?
Yeah, I think Netflix is poised for to hit their guidance this quarter, but I do think the focus is primarily on the fourth quarter guidance and whether or not they give 2026 guidance. I think there's a lot of high expectations that they'll give 26 guidance, and I think they might give a couple metrics, but not overall guidance. The fourth quarter, though, is shaping up to be extremely strong from all the metrics that we have seen. The upfront season was really healthy for Netflix, and they have a lot working for them in terms of their partnerships, live events, and like Geetha said, that there's incredible engagement. And I think that crosses the ad tier as well as the premium tiers. And so they're positioned very well going into the fourth quarter and certainly throughout 2026 here.
We've been talking a lot about how frustrating it is for people, Alicia, to not know where their favorite programs are playing, whether it comes to sporting events or whether it comes to their favorite shows. And that's the reason why M&A has always been percolating in the distance. How much do you expect them to address M&A in 2026? We know that they kind of shunned it this year.
Yeah, I don't think Netflix is as keen on M&A generally as many others. I think Roku and Amazon, the other platforms, are doing a good job of, curating the content and working with the likes of, Roku and Amazon as a platform on just M&A spending, doing some good marketing, having the sports landing page on the Roku. I think it's really helpful. So those are good partners, and I think as Netflix continues to partner with Amazon ads, the Roku platform, and in the future, performance marketers, I think there's a lot more potential with that than pure M&A.
Are we reaching a breaking point when it comes to how much, Alicia, consumers are willing to pay right now, given the fact that prices have been going up significantly and there are so many different outlets?
I think, all the data that we have seen shows incredible resilience on this latest round of price increases, which says to us that, there's still a room. You have something for everyone on the Netflix tiers. You have premium tiers that's incredibly elastic. And then you have the ad tier, which is less so. But, it's reasonably priced. It's, $7. They increased it $1 and, there was no pushback from what we could see.
Alicia, do you think there's going to be any impact from Elon Musk earlier this month in October calling for his supporters on X to cancel their Netflix subscriptions?
There was probably some brief pushback, but our survey work that we did, which kind of coincided with that happening, indicated very little pushback. There's some churn, but interestingly, the amount of people who are planning to subscribe in the fourth quarter who had never been on the service before was higher than we've ever seen it. So I think people are planning to come on for the Christmas NFL games and for some other live content, some specialty content, and all the content that Netflix is bringing to the service to increase that engagement. And they're spending quite a bit on content. That should keep that engagement high and keep those people on the service.
Is basically all press good press? Individuals want to know what Elon Musk is talking about, why he's saying they should cancel their subscriptions?
That's a tough one. I think to some extent, yes. But the boycotts, look at Disney. That boycott, was really impactful, and that was quite damaging, I think. I don't know how long that will last for them, but it certainly did impact them. I think this is less important.
Alicia, are content decisions getting harder? Is that ultimately what we're witnessing here? The kind of content that you produce, you have to be a little bit more careful about the decisions you make and maybe not follow and chase the political winds of the moment.
Sure, to some extent, yes, but you also want something for everyone. And that's what Netflix's strategy is. They have content for everyone, and they have such a huge user base across the world that they have to have something for, people of all political persuasions, geographic locations, so they're trying to get content on there for everyone. That's, to the point that they're, adding podcast content, video games. They have something for everyone. Sports, it doesn't matter. So I think, if people don't like some content, they can avoid it.
Alicia Reese of Wedbush. Alicia, thank you. Appreciate it. Just need Landman. More Landman. That's paramount, right? We get another season.
Yeah, we get another season of Landman.
Very cool.
And Sheridan is, I'm sure, working on his next hit to really placate.
I saw the commercials at the F1 race over the weekend.
I gotta say, I love that show. It was actually amazing.
Fantastic,
it was an
right?
amazing first season. So I'm looking forward to.
You want some more
next.
good news?
Yes.
Cane sugar Coke will be sold in glass bottles, according to the Coca-Cola CFO.
How long have we been waiting
We
for
don't need
this?
microplastics.
There we go.
Oh, they're actually
another
more
win for RFK, right?
Yeah. I mean, actually it is.
There are more microplastics in recycled glass than there is in plastic bottles. They've actually found that.
You're just trying to ruin this for us.
Yeah, I don't think that's true.
A glass bottle of chilled Coca-Cola with cane sugar.
I think it's great. I'm just
fantastic thing, Bramo. Why are you a downer about everything?
I'm not a downer at all.
The opening bell 60 minutes away after closing yesterday. That close to all-time highs. Equity futures on the S&P 500 up by not even 0.1%. On the Nasdaq, just about unchanged. Earnings so far this morning, pretty good. Coca-Cola, General Motors, Zion's overnight. More still to come. With your morning movers, let's cross over to Yahira for more. Hey, Yahira.
Hi, John. Exactly. A strong showing in earnings. And among the winners is Halliburton. Shares are up nearly 5% in the pre-market after the oilfield services giant beat on revenue and blew past suggested earnings estimates, even as oil prices remain under pressure amid global oversupply. So investors are rewarding the company's ability to hold up in this tough market. And we move on to Coca-Cola. Those shares are also rising 2.7% after it topped third quarter expectations, thanks in large part to higher prices amid steady demand. The company raised prices 6% in the last quarter, and yet shoppers continue to snap up its beverages. Coca-Cola Zero Sugar was a standout in the quarter, topping sales of Diet Coke. And yes, they are two different products, but I'm just waiting for that cane sugar Coke that's, as you said, is coming in glass bottles. And we end on GM shares. Those are stealing the spotlight this morning, up 11% now. It was a beat and a raise for the car maker after red hot demand for its trucks and SUVs helped offset tariff pressures. And CEO Mary Barra giving credit to President Trump because those tariffs were not as bad as expected due to some discounts. CFO Paul Jacobson saying the same to you guys earlier. John?
Thank you very much, Shahara. Diet Coke's got a different flavour profile. You know?
Have you ever tasted Diet Coke?
Sure, of course, yeah.
Okay.
Once upon a time.
Okay.
I'm a Diet Coke
I'm not a regular
fan
drinker.
over a regular
I've never
Coke
met
fan.
a healthy person that is a regular drinker of Diet Coke. Have you?
How do you define healthy? I mean, honestly, yes, okay, sure. It's not a healthy thing to do, but everyone can have a treat.
Two biggest Coke drinkers I know, President of the United States and the former Treasury Secretary Janet Yellen.
How healthy are they? Don't
No
go
comment.
there. Don't go there. Let's stick with General Motors. The stock's surging after delivering a beat and a raise. Does she still smoke? I think she still smokes, right? Or she quit?
Definitely likes Diet
Okay,
Coke.
back to GM. Bloomberg's Craig Trudell joined us now for more. The stock is higher by close to 11%. Craig, don't worry. We're avoiding all of that. This is a safe place for you. Let's talk about General Motors. Craig, just frame for us how impressive this beat and raise is, given what this company has faced down so far this year.
Yeah, I can vouch for GM being healthy. I think the trifecta here, as Evercore put it, was a beat, a raise, and also maybe some upside for the fourth quarter, and even sort of an early taste of where GM's head is at for the outlook for 2026. I think there was a lot to like in these results, and coming into these numbers, reasons for pause. Right, we've been very concerned about the degree of tariff disruption to car makers, and even the likes of GM, where, as big as they are in the U.S., as much of a presence as they have, they also do a heck of a lot of importing from Mexico and Canada and even South Korea. And so, for them to be able to execute through all of this tumult is pretty impressive for the company, and the reason why we're seeing the shares move the way they are.
Craig, in a few days we get Ford. Did the bar just creep higher for Jim Farley and the team in a few days' time?
I think absolutely, and we've seen this, sort of long-standing, pattern of Mary Barra and GM sort of outperforming Ford from an execution standpoint, where Jim Farley will be the first to sort of cop to this idea of, particularly on warranty expense and quality issues. We've seen that continue into this year, where Ford has had to, delay, new product introductions and really take it on the chin in terms of, just how much it's spending on a regular basis with recalls and fixing up vehicles that have already been sold. That is something that we've not seen anywhere near to the degree out of GM. So much sort of smoother execution on GM's part through all of these, ups and downs that is difficult for any automaker to be navigating at this juncture.
Craig, just before you go, in just a moment, we'll be talking about prices, looking ahead to CPI data in America that drops on Friday. Can you briefly describe pricing power and how that's evolved at these automakers and whether that changes going into the new year?
Yeah, we've talked, offline. Anne-Marie and I were just exchanging messages. It really is eye-popping to see average new vehicle transaction prices with a 5 on it, $50,000. Last month that was a new record for the U.S. We've absolutely seen pricing power, and yet we've seen reasons to be concerned about just how sort of long-standing or sort of sustainable that is when we see 84-month auto loans becoming the new 72-month auto loans. There is a reason to sort of pause and consider just how long we can sort of keep this up, and as we monitor this industry closely of, what some of the dynamics are under the hood that are allowing for sales to continue at a strong level for the likes of GM.
50K. Craig, thank you, sir. Craig Trudell. And when we talk about the banks and some of the credit issues, this is the industry that's been a source of some of those issues more recently.
Yeah, especially when you talk about the idea of a 7-year loan to buy the car. And what you're seeing is the pace of the value of the car is actually coming in lower than the total outstanding loan that people owe. It creates a real issue in terms of just what kinds of losses there could be on the financing of this, and what the willingness really is to continue to extend it.
Let's talk about prices. $50,000 for a car. Unreal. The data desert getting a drip of water this week with the September CPI report set to be released on Friday. Blurino Urucci of T. Rowe Price writing the following. The availability of data has been curtailed because of the shutdown, but what we have seen so far from the private sector suggests that the economy is still holding up quite well. Blurina joins us now for more. Let's start with that data on Friday. There are several sources for inflation: goods, services, energy and labour. What's the dominant source at the moment?
I think there is an interaction here of various components of core inflation. So we'd seen deflation and disinflation in goods, in the goods sector for quite some time, and that's reversed this year. I think that's a combination of a number of factors, including tariffs. And it's true that the pass-through of tariffs to consumer prices has been slow, but we've seen signs of it already happening this year. But I also think that we are seeing a stickiness in services inflation that hasn't been here before. We're looking at 3% or more services inflation. It has not gone back to pre-pandemic levels yet. And that, I think, is reflecting the fact that you have a labor market that maybe has cooled a bit from the peak of the tightness back in 2022, but it's not really weak. And we're talking about consumer demand being there and sort of consumers finding different ways to fund their spending. Perhaps initially post-pandemic, it was being funded by excess savings and aggregate income being very strong. And now it's shifting a bit more to leverage and financing of that consumption. So there is a resilience here on the part of demand that is allowing companies to continue increasing prices at a pace that so far is not consistent with the Fed's 2% inflation target, I'm afraid.
How much has the inflation story really been muddied by oil prices that have come down as much as they have?
I think that's definitely been very helpful for two reasons. We're seeing headline inflation running a little bit below core inflation every now and then. We also know that consumers, they buy oil, they buy gasoline on a daily basis. They're much more exposed to it, and it can affect inflation expectations. So I think this has been helpful for policymakers. But if you're looking at where inflation is going to settle over the medium to long run, I think core inflation is really what matters. And I think the fact that we've been now for over 4 years above the inflation target, and we've been stuck at 3% for the last 12 months, I think that's problematic, even with the help of energy. One other area that I think we're not paying enough attention to is food inflation, because, again, this is something that consumers buy more frequently, and it can affect inflation expectations, even though it's not part of the core index. If I'm correct in my prediction, I think in 2026, we will see a pickup in food inflation, both food services as well as food at home. And that's going to be a mixture of the fact that we are importing food ingredients and we're going to pay more tariffs on them, but also the tightness in the labor market and the immigration enforcement that seems to be one of the key pillars of this administration's policy. I think that's going to lead to tightness both in farming, in the farming industry, but also in retail and hospitality. And that's going to reflect in higher prices next year.
Blorina, what's the role of the Fed in terms of curtailing inflation right now? And I ask this because a lot of these inflationary forces are exogenous and don't necessarily come from wage increases and the typical wage price spiral. And there's this idea that some of this will just work itself off on one-time effects. And the Fed wants to cater to the fact that there is weakness in certain parts of the labor market. Do you think that if the Fed cuts rates later this month, in December, that actually will cause a reacceleration of inflation higher?
I think the risk is there. The ingredients are there for a reflation or inflation trade in 2026, and I'll tell you why. I think, of course, we've seen that deceleration in employment growth, and that's something that is concerning the Fed. And it has a dual mandate, and it needs to pay attention to the employment side of the mandate. But when you look at the unemployment rate, that's still fairly low. Wage inflation has slowed, but it has not come down all the way to where it needs to be to hit the 2% inflation target over the medium run. Maybe there will be productivity gains next year that will help the Fed on the wage front, but we're still not there at target. And then I honestly think it's problematic that inflation has been stuck at 3% for the last year, for the last 12 months. And we also have seen since spring a real easing in financial conditions. We know that that works through the economy with a bit of a lag. So next year, we're going to have the boost to demand from easing financial conditions and probably some positive fiscal impulse. I know that over the forecast horizon for the government, the deficits will be neutral to growth, but over the next 12 months, I think they will be positive to growth. So you have, in my view, a rebound in activity next year, held by financial conditions easing and some positive fiscal impulse. You have an unemployment rate that is still fairly low. U.S. consumers don't have excess savings anymore, but they're very good at leveraging. And we just spoke about that and taking auto loans and extending the window of borrowing compared to previous business cycles. So you can do all sorts of things to support demand next year. And you have a Fed that is easing or cutting interest rates when all those factors are pointing to demand picking up in 2026. I think that sets us up for an environment where inflation certainly won't go back to target, but it might even accelerate.
You wonder where that leaves the bond market, which is 90 basis points lower on a 10-year maturity compared to where it was in the middle of January. Blarina, thank you, as always. Blarina Urici there of T. Rowe Price, looking for higher inflation in 2026. The Federal Reserve's cutting interest rates into that.
And at the same time, what we heard from Earl Davis earlier is that even if the Fed cuts aggressively, it's going to cause the long end to rally. And when we asked why, it doesn't make any sense if you expect inflation's going to pick up. And he said, well, the market can only focus on one thing at a time. So that's a 2026 story. And that seems to be what a lot of people are banking on.
Chairman Powell set himself up to ignore it. Is this market going to ignore it too? Let's get you an update on stories worldwide this morning with your Bloomberg Brief. Let's cross over to Lizzie Burden. Hey, Lizzie.
Hey, John. A U.S. appeals court is allowing, for now, President Donald Trump's plan to send National Guard troops to Portland to counter protests against his immigration crackdown. A divided court in San Francisco lifted the order, blocking deployment of 200 troops. Elsewhere, Unilever has delayed its demerger from Magnum Ice Cream due to the U.S. government shutdown. The company shared the SEC is currently unable to approve its registration to list on the New York Stock Exchange. The spun-off unit was initially scheduled to debut in the Amsterdam trade on November the 10th, with planned secondary listings in New York and London. And police are still looking for those precious jewellery stolen from the Louvre and the thieves behind the heist as well. The robbers got away with a haul on Sunday that included a tiara, an emerald necklace, earrings and a sapphire necklace. They dropped a crown and a yellow vest with DNA traces, which gives authorities hope for recovery. And that's your Bloomberg Brief, John.
As you do, just casually dropping a crown.
Okay, actually, they damaged this crown from the 1800s, and people are saying amateurs. That was the response. Amateurs. Come on, get with Ocean's 11.
Thank you. Great work, Lizzie, as always. Up next on the programme, we'll set you up for the day ahead. Plus, we'll catch up with the former Barclays CEO, Bob Diamond, as he remains bullish on regional banking. That conversation up next.
We kind of all recognize that The part of the reason why we have had such a strong economy is that we have a consumer who is so willing to go out there and spend money. And that has really propped up a lot of this economy in a really major way. If we lose that, as we're starting to see some degradation in the consumer strength at the low income, it really does ripple through this economy when so much of it is driven off the health of what the retail consumer is doing.
That was Julie Beale of Kane Anderson Rudnick talking about the adaptability of corporate America and a whole lot more. As we count you down to the opening bell, lots of earnings in focus. Later on today, Netflix results after the market close. You'll also hear from Western Alliance too. As we make our way to Wednesday, Tesla and IBM results. On Thursday, numbers from Intel, Ford and American Airlines. On Friday, CPI data, the main event on the data front, because we don't get much of it these days. And UMich consumer sentiment going into the weekend. Let's stick with earnings. Zion's reporting a beat on earnings with a net income of $222 million, despite a $50 million loss from an alleged fraud. The former Barclays CEO, Bob Diamond, writes the following: the dislocation in regional banks stems from a few single bank-specific issues, but doesn't change our view on the opportunity. We remain very bullish on regional bank consolidation. Bob joins us now for more. Bob, good morning.
Good morning, John.
It's good to see you, sir. Look, a few years ago, we had some problems managing interest rate risk. Can we avoid it with credit risk in this segment now?
I think broadly in regional banks, as you just quoted me, we're very bullish. I think, both the interest rate dislocation that started with SVB or was recognized with SVB, and we were really a function of rates going from 0 to 5.5%, is in the market. I think the regional bank area has some really strong banks and some that are not as well managed. So, of course, some have more exposure, for example, to commercial real estate than others have. And if the commercial real estate is in Iowa, it might be different than if it's in L.A. So we look at all of those things. But as a sector, this is a really, really strong sector, the banks. There's 4,500. It has the support of Secretary of the Treasury Bessent. That consolidation is necessary, makes the banks more competitive. It increases the ROEs. It makes them just better investments. And I think 4,500 banks in the United States of America, it's the wrong number. And so we see this going over the next 2 to 3 years to closer to 1,000 or 1,500. And we think also, John, I think this is really important. The thesis here is one of consolidation and taking costs out. So many of these smaller community banks are just too small to succeed. They're very good banks, but to get a positive ROE with technology costs, with regulatory relation costs, virtually all of these banks have the same technology platform. So you eliminate one technology platform. Many of them, or all of them, have regulatory relations staffs. You can eliminate one of those. You don't really need two. So if you add the cost synergies, which we've proven in back testing really come out and are real, and you add the increase in ROE, because when a bank buys another bank, there's purchasing accounting, and you have to market fully through the P&L, the bank that you're acquiring. You're putting capital in. Automatically, the ROE goes up because the asset prices are different. So when we look at the cost savings, we look at the increase in ROE, we look at 4,500 banks, we look at too many or too small to succeed. This is probably the best investment we've seen where the downside is really, really protected and there's good upside.
It's happening. Your forecast is happening. Yeah. We've seen it with Fifth Third and Comerica. You're suggesting there's more to come. You talked about how region-specific some of these issues can be. Is there a common thread in the consolidation so far?
I think what we have seen is where the synergies are most clear is in-state and close to state. So when you have a really good front office, meaning you have a good business around deposits and loans, and a similarity in terms of region where you're really adding clients and customers and taking out costs, those are the best opportunities. But not in terms of where in the U.S. It's more that in-state and close to state is the preference.
There's been this fear that some of the biggest banks have really taken the wealthiest and the highest credit ratings in terms of customer base, and that mid-tier banks are stuck with everybody else, and that's where the credit problems have really come. Has there been anything that you've seen that proves that to be true?
No. We've seen idiosyncratic issues. We've seen certain banks that, may have a specific name issue. But the truth is that, 40 to 50% of lending to small businesses in the U.S. come from the regional and community banks. They don't come from the big banks. Many of the big four, many of the larger regionals just don't have the cost structure or the attention to service smaller businesses. So we think the credit quality on balance in lending is very, very good across regional and community banks.
If there's no real weakness that they're seeing with respect to consumers or smaller businesses, does it make sense and does it really help the case to have the Fed cutting rates at the same time that inflation is still a concern?
I think the cutting rates, I mean, if you think of the go-forward environment, so let's say a regional bank buys a community bank, you get the synergies, you have an ROE, and now you're focused on additional acquisitions and what's the go-forward. The go-forward is terrific. I mean, the Treasury, the Fed, the SEC are encouraging consolidation. They're talking about simplifying capital rules. They're talking about endorsing these mergers and this consolidation, and then you have rates at 4 to 4.25%, likely coming down this month, potentially again in December. You have 100 basis points between 2s and 10s. You can't make a better environment for banks going forward than this. So if you strengthen through consolidation, and then you look at the go forward, obviously, assuming that the economy stays stable and strong, it's a great environment for banks.
But you're forecasting at least that 4,500 number to be cut in half in the next 3 years. Is that right?
More than that.
More than that.
Yeah.
How is that possible?
I think one of the situations we faced prior to this administration is there wasn't quite the same support for approving mergers. Was it Elizabeth Warren and Bernie Sanders a little bit on the edge? Like, I'm very, very surprised, Anne-Marie, that Elizabeth Warren would come out and say we shouldn't approve consolidation in banks. And we're talking about putting additional capital in banks, making them stronger, making them better competitors with JP Morgan and Citi, and yet she's against it. And that's the politics of being a liberal and saying no, no, no to anything that looks like it's positive for business and positive for profits. This administration has been very clear. It's going to make the banks stronger. It's going to make them better competitors to the big banks. It's going to provide more lending. In a way, it's getting more, it's kind of monetary easing, right? It's getting more money into the market for businesses that need to raise money, small businesses, to expand what they do.
Bob, we've got 30 seconds left with you, which is not enough, I know.
Oh, come on, give me more.
The mayoral race in New York City.
Yes.
The beating heart of capitalism and the socialist is ahead. What's your brief take on what's happening in this city?
You know, I think the city is at the strongest it's been since pre-COVID. I live in Midtown. We have our office in Midtown. I walk to work in the morning for 11 blocks, and I have never seen so many people on the streets every morning as we've seen in the last couple of months. The city was really hit by COVID. It was really, really tough. I think we all kind of, struggled through, not quite able to admit this is really bad. And it's really good. The city's back, new restaurants, new clubs, people excited, down in the village. My son and his family who live in London are moving to Brooklyn. They're really excited. I think the city has a lot of buzz.
You managed to answer that question without
Don't
answering
you love
that
the way I
question.
avoided that?
He's running. Diplomat.
Bob Diamond, everyone.
ओके गाइस, ये नेचुरल गैस में अपना एसएल थोड़ा स्ट्रिक्ट रखना। ये काफ़ी देर से रुका हुआ है, कहीं ब्रेकडाउन किया तो फिर नीचे कोई सपोर्ट है नहीं करंटली। क्रूड ऑयल देखोगे बहुत वॉलेटाइल हो रहा है, रेजिस्टेंस होल्ड करके बैठा हुआ है बट नीचे और नहीं जा रहा है। मॉर्निंग पे यूएस ने जो सैंक्शन लगाए थे रशियन ऑयल कंपनीज पर, और यूरोप ने जो सैंक्शन लगाए थे रशियन एलएनजी इंपोर्ट पर, उसकी वजह से क्रूड ऑयल काफ़ी बड़ा गैप अप हुआ। उसके बाद कंटिन्यूसली अपसाइड जाता चला गया, फिर एक रेजिस्टेंस एरिया से थोड़ी बहुत प्रॉफिट बुकिंग या सेलिंग ये देखने के लिए मिली थी। थोड़ी देर पहले वॉलेटाइल हो गया था मार्केट बिकॉज उन सैंक्शन की वजह से चाइना और इंडिया दोनों ने ही कहा है कि वो रसिया से ऑयल और नेचुरल गैस प्रोडक्शन कम कर देंगी या बाई करना बंद कर देंगी, जिसकी वजह से एक सडन जंप फिर से देखने के लिए मिला था। बट ऊपर रेजिस्टेंस अभी भी होल्ड है। मैंने पहले ही बोल दिया इसमें हाफ प्रॉफिट बुक करके ही ट्रेल करना, ठीक है। हाफ प्रॉफिट बुक करके ही ट्रेल करना अगर ट्रेल कर रहे हो अगर क्रूड ऑयल में। यूएस मार्केट भी बाकी ओपन हो गया है, देखते हैं कितना और मूव करता है। नीचे जाता है तो बढ़िया रहता है, अगर यहाँ से ऊपर ब्रेकआउट हुआ तो फिर नेक्स्ट रेजिस्टेंस अभी के लिए तो 5600 के आसपास ही है। बाकी नेचुरल गैस भी मॉर्निंग पे साइडवेज ही था, एक थोड़ा बहुत मोमेंटम थोड़ी देर पहले आया। वो जो एलएनजी इंपोर्ट पे बैन लगाया है यूएस ने, तो चाइना ने भी लेनो उसको बाई करने से मना कर दिया शायद उनकी कंपनीज, तो उसका एक इम्पैक्ट नेचुरल गैस में बेरिसनेस होता हुआ। गोल्ड और सिल्वर एमसीएक्स के लेवल देख लेते हैं। इम्पैक्ट गोल्ड और सिल्वर पे देखो, गोल्ड के लिए तो बुलिश ही है ओवरऑल, वैसे देखा जाए देखना पड़ेगा मोमेंटम करता है नहीं करता, क्योंकि प्रॉफिट बुकिंग में ही चल रहा है गोल्ड भी। एक बार देख लेते हैं फिर भी एमसीएक्स में अभी बाय द वे एक डेटा भी आने वाला है। नेचुरल गैस की इन्वेंट्री है और 730 पे एक एग्जिस्टिंग होम सेल्स का रेट है, दोनों ही गोल्ड और सिल्वर को इम्पैक्ट करेंगे। नेचुरल गैस की इन्वेंट्री, नेचुरल गैस के प्राइस को, तो 8 बजे नेचुरल गैस की इन्वेंट्री के लिए भी रेट है ना। तो डेटा तो पॉजिटिव ही है। सैंक्शन का जो इम्पैक्ट है मॉर्निंग पे वॉलेटाइल था, अभी थोड़ा बहुत पॉजिटिव ही दिख रहा है। 730 के डेटा का वेट कर लो मेरे अकॉर्डिंग, तो बाकी इम्पैक्ट तो पॉजिटिव ही है ओवरऑल गोल्ड और सिल्वर के लिए। बाकी एक बार देख लेते हैं इसमें रेजिस्टेंस है भी या फिर जैसे मेरे अकॉर्डिंग तो फॉरेक्स में देखोगे बेटर रहेगा, वहाँ पर लेवल थोड़ा सा ज़्यादा क्लियर होते हैं। फिर भी देख लेता हूँ एक बार एमसीएक्स में कुछ अगर 15 मिनट में एटलीस्ट बन रहा है। ओवरऑल न्यूज़ तो बुलिश ही है, बट देखना पड़ेगा प्रॉफिट बुकिंग में जाता है या फिर न्यूज़ की वजह से और बुलिश होता चला जाता है ऑल टाइम हाई पर। बाकी 4 आवर में एम पैटर्न तो बन ही गया था। ओके हाँ ये है। देखो इसमें ऊपर क्या है लेवल 4160 100 हाँ 4160 के आसपास वो एक सपोर्ट था, परसों ब्रेकडाउन हुआ है उसका, कल एक रीटेस्ट कर दिया है, अभी फिर से उसी रीटेस्ट पे पहुंचने वाला है। मेरे अकॉर्डिंग तो वो रीटेस्ट हो गया है, तो उसको वैसे ज़्यादा कंसिडर करना, मतलब चार चार बार तो रीटेस्ट करेगा नहीं, बट या अभी के लिए वही एक लेवल है हमारे पास एज अ रेजिस्टेंस। गोल्ड एमसीएक्स 15 मिनट टाइम फ्रेम पे। बाकी इस रिटेस्ट के ऊपर अगर जाके कोई नया रेजिस्टेंस बनाएगा तो बात अलग है, तो दैट इज़ अ रेजिस्टेंस एरिया जो टेस्ट एक बार कर चुका है। इसके ऊपर ऊपर तो बस सीधा ऑल टाइम हाई ही है रेजिस्टेंस, और तो मुझे कुछ दिख नहीं रहा यहाँ पर। सीधा ऑल टाइम हाई का ही रेजिस्टेंस है। ठीक है, अभी के लिए ये एक रिटेस्ट ऑलरेडी कर चुका है, उसे वही सेम जोन बना हुआ है। यहाँ पर तो मुझे कुछ दिख नहीं रहा, ऑल टाइम हाई का ही फिर रेजिस्टेंस है आपके पास एक। यहाँ पर कोई नया रेजिस्टेंस बनाता है तो बात अलग है। तो मोस्टली तो ये ब्रेक सस्टेन नहीं होना चाहिए 4160। थोड़ा और एक ग्रेस नंबर ले लो तो 4170, दैट इज़ अ मेजर जोन नाउ। अगर यहाँ से नहीं आया तो थोड़ा सा अगर हायर टाइम फ्रेम पे देखोगे ना, ये जो एम पैटर्न बना है, इसको काउंटर करने के लिए ये कहीं ऐसा ना हो कि डब्ल्यू पैटर्न के अंदर घुस जाए इस तरीके से। तो अभी के लिए तो यही रेजिस्टेंस है 15 मिनट टाइम फ्रेम पे। बाकी न्यूज़ तो पॉजिटिव है, देखते हैं इम्पैक्ट कितना डालती है। ठीक है, बाकी क्रूड ऑयल में ये यहाँ पर रुक इसलिए रहा है बिकॉज ये भी एक रेजिस्टेंस ही था, बट यहाँ पर ओपन इक्वल टू लो बना के मार्केट ने ऊपर ब्रेकआउट कर दिया था। यहाँ पर हमने सेल नहीं किया था, याद होगा। ये नीचे आ रहा है तो यहाँ पर ये रीटेस्ट में फंसा हुआ है, तो ऊपर रेजिस्टेंस है, नीचे रीटेस्ट का सपोर्ट, इसलिए रुक रहा है। इसलिए हाफ प्रॉफिट बुक करके ट्रेल करना, अभी रेंज के अंदर है कम्प्लीटली। दोनों साइड ट्राई कर चुका है, जितने लेवल बार ट्राई करना है, जिस साइड भी अब ब्रेक करेगा अब साइड अच्छा मूव कर जाएगा। कि और कोई नया रेजिस्टेंस सपोर्ट बना भी नहीं है क्रूड में। दोज आर द लेवल्स ओनली, ये रेजिस्टेंस, ये रीटेस्ट का सपोर्ट। रेजिस्टेंस था, ब्रेकआउट हुआ तो सपोर्ट की तरह काम कर रहा है। ऊपर ब्रेक करता है तो फिर नेक्स्ट रेजिस्टेंस 5600, नीचे आता है तो वो जो कल का रेजिस्टेंस था आज ऑलरेडी उसके ऊपर निकल गया प्राइस, तो दैट एक्ट लाइक एज अ सपोर्ट। देखते हैं और कुछ इंट्राडे में न्यूज़ अगर आती है तो। ये बाकी नेचुरल गैस को भी देखोगे काफी क्रिटिकल पॉइंट पे कह सकते हो लास्ट रेजिस्टेंस है। मुझे नेचुरल गैस की भी ज़्यादा उम्मीद नहीं लग रही ऊपर जाने की। मैक्स टू मैक्स 302 303 तक ही लग रहा है जाता हुआ अभी। यहाँ पर लग रहा है ज़्यादा ही इंटरेस्ट अलाइन नहीं हो रहा है यहाँ पर। इसमें ना यहीं पर बुक कर लेना, ज़्यादा उम्मीद नहीं है। इस लेवल को हिट कर जाए तो इस जोन को हिट कर जाए तो निकल दो यहाँ से। बेस्ट केस सिनेरियो ये रहेगा। यहाँ पर एरिया ऑफ इंटरेस्ट बन चुका है ऑलरेडी। ठीक है, ठीक है, ये इतना ही एक्सपेक्ट है मुझे, इससे ज़्यादा मुझे लग नहीं रहा है जाने के मूड में है। मोस्टली यहाँ से रिजेक्शन मिल जाएगा वापस से इसको, तो ये टारगेट थोड़ा सा इतना ही रखो। हाँ सस्टेन कर गया तो बात अलग है, अदरवाइज यहीं पर बुक कर लेना मेरे अकॉर्डिंग। तो नहीं दिख रहा है इससे ऊपर का स्पेस अभी, अभी तो नहीं दिख रहा है बिल्कुल भी। देखते हैं 302 302 302 303 वापस रिजेक्शन मिलने के चांसेस काफ़ी हाई हैं। ये रेजिस्टेंस है, रेजिस्टेंस लिया ब्रेकआउट हुआ, रीटेस्ट किया, फिर से रीटेस्ट किया, फिर ब्रेकडाउन हो गया, रेजिस्टेंस बन गया यहाँ पर। बाकी नीचे आता है नेचुरल गैस भी, तो फिर नेक्स्ट सपोर्ट 285 के आसपास ही देखने के लिए मिलेगा। वो भी अच्छा सपोर्ट है, वो तो एग्जैक्टली सपोर्ट ही है नीचे। सो कोई न्यूज़ वगैरह नहीं आती है तो आई एम एक्सपेक्टिंग कि ये इसी लेवल से रिजेक्शन ले और फिर गिरे और फिर यहाँ तक आए और फिर यहाँ से सपोर्ट ले। इट इज़ अ बेस्ट केस सिनेरियो एज पर माय एनालिसिस कि यहाँ तक ही जाए, यहाँ से फिर रिजेक्शन लेके नीचे यहाँ आए और यहाँ से फिर सपोर्ट ले। हाँ, इसके ऊपर सस्टेन कर गया तो बात अलग है, फिर तो सिनेरियो चेंज हो जाएगा, बट मोस्टली इतना ही है। यहाँ से मुझे सेलिंग ही एक्सपेक्ट लग रही है इसमें। यहाँ पर प्राइस एक्शन ही ऐसा बन गया यहाँ पे। बाकी अब चांसेस भी कम ही है मोमेंटम होने के, इन्वेंट्री भी आने वाली है, तो देख लो। इन्वेंट्री तो अगर नहीं मूव करता है तो एसएल कॉस्ट पर रख लेना, ऐसा नहीं कि इन्वेंट्री आ रही है बेरिस और बैठे रह गए बाई करके, प्रॉब्लम हो जाएगी। बाकी फोरकास्ट देखो इन्वेंट्री का, तो लास्ट टाइम 80 बिलियन था, इस बार 78, मतलब लास्ट टाइम से कम एक्सपेक्ट कर रहे हैं, तो फोरकास्ट तो बुलिश ही है। अगर फोरकास्ट के अकॉर्डिंग डेटा आता है तो, नहीं आया फोरकास्ट के अकॉर्डिंग तो गिर भी सकता है। तो फोरकास्ट के अकॉर्डिंग तो ऊपर जाना चाहिए। लेट्स सी फोरकास्ट के अकॉर्डिंग ही डेटा आता है या फिर नहीं।
$1 trillion pay package. Now, we're going to bring you some top guests from the Berlin Global Dialogue over the coming 2 days, including the Bank of America France Chief Executive Vanessa Holtz a little bit later on in the program. Now, first thing is first, you know the drill. We start the show, we look at markets. Now, European stocks seem to be hovering near this record peak. Again, there's a lot of earnings. We're in the middle of the earnings season. Third quarter earnings continuing to flow in. The stock 600 gaining about 0.1, 0.2%. Of course, the big story is what's happening with crude jumping to a 2-week high. This is after the U.S. President Donald Trump imposed sanctions on Russia's biggest producer. And then gold. We always look at gold. That's our golden rule on the pulse because it gives us a good indication of maybe money flowing outside U.S. assets somewhere else, and gold 4,099. Again, if you look at Brent crude, look, it's up almost 4%, and then earnings definitely changing the way we look at some European indices. We have another packed agenda for you. On the earnings front, Tesla disappoints. Elon Musk, though, still wants his $1 trillion pay package. On the market news, look, gold again fluctuating after retreating from a record price surge. But first, let's begin with a U-turn from President Trump, with the U.S. stepping up pressure on Russia by targeting its biggest oil producers with sanctions.
We canceled the meeting with President Putin. It didn't feel right to me. It didn't feel like we were going to get to the place we have to get, so I canceled it. But we'll do it in the future.
Mr. President, can you tell us a little bit about why you're elevating sanctions against Russia right now?
I just felt it was time. We've waited a long time. I thought that we'd go long before the Middle East. And Mark, as you know, we did the Middle East plus 7. So we did 7 different wars.
Well, let's bring in Chad Thomas, Bloomberg's executive editor for Europe. Chad, thank you for joining us. It's great being here because we're going to have some great conversations with some of the newsmakers. But if you just followed what Donald Trump wanted to do with Russia and Ukraine, kind of got whiplash because it was a big week to try and understand whether he was friendly with Putin, wanted to meet him, and now these big sanctions.
We got huge whiplash. You and I were talking just a week ago, and we were talking about the Budapest summit. And did that make sense to do that? Should President Trump meet with President Putin for a second time, and whether that he was being played? Clearly, within the last week, things reversed significantly. We were hearing already early this week that the talks between Rubio, the Secretary of State, and Lavrov, the Russian foreign minister, weren't going well. And then Trump not only backed away from the idea of there being a second meeting, saying it would be a waste of time to do that now, but he slapped these sanctions on Russia. This is what the European Union has been asking the U.S. to do for a long time. There will be a significant impact on Russia here. These two companies are 50% of oil production out of Russia. 25% of the Russian budget comes from these two companies. So if you want to impact Vladimir Putin's ability to wage war, you just did that.
Yeah, why did it take so long? I guess is one of the questions. The other one is the ripple effects will be felt far and wide, including China. That buys still a lot of Russian oil.
Yeah, why did it take so long? People were really pushing President Trump to do something, and he's been saying for months that he would. He did say yesterday, and I think this was interesting, I've had some great talks with Vladimir Putin, but then nothing happens. He seems to have finally decided that he needed to take action. China today, we're seeing real strong reaction there. They get 20% of their oil from Russia, and so there's a real concern. They either have to abide by the sanctions or they face the consequences of secondary sanctions on them when it comes to things like access to SWIFT and so on, where Russia obviously has already been cut off from that years ago when the full-scale invasion of Ukraine took place.
So yesterday, a lot of leaders were in Europe, actually in the UK. Yeah. That's a Freudian slip. Still Europe. And today, actually, there's an EU leader summit. What can we expect from that?
Yeah, so we've already seen this morning more sanctions coming out of the European Union against Russia. It will clearly be a big topic. This, by the way, the European Union, Trump says that they love sanctions. This is the 19th sanctions package against Russia from the EU. It's really an effort by them to cut off the ways in which Russia has gone around some of their previous sanctions. So clearly that will be a big topic of discussion at the Leader Summit starting a little bit later today.
Chad, thank you so much. As always, Chad Thomas there and his team with some great coverage, of course, coming all over Europe. Bloomberg's executive editor for Europe. Now on to some corporates, and Tesla profit plunged as rising costs undercut a record quarter of vehicle sales. Now shares in pre-market actually lower, with analysts saying there's just not much to inspire investors and really questioning the timeline to develop new businesses like AI and robots. Well, despite the concerns, the chief executive, Elon Musk, ended the call by pleading with investors to ratify his upcoming $1 trillion pay package.
The point is, I just like there needs to be enough voting control to give a strong influence, but not so much that I can't be fired if I go insane.
Let's go straight to Craig Trudell, Bloomberg's global autos editor in London. Our cards are. Craig, I mean, this is a pretty extraordinary end to a difficult earnings call.
It was, and I guess, I walked away from some of those comments, scratching my head, because if we really sort of have any doubt as to the amount of control that Musk has of this company, it's reinforced quarter after quarter that he's taken them in this direction of kind of sticking with, just the product that they have in terms of their actual core vehicle business. It's been years since we've seen this company bring out entirely new models. The Cybertruck was the last one added. It's also been quite a disappointment and was a product that Musk was very hands-on with. And yet, he is very much in control of this company. And this is a company that is taking his lead into these uncertain directions, chiefly I would sort of flag humanoid robots as being sort of the best example there, where it's really unclear just how quickly this, business is going to be something tangible for investors to wrap their minds around.
Craig, can Elon Musk turn Tesla's fortunes around? I feel like I ask you this every quarter.
Yeah, I mean, I think there's a big debate over, this idea that the auto business is getting really difficult for everybody, right? And it's getting particularly tough for electric vehicle makers where, and particularly for U.S. companies, right? In that with the $7,500 tax credits in the U.S. going away at the federal level, real concerns about how much of an effect that's going to have on the EV industry more broadly. And, a quarter ago, we heard Musk acknowledge that may lead to, in his words, a few rough quarters for Tesla, going forward. There was very little sort of discussion of that last night, which I found surprising. And it was much more emphasis on, again, the humanoid robots that Musk refers to as Optimus, and also on sort of robotaxi efforts that are still, not quite actually robotaxis. You still have human operators in these vehicles that are sort of there to step in and prevent against any crashes or accidents in Austin, Texas.
Craig, I'd love to get a humanoid robot on TV actually next time. It's you and I on the pulse with a humanoid robot. This morning, we also had some pretty strong numbers from Volvo Cars. Challenges ahead. That's what the chief executive told us this morning.
Yeah, I think Hans Samuelsson, to his credit, was pretty clear-eyed about that, and yet the market absolutely is loving what he had to say this morning and the numbers he had to present. This was a company that, when he left it a few years back, was in quite good shape. I think the company sort of felt really compelled to bring him in as a steady hand to turn things around, because performance has gone in the wrong direction since he left. And, he's only been back since April, I believe, and we've seen some pretty decisive moves on his part to really cut costs and sort of unwind some of the things that were happening under Jim Rowan, who was running Volvo for the years since he had stepped away. So, kind of walking back some of this ambition to go fully electric as quickly as previously thought. And again, just sort of reining in costs. I think the job cuts that Samuelsson has announced and moves to sort of improve the operations of this business are bearing fruit much more quickly than everybody was anticipating going into this print.
Craig, thank you so much. What a story. Craig Trudell there, our Bloomberg Global Autos editor. Now, a majority of European Union members, including Germany and France, are now calling for a systematic review of bloc's regulations by the end of the year. It's hoped that the push will dismantle old rules that pose challenges for the competitiveness of EU companies, which are facing a host of headwinds, from tariffs to the ongoing war in Ukraine. Now, these themes are top of the agenda at this year's Berlin Global Dialogue. And I'm now delighted to be joined by Lars-Henrik Holler, the founder and chair of the event. He also served as chief economic advisor to the German Chancellor Angela Merkel. So thank you so much for joining us. Thank you so much for having us. Actually, it's a great event that kind of brings public and private newsmakers at the table. First of all, when you look at Germany, I mean, we talk about an economic revival. This has not happened yet. When do you think we'll have meaningful growth in this country?
Well, I think we're in a very important time. I think this fall is going to be very important, as the German Chancellor said himself. There's a very important summit in Brussels also today and tomorrow, which looks at these regulatory issues. As many have said, Europe is too regulated, so I think that is important. The second element, which I think is very important, that Germany relaxes fiscal, so-called the debt brake, for more infrastructure, but also for defense spending. And now the proof of the pudding is in the eating, that you have all that money and all that flexibility, but now you need to do the reforms, you need to make it easier, you need to create space for private investment to come into place, all things we'll be discussing at the Berlin Global Dialogue, so that that money actually leads into growth.
How is Chancellor Merz doing?
He's doing fine. I think that he's certainly brought Germany back on the international stage. And I think that's very important. And I think a big priority for him is actually Europe, even though he's also, met with Donald Trump and with many other world leaders. But he has to do homeworks at home, and that includes Europe. And he needs support to do it. Germany is a complicated country, not the only one. France is also challenging right now. But I'm quite hopeful that he's going to be able to do it.
What do you think are the main obstacles, actually, for Germany, but also maybe for Europe? I mean, in Germany, is it geopolitics?
Right.
Is it trade?
Yeah, trade is important. I think the defense sector also as an engine of growth for Germany, transforming the economy. Because Germany is an industrial powerhouse. We have lots of companies at the Berlin Global Dialogue which would be willing to move into these areas related to defense or dual use. But it's not easy to transform your economy. So I think that's an issue. And the other one is sort of other regulatory constraints. For example, climate change. We haven't decided on our NDC goal for the Paris. Paris is 2 weeks away. And therefore, don't change the goals. I think we all want climate neutrality by 2050, but I think the way to get there has to be redone, and this is not easy.
But what is the right way? I mean, we're seeing a number of things also from Brussels actually being changed, some of the laws with deforestation maybe taking more time.
That's right.
I mean, there could be a link between defense rights and climate change. Is that far-fetched? Some people say it should be folded into the ESG world.
Yeah, I think defense is an important aspect of it. Yeah. I think what you mentioned is true, that we should not overdo it in terms of time. I think we should have realistic goals. And as I said, the reporting and the regulatory stuff, I mean, this is really horrible when you look at it. Yeah. They were all there for good intentions, so it's not the intentions, but actually we need to be more pragmatic and think about what generates growth, and that is a change of mind, which I think is happening in Europe.
But does that happen by actually breaking up the rule book? So if you say, look, we're going to really cut down on regulation, and again, let's see actually what happens on that.
Right.
You know, at the country level, some people have tried.
Right.
Then do you really become competitive towards, you know, the U.S. and China?
I think that's a big part of it. By the way, we had, I think, 3 deep regulatory packages under the Merkel regime. So as you said, we've tried so many years. The big difference between then and now is it's blatantly obvious that we need it right now, because I think Europe is going to be irrelevant in the rest of the world if it's not economically strong. That was different 10 years ago. We were doing actually much better economically relatively to other parts of the world. So the pressure is there. There are proposals on the table, which heads of states will discuss today and tomorrow. One big issue, which I think is very important, is rather than having what people call an ex-ante regulatory approach, that before you do anything, you need to report and you need to show there are no risks, to an ex-post approach, when you actually intervene, is more the American way of doing things. If things don't go well, you intervene afterwards, but you let people go and get started.
But what would you do? I mean, is it AI regulation? Again, we don't have these big AI companies, and the energy market is a bit of a mess.
There's AI, there's climate, there's supply chain management, all of these. I think the AI Act, we are trying to look at a European way of doing AI, which looks also at security and trust, and remains to be seen, and that people are skeptical whether this is really a market or whether we should be more innovation prone. But this is on the table, and also a discussion we're having here.
Christine Lagarde actually steps down from her role at the ECB in October 2027. Is it time for a German to be in charge of the ECB?
If you ask a German, I think it would be time, but it's complicated. It's usually also a package deal with other jobs, but at that time, I think the other big jobs in Europe are not on the line.
Who would you put forward? You're so ingrained in German politics. You must have a list or a name.
I like our finance minister, ex-finance minister, your cookies. I think he's a good person, but there will be others. And I think it's more important to get a good person, but where it also applies to other countries. In the US, there's also a big change coming up with, Kevin Hassett, who's a good friend of mine, is also in the running. But to get the right person to do that, and I think we'll do that. Yeah.
Thank you so much for joining us, Lars-Henrik Holler. They're the founder and chair of the Berlin Global Dialogue, and of course we'll be broadcasting live today and tomorrow with many panels, so I know we'll see you around the corridors. Now, coming up, it's been a turbulent week for gold prices. We'll discuss all of that with Lombard Odier's Nanette Hechler-Feiderb. That's next, and this is Bloomberg.
As I reach a milestone in my life, I'm humbled by my good fortune, yet well aware that I still have much to learn. And if I stay true to myself and follow my instincts, my legacy will be looked on kindly by my friends, my family, and hopefully generations to come.
I think the Fed should be putting a little bit more weight on the fact that the stock market's been very strong, bond yields have fallen, the dollar has weakened, credit spreads are narrow, all those things are supporting economic activity, and put a little bit less weight on the level of the federal funds rate.
That was Bill Dudley, former New York Fed president and Bloomberg opinion columnist. Now, it's been a pretty dramatic week for gold prices. Gold fluctuating this morning. That's after a rout on investor concern over the market overheating. Well, joining us now, Nanette Hechler-Feiderb, EMEA Chief Investment Officer at Lombard Odier. Nanette, so good to see you. Thank you so much for coming in, and in London. Nanette, there's three things that the market is obsessed with. Of course, it's credit because of the jitters that we had last week. It's gold, and it's AI. What does gold represent to you now?
Really, gold has been the one asset that has come forward in 2025 as the ultimate diversifier. Remember, in April, actually government bonds were not really helping to diversify. So gold has taken this new position for asset allocators. And it's also part of the explanation of the incredible rally and ascent of gold, in spite of the volatility now of past week, has experienced this year. So a very important asset for diversification purposes, but also for structural purposes, Francine. Gold is going to be really quite critical in everything that is happening at central bank reserve shifts.
So, Nanette, I mean, is this really also part of the geopolitical reordering? And if this is, maybe central banks selling treasuries, selling in dollar to buy gold, is there a target price, or does it just go up and up?
Well, you can take basically pre-Bretton Woods and take a look at how much gold represented in central bank reserves, and it's about twice as much as it does now. I'm not suggesting that central banks overall are going that way, but what is clear is that if the financial system continues to evolve and financial settlement systems continue to evolve with a parallel one where central banks are providing liquidity to each other in their domestic currencies, gold is playing a very interesting role as a security, if you like, against that. So I do think that central bank reserves are going to go up, and I do also think that this will push up the gold price. For now, our forecast for next year is that it might reach 4,600.
Nanette, if you look at AI, and we're in the middle of earnings season, there's a lot of concern that AI could be in a bubble, but then there's a good earnings report in an AI world, and then it keeps on going higher. I mean, it's priced to perfection.
It is, and at the same time, it's really quite close to what it has been all along. I mean, take a look at valuations. They are around 28. That is not far from what they have been on average as well. And it is very far from the absolutely excessive valuations we had during a true bubble, a true tech bubble in the dot-com period. Back then, we had multiples of around 55. Right now, we are turning at around 28. So you can see that we, I think, are not in this completely overextended terrain. But what I really would want to point out is that earnings growth as well, Francine, has been really strong in a lot of these AI-related companies. And they are turning around 1.5 or twice as strong as the market globally. So I do think that there are fundamental drivers that are explaining this strength and these prices. Of course, one has to be very selective. And within all these technology stocks, there are some smaller ones that have really seen a very strong multiple expansion, and where earnings have not so much been supporting that. There you have to apply caution. That's very, very clear. But selectivity, in my view, doesn't mean that we are facing a bubble here. On the contrary, AI is at this moment really standing ahead of a very broad adoption.
Yeah. Is there a worry actually that there's too much money, that there's too much investment, for example, going in data centers? Because if you don't see a return in a fairly brief time horizon or timeline, then maybe there's just going to be overcapacity.
It's very true, Francine, that the capital expenditure into the infrastructure of AI and data centers are part of the infrastructure has been mind-boggling. But I do think that it is absolutely what will be required. I am confident that technology and AI is going to pervade so many different sectors, and in particular services, that the infrastructure required to process that is just going to be there. So I'm really not so worried about that trend. I think that the world of tomorrow is going to make use of data and, by the way, of energy in a way we haven't seen or imagined before.
Nanette, what do you do with the credit jitters? We were talking, last week whether there'd be more defaults, whether there are systemic risks out there. Like a chief investment officer at Lombard Odier, like how do you deal with it?
I mean, look, we've been very, very attentive to all of these news. Anything that is happening on the credit market is always cause for attention for us, because there are really two areas that transmit into the global economy and into recessionary risks. One is credit, the other one is real estate. So anything that is touching to these two areas deserves a lot of caution. But the good news is, in our view, that these are at the moment very contained events. We have had some of them before. We are certainly of the view that credit spreads, Francine, have narrowed down to a point that they are not really compensating for any credit risk. And therefore, we have taken the decision to be a little bit less overweight, in fact, neutral now on investment grade credit, where we find that the overall yield is probably not going to give us much more room for bond price appreciation.
Mm-hmm. Nanette, thank you so much. Nanette Hesler-Feiderb, their EMEA Chief Investment Officer at Lombard Odier. Coming up, we'll be discussing long-term capital markets with John Bilton, Global Multi-Asset Strategy Head at JP Morgan. Welcome back, everyone, to a special edition of The Pulse, live from the Berlin Global Dialogue, uniting leaders from business, politics, and academia on the biggest issues facing the global economy. But first, here are the top stories making the headlines. Donald Trump ramps up pressure on Vladimir Putin to end the war in Ukraine, slapping sanctions on Russia's two biggest oil producers, oil soaring as a result. European gas also rising as the EU adopts its own fresh packages of sanctions on Russia's energy infrastructure. The bloc joins a new U.S. push to chip away at Moscow's ability to wage its war against Kyiv. Plus, Tesla's third quarter profit drops as rising costs undercut a record quarter of vehicle sales, but Elon Musk still wants his $1 trillion pay package. So the European Union is adopting a new package of sanctions targeting Russia's energy infrastructure. The move includes a ban on LNG imports from 2027. Let's get straight from Bloomberg's Brussels bureau chief, Suzanne Lynch, who's monitoring events at the EU summit. Suzanne, thank you for joining us. So tell us more about these sanctions and what exactly is in the package.
Yeah, so this is the 19th sanctions package that the EU has brought forward against Russia. So it's been tightening the screws gradually since that full-scale invasion of Ukraine. In this package, we're seeing them targeting some more Russian entities, but also significantly Indian and Chinese entities that are seen to have facilitated the Russian war effort. It's also including that very important ban on LNG. That was a very important part of this package. Now, why this is significant is that over the last few weeks here in Brussels, diplomats had been negotiating the finer points of this, and we had objections from countries like Austria, which was concerned about implications for a bank linked to the oligarch Deripaska. We had concerns from Hungary and we had concerns from Slovakia. The situation now is that all those countries lifted their concerns, and that is why we have agreement here today at this EU summit. So it's a big win for Europe, and I think it's very important that the EU is able to show something, some deliverable, particularly as it welcomes Volodymyr Zelensky, the Ukrainian president, here today.
And Suzanne, this, of course, all comes as Europe is looking to really strengthen its defense strategy.
Absolutely. I mean, I think there's been a lot of concern here over the last few weeks about the fact that Europe yet again seems to be watching from afar as the future of Ukraine is mapped out between Donald Trump and Vladimir Putin. But of course, we've seen a lot of flip-flopping by the US president on Ukraine policy. Earlier this week, leaders were scrambling to respond to the fact that they thought a summit was going to happen between Putin and Trump in Budapest, in Europe, on European soil. Now it seems that's not going to happen. And then we've seen this latest move by the United States last night, which we do believe the EU was aware of, about these new sanctions on Russia. So we see Donald Trump tightening the screws and getting tougher on Russia. So I think the EU all the time is trying to prove that it's a serious defence player. It is. It has enhanced its own defence capabilities, and it's doing things like the sanctions package, and also a move to use these immobilised Russian assets, most of which are based here in Belgium. Now, we do expect EU leaders to discuss this today at the summit, which is just beginning around now, but we don't expect a major sign-off on that. Rather, we expect leaders to give the European Commission the mandate to come back with a proposal. This is highly complex. The idea of using these assets to help Ukraine is extremely complex. Belgium wants other countries to share the risk. The Belgian Prime Minister here today, coming into this meeting, was very clear that he's got demands before Belgium will agree to this. So there's a lot of road still to go on that issue, but we do expect some progress here on that today.
And Suzanne, Europe is also facing this harsh reality check to cut its emissions. Are leaders likely to actually reach an agreement on that?
Yeah, that's something that we expect could really, open up a Pandora's box here in Brussels today. Climate targets are on the agenda. And again, as always with the EU, you see some very different perspectives. Different countries, trying to protect their own industries, if you like, and their own energy mixes. So on the agenda is discussion about the 2040 climate targets by the EU. But really what we've been seeing, Francine, is a real pushback against some of these strict targets. We've been seeing a lot of debate, a lot of pushback from business, from corporations, from capital saying, look, we need to be careful not to stifle innovation, even though the EU has generally been a leader on climate. So some pushback from some of the bigger countries here. This is all coming, of course, ahead of the COP climate talks that are going to happen very soon in Brazil. So we don't expect any decision on this. We do expect a very tense debate. And then in early November, EU environment ministers are going to come together. And that's when we should see more decisions on targets or a range of targets that the EU will hit.
Susan, thank you so much. Suzanne Lynch there, our Brussels Bureau Chief. And then I'm looking forward also to catching up with Susan, who's on her way tomorrow to the Berlin Global Dialogue. Now, Thales's third quarter orders and sales beat expectations thanks to strong defense demand. That's as governments across the world, of course, seek to bolster their military capabilities. It comes as Thales and aerospace peers Airbus and Leonardo seal a deal to merge their space businesses in an effort to compete with Elon Musk's SpaceX. And Europe's most valuable software company, SAP, has offered a mixed forecast for 2025, which has sent shares lower. Well, SAP sees full-year revenue for its key cloud business trending towards the lower end of guidance. Investors have been focusing on SAP's progress with cloud sales since the chief executive, Christian Klein, pivoted the company away from selling traditional software licenses to subscription services. Well, SAP's chief financial officer says the company has maintained momentum despite an uncertain macroeconomic backdrop. And the blurring between public and private markets and the future of the AI boom are just some of the top themes in JP Morgan's reports on long-term capital market assumptions. Now, for more on this, we're joined by John Bilton, Head of Global Multi-Asset Strategy at JP Morgan Asset Management. John, great to speak to you. It's like a yearly catch-up on this report. Is it much more difficult now looking at long-term trends, given all the volatility and all the disruptions we're seeing almost on a weekly basis?
Yeah, so it's actually always interesting to actually take a step back. And I think any investor who's caught up with the news flow, what's the Fed up to, what's the ECB up to, and quarterly earnings, to actually take that step back. So it's especially important at a time like this. And this is our 30th edition. We use it to run $1 trillion of the assets that we're privileged to look after. So it's incumbent on us to do that. And actually, we have had this really interesting year of a lot of changes. And we titled the report Shifting Landscapes and Silver Linings because there's so much going on, which is changing the economic fabric of how we think about the world. Things like trade friction, restrictions on labour, which are bringing down how much workforce we have to drive global growth. But surprisingly, we've had big fiscal responses, and we're beginning to see an uplift in total factor productivity as a result of capital spending, which is keeping growth moving at a reasonable level at a global, from a global perspective, but is starting to even up the differential between some regions, such as the US and Eurozone.
John, and I love the fact that you've basically identified three key themes, which, frankly, we try and keep on top of, on the pulse on a daily basis. This is like AI and the impact on financial markets. It's, of course, privatization or private markets and the impact on getting the markets to more people, democratization, and then you have the emergence of new assets and market actors, which kind of backs up that. I mean, what will be most disruptive? What's a real game changer out of these three diverse forces?
Well, I think all of them actually link together in quite an interesting way. So if we think about, regulations and policy, we think we're moving away from a world which was principally driven by things like the inventory cycle, dictating the business cycle, to one which is much more to do with lurching between more extreme positions in terms of economic policy. We've seen a bit of that this year. So what's happening is that is prompting, to some degree, investment in productivity enhancing technology. And that's really where that whole technology angle comes into play. And the reason for that is, of course, that some of the issues around migration have obviously been in the headlines a great deal this year. Trade has, no doubt had frictions placed into its flow. And so as a result, we're having to see a bit of investment, a bit of capital spending to make up for some of that shortfall in the labour market. And what that's doing, of course, is that's giving a boost to the profit share of the economy. It's supportive for cyclical growth. It's supportive for companies. So even though we're seeing these frictions, actually companies are doing relatively well out of it. And what that's doing in terms of the overlap between public and private markets, of course, is we're seeing the private markets significantly leaning into this trend and really beginning to invest heavily in the next generation of this technology as it evolves. 36% of private equity is involved within AI, 25% of private credit, and 71% of deals in the VC industry this year have been involved in technology. And when you have this kind of investment, that kind of capital in motion, then it can be very supportive for returns over the intermediate and longer term.
John, I mean, on the shorter term, do you worry about private credit? We saw there were a lot of questions on when the next default would be after the week that was. So if you just put your news of the day hat on, how should we be looking at it now?
Well, it has a role in a portfolio. It's no doubt about it. But as with any credit instrument, there are tail risks to it. And when you get a big explosion, as we've seen in terms of the volume of funds going into private credit, then there is a risk that you get some issues at the margin with certain deals. Now, whether that's systemic, we're perhaps we're taking less of a sort of pessimistic view on that, because we do note that there's less involvement from some of the levered institutions. It's not bank balance sheets supporting this. Oftentimes it's real money. So, yes, there has to be proper sizing of the private credit risk within portfolios. But this is not something that is an industry that's going away. In our view, it's an extension of credit that actually means that you've got a buffer to some degree to the public credit markets. It's opening up credit availability to firms around the globe. And so it is a reasonable part of the financial markets. But this year in our numbers, the return expectations from private credit for the next 10 to 15 years have necessarily come down because there's been such a rush of money into there. So we're already reflecting that to some degree in the numbers that we expect. And certainly, in terms of some of the more recent news, as with any credit investment, you've got to be very, very aware of the left tail.
John, I like the report, and there's something that actually struck with me, right? It's a great read. It's an easy read. There's something about an inflection point, and you basically say that we're moving from cheap money or cheap capital to expensive capital. What does that mean?
Well, so if we think about the last 10 to 15 years, we've had predominantly a period where central banks were supporting growth with very easy monetary policy. It was coined the new normal back in the day. And of course, what we've now seen post-pandemic is much greater willingness of governments to use their fiscal levers. Now, this is going to be quite interesting in terms of how it works out. A country like Germany, of course, there's plenty of fiscal headroom, and it makes sense to do a lot of fiscal spending. With other countries, you're perhaps taking more of a risk with the deficits. What that ultimately means is the gamble being taken is, can we use this deficit spending alongside the private sector to build productive assets so that we push up our trend growth over the long term? And some will do that right and some will do it wrong. And the issue, of course, that we have is that the cost of money has to rise to take on board the risk that some of this fiscal spending won't be well directed. So as a result, the overall cost of money goes up when we have that fiscal lever being pulled. So we've moved from a world where central banks really were the only ones providing the support for the economy, where we're now using the twin levers of fiscal and monetary. So monetary policy has to do less. Interest rates are necessarily that little bit higher. As a result, that cost of capital has gone up some.
John, what is the one thing that is actually the most underestimated by the markets, where you could see a correction because of what you found in your report?
The risk of correction, you're asking. I think, well, there's two things that are underestimated, and let's look at a negative and let's look at a positive, if we can. I think first and foremost, we've seen a huge rush into sort of some of these commodity-type assets, particularly gold, and we're beginning to see that unfold in front of our eyes. There's been a bit of a correction coming through there. We do think that gold looks good over the long run, but investors need to remember that in volatility terms, gold is a lot more like an equity-type asset. It has a volatility of around 13% compared with the S&P at around 16%, then it's like a bond asset, which has a volatility around 5%. And so we think that that's one area just to keep an eye on, because there's been a lot of rush into there. We still see a good outlook for gold, don't get me wrong. But staying with gold and thinking about currencies, that's where I think there's some upside opportunities. We've seen the euro appreciate 13% this year relative to the dollar. We've seen it appreciate about 8% relative to the yen. If we look at where a euro-based investor can look now, there's much less of a currency headwind from investing in the US, and there's still a currency tailwind from investing in places like emerging markets. So as a result, even though we've seen our outlook for European equities come down just a touch, about 10 basis points to around 7.2% average annualized expected return, the US number has come up and the emerging market number has come up, and that's about currencies. So for a euro-based investor thinking about currency overlay and just how to use that in a diversified portfolio, Europe's really in a sweet spot because of the currency moves.
John, thank you so much. As always, John Bilton, their head of global multi-asset strategy at JP Morgan Asset Management. Now, coming up, we discuss capital markets and the deal-making outlook for Europe with Vanessa Holtz, the Bank of America chief executive for France. This is Bloomberg. Well, Lloyds Banking Group raises its outlook for net interest income to £13.6 billion this year. That's despite earnings for the third quarter falling. Now, for more on this, we're joined by Tom Metcalf, who leads our EMEA finance coverage. So, Tom, thank you for joining us. What are your key takeaways from these results?
Well, like you say, a little bit messy because they're absorbing this big motor finance provision. So they've already disclosed an 800 million hit. So you're seeing that roll through these Q3 results. And it just distorts a bit of everything, so their profit missed, etc. But if you can back that out, I think broadly speaking, this is kind of as the market expected. So net interest income, that's probably the most interesting thing on the underlying business. They tweaked their guidance a bit, put it up very marginally. That's always a good sign. So yeah, perhaps no surprise to see the shares kind of unchanged really today, just because they've done a good job of flagging that motor finance provision, which otherwise would have come as a big nasty shock.
Tom, so how big could actually this impact be from the motor finance provision?
So far they've basically provided about £2 billion worth. And, it's still pretty much up in the air. Basically, where they are in that situation is with the UK regulator. They're basically having some back and forth and effectively telling the UK regulator, we think you're casting the net too wide. We shouldn't be on the hook for all these cases that you're sort of throwing our way. And that's true of all the banks that are kind of being dragged into this situation. So over the next few weeks, there might be some movement on that. I mean, it would certainly be a big victory for the banks if they're able to persuade the FCA to sort of roll back a little bit. And maybe you'll see that provision, that £2 billion provision kind of be reduced a bit or written off a bit, which would be obviously a bit of a win. I think right now what management are saying is this is a worst case scenario. We may be looking down the barrel of a £2 billion hit. And hopefully, we can kind of even that out a bit, soften it a bit.
Tom, what are you looking for with results from NatWest tomorrow?
Yeah, they should be a little bit more straightforward than Lloyds. NatWest not as exposed to the motor finance thing, so we're not really expecting kind of too many external shocks or anything like that. I think like with Lloyds, the biggest thing is what are the indications we can get about the UK economy. It was all fairly benign today with Lloyds. You'd expect NatWest to say something similar. I mean, every quarter these banks are basically saying the same thing: is yes, there's lots of macro doom and gloom, but when we look at our own books, when we look at the stresses our customers are under, we're not really seeing that flow through any results.
And Tom, finally, Jane Fraser at Citi has just been given a lot more power.
Yeah, exactly. She's CEO there, but also in the great American tradition, also now becoming the chairman. So, in the UK here, those roles are typically split, but in the US, it's normally an indication, you're really getting your back into the bank, right? So, real fillip for her. I think it's kind of also getting a bit more of a pay rise as well. And it just kind of goes to show it's very much her bank, right? Much as Jamie Dimon, JP Morgan. When you think of Citigroup, it really is Jane Fraser calling the shots there.
Tom, thank you so much. As always, Tom Metcalf there with all of our banking earnings. Now, it's been a volatile period for broader sentiment over the past week. European stocks headed for a fresh record as third quarter earnings continue to flow in. So let's discuss the capital markets outlook and how the deal-making environment is shaping up with Vanessa Holtz, Chief Executive of France at Bank of America. Vanessa, thank you so much for joining us. When you look at the capital markets in general, I don't know what you're seeing. We're still expecting a banking union. Is Europe more competitive? Are we going to see more IPOs in the pipeline?
So we've seen, resurgence of IPOs. It's been subdued for quite some time now, but, this year we've seen the number of IPO doubling in terms of volume, especially since Q3, during the summer. So it's definitely like some more interest from investor to do public offering. The question is, and the thing which is at stake is obviously we are in a more stable environment, with low interest rate, more certainty on the easing, geopolitical tension and uncertainty is still there, but it looks like the market is taking more confidence about the market itself. And I think overall, inflation is much lower. So I think it's all positive for the market to start to, reflect on renewal IPOs across the board. So
what are your clients saying? Are they, because there's still a lot of disruption, are they getting used to the slight volatility or kind of like news changing quite
I guess the
fast?
market is starting to get used to the volatility. If you look at the market trend, there's been a lot of obviously uncertainties. Financial assets have been moving all over, but the level of volatility itself has come down significantly. Obviously, even more since Liberation Day. So I think the market, and when the tariff gets to a kind of a stable stance, I think, there's definitely some room for markets who have been delayed investment, delayed IPOs to pull the trigger and make sure that it is happening right now. So we've seen definitely some increased volume on that front.
Are you expecting a catalyst actually for, for like the animal spirits? I know there's a lot of things being discussed at the European Union level. Do we need something like regulation taking a back step for clients to be fully in?
Well, we definitely need this capital market union. We've been talking about it for quite some time. There is some progress that has been made, but there's still a lot of fragmentation. I think it's absolutely critical that, Europe act with a sense of urgency right now. So everyone is mobilized. And I think securitization is a very key aspect of that. We need to de-risk, we need to have better source of financing. And I think deregulation and simplification is critical for the time being.
But Europe is looking at France and saying, look, this is what maybe Italy was like 10, 15 years ago. There was a credit downgrade. There's a lot of uncertainty politically. How's that playing out for your business?
Well, we still have credit downgrade in France, by Fitch and S&Ps. And obviously the service of the debt is increasing. So that's definitely on the radar. The deficit obviously is important. The budget, still needs to be passed at some stage. So yes, there is some turbulence, political instability. But I think, on the long run, France is quite resilient. It has a lot of strengths, France has been the one that attracted foreign direct investment in one of the first countries in Europe to attract that. There's still, the world-class corporate that is there. Financial ecosystem is still there. So I definitely think that there is resilience in France. The household saving, financial asset is huge in France. Yeah. So there's capital to mobilize, but it needs to go in the real economy. So that's the key aspect, obviously, of this capital market union and securitization that needs to happen now. It's all the 27 countries that needs to go together. And as I was saying at the beginning, it is urgent.
Do people understand it's urgent? I mean, in your conversations with policymakers, do you think this is, a crucial point actually in a change in how Europe can reinvigorate itself?
I think people understand it's urgent. What is critical now is that Europe comes together, and obviously as the national, there is political agenda on each country. People need to overweight the importance of Europe beyond, obviously, the political national agenda, and I think this is critical right now. So there's definitely some work. It's slow, but I think the private sector and the governments need to act together to make sure this is happening.
I mean, Chancellor Merz was talking about some kind of pan-European stock exchange. Does that make sense?
Yeah, I think it could make sense, to have a pan-European stock exchange. I think it will help, the transaction and flow the liquidity back into the European market.
Vanessa, thank you so much, as always, for joining us. Vanessa Holzler, the Bank of America France Chief Executive. Now, plenty more to come from the Berlin Global Dialogue over the next 2 days. We'll have interviews including Ukraine's Deputy Minister for Digital Transformation. We'll be speaking to Bernie Mensah, Bank of America International President. And, of course, we'll follow a lot of the big conversation. We're actually speaking to Henry Kravitz and also Nadia Calvino a little bit later on. The focus still on earnings across the board. We're also getting a little bit of data, not the easiest thing to understand what the Fed does next because of the government shutdown. But look, the main story is also oil. Oil is really up because of what we heard from President Trump over the U.S. So oil rallying after the U.S. announced these extra sanctions on Russia's two biggest producers. President Donald Trump ramping up pressure on his counterpart Vladimir Putin to negotiate an end to the war in Ukraine. Up next, it's Bloomberg Brief, and this is Bloomberg.
गाइस लगता है नेचुरल गैस आज क्रूड ऑयल के साथ साथ रेंज के अंदर ही चलेगा। इन्वेंट्री तो आ गई है, बेरिश सी थी इन्वेंट्री नेचुरल गैस की। गैप डाउन ओपन हुआ कैंडल बट ब्रेक भी नहीं कर पाया अभी भी। थोड़ा सा ऊपर जाता तो सेल करते बट नहीं गया वहाँ तक अभी। इन्वेंट्री नेचुरल गैस की बेरिश ही है प्राइस की एज पर द इन्वेंट्री। स्टिल इट इज होल्डिंग द लेवल, अभी भी होल्ड कर रहा है। Gold back ETFs buyer retreat after bullion suffers a rout. FBI arrest NBA Roger Johnson believes in betting case.
When the rest of the markets slow down, the futures market keeps moving. Did you know that CME Group S&P 500 and NASDAQ 100 futures trade nearly 24 hours with great liquidity? In the ETF markets, volume and liquidity lessens after 4 p.m. until the next morning. But with futures, you get trading opportunities both day and night. Learn more at cmegroup.com/equity-futures. When the rest of the markets slow down, the futures market keeps moving. Did you know that CME Group S&P 500 and NASDAQ 100 futures trade nearly 24 hours with great liquidity? In the ETF markets, volume and liquidity lessens after 4 p.m. until the next morning. But with futures, you get trading opportunities both day and night. Learn more at cmegroup.com/equity-futures.
News when you want it with Bloomberg News Now. I'm Nathan Hager. Some of the biggest names in professional basketball are under arrest in a widening federal investigation into sports betting and gambling.
Individuals such as Chauncey Billups, Damon Jones, and Terry Rozier were taken into custody today. Former, current NBA players and coaches.
FBI Director Kash Patel says more than 30 people are in custody across 11 states. He is speaking at a news conference in New York this morning. Bloomberg's Miles Miller is there.
We're talking about the arrests of 31 people, or potential arrests of 31 people, as it relates to a sports betting and gambling scandal that has not only shooken the NBA, but we're talking about high-stakes poker games, and all of it.
Bloomberg's Miles Miller reports federal prosecutors have tied the games to organized crime in New York. Director Patel says the investigation is ongoing. Oil prices are surging this morning. Right now, West Texas Intermediate is up about 5%. That's after President Trump announced new sanctions on Russia's two biggest crude producers, state-run Rosneft and Lukoil.
These are tremendous sanctions. These are very big. Those are against their two big oil companies, and we hope that they won't be on for long. We hope that the war will be settled.
The president announced the new penalties last night at the White House. What it means for the Ukraine war remains to be seen, as we hear from Bloomberg's Stephanie Baker.
I don't think this is going to cause Putin to change his calculus overnight, but it will impose a significant squeeze on Russian oil revenues and the budget, which is already under strain due to falling oil prices.
Bloomberg's Stephanie Baker is the author of the book Punishing Putin. Vice President J.D. Vance is blasting right-wing lawmakers in Israel for voting this week to annex the West Bank. He says it could jeopardize the fragile ceasefire with Hamas in Gaza.
The West Bank is not going to be annexed by Israel. The policy of the Trump administration is that the West Bank will not be annexed by Israel. That will continue to be our policy. And if people want to take symbolic votes, they can do that. But we certainly weren't happy about it.
Vice President Vance spoke at the end of a 3-day visit to Israel aimed at shoring up the ceasefire. Secretary of State Marco Rubio has just arrived in Israel today. Back in Washington, it's day 23 of the government shutdown, and Republicans may be divided now on how to end it. The House Freedom Caucus and at least one committee chair are calling for a long-term stopgap that could extend into after next year's elections. House Speaker Mike Johnson's been pushing a short-term measure to allow for negotiations on new full-year funding. Bloomberg's David Gura has more from Washington.
Democrats note that even if you had this longer-term bill, that would do nothing to address the policy issues that they say are the crux of this for them, which is those healthcare subsidies. We've been talking about the president's upcoming trips. A lot of lawmakers on the Democratic side see the president as sort of a key to making any progress here. He, of course, leaving on this trip to Asia, so unlikely to make any headway there.
Bloomberg's David Gura in Washington, where he's speaking now to House Minority Leader Hakeem Jeffries. He says the president should negotiate with Democrats before he leaves for Asia. Catch David's conversation with the Democratic leader at noon Wall Street time on Bloomberg Radio and on the Bloomberg podcast page on YouTube. Turning back to Wall Street, we got some data on existing home sales with most economic reports on hold due to the shutdown. The National Association of Realtors says previously owned home sales rose 1.5% last month on lower mortgage rates and tamer price gains, and that was about what economists surveyed by Bloomberg were expecting. Investors are still putting the hurt on Tesla after its earnings. Those shares are down more than 3%, but CEO Elon Musk is still pushing for his $1 trillion pay package on hopes for autonomous cars and humanoid robots. Bloomberg's Craig Trudell has more.
We've had 2 votes already on a previous pay award package that the board lined up for him in 2018. The first time around it was to approve it. The second time around was to get a sort of, reinforce approval after that package was thrown out by a court in Delaware. And in both of those cases, the vote wasn't particularly close.
And Bloomberg's Bloomberg's Craig Trudell reports the next vote on Musk's pay is set for November 6th. Amazon is rolling out a new AI tool for shoppers who may be feeling overwhelmed. A Help Me Decide button will appear at the top of a page if shoppers have looked at similar items. Amazon says the button will be available at first to millions of randomly selected users before a bigger rollout in the coming months. Amazon shares are up nearly 1%. The S&P 500 is up 0.25%. The Dow Jones Industrial Average is little changed. The NASDAQ Composite is higher by almost 0.5%. And that's news when you want it. With Bloomberg News Now, I'm Nathan Hager. This is Bloomberg.
Introducing IVF Disrupted, the Kindbody story, a podcast about a company that promised to revolutionize fertility care. It grew like a tech startup. While Kindbody did help women start families, it also left behind a stream of disillusioned and angry patients.
You think you're finally in the right hands. You're just not.
Listen to IVF Disrupted, the Kindbody story on the iHeartRadio app, Apple Podcasts, or wherever you get your podcasts.
In an age of extremes, Bloomberg New Economy Forum is a space for clarity, connection, and collaboration. From November 19th to the 21st, global leaders will gather to discuss the future of trade, technology, climate, and investment. Founding partners: Envision, HSBC, Hyundai, and Tata Sons. Host partner: Singapore. Presenting partner: PwC. Learn more at BloombergNewEconomy.com.
For India on an overall basis and for the steel tariffs as well. As you rightly said, the impact on India on a direct basis is very limited, but indirectly, surplus steel can find its way into India, and that's something which is a risk for us. Indian government is conscious and the industry is conscious about that, and we are taking measures to see that dumping does not take place.
And in relation to that, it is not just about the US, it's also about the EU proposing 50% tariffs on steel. You talked about dumping. Could that be an even bigger problem?
Yes, the European Union proposal, which has now gone to the European Council and the European Parliament, gives an indication that they are also concerned about the tariff impact which it may have on India. On Europe, and therefore they're proposing to reduce the quota quantity and double their duty. I think we'll have to watch how it unfolds. However, I think the positive tailwind could be the reconstruction demand, which may come up in the Middle East and Ukraine post the cessation of the war. India remains a very positive growing market. We have been growing in double digits for the past 4 years. We see a strong growth for the next decade or two. And I think from an India domestic market perspective, we remain very optimistic and constructive.
The thing is, safeguards have been put in place, but despite those safeguards, we know that import volumes have been rising. How are you navigating all of that, and are those safeguards enough?
So the safeguards, when they were announced in the month of March, have been positive. The imports have gone down, but you're right. Over the last 2 months, import has inched up again. That's something which we need to watch. The uncertainty in the world is causing that move. From a safeguard and anti-dumping, we are looking at various anti-dumping measures as well on countries and products where we see an injury. Those are also being attended to by the Director General of Trade, and we hope to see some action on that soon. So we will have to keep and watch on the inflow of trade into the country. The domestic demand is one of the fastest growing in the world, and therefore we remain vulnerable to external challenges which may come in.
Right. So we know that those safeguard duties are due for renewal. It does make sense then for them to be extended by the government. Would you agree?
Absolutely. And the government has already proposed that the safeguard duties should be extended for 3 years. I think we should see that getting finalized by November or so, when it is up for renewal.
When it comes to raising steel prices, we know there have been headwinds. What need to happen? What factors need to align for you to be able to do that?
So on the positive side, let me say that July-September quarter, if you've seen our performance as well, we had a very strong operational performance in spite of a seasonally weak quarter in India because of monsoons and prolonged monsoons this time. The demand post-monsoons is picking up because, in Diwali, we have seen a very strong consumption sale on the back of GST reduction and interest rate reduction in India. And we are hopeful that the consumption story in India will actually now unfold at a faster pace. The capex by the central government and the state government, we will see that also going up in the second half of this financial year. And that also should aid steel demand. So from a demand perspective, India, we remain very optimistic as we go into the next half. The only thing which we need to be wary of is any kind of imports which comes into the country at low prices and impacts us. That's something which we will be working along with the government to see that at least dumping doesn't happen into the country.
How about in terms of iron ore supply? We know that there have been constraints. Constraints have been tightened. How are you looking at it?
Iron ore supplies in the country have to really move up in line with the steel production, which is going up. If you really look at the last year's production, we had a production of 152 million tons. We are expecting that this will move up by another 100 million tons over the next 5 to 6 years. So therefore, you will require a substantial amount of iron ore to be locally produced. The companies and the mines are being pushed to gear up for that. And the government is taking necessary measures to see that all the mines which have been taken up actually start producing wherever there are any constraints. So there is a government push to see that iron ore production in the country increases. We are hopeful that in the next 1 year, there are policies which are coming in for auction, which will make auction easier, will also make sure that people do not squat on resources. That means they get a mine on an auction, but don't sit on it. They should produce and see that the material reaches a market. Government is taking steps to ensure that, and I think that's very positive, and we look forward to a very constructive engagement of that.
Right. If you take a look at the next 12 to 24 months, do you see iron ore perhaps becoming, a bigger share of your raw materials sourcing strategy?
Yes. So, iron ore is the key ingredient for steel. As far as JSW Steel is concerned, we have about 23 mines, which we had won through an auction process. We have about 1.6 billion tons of resources. Out of that, we have certain mines are under operation. Some more mines are yet to come into operation as the approvals and clearances set in. In addition to that, as we ramp up our capacity from 34.2 million in India today to 50 million tons by the end of this decade, we continue to look for new assets which make strategic and economic sense for us as they come up for auction. So we are keenly watching the iron ore space. Our idea is to see that we at least have a 50% raw material security in terms of iron ore and coking coal both. And we continue to pursue that goal.
Jayan, I want to take a look at your joint venture with POSCO. What's the status of that? What's the timeline for this collaboration?
We are progressing on the documentation. I think both the parties are actively engaged to see that the documentation around the joint venture is closed soon. We have identified some land in Orissa for the putting up the works for the plant. We would be finalizing that in the next few months, and then we should be ready to go into the approval process for taking the requisite approvals for starting the operations. I think by the end of this financial year, we should be able to close everything and start getting the approvals, and maybe within a year start work on ground.
And what's the goal? What's the target for this joint venture?
Initially, we would be looking at a capacity of about 6 million tons in the east of India. And it can be scaled up over time to 10 million to 12 million tons.
Good morning. This is Bloomberg Daybreak Europe. I'm Lizzie Verdon in London, and these are the stories that set your agenda. Oil jumps as the US sanctions Russia's two biggest producers. The Trump administration says Moscow is not serious about ending the war in Ukraine. And Asian stocks fall after a volatile session on Wall Street, and gold extends declines as the momentum trade unwinds further. Plus, Tesla's profit tumbles and SAP's revenue misses. We'll bring you third quarter earnings from Volvo Cars next. We've got a raft of earnings to bring you this morning, and we kick off the show with Nokia earnings. Third quarter net sales coming in at 4.83 billion euros. The estimate was for 4.63 billion euros. So a beat there for Nokia. The currency headwinds and US tariffs have been a bit of an obstacle when it comes to demand and profitability. And yet Nokia saying that they're tracking towards the midpoint when it comes to the operating profit outlook range. They see full year adjusted operating profit of 1.7 billion to 2.2 billion euros. The estimate had been for 1.8 billion euros. So really covering their bases. They're very much around the estimate, and the CEO saying that they're on track to achieve their full year outlook. Now, next we turn over to France for ST Micro. Of course, it's especially exposed to tariff risks because it doesn't have a US manufacturing base despite their heavy reliance on US customers. They're saying they see full year gross margin of about 33.8%. The estimate had been for 33.9%, so very much in line there. When it comes to gross margin, 35% is what they have for the fourth quarter. The estimate was for 34.9%. Net revenue coming in at $3.19 billion. The estimate was for $3.17 billion. So, again, a beat there. Overall, they're seeing net revenue of $3.28 billion. Estimates were $3.35 billion. So a bit of a miss when it comes to fourth quarter net revenue. Now, I also want to look over at Volvo Cars, not trucks, in Sweden, of course. And the fact that the company is controlled by China's Geely means that Volvo Cars, again, is one of the more tariff-exposed passenger vehicle brands with US operations. They say that the US-EU tariff deal does offer much-needed clarity. They see the market to be increasingly challenging, though, and they have third quarter revenue at 86.4 billion Swedish krona. The estimate was for 83.4 billion Swedish krona. So quite a beat there, actually. Third quarter retail sales, though, dropping 7%. We're going to be speaking to the CEO, Håkan Samuelsson, of Volvo Cars CEO, in about 5 to 10 minutes. So really looking forward to that conversation. He, of course, was brought back in April by the Geely owner to turn the company around. So really looking forward to hearing how that is going. Next up, we go to Pharma, and we're in Switzerland now with Roche. The shares up about 10% year to date. They have raised their 2025 core EPS outlook, going red across your terminal as we speak. And they're seeing an increase in group sales in the mid-single digit range, but core EPS in the high single to low double digit range. Their outlook, as I say, for 2025 earnings raised. They have pharma sales here just slightly missing estimates, in fact, but the latest from Roche when it comes to pharma. And so really a raft of earnings this morning, the highlights at least when it comes to results in Europe this morning. But let's check in on how these broader markets are faring at the moment. We have futures pointing higher, actually, stateside. S&P E-minis up about 0.1%. Euro Stoxx 50 futures, though, as well as FTSE 100 futures, flat to the down. downside. We've had a choppy session on Wall Street yesterday after that Tesla earnings miss, and the sentiment seeming to continue into the Asia session. Traders also, of course, minding President Trump's trade threats on China. We'll dive into all of this throughout the programme, but not a lot of movement in either direction when it comes to the transatlantic futures picture so far. Now let's flip over to the cross-asset picture as well. We have the 10-year Treasury yield up a basis point at 3.95%. We had quite a strong 20-year auction yesterday, paving the way for a flatter curve into CPI tomorrow, the first meaningful data print, of course, in weeks. But euro-dollar currently weaker, a 0.1% at a 115 handle. Gold down for a third straight session. And again, we ask, has the rally run out of steam? It seems like the question on gold isn't where's the ceiling anymore, but where's the floor? So $4,090 a troy ounce is where we trade right now. But oil higher today at $64 a barrel after the US announced sanctions on Russia's biggest producers, ramping up the pressure on Putin to end the war in Ukraine. So let's take a closer look at those sanctions now. The US stepping up that pressure by targeting Russia's biggest oil producers, including Rosneft and Lukoil. This move really a U-turn for US President Donald Trump.
We canceled the meeting with President Putin. It didn't feel right to me. It didn't feel like we were going to get to the place we have to get, so I canceled it. But we'll do it in the future.
Mr. President, can you tell us a little bit about why you're elevating sanctions against Russia right now?
I just felt it was time. We've waited a long time. I thought that we'd go long before the Middle East. And Mark, as you know, we did the Middle East plus 7, so we did 7 different wars.
Well, will they be worth the wait? Bloomberg's Balazs Pence joins us now with more details, our new desk editor. Balazs, we know that sanctions work slowly. We know they haven't much deterred Putin in the past. Is President Trump's aim simply to bring him to the negotiating table?
Well, he's trying to get Putin to budge, which he hasn't been able to do with his previous strategy, where he was holding off on sanctions. There were some threats sometimes. There were a lot of meetings, and as the president said, they had a lot of very nice conversations, and then seemingly nothing happened. Russia just went back to bombing Ukraine, even stepping up its assault on Ukraine. So now it took this very substantial step of targeting Russia's biggest oil companies, Rosneft and Lukoil, which together account for 50% of Russian oil exports, in the hopes of changing Russia's calculus on the war economy, really targeting Russia's revenue, the commodities revenue, which is so key to keep the Russian economy going. We know that the Russian economy has been under pressure, and now the question is whether this does change how the Kremlin sees the war. We know that just hours after the announcement, there was a phone call between Marco Rubio and Sergei Lavrov. So it does seem like the U.S. was able to get the Kremlin's attention. What was discussed in those calls, we don't know, and how far they are able to push the Kremlin in terms of coming back to the negotiating table. It also remains to be seen, but this is a step that goes further than anything before. This is a step that even the Biden administration was reluctant to take because of the potential impact on oil prices, as we see today. So this is potentially a change in strategy for the U.S.
OK, Bloomberg's news desk editor Balazs Pence out of Hong Kong, we thank you so much for that detail. Now to some breaking news, and this is that Airbus, Leonardo and Thales have signed a memorandum of understanding for a space and satellite player. Now this is a story that had been speculated about earlier in the week. We had Leonardo's board meeting on Tuesday, but it looks like they have reached an agreement on this merger of their space businesses, as I say, to create a space and satellite player. So that story just breaking across the terminal. You can see the gains for all of those stocks so far this year. We'll keep an eye on those in particular at the open. But turning back to geopolitics now, President Donald Trump is ratcheting up pressure also on his Chinese counterpart, Xi Jinping, ahead of their expected meeting. Now, the US is considering export restrictions that would bar China from buying a swathe of critical software. Treasury Secretary Scott Bessent says that everything is on the table. Now, Winnie Xu joins us for more detail out of Hong Kong. And Winnie, I wonder how damaging these restrictions are going to be for China, potentially.
Yeah, morning. Interestingly, that we are seeing actually quite limited impact when it comes to the direct impact on China. When you look at just the markets, how the markets are doing today, you see that stocks in Hong Kong actually fluctuating with the CSI 300 slightly to the downside. And it is really how people are seeing this more of a negotiation tactic ahead of the potential meeting between Trump and Xi. And actually, we are seeing, interestingly, that these software stocks in China, we see two examples on the screen here, both in the green. So that's really also showing how investors see that there are more potentials positioning into these domestic alternatives and expecting more adoptions there. So we take a kind of zooming out and looking at how the broader Asian market is trading here today. Still under a bit of a pressure. It is that ongoing tension between U.S. and China, but also the global unwinding of momentum playing out here. And interestingly, we are seeing actually Indian stocks up slightly. It's a bit of a catch up from a holiday yesterday, but also sentiment still capped because Prime Minister Modi actually said that he will not be attending the ASEAN summit, which also means that he might not be meeting Donald Trump. Now, let's take a look at what's going on in Japanese market, because the Nikkei 225 is actually the biggest drag here in the region today, with the benchmark down more than 8%. So it's still a bit of that profit taking from the Takaichi trade, and also the yen is down, is weakening for a fifth session.
All right, Winnie Xu out of Hong Kong, we thank you so much. And just continuing that theme on momentum, equities sliding on Wall Street in trading yesterday. Perhaps a sign that earnings season isn't going quite so well for everybody. We can get detail now from Bloomberg's Valerie Teitel. And Val, as we just heard from Winnie, momentum seems to be unwinding.
Well, it could be, Lizzie, that we've just gotten some new information and the lack of U.S. data. We are relying on earnings for a guide on how the U.S. economy is doing. And Netflix sinking 10% by the end of the session yesterday, I think just shows that the market is getting a bit more wary that this tech round of results next week might not be as stellar as we hope. So we did see a slide when it comes to NASDAQ futures by the end of the session yesterday, down around 1%. Now, some of that weakness was also added to by what Winnie was just talking there, the U.S. threatening software curbs on China, but also the continued fall in gold. This is another example of a momentum trade, a trade that's performed very well, seeing some decent profit taking ahead of that U.S. CPI report on Friday, and a busy, very busy week of monetary policy decisions next week. So gold continues its decline. It's down now for 3 days in a row, dropped 6% in that time frame. And Lizzie, we're eyeing that 4,000 level yet again. Now, there is some interesting things going on here with the gold market. We are starting to see ETF outflows. So that kind of momentum outflows out of ETFs. It's going to be hard to see gold rally without those inflows coming back. But I mentioned it has been maybe a weaker than expected earnings a week, at least for tech. We did have IBM out after hours yesterday. The shares sunk nearly 6.5% in post-market trade. Now, Lizzie, this one had to do with the fact that IBM's more AI-related cloud service unit called Red Hat saw a slowdown in sales growth. So there's some skepticism now on whether IBM is best able to capture the AI enthusiasm trade with that slowdown.
All right, Valerie Teitel, we thank you so much. And I want to stay with earnings because, as you say, Tesla's profit plunging as rising costs undercut a record quarter of vehicle sales. Shares dropped in extended trading, with analysts saying there's not much to inspire investors and questioning the timeline to develop new businesses like AI and robots. Now, despite the concerns, the chief executive Elon Musk ended the call by pleading with investors to ratify his upcoming $1 trillion pay package.
The point is that I just like there needs to be enough voting control to give a strong influence, but not so much that I can't be fired if I go insane.
Well, Bloomberg Tech Asia anchor Annabelle Drewlers has more for us. Morning, Annabelle. Just talk to us about how much of Tesla's woes come back to Donald Trump's policies.
Yeah, well, actually, that's got quite a lot to do with it, really. I mean, in the numbers, we saw revenue coming in better than expected. Margin was better than expected as well for the latest period. But the big thing that really surprised investors to the downside was operating profit. And there was a 40% drop in that number. What is driving that, or what's what's behind that in large part is the impact of US tariffs, what they're having on the business, because we saw them taking a $400 million hit in that period from those US extra duties alone. So it did have a big bearing on the business, and you really saw that underscored in that aftermarket trading activity because it slumped nearly 4%, and really as well underscored the concern that people have as well that Tesla isn't very clear on what are the near-term growth drivers and how they're planning to revive this EV business. But as you said, to your point, I mean, we heard it during the call as well, Elon Musk really making this pitch at the end that he needs this remuneration package, that $1 trillion pay package at the maximum if he meets the milestones approved. And he also wants to have a 25% stake, or at least a 25% stake in the business, so he has a say in the direction of the business as well.
All right, Bloomberg's Annabelle Drewlers, we thank you so much. Well, coming up on the programme, we're going to stay with earnings. Volvo Cars reporting a big beat on third quarter operating income, and I'll be speaking to the CEO next. Plus, could EU regulations kill Europe's gaming industry? We'll be speaking to the CEO of the company behind Candy Crush and Clash of Clans. They say that they're an existential threat. So that conversation coming up as well later in the show. Stay with us. This is Bloomberg. Volvo Cars' third quarter profit rose as the automaker benefited from the effects of its $1.9 billion cost-saving program. That's even as Volvo Cars' sales are down 8% this year through September. So to bring it all together, I'm pleased to welcome the automaker's CEO, Håkan Samuelsson, to the program. Good morning, Håkan. Thank you so much for making time for us. As I say, you've done well on profit here, but sales less rosy. Are you concerned about demand? How's your outlook change going forward?
Now I'm quite confident because we know really why we were down in sales. We had very high sales of our smallest electric car last year, and that was made in China, and then we need to move it to Europe and localize it in Belgium, and then we lost production capacity. But now we are back producing that car, so I'm not too nervous about the volume. I'm more concerned that we continue with our actions on profitability, coming back to a solid cash flow. That's my number one priorities.
Well, yeah, you hint at the fact that you're more exposed to US tariffs than many European rivals. You've moved some production already. Is there going to be more of that, more moving production?
Yes. I don't think you should call it moving production, but we will increase the utilization in the factory in Charleston. We need to introduce more cars, but they will be new cars, so they will not be moved from Europe. But we need to really utilize the factory to a much higher degree than we do today. And then that's really a very important part of our turnaround in America as well. We need to be industrially present. We need to be an American company in producing closer to our customers.
But of course, you do have a Chinese owner, and I believe you're waiting for feedback from the US Commerce Department on whether you'll be allowed to sell future models into the US. Have you heard anything back yet from the Commerce Department?
Now, there is a constant dialogue with our legal expert and with the people in the department, and there is no urgency. I think this is for model year 27 or something, but there is a process going on, and I must say I'm not too nervous about that. We have been in the U.S. for 70 years, and we will continue being present in the U.S.
OK, not too nervous, but you're fully confident, are you, that the administration is going to grant you this exemption?
I think you can never be fully confident about anything these days, but that's not what keeps me awake in nights.
So what does keep you awake at night then, Håkan?
No, I'm too old for that, so I sleep rather well. I'm quite confident about the future of our company, and I'm really glad to be back. And I think with our result of 7.4, I think hopefully that is still a sign of a turnaround of the company. Maybe it's too early to say, but it's still very positive, combined with also positive signals on the sales side. September was the first month where we are back into growth.
Well, we've also been reading about how Europe's auto industry is exposed to chip disruptions potentially from China because of the new export restrictions on China-made semiconductors from Dutch chipmaker Nexperia. Has that affected Volvo Cars at all?
No, but not yet. But we are, of course, this will affect our suppliers. So it's not supplied directly to us, but we are monitoring this very closely. And I think this is almost coming back in time to the pandemic, where we had a similar situation. And I think we learned then to really be hands-on and really together with our suppliers looking into exactly how the supply of the ships are coming in. So we are monitoring it, and very difficult to say anything more today. This is a problem the whole industry is facing, so we're definitely not alone with it.
Okay, really great to talk to you this morning. Håkan Samuelsson, the CEO of Volvo Cars, off the back of their results. Thank you so much for making time for Daybreak Europe this morning. Well, we also have earnings from SAP, third quarter earnings of Europe's most valuable software company, missing estimates. So we're going to talk through those numbers coming up next. This is Bloomberg.
Earnings season is here. European earnings in focus. We'll break down the results. Bloomberg is first to break the numbers.
And we bring you some earnings that are coming through a Nordea Bank.
LVMH reporting a surprising return.
And BP.
The earnings story, I think, is really fascinating.
There's just so much news. With the smartest insights.
It has been a record half-year result. We are committed to capital return. We were even able to increase our outlook. It's very good news, I think, for our shareholders.
Continuing coverage on Bloomberg.
Welcome back to Bloomberg Daybreak Europe. We are in the thick of earnings season, but let's get you some of our top corporate stories this morning. The Gucci owner Kering reporting third quarter sales that fell less than expected as demand in North America improved. Comparable revenue fell 5% as analysts had been expecting a drop of almost 9%. Kering's ADRs jumped on the results, which come just weeks after Luca De Meo took over as CEO. Elsewhere, Google says that it's made a breakthrough in its quantum computing chip called Willow. The company says it ran an algorithm on the chip that can be repeated on similar platforms, outperforming classical supercomputers. Google says that the advances point to a broad range of potential uses in medicine and materials science too. And shares in Beyond Meat erased gains of as much as 112% to end yesterday's session 1% lower. It's been a dizzying week for the stock, which rose 600% in 3 days, having been swept up in a revival of the meme stock frenzy. The rally, which began on Friday, gathered steam on Monday on reports that a trader was touting the stock on social media. And Wall Street analysts remain sceptical, with 6 sell equivalent recommendations, 5 holds and no buys. Well, those are some of our top corporate stories this morning. Let's just take you through the risk events on the horizon for today. It's quite a busy one. We've got at 1:30 p.m. London time, US state-level jobless claims numbers. Then at 3 p.m. we have Euro area consumer confidence data. And then aftermarket, more earnings coming from Intel and Ford as well. Checking in on your broader markets, at the moment we have futures pointing a touch higher, and I really mean it when I say a touch. We're just flat to the upside when it comes to S&P E-minis and Nasdaq futures, and it's about the same to the other direction when it comes to European futures. So Euro Stoxx 50 futures down 2 basis points, FTSE 100 futures down 5 basis points. We really are treading water this morning in the futures picture, although when you look at the Asian session already, the MSCI Pacific Index down 0.6%. Of course, we're factoring in the tariff story we were discussing earlier with Winnie, the ratcheting up of pressure on on China's President Xi Jinping by President Trump ahead of their expected meeting. The US considering these export restrictions that would bar China from buying a swathe of critical software. So you're looking at the MSCI Pacific Index down 0.6% there. And in fact, the CSI 300 is one of the underperformers, but the Nikkei 225 down 1.5% at the moment. Well, coming up on the programme, we'll take a broader look at the markets and taking all the fun out of the games. We're going to speak to the Supercell CEO about proposed EU gaming laws. Next, Candy Crush fans, don't go anywhere. That's next. This is Bloomberg. Good morning. This is Bloomberg Daybreak Europe. I'm Lizzie Verdon in London, and these are the stories that set your agenda. Oil jumps as the US sanctions Russia's two biggest producers. The Trump administration says Moscow is not serious about ending the war in Ukraine. And Asian stocks fall after a volatile session on Wall Street, and gold extends declines as the momentum trade unwinds further. Plus, Tesla's profit tumbles and SAP's revenue misses. We'll bring you third quarter earnings from Volvo Cars next. We've got a raft of earnings to bring you this morning, and we kick off the show with Nokia earnings. Third quarter net sales coming in at 4.83 billion euros. The estimate was for 4.63 billion euros. So a beat there for Nokia. The currency headwinds and US tariffs have been a bit of an obstacle when it comes to demand and profitability. And yet Nokia saying that they're tracking towards the midpoint when it comes to the operating profit outlook range. They see full year adjusted operating profit of 1.7 billion to 2.2 billion euros. The estimate had been for 1.8 billion euros. So really covering their bases. They're very much around the estimate, and the CEO saying that they're on track to achieve their full year outlook. Now, next we turn over to France for ST Micro. Of course, it's especially exposed to tariff risks because it doesn't have a US manufacturing base despite their heavy reliance on US customers. They're saying they see full year gross margin of about 33.8%. The estimate had been for 33.9%, so very much in line there. When it comes to gross margin, 35% is what they have for the fourth quarter. The estimate was for 34.9%. Net revenue coming in at $3.19 billion. The estimate was for $3.17 billion. So, again, a beat there. And overall, they're seeing net revenue of $3.28 billion. Estimates were $3.35 billion. So a bit of a miss when it comes to fourth quarter net revenue. Now, I also want to look over at Volvo Cars, not trucks, in Sweden, of course. And the fact that the company is controlled by China's Geely means that Volvo Cars, again, is one of the more tariff-exposed passenger vehicle brands with US operations. They say that the US-EU tariff deal does offer much-needed clarity. They see the market to be increasingly challenging, though, and they have third quarter revenue at 86.4 billion Swedish krona. The estimate was for 83.4 billion Swedish krona. So quite a beat there, actually. Third quarter retail sales, though, dropping 7%. We're going to be speaking to the CEO, Håkan Samuelsson, of Volvo Cars CEO, in about 5 to 10 minutes. So really looking forward to that conversation. He, of course, was brought back in April by the Geely owner to turn the company around. So really looking forward to hearing how that is going. Next up, we go to pharma, and we're in Switzerland now with Roche. The shares up about 10% year to date. They have raised their 2025 core EPS outlook, going red across your terminal as we speak. And they're seeing an increase in group sales in the mid-single digit range, but core EPS in the high single to low double digit range. Their outlook, as I say, for 2025 earnings raised. They have pharma sales here just slightly missing estimates, in fact, but the latest from Roche when it comes to pharma. And so really a raft of earnings this morning, the highlights at least when it comes to results in Europe this morning. But let's check in on how these broader markets are faring at the moment. We have futures pointing higher, actually, stateside. S&P E-minis up about 0.1%. Euro Stoxx 50 futures, though, as well as FTSE 100 futures, flat to the downside. We've had a choppy session on Wall Street yesterday after that Tesla earnings miss, and the sentiment seeming to continue into the Asia session. Traders also, of course, minding President Trump's trade threats on China. We'll dive into all of this throughout the programme, but not a lot of movement in either direction when it comes to the transatlantic futures picture so far. Now let's flip over to the cross-asset picture as well. We have the 10-year Treasury yield up a basis point at 3.95%. We had quite a strong 20-year auction yesterday, paving the way for a flatter curve into CPI tomorrow, the first meaningful data print, of course, in weeks. But euro-dollar currently weaker, a 0.1% at a 115 handle. Gold down for a third straight session. And again, we ask, has the rally run out of steam? It seems like the question on gold isn't where's the ceiling anymore, but where's the floor? So $4,090 a troy ounce is where we trade right now. But oil higher today at $64 a barrel after the US announced sanctions on Russia's biggest producers, ramping up the pressure on Putin to end the war in Ukraine. So let's take a closer look at those sanctions now. The US stepping up that pressure by targeting Russia's biggest oil producers, including Rosneft and Lukoil. This move really a U-turn for US President Donald Trump.
We canceled the meeting with President Putin. It didn't feel right to me. It didn't feel like we were going to get to the place we have to get, so I canceled it. But we'll do it in the future.
Mr. President, can you tell us a little bit about why you're elevating sanctions against Russia right now?
I just felt it was time. We've waited a long time. I thought that we'd go long before the Middle East. And Mark, as you know, we did the Middle East plus 7, so we did 7 different wars.
Well, will they be worth the wait? Bloomberg's Balazs Pence joins us now with more details, our new desk editor. Balazs, we know that sanctions work slowly. We know they haven't much deterred Putin in the past. Is President Trump's aim simply to bring him to the negotiating table?
Well, he's trying to get Putin to budge, which he hasn't been able to do with his previous strategy, where he was holding off on sanctions. There were some threats sometimes. There were a lot of meetings, and as the president said, they had a lot of very nice conversations, and then seemingly nothing happened. Russia just went back to bombing Ukraine, even stepping up its assault on Ukraine. So now it took this very substantial step of targeting Russia's biggest oil companies, Rosneft and Lukoil, which together account for 50% of Russian oil exports, in the hopes of changing Russia's calculus on the war economy, really targeting Russia's revenue, the commodities revenue, which is so key to keep the Russian economy going. We know that the Russian economy has been under pressure, and now the question is whether this does change how the Kremlin sees the war. We know that just hours after the announcement, there was a phone call between Marco Rubio and Sergei Lavrov. So it does seem like the U.S. was able to get the Kremlin's attention. What was discussed in those calls, we don't know, and how far they are able to push the Kremlin in terms of coming back to the negotiating table. It also remains to be seen. But this is a step that goes further than anything before. This is a step that even the Biden administration was reluctant to take because of the potential impact on oil prices, as we see today. So this is potentially a change in strategy for the U.S.
OK, Bloomberg's news desk editor Balazs Pence out of Hong Kong. We thank you so much for that detail. Now to some breaking news, and this is that Airbus, Leonardo and Thales have signed a memorandum of understanding for a space and satellite player. Now this is a story that had been speculated about earlier in the week. We had Leonardo's board meeting on Tuesday, but it looks like they have reached an agreement on this merger of their space businesses, as I say, to create a space and satellite player. So that story just breaking across the terminal. You can see the gains for all of those stocks so far this year. We'll keep an eye on those in particular at the open. But turning back to geopolitics now, President Donald Trump is ratcheting up pressure also on his Chinese counterpart, Xi Jinping, ahead of their expected meeting. Now, the US is considering export restrictions that would bar China from buying a swathe of critical software. Treasury Secretary Scott Bessent says that everything is on the table. Now, Winnie Xu joins us for more detail out of Hong Kong. And Winnie, I wonder how damaging these restrictions are going to be for China, potentially.
Yeah, morning. Interestingly, that we are seeing actually quite limited impact when it comes to the direct impact on China. When you look at just the markets, how the markets are doing today, you see that stocks in Hong Kong actually fluctuating with the CSI 300 slightly to the downside. And it is really how people are seeing this more of a negotiation tactic ahead of the potential meeting between Trump and Xi. And actually, we are seeing, interestingly, that these software stocks in China, we see two examples on the screen here, both in the green. So that's really also showing how investors see that there are more potentials positioning into these domestic alternatives and expecting more adoptions there. So we take a kind of zooming out and looking at how the broader Asian market is trading here today. Still under a bit of a pressure. It is that ongoing tension between U.S. and China, but also the global unwinding of momentum playing out here. And interestingly, we are seeing actually Indian stocks up slightly. It's a bit of a catch up from a holiday yesterday, but also sentiment still capped because Prime Minister Modi actually said that he will not be attending the ASEAN summit, which also means that he might not be meeting Donald Trump. Now, let's take a look at what's going on in Japanese market, because the Nikkei 225 is actually the biggest drag here in the region today, with the benchmark down more than 8%. So it's still a bit of that profit taking from the Takaichi trade, and also the yen is down, is weakening for a fifth session.
All right, Winnie Xu out of Hong Kong, we thank you so much. And just continuing that theme on momentum, equities sliding on Wall Street in trading yesterday. Perhaps a sign that earnings season isn't going quite so well for everybody. We can get detail now from Bloomberg's Valerie Teitel. And Val, as we just heard from Winnie, momentum seems to be unwinding.
Well, it could be, Lizzie, that we've just gotten some new information, and the lack of U.S. data. We are relying on earnings for a guide on how the U.S. economy is doing. And Netflix sinking 10% by the end of the session yesterday, I think just shows that the market is getting a bit more wary that this tech round of results next week might not be as stellar as we hope. So we did see a slide when it came to NASDAQ futures by the end of the session yesterday, down around 1%. Now, some of that weakness was also added to by what Winnie was just talking there, the U.S. threatening software curbs on China, but also the continued fall in gold. This is another example of a momentum trade, a trade that's performed very well, seeing some decent profit taking ahead of that U.S. CPI report on Friday, and a busy, very busy week of monetary policy decisions next week. So gold continues its decline. It's down now for 3 days in a row, dropped 6% in that time frame. And Lizzie, we're eyeing that 4,000 level yet again. Now, there is some interesting things going on here with the gold market. We are starting to see ETF outflows. So that kind of momentum outflows out of ETFs is going to be hard to see gold rally without those inflows coming back. But I mentioned it has been maybe a weaker than expected earnings a week, at least for tech. We did have IBM out after hours yesterday. The shares sunk nearly 6.5% in post-market trade. Now, Lizzie, this one had to do with the fact that IBM's more AI-related cloud service unit called Red Hat saw a slowdown in sales growth. So there's some skepticism now on whether IBM is best able to capture the AI enthusiasm trade with that slowdown.
All right, Valerie Teitel, we thank you so much. And I want to stay with earnings because, as you say, Tesla's profit plunging as rising costs undercut a record quarter of vehicle sales. Shares dropped in extended trading, with analysts saying there's not much to inspire investors and questioning the timeline to develop new businesses like AI and robots. Now, despite the concerns, the chief executive Elon Musk ended the call by pleading with investors to ratify his upcoming $1 trillion pay package.
The point is, I just like there needs to be enough voting control to give a strong influence, but not so much that I can't be fired if I go insane.
Well, Bloomberg Tech Asia anchor Annabelle Drewlers has more for us. Morning, Annabelle. Just talk to us about how much of Tesla's woes come back to Donald Trump's policies.
Yeah, well, actually, that's got quite a lot to do with it, really. I mean, in the numbers, we saw revenue coming in better than expected. Margin was better than expected as well for the latest period. But the big thing that really surprised investors to the downside was operating profit. And there was a 40% drop in that number. What is driving that, or what's behind that in large part, is the impact of US tariffs, what they're having on the business, because we saw them taking a $400 million hit in that period from those US extra duties alone. So it did have a big bearing on the business, and you really saw that underscored in that aftermarket trading activity because it slumped nearly 4%. And really as well underscored the concern that people have as well that Tesla isn't very clear on what are the near-term growth drivers and how they're planning to revive this EV business. But as you said, to your point, I mean, we heard it during the call as well. Elon Musk really making this pitch at the end that he needs this remuneration package, that $1 trillion pay package at the maximum if he meets the milestones approved. And he also wants to have a 25% stake, or at least a 25% stake in the business. So he has a say in the direction of the business as well.
All right, Bloomberg's Annabelle Drewlers, we thank you so much. Well, coming up on the programme, we're going to stay with earnings. Volvo Cars reporting a big beat on third quarter operating income, and I'll be speaking to the CEO next. Plus, could EU regulations kill Europe's gaming industry? We'll be speaking to the CEO of the company behind Candy Crush and Clash of Clans. They say that they're an existential threat. So that conversation coming up as well later in the show. Stay with us. This is Bloomberg. Volvo Cars' third quarter profit rose as the automaker benefited from the effects of its $1.9 billion cost-saving program. That's even as Volvo Cars' sales are down 8% this year through September. So to bring it all together, I'm pleased to welcome the automaker's CEO, Håkan Samuelsson, to the program. Good morning, Håkan. Thank you so much for making time for us. As I say, you've done well on profit here, but sales less rosy. Are you concerned about demand? How's your outlook change going forward?
Now I'm quite confident because we know really why we were down in sales. We had very high sales of our smallest electric car last year, and that was made in China, and then we need to move it to Europe and localize it in Belgium, and then we lost production capacity. But now we are back producing that car, so I'm not too nervous about the volume. I'm more concerned that we continue with our actions on profitability, coming back to a solid cash flow. That's my number one priorities.
Well, yeah, you hint at the fact that you're more exposed to US tariffs than many European rivals. You've moved some production already. Is there going to be more of that, more moving production?
Yes. I don't think you should call it moving production, but we will increase the utilization in the factory in Charleston. We need to introduce more cars, but they will be new cars, so they will not be moved from Europe. But we need to really utilize the factory to a much higher degree than we do today. And that's really a very important part of our turnaround in America as well. We need to be industrially present. We need to be an American company in producing closer to our customers.
But of course, you do have a Chinese owner, and I believe you're waiting for feedback from the US Commerce Department on whether you'll be allowed to sell future models into the US. Have you heard anything back yet from the Commerce Department?
Now, there is a constant dialogue with our legal expert and with the people in the department, and there is no urgency. I think this is for model year 27 or something, but there is a process going on, and I must say I'm not too nervous about that. We have been in the U.S. for 70 years, and we will continue being present in the U.S.
OK, not too nervous, but you're fully confident, are you, that the administration is going to grant you this exemption?
I think you can never be fully confident about anything these days, but that's not what keeps me awake in nights.
So what does keep you awake at night then, Håkan?
No, I'm too old for that, so I sleep rather well. I'm quite confident about the future of our company, and I'm really glad to be back. And I think with our result of 7.4, I think hopefully that is still a sign of a turnaround of the company. Maybe it's too early to say, but it's still very positive, combined with also positive signals on the sales side. September was the first month where we are back into growth.
Well, we've also been reading about how Europe's auto industry is exposed to chip disruptions potentially from China because of the new export restrictions on China-made semiconductors from Dutch chipmaker Nexperia. Has that affected Volvo Cars at all?
No, but not yet. But we are, of course, this will affect our suppliers. So it's not supplied directly to us, but we are monitoring this very closely. And I think this is almost coming back in time to the pandemic, where we had a similar situation. And I think we learned then to really be hands-on and really together with our suppliers looking into exactly how the supply of the ships are coming in. So we are monitoring it, and very difficult to say anything more today. This is a problem the whole industry is facing, so we're definitely not alone with it.
Okay, really great to talk to you this morning. Håkan Samuelsson, the CEO of Volvo Cars, off the back of their results. Thank you so much for making time for Daybreak Europe this morning. Well, we also have earnings from SAP, third quarter earnings of Europe's most valuable software company, missing estimates. So we're going to talk through those numbers coming up next. This is Bloomberg.
Earnings season is here. European earnings in focus. We'll break down the results. Bloomberg is first to break the numbers.
And we bring you some earnings that are coming through Nordea Bank.
LVMH reporting a surprising return.
And BP.
The earnings story, I think, is really fascinating.
There's just so much news.
With the smartest insights.
It has been a record half-year result. We are committed to capital return. We were even able to increase our outlook. It's very good news, I think, for our shareholders.
Continuing coverage on Bloomberg.
Welcome back to Bloomberg Daybreak Europe. We are in the thick of earnings season, but let's get you some of our top corporate stories this morning. The Gucci owner Kering reporting third quarter sales that fell less than expected as demand in North America improved. Comparable revenue fell 5% as analysts had been expecting a drop of almost 9%. Kering's ADRs jumped on the results, which come just weeks after Luca De Meo took over as CEO. Elsewhere, Google says that it's made a breakthrough in its quantum computing chip called Willow. The company says it ran an algorithm on the chip that can be repeated on similar platforms, outperforming classical supercomputers. Google says that the advances point to a broad range of potential uses in medicine and material science too. And shares in Beyond Meat erased gains of as much as 112% to end yesterday's session 1% lower. It's been a dizzying week for the stock, which rose 600% in 3 days, having been swept up in a revival of the meme stock frenzy. The rally, which began on Friday, gathered steam on Monday on reports that a trader was touting the stock on social media. And Wall Street analysts remain sceptical, with 6 sell equivalent recommendations, 5 holds and no buys. Well, those are some of our top corporate stories this morning. Let's just take you through the risk events on the horizon for today. It's quite a busy one. We've got at 1:30 p.m. London time, US state-level jobless claims numbers. Then at 3 p.m. we have Euro area consumer confidence data. And then aftermarket, more earnings coming from Intel and Ford as well. Checking in on your broader markets, at the moment we have futures pointing a touch higher, and I really mean it when I say a touch. We're just flat to the upside when it comes to S&P E-minis and Nasdaq futures, and it's about the same to the other direction when it comes to European futures. So Euro Stoxx 50 futures down 2 basis points, FTSE 100 futures down 5 basis points. We really are treading water this morning in the futures picture, although when you look at the Asian session already, the MSCI Asia Pacific Index down 0.6%. Of course, we're factoring in the tariff story we were discussing earlier with Winnie, the ratcheting up of pressure on China's President Xi Jinping by President Trump ahead of their expected meeting. The US considering these export restrictions that would bar China from buying a swathe of critical software. So you're looking at the MSCI Pacific Index down 0.6% there. And in fact, the CSI 300 is one of the underperformers, but the Nikkei 225 down 1.5% at the moment. Well, coming up on the programme, we'll take a broader look at the markets and taking all the fun out of the games. We're going to speak to the Supercell CEO about proposed EU gaming laws. Next, Candy Crush fans, don't go anywhere. That's next. This is Bloomberg. Good morning. This is Bloomberg Daybreak Europe. I'm Lizzie Verdon in London, and these are the stories that set your agenda. Oil jumps as the US sanctions Russia's two biggest producers. The Trump administration says Moscow is not serious about ending the war in Ukraine. And Asian stocks fall after a volatile session on Wall Street, and gold extends declines as the momentum trade unwinds further. Plus, Tesla's profit tumbles and SAP's revenue misses. We'll bring you third quarter earnings from Volvo Cars next. We've got a raft of earnings to bring you this morning, and we kick off the show with Nokia earnings. Third quarter net sales coming in at 4.83 billion euros. The estimate was for 4.63 billion euros, so a beat there for Nokia. The currency headwinds and US tariffs have been a bit of an obstacle when it comes to demand and profitability, and yet Nokia saying that they're tracking towards the midpoint when it comes to the operating profit outlook range. They see full-year adjusted operating profit of 1.7 billion to 2.2 billion euros. The estimate had been for 1.8 billion euros. So really covering their bases. They're very much around the estimate, and the CEO saying that they're on track to achieve their full-year outlook. Now, next we turn over to France for ST Micro. Of course, it's especially exposed to tariff risks because it doesn't have a US manufacturing base despite their heavy reliance on US customers. They're saying they see full-year gross margin of about 33.8%. The estimate had been for 33.9%, so very much in line there. When it comes to gross margin, 35% is what they have for the fourth quarter. The estimate was for 34.9%. Net revenue coming in at $3.19 billion. The estimate was for $3.17 billion. So, again, a beat there. Overall, they're seeing net revenue of $3.28 billion. Estimates were $3.35 billion. So a bit of a miss when it comes to fourth quarter net revenue. Now, I also want to look over at Volvo Cars, not trucks, in Sweden, of course. And the fact that the company is controlled by China's Geely means that Volvo Cars, again, is one of the more tariff-exposed passenger vehicle brands with US operations. They say that the US-EU tariff deal does offer much-needed clarity. They see the market to be increasingly challenging, though, and they have third quarter revenue at 86.4 billion Swedish krona. The estimate was for 83.4 billion Swedish krona. So quite a beat there, actually. Third quarter retail sales, though, dropping 7%. We're going to be speaking to the CEO, Håkan Samuelsson, of Volvo Cars CEO, in about 5 to 10 minutes. So really looking forward to that conversation. He, of course, was brought back in April by the Geely owner to turn the company around. So really looking forward to hearing how that is going. Next up, we go to pharma, and we're in Switzerland now with Roche. The shares up about 10% year to date. They have raised their 2025 core EPS outlook, going red across your terminal as we speak. And they're seeing an increase in group sales in the mid-single digit range, but core EPS in the high single to low double digit range. Their outlook, as I say, for 2025 earnings raised. They have pharma sales here just slightly missing estimates, in fact, but the latest from Roche when it comes to pharma. And so really a raft of earnings this morning, the highlights at least when it comes to results in Europe this morning. But let's check in on how these broader markets are faring at the moment. We have futures pointing higher, actually, stateside. S&P E-minis up about 0.1%. Euro Stoxx 50 futures, though, as well as FTSE 100 futures, flat to the downside. We've had a choppy session on Wall Street yesterday after that Tesla earnings miss, and the sentiment seeming to continue into the Asia session. Traders also, of course, minding President Trump's trade threats on China. We'll dive into all of this throughout the programme. But not a lot of movement in either direction when it comes to the transatlantic futures picture so far. Now let's flip over to the cross-asset picture as well. We have the 10-year Treasury yield up a basis point at 3.95%. We had quite a strong 20-year auction yesterday, paving the way for a flatter curve into CPI tomorrow, the first meaningful data print, of course, in weeks. But euro-dollar currently weaker, a 0.1% at a 115 handle. Gold down for a third straight session. And again, we ask, has the rally run out of steam? It seems like the question on gold isn't where's the ceiling anymore, but where's the floor? So $4,090 a troy ounce is where we trade right now. But oil higher today at $64 a barrel after the US announced sanctions on Russia's biggest producers, ramping up the pressure on Putin to end the war in Ukraine. So let's take a closer look at those sanctions now. The US stepping up that pressure by targeting Russia's biggest oil producers, including Rosneft and Lukoil. This move really a U-turn for US President Donald Trump.
We canceled the meeting with President Putin. It didn't feel right to me. It didn't feel like we were going to get to the place we have to get, so I canceled it. But we'll do it in the future.
Mr. President, can you tell us a little bit about why you're elevating sanctions against Russia right now?
I just felt it was time. We've waited a long time. I thought that we'd go long before the Middle East. And Mark, as you know, we did the Middle East plus 7, so we did 7 different wars.
Well, will they be worth the wait? Bloomberg's Balazs Pence joins us now with more details, our new desk editor. Balazs, we know that sanctions work slowly. We know they haven't much deterred Putin in the past. Is President Trump's aim simply to bring him to the negotiating table?
Well, he's trying to get Putin to budge, which he hasn't been able to do with his previous strategy, where he was holding off on sanctions. There were some threats sometimes. There were a lot of meetings, and as the president said, they had a lot of very nice conversations, and then seemingly nothing happened. Russia just went back to bombing Ukraine, even stepping up its assault on Ukraine. So now it took this very substantial step of targeting Russia's biggest oil companies, Rosneft and Lukoil, which together account for 50% of Russian oil exports, in the hopes of changing Russia's calculus on the war economy, really targeting Russia's revenue, the commodities revenue, which is so key to keep the Russian economy going. We know that the Russian economy has been under pressure, and now the question is whether this does change how the Kremlin sees the war. We know that just hours after the announcement, there was a phone call between Marco Rubio and Sergei Lavrov. So it does seem like the U.S. was able to get the Kremlin's attention. What was discussed in those calls, we don't know, and how far they are able to push the Kremlin in terms of coming back to the negotiating table. It also remains to be seen. But this is a step that goes further than anything before. This is a step that even the Biden administration was reluctant to take because of the potential impact on oil prices, as we see today. So this is potentially a change in strategy for the U.S.
OK, Bloomberg's news desk editor Balazs Pence out of Hong Kong. We thank you so much for that detail. Now to some breaking news, and this is that Airbus, Leonardo and Thales have signed a memorandum of understanding for a space and satellite player. Now this is a story that had been speculated about earlier in the week. We had Leonardo's board meeting on Tuesday, but it looks like they have reached an agreement on this merger of their space businesses, as I say, to create a space and satellite player. So that story just breaking across the terminal. You can see the gains for all of those stocks so far this year. We'll keep an eye on those in particular at the open. But turning back to geopolitics now, President Donald Trump is ratcheting up pressure also on his Chinese counterpart, Xi Jinping, ahead of their expected meeting. Now, the US is considering export restrictions that would bar China from buying a swathe of critical software. Treasury Secretary Scott Bessent says that everything is on the table. Now, Winnie Xu joins us for more detail out of Hong Kong. And Winnie, I wonder how damaging these restrictions are going to be for China, potentially.
Yeah, morning. Interestingly, that we are seeing actually quite limited impact when it comes to the direct impact on China. When you look at just the markets, how the markets are doing today, you see that stocks in Hong Kong actually fluctuating with the CSI 300 slightly to the downside. And it is really how people are seeing this more of a negotiation tactic ahead of the potential meeting between Trump and Xi. And actually, we are seeing, interestingly, that these software stocks in China, we see two examples on the screen here, both in the green. So that's really also showing how investors see that there are more potentials positioning into these domestic alternatives and expecting more adoptions there. So we take a kind of zooming out and looking at how the broader Asian market is trading here today. Still under a bit of a pressure. It is that ongoing tension between U.S. and China, but also the global unwinding of momentum playing out here. And interestingly, we are seeing actually Indian stocks up slightly. It's a bit of a catch up from a holiday yesterday, but also sentiment still capped because Prime Minister Modi actually said that he will not be attending the ASEAN summit, which also means that he might not be meeting Donald Trump. Now, let's take a look at what's going on in Japanese market, because the Nikkei 225 is actually the biggest drag here in the region today, with the benchmark down more than 8%. So it's still a bit of that profit taking from the Takaichi trade, and also the yen is down, is weakening for a fifth session.
All right, Winnie Xu out of Hong Kong, we thank you so much. And just continuing that theme on momentum, equities sliding on Wall Street in trading yesterday. Perhaps a sign that earnings season isn't going quite so well for everybody. We can get detail now from Bloomberg's Valerie Teitel. And Val, as we just heard from Winnie, momentum seems to be unwinding.
Well, it could be, Lizzie, that we've just gotten some new information and the lack of U.S. data. We are relying on earnings for a guide on how the U.S. economy is doing. And Netflix sinking 10% by the end of the session yesterday, I think just shows that the market is getting a bit more wary that this tech round of results next week might not be as stellar as we hope. So we did see a slide when it comes to NASDAQ futures by the end of the session yesterday, down around 1%. Now, some of that weakness was also added to by what Winnie was just talking there, the U.S. threatening software curbs on China, but also the continued fall in gold. This is another example of a momentum trade, a trade that's performed very well, seeing some decent profit taking ahead of that U.S. CPI report on Friday, and a busy, very busy week of monetary policy decisions next week. So gold continues its decline. It's down now for 3 days in a row, dropped 6% in that time frame. And Lizzie, we're eyeing that 4,000 level yet again. Now, there is some interesting things going on here with the gold market. We are starting to see ETF outflows. So that kind of momentum outflows out of ETFs. It's going to be hard to see gold rally without those inflows coming back. But I mentioned it has been maybe a weaker than expected earnings a week, at least for tech. We did have IBM out after hours yesterday. The shares sunk nearly 6.5% in post-market trade. Now, Lizzie, this one had to do with the fact that IBM's more AI-related cloud service unit called Red Hat saw a slowdown in sales growth. So there's some skepticism now on whether IBM is best able to capture the AI enthusiasm trade with that slowdown.
All right, Valerie Teitel, we thank you so much. And I want to stay with earnings because, as you say, Tesla's profit plunging as rising costs undercut a record quarter of vehicle sales. Shares dropped in extended trading, with analysts saying there's not much to inspire investors and questioning the timeline to develop new businesses like AI and robots. Now, despite the concerns, the chief executive Elon Musk ended the call by pleading with investors to ratify his upcoming $1 trillion pay package.
The point is, I just like there needs to be enough voting control to give a strong influence, but not so much that I can't be fired if I go insane.
Well, Bloomberg Tech Asia anchor Annabelle Drewlers has more for us. Morning, Annabelle. Just talk to us about how much of Tesla's woes come back to Donald Trump's policies.
Yeah, well, actually, that's got quite a lot to do with it, really. I mean, in the numbers, we saw revenue coming in better than expected. Margin was better than expected as well for the latest period. But the big thing that really surprised investors to the downside was operating profit. And there was a 40% drop in that number. What is driving that, or what's behind that in large part, is the impact of US tariffs, what they're having on the business, because we saw them taking a $400 million hit in that period from those US extra duties alone. So it did have a big bearing on the business, and you really saw that underscored in that aftermarket trading activity because it slumped nearly 4%. And really as well underscored the concern that people have as well that Tesla isn't very clear on what are the near-term growth drivers and how they're planning to revive this EV business. But as you said, to your point, I mean, we heard it during the call as well. Elon Musk really making this pitch at the end that he needs this remuneration package, that $1 trillion pay package at the maximum if he meets the milestones approved. And he also wants to have a 25% stake, or at least a 25% stake in the business, so he has a say in the direction of the business as well.
All right, Bloomberg's Annabelle Drewlers, we thank you so much. Well, coming up on the programme, we're going to stay with earnings. Volvo Cars reporting a big beat on third quarter operating income, and I'll be speaking to the CEO next. Plus, could EU regulations kill Europe's gaming industry? We'll be speaking to the CEO of the company behind Candy Crush and Clash of Clans. They say that they're an existential threat. So that conversation coming up as well later in the show. Stay with us. This is Bloomberg. Volvo Cars' third quarter profit rose as the automaker benefited from the effects of its $1.9 billion cost-saving program. That's even as Volvo Cars' sales are down 8% this year through September. So to bring it all together, I'm pleased to welcome the automaker's CEO, Håkan Samuelsson, to the program. Good morning, Håkan. Thank you so much for making time for us. As I say, you've done well on profit here, but sales less rosy. Are you concerned about demand? Well, how's your outlook change going forward?
Now I'm quite confident because we know really why we were down in sales. We had very high sales of our smallest electric car last year, and that was made in China, and then we need to move it to Europe and localize it in Belgium, and then we lost production capacity. But now we are back producing that car, so I'm not too nervous about the volume. I'm more concerned that we continue with our actions on profitability, coming back to a solid cash flow. That's my number one priorities.
Well, yeah, you hint at the fact that you're more exposed to US tariffs than many European rivals. You've moved some production already. Is there going to be more of that, more moving production?
Yes. I don't think you should call it moving production, but we will increase the utilization in the factory in Charleston. We need to introduce more cars, but they will be new cars, so they will not be moved from Europe. But we need to really utilize the factory to a much higher degree than we do today. And that's really a very important part of our turnaround in America as well. We need to be industrially present. We need to be an American company in producing closer to our customers.
But of course, you do have a Chinese owner, and I believe you're waiting for feedback from the US Commerce Department on whether you'll be allowed to sell future models into the US. Have you heard anything back yet from the Commerce Department?
Now, there is a constant dialogue with our legal expert and with the people in the department, and there is no urgency. I think this is for model year 27 or something, but there is a process going on, and I must say I'm not too nervous about that. We have been in the US for 70 years, and we will continue being present in the US.
Okay, not too nervous, but you're fully confident, are you, that the administration is going to grant you this exemption?
I think you can never be fully confident about anything these days, but that's not what keeps me awake in nights.
So what does keep you awake at night then, Håkan?
No, I'm too old for that, so I sleep rather well. I'm quite confident about the future of our company, and I'm really glad to be back. And I think with our result of 7.4, I think hopefully that is still a sign of a turnaround of the company. Maybe it's too early to say, but it's still very positive, combined with also positive signals on the sales side. September was the first month where we are back into growth.
Well, we've also been reading about how Europe's auto industry is exposed to chip disruptions potentially from China because of the new export restrictions on China-made semiconductors from Dutch chipmaker Nexperia. Has that affected Volvo Cars at all?
No, but not yet. But we are, of course, this will affect our suppliers. So it's not supplied directly to us, but we are monitoring this very closely. And I think this is almost coming back in time to the pandemic, where we had a similar situation. And I think we learned then to really be hands-on and really together with our suppliers looking into exactly how the supply of the ships are coming in. So we are monitoring it, and very difficult to say anything more today. This is a problem the whole industry is facing, so we are definitely not alone with it.
Okay, really great to talk to you this morning. Håkan Samuelsson, the CEO of Volvo Cars, off the back of their results. Thank you so much for making time for Daybreak Europe this morning. Well, we also have earnings from SAP, third quarter earnings of Europe's most valuable software company, missing estimates. So we're going to talk through those numbers coming up next. This is Bloomberg.
Earnings season is here. European earnings in focus. We'll break down the results. Bloomberg is first to break the numbers.
And we bring you some earnings that are coming through Nordea Bank.
LVMH reporting a surprising return.
And BP.
The earnings story, I think, is really fascinating.
There's just so much news. With the smartest insights.
It has been a record half-year result. We are committed to capital return. We were even able to increase our outlook. It's very good news, I think, for our shareholders.
Continuing coverage on Bloomberg.
Welcome back to Bloomberg Daybreak Europe. We are in the thick of earnings season, but let's get you some of our top corporate stories this morning. The Gucci owner Kering reporting third quarter sales that fell less than expected as demand in North America improved. Comparable revenue fell 5% as analysts had been expecting a drop of almost 9%. Kering's ADRs jumped on the results, which come just weeks after Luca De Meo took over as CEO. Elsewhere, Google says that it's made a breakthrough in its quantum computing chip called Willow. The company says it ran an algorithm on the chip that can be repeated on similar platforms, outperforming classical supercomputers. Google says that the advances point to a broad range of potential uses in medicine and materials science too. And shares in Beyond Meat erased gains of as much as 112% to end yesterday's session 1% lower. It's been a dizzying week for the stock, which rose 600% in 3 days, having been swept up in a revival of the meme stock frenzy. The rally, which began on Friday, gathered steam on Monday on reports that a trader was touting the stock on social media, and Wall Street analysts remain sceptical, with 6 sell equivalent recommendations, 5 holds and no buys. Well, those are some of our top corporate stories this morning. Let's just take you through the risk events on the horizon for today. It's quite a busy one. We've got at 1:30 p.m. London time, US state-level jobless claims numbers. Then at 3 p.m. we have Euro area consumer confidence data. And then aftermarket, more earnings coming from Intel and Ford as well. Checking in on your broader markets, at the moment we have futures pointing a touch higher, and I really mean it when I say a touch. We're just flat to the upside when it comes to S&P E-minis and Nasdaq futures, and it's about the same to the other direction when it comes to European futures. So Euro Stoxx 50 futures down 2 basis points, FTSE 100 futures down 5 basis points. We really are treading water this morning in the futures picture, although when you look at the Asian session already, the MSCI Asia Pacific Index down 0.6%. Of course, we're factoring in the tariff story we were discussing earlier with Winnie, the ratcheting up of pressure on on China's President Xi Jinping by President Trump ahead of their expected meeting. The US considering these export restrictions that would bar China from buying a swathe of critical software. So you're looking at the MSCI Pacific Index down 0.6% there. And in fact, the CSI 300 is one of the underperformers, but the Nikkei 225 down 1.5% at the moment. Well, coming up on the programme, we'll take a broader look at the markets and taking all the fun out of the games. We're going to speak to the Supercell CEO about proposed EU gaming laws. Next, Candy Crush fans, don't go anywhere. That's next. This is Bloomberg. Good morning. This is Bloomberg Daybreak Europe. I'm Lizzie Verdon in London, and these are the stories that set your agenda. Oil jumps as the US sanctions Russia's two biggest producers. The Trump administration says Moscow is not serious about ending the war in Ukraine. And Asian stocks fall after a volatile session on Wall Street, and gold extends declines as the momentum trade unwinds further. Plus, Tesla's profit tumbles and SAP's revenue misses. We'll bring you third quarter earnings from Volvo Cars next. We've got a raft of earnings to bring you this morning, and we kick off the show with Nokia earnings. Third quarter net sales coming in at 4.83 billion euros. The estimate was for 4.63 billion euros, so a beat there for Nokia. The currency headwinds and US tariffs have been a bit of an obstacle when it comes to demand and profitability, and yet Nokia saying that they're tracking towards the midpoint when it comes to the operating profit outlook range. They see full-year adjusted operating profit of 1.7 billion to 2.2 billion euros. The estimate had been for 1.8 billion euros. So really covering their bases. They're very much around the estimate, and the CEO saying that they're on track to achieve their full-year outlook. Now, next we turn over to France for ST Micro. Of course, it's especially exposed to tariff risks because it doesn't have a US manufacturing base despite their heavy reliance on US customers. They're saying they see full-year gross margin of about 33.8%. The estimate had been for 33.9%, so very much in line there. When it comes to gross margin, 35% is what they have for the fourth quarter. The estimate was for 34.9%. Net revenue coming in at $3.19 billion. The estimate was for $3.17 billion. So, again, a beat there. Overall, they're seeing net revenue of $3.28 billion. Estimates were $3.35 billion. So a bit of a miss when it comes to fourth quarter net revenue. Now, I also want to look over at Volvo Cars, not trucks, in Sweden, of course. And the fact that the company is controlled by China's Geely means that Volvo Cars, again, is one of the more tariff-exposed passenger vehicle brands with US operations. They say that the US-EU tariff deal does offer much-needed clarity. They see the market to be increasingly challenging, though, and they have third quarter revenue at 86.4 billion Swedish krona. The estimate was for 83.4 billion Swedish krona. So quite a beat there, actually. Third quarter retail sales, though, dropping 7%. We're going to be speaking to the CEO, Håkan Samuelsson, of Volvo Cars CEO, in about 5 to 10 minutes. So really looking forward to that conversation. He, of course, was brought back in April by the Geely owner to turn the company around. So really looking forward to hearing how that is going. Next up, we go to pharma, and we're in Switzerland now with Roche. The shares up about 10% year to date. They have raised their 2025 core EPS outlook, going red across your terminal as we speak. And they're seeing an increase in group sales in the mid-single digit range, but core EPS in the high single to low double digit range. Their outlook, as I say, for 2025 earnings raised. They have pharma sales here just slightly missing estimates, in fact, but the latest from Roche when it comes to pharma. And so really a raft of earnings this morning, the highlights at least when it comes to results in Europe this morning. But let's check in on how these broader markets are faring at the moment. We have futures pointing higher, actually, stateside. S&P E-minis up about 0.1%. Euro Stoxx 50 futures, though, as well as FTSE 100 futures, flat to the downside. We've had a choppy session on Wall Street yesterday after that Tesla earnings miss, and the sentiment seeming to continue into the Asia session. Traders also, of course, minding President Trump's trade threats on China. We'll dive into all of this throughout the programme, but not a lot of movement in either direction when it comes to the transatlantic futures picture so far. Now let's flip over to the cross-asset picture as well. We have the 10-year Treasury yield up a basis point at 3.95%. We had quite a strong 20-year auction yesterday, paving the way for a flatter curve into CPI tomorrow, the first meaningful data print, of course, in weeks. But euro-dollar currently weaker, a 0.1% at a 115 handle. Gold down for a third straight session. And again, we ask, has the rally run out of steam? It seems like the question on gold isn't where's the ceiling anymore, but where's the floor? So $4,090 a troy ounce is where we trade right now. But oil higher today at $64 a barrel after the US announced sanctions on Russia's biggest producers, ramping up the pressure on Putin to end the war in Ukraine. So let's take a closer look at those sanctions now. The US stepping up that pressure by targeting Russia's biggest oil producers, including Rosneft and Lukoil. This move really a U-turn for US President Donald Trump.
We canceled the meeting with President Putin. It didn't feel right to me. It didn't feel like we were going to get to the place we have to get, so I canceled it. But we'll do it in the future.
Mr. President, can you tell us a little bit about why you're elevating sanctions against Russia right now?
I just felt it was time. We've waited a long time. I thought that we'd go long before the Middle East. And Mark, as you know, we did the Middle East plus 7, so we did 7 different wars.
Well, will they be worth the wait? Bloomberg's Balazs Pence joins us now with some more details, our new desk editor. Balazs, we know that sanctions work slowly. We know they haven't much deterred Putin in the past. Is President Trump's aim simply to bring him to the negotiating table?
Well, he's trying to get Putin to budge, which he hasn't been able to do with his previous strategy, where he was holding off on sanctions. There were some threats sometimes. There were a lot of meetings, and as the president said, they had a lot of very nice conversations, and then seemingly nothing happened. Russia just went back to bombing Ukraine, even stepping up its assault on Ukraine. So now it took this very substantial step of targeting Russia's biggest oil companies, Rosneft and Lukoil, which together account for 50% of Russian oil exports, in the hopes of changing Russia's calculus on the war economy, really targeting Russia's revenue, the commodities revenue, which is so key to keep the Russian economy going. We know that the Russian economy has been under pressure, and now the question is whether this does change how the Kremlin sees the war. We know that just hours after the announcement, there was a phone call between Marco Rubio and Sergei Lavrov. So it does seem like the U.S. was able to get the Kremlin's attention. What was discussed in those calls, we don't know, and how far they are able to push the Kremlin in terms of coming back to the negotiating table. It also remains to be seen. But this is a step that goes further than anything before. This is a step that even the Biden administration was reluctant to take because of the potential impact on oil prices, as we see today. So this is potentially a change in strategy for the U.S.
OK, Bloomberg's news desk editor Balazs Pence out of Hong Kong. We thank you so much for that detail. Now to some breaking news, and this is that Airbus, Leonardo and Thales have signed a memorandum of understanding for a space and satellite player. Now this is a story that had been speculated about earlier in the week. We had Leonardo's board meeting on Tuesday, but it looks like they have reached an agreement on this merger of their space businesses, as I say, to create a space and satellite player. So that story just breaking across the terminal. You can see the gains for all of those stocks so far this year. We'll keep an eye on those in particular at the open. But turning back to geopolitics now, President Donald Trump is ratcheting up pressure also on his Chinese counterpart, Xi Jinping, ahead of their expected meeting. Now, the US is considering export restrictions that would bar China from buying a swathe of critical software. Treasury Secretary Scott Bessent says that everything is on the table. Now, Winnie Xu joins us for more detail out of Hong Kong. And Winnie, I wonder how damaging these restrictions are going to be for China, potentially.
Yeah, morning. Interestingly, that we are seeing actually quite limited impact when it comes to the direct impact on China. When you look at just the markets, how the markets are doing today, you see that stocks in Hong Kong actually fluctuating with the CSI 300 slightly to the downside. And it is really how people are seeing this more of a negotiation tactic ahead of the potential meeting between Trump and Xi. And actually, we are seeing, interestingly, that these software stocks in China, we see two examples on the screen here, both in the green. So that's really also showing how investors see that there are more potentials positioning into these domestic alternatives and expecting more adoptions there. So we take a kind of zooming out and looking at how the broader Asian market is trading here today. Still under a bit of a pressure. It is that ongoing tension between U.S. and China, but also the global unwinding of momentum playing out here. And interestingly, we are seeing actually Indian stocks up slightly. It's a bit of a catch up from a holiday yesterday, but also sentiment still capped because Prime Minister Modi actually said that he will not be attending the ASEAN summit, which also means that he might not be meeting Donald Trump. Now, let's take a look at what's going on in Japanese market, because the Nikkei 225 is actually the biggest drag here in the region today, with the benchmark down more than 8%. So it's still a bit of that profit taking from the Takaichi trade, and also the yen is down, is weakening for a fifth session.
All right, Winnie Xu out of Hong Kong, we thank you so much. And just continuing that theme on momentum, equities sliding on Wall Street in trading yesterday. Perhaps a sign that earnings season isn't going quite so well for everybody. We can get detail now from Bloomberg's Valerie Teitel. And Val, as we just heard from Winnie, momentum seems to be unwinding.
Well, it could be, Lizzie, that we've just gotten some new information. And the lack of U.S. data, we are relying on earnings for a guide on how the U.S. economy is doing. And Netflix sinking 10% by the end of the session yesterday, I think just shows that the market is getting a bit more wary that this tech round of results next week might not be as stellar as we hope. So we did see a slide when it comes to NASDAQ futures by the end of the session yesterday, down around 1%. Now, some of that weakness was also added to by what Winnie was just talking there, the U.S. threatening software curbs on China, but also the continued fall in gold. This is another example of a momentum trade, a trade that's performed very well, seeing some decent profit taking ahead of that U.S. CPI report on Friday, and a busy, very busy week of monetary policy decisions next week. So gold continues its decline. It's down now for 3 days in a row, dropped 6% in that time frame. And Lizzie, we're eyeing that 4,000 level yet again. Now, there is some interesting things going on here with the gold market. We are starting to see ETF outflows. So that kind of momentum outflows out of ETFs is going to be hard to see gold rally without those inflows coming back. But I mentioned it has been maybe a weaker than expected earnings a week, at least for tech. We did have IBM out after hours yesterday. The shares sunk nearly 6.5% in post-market trade. Now, Lizzie, this one had to do with the fact that IBM's more AI-related cloud service unit called Red Hat saw a slowdown in sales growth. So there's some skepticism now on whether IBM is best able to capture the AI enthusiasm trade with that slowdown.
All right, Valerie Teitel, we thank you so much. And I want to stay with earnings because, as you say, Tesla's profit plunging as rising costs undercut a record quarter of vehicle sales. Shares dropped in extended trading, with analysts saying there's not much to inspire investors and questioning the timeline to develop new businesses like AI and robots. Now, despite the concerns, the chief executive Elon Musk ended the call by pleading with investors to ratify his upcoming $1 trillion pay package.
The point is, I just like that there needs to be enough voting control to give a strong influence, but not so much that I can't be fired if I go insane.
Well, Bloomberg Tech Asia anchor Annabelle Drewlers has more for us. Morning, Annabelle. Just talk to us about how much of Tesla's woes come back to Donald Trump's policies.
Yeah, well, actually, that's got quite a lot to do with it, really. I mean, in the numbers, we saw revenue coming in better than expected. Margin was better than expected as well for the latest period. But the big thing that really surprised investors to the downside was operating profit. And there was a 40% drop in that number. What is driving that, or what's behind that in large part, is the impact of US tariffs, what they're having on the business, because we saw them taking a $400 million hit in that period from those US extra duties alone. So it did have a big bearing on the business, and you really saw that underscored in that aftermarket trading activity because it slumped nearly 4%. And really as well underscored the concern that people have as well that Tesla isn't very clear on what are the near-term growth drivers and how they're planning to revive this EV business. But as you said, to your point, I mean, we heard it during the call as well, Elon Musk really making this pitch at the end that he needs this remuneration package, that $1 trillion pay package at the maximum if he meets the milestones approved. And he also wants to have a 25% stake, or at least a 25% stake in the business, so he has a say in the direction of the business as well.
All right, Bloomberg's Annabelle Drewlers, we thank you so much. Well, coming up on the programme, we're going to stay with earnings. Volvo Cars reporting a big beat on third quarter operating income, and I'll be speaking to the CEO next. Plus, could EU regulations kill Europe's gaming industry? We'll be speaking to the CEO of the company behind Candy Crush and Clash of Clans. They say that they're an existential threat. So that conversation coming up as well later in the show. Stay with us. This is Bloomberg. Volvo Cars' third quarter profit rose as the automaker benefited from the effects of its $1.9 billion cost-saving program. That's even as Volvo Cars' sales are down 8% this year through September. So to bring it all together, I'm pleased to welcome the automaker's CEO, Håkan Samuelsson, to the program. Good morning, Håkan. Thank you so much for making time for us. As I say, you've done well on profit here, but sales less rosy. Are you concerned about demand? How's your outlook change going forward?
Now I'm quite confident because we know really why we were down in sales. We had very high sales of our smallest electric car last year, and that was made in China, and then we need to move it to Europe and localize it in Belgium, and then we lost production capacity. But now we are back producing that car, so I'm not too nervous about the volume. I'm more concerned that we continue with our actions on profitability, coming back to a solid cash flow. That's my number one priorities.
Well, yeah, you hint at the fact that you're more exposed to US tariffs than many European rivals. You've moved some production already. Is there going to be more of that, more moving production?
Yes. I don't think you should call it moving production, but we will increase the utilization in the factory in Charleston. We need to introduce more cars, but they will be new cars, so they will not be moved from Europe. But we need to really utilize the factory to a much higher degree than we do today. And that's really a very important part of our turnaround in America as well. We need to be industrially present. We need to be an American company in producing closer to our customers.
But of course you do have a Chinese owner, and I believe you're waiting for feedback from the US Commerce Department on whether you'll be allowed to sell future models into the US. Have you heard anything back yet from the Commerce Department?
Now, there is a constant dialogue with our legal expert and with the people in the department, and there is no urgency. I think this is for model year 27 or something, but there is a process going on, and I must say I'm not too nervous about that. We have been in the US for 70 years, and we will continue being present in the US.
Okay, not too nervous, but you're fully confident, are you, that the administration is going to grant you this exemption?
I think you can never be fully confident about anything these days, but that's not what keeps me awake in nights.
So what does keep you awake at night then, Håkan?
No, I'm too old for that, so I sleep rather well. I'm quite confident about the future of our company, and I'm really glad to be back. And I think with our result of 7.4, I think hopefully that is still a sign of a turnaround of the company. Maybe it's too early to say, but it's still very positive, combined with also positive signals on the sales side. September was the first month where we are back into growth.
Well, we've also been reading about how Europe's auto industry is exposed to chip disruptions potentially from China because of the new export restrictions on China-made semiconductors from Dutch chipmaker Nexperia. Has that affected Volvo Cars at all?
No, but not yet. But we are, of course, this will affect our suppliers, so it's not supplied directly to us, but we are monitoring this very closely, and I think this is almost coming back in time to the pandemic, where we had a similar situation. And I think we learned then to really be hands-on and really together with our suppliers looking into exactly how the supply of the ships are coming in. So we are monitoring it, and very difficult to say anything more today. This is a problem the whole industry is facing, so we're definitely not alone with it.
Okay, really great to talk to you this morning. Håkan Samuelsson, the CEO of Volvo Cars, off the back of their results. Thank you so much for making time for Daybreak Europe this morning. Well, we also have earnings from SAP, third quarter earnings of Europe's most valuable software company, missing estimates. So we're going to talk through those numbers coming up next. This is Bloomberg.
Earnings season is here. European earnings in focus. We'll break down the results. Bloomberg is first to break the numbers.
And we bring you some earnings that are coming through a Nordea bank.
LVMH reporting a surprising return.
And BP.
The earnings story, I think, is really fascinating.
There's just so much news. With the smartest insights.
It has been a record half-year result. We are committed to capital return. We were even able to increase our outlook. It's very good news, I think, for our shareholders.
Continuing coverage on Bloomberg.
Welcome back to Bloomberg Daybreak Europe. We are in the thick of earnings season, but let's get you some of our top corporate stories this morning. The Gucci owner Kering reporting third quarter sales that fell less than expected as demand in North America improved. Comparable revenue fell 5% as analysts had been expecting a drop of almost 9%. Kering's ADRs jumped on the results, which come just weeks after Luca De Meo took over as CEO. Elsewhere, Google says that it's made a breakthrough in its quantum computing chip called Willow. The company says it ran an algorithm on the chip that can be repeated on similar platforms, outperforming classical supercomputers. Google says that the advances point to a broad range of potential uses in medicine and materials science too. And shares in Beyond Meat erased gains of as much as 112% to end yesterday's session 1% lower. It's been a dizzying week for the stock, which rose 600% in 3 days, having been swept up in a revival of the meme stock frenzy. The rally, which began on Friday, gathered steam on Monday on reports that a trader was touting the stock on social media. And Wall Street analysts remain sceptical, with 6 sell-equivalent recommendations, 5 holds and no buys. Well, those are some of our top corporate stories this morning. Let's just take you through the risk events on the horizon for today. It's quite a busy one. We've got at 1:30 p.m. London time, US state-level jobless claims numbers. Then at 3 p.m. we have Euro area consumer confidence data. And then aftermarket, more earnings coming from Intel and Ford as well. Checking in on your broader markets, at the moment we have futures pointing a touch higher, and I really mean it when I say a touch. We're just flat to the upside when it comes to S&P E-minis and Nasdaq futures, and it's about the same to the other direction when it comes to European futures. So Euro Stoxx 50 futures down 2 basis points, FTSE 100 futures down 5 basis points. We really are treading water this morning in the futures picture, although when you look at the Asian session already, the MSCI Asia Pacific Index down 0.6%. Of course, we're factoring in the tariff story we were discussing earlier with Winnie, the ratcheting up of pressure on China's President Xi Jinping by President Trump ahead of their expected meeting. The US considering these export restrictions that would bar China from buying a swathe of critical software. So you're looking at the MSCI Pacific Index down 0.6% there. And in fact, the CSI 300 is one of the underperformers, but the Nikkei 225 down 1.5% at the moment. Well, coming up on the programme, we'll take a broader look at the markets and taking all the fun out of the games. We're going to speak to the Supercell CEO about proposed EU gaming laws. Next, Candy Crush fans, don't go anywhere. That's next. This is Bloomberg. Good morning. This is Bloomberg Daybreak Europe. I'm Lizzie Burden in London, and these are the stories that set your agenda. Oil jumps as the US sanctions Russia's two biggest producers. The Trump administration says Moscow is not serious about ending the war in Ukraine. And Asian stocks fall after a volatile session on Wall Street, and gold extends declines as the momentum trade unwinds further. Plus, Tesla's profit tumbles and SAP's revenue misses. We'll bring you third quarter earnings from Volvo Cars next. We've got a raft of earnings to bring you this morning, and we kick off the show with Nokia earnings. Third quarter net sales coming in at 4.83 billion euros. The estimate was for 4.63 billion euros. So a beat there for Nokia. The currency headwinds and US tariffs have been a bit of an obstacle when it comes to demand and profitability. And yet Nokia saying that they're tracking towards the midpoint when it comes to the operating profit outlook range. They see full year adjusted operating profit of 1.7 billion to 2.2 billion euros. The estimate had been for 1.8 billion euros. So really covering their bases. They're very much around the estimate, and the CEO saying that they're on track to achieve their full year outlook. Now, next we turn over to France for ST Micro. Of course, it's especially exposed to tariff risks because it doesn't have a US manufacturing base despite their heavy reliance on US customers. They're saying they see full year gross margin of about 33.8%. The estimate had been for 33.9%, so very much in line there. When it comes to gross margin, 35% is what they have for the fourth quarter. The estimate was for 34.9%. Net revenue coming in at $3.19 billion. The estimate was for $3.17 billion. So, again, a beat there. Overall, they're seeing net revenue of $3.28 billion. Estimates were $3.35 billion. So a bit of a miss when it comes to fourth quarter net revenue. Now, I also want to look over at Volvo Cars, not trucks, in Sweden, of course. And the fact that the company is controlled by China's Geely means that Volvo Cars, again, is one of the more tariff-exposed passenger vehicle brands with US operations. They say that the US-EU tariff deal does offer much-needed clarity. They see the market to be increasingly challenging, though, and they have third quarter revenue at 86.4 billion Swedish krona. The estimate was for 83.4 billion Swedish krona. So quite a beat there, actually. Third quarter retail sales, though, dropping 7%. We're going to be speaking to the CEO, Håkan Samuelsson, of Volvo Cars CEO, in about 5 to 10 minutes. So really looking forward to that conversation. He, of course, was brought back in April by the Geely owner to turn the company around. So really looking forward to hearing how that is going. Next up, we go to pharma, and we're in Switzerland now with Roche. The shares up about 10% year to date. They have raised their 2025 core EPS outlook, going red across your terminal as we speak. And they're seeing an increase in group sales in the mid-single digit range, but core EPS in the high single to low double digit range. Their outlook, as I say, for 2025 earnings raised. They have pharma sales here just slightly missing estimates, in fact, but the latest from Roche when it comes to pharma. And so really a raft of earnings this morning, the highlights at least when it comes to results in Europe this morning. But let's check in on how these broader markets are faring at the moment. We have futures pointing higher, actually, stateside. S&P E-minis up about 0.1%. Euro Stoxx 50 futures, though, as well as FTSE 100 futures, flat to the downside. We've had a choppy session on Wall Street yesterday after that Tesla earnings miss, and the sentiment seeming to continue into the Asia session. Traders also, of course, minding President Trump's trade threats on China. We'll dive into all of this throughout the programme, but not a lot of movement in either direction when it comes to the transatlantic futures picture so far. Now let's flip over to the cross-asset picture as well. We have the 10-year Treasury yield up a basis point at 3.95%. We had quite a strong 20-year auction yesterday, paving the way for a flatter curve into CPI tomorrow, the first meaningful data print, of course, in weeks. But euro-dollar currently weaker, 0.1% at a 115 handle. Gold down for a third straight session. And again, we ask, has the rally run out of steam? It seems like the question on gold isn't where's the ceiling anymore, but where's the floor? So $4,090 a troy ounce is where we trade right now. But oil higher today at $64 a barrel after the US announced sanctions on Russia's biggest producers, ramping up the pressure on Putin to end the war in Ukraine. So let's take a closer look at those sanctions now. The US stepping up that pressure by targeting Russia's biggest oil producers, including Rosneft and Lukoil. This move really a U-turn for US President Donald Trump.
We canceled the meeting with President Putin. It didn't feel right to me. It didn't feel like we were going to get to the place we have to get, so I canceled it. But we'll do it in the future.
Mr. President, can you tell us a little bit about why you're elevating sanctions against Russia right now?
I just felt it was time. We've waited a long time. I thought that we'd go long before the Middle East. And Mark, as you know, we did the Middle East plus 7, so we did 7 different wars.
Well, will they be worth the wait? Bloomberg's Balazs Pence joins us now with more details, our new desk editor. Balazs, we know that sanctions work slowly. We know they haven't much deterred Putin in the past. Is President Trump's aim simply to bring him to the negotiating table?
Well, he's trying to get Putin to budge, which he hasn't been able to do with his previous strategy, where he was holding off on sanctions. There were some threats sometimes. There were a lot of meetings, and as the president said, they had a lot of very nice conversations, and then seemingly nothing happened. Russia just went back to bombing Ukraine, even stepping up its assault on Ukraine. So now it took this very substantial step of targeting Russia's biggest oil companies, Rosneft and Lukoil, which together account for 50% of Russian oil exports, in the hopes of changing Russia's calculus on the war economy, really targeting Russia's revenue, the commodities revenue, which is so key to keep the Russian economy going. We know that the Russian economy has been under pressure, and now the question is whether this does change how the Kremlin sees the war. We know that just hours after the announcement, there was a phone call between Marco Rubio and Sergei Lavrov. So it does seem like the U.S. was able to get the Kremlin's attention. What was discussed in those calls, we don't know, and how far they are able to push the Kremlin in terms of coming back to the negotiating table. It also remains to be seen. But this is a step that goes further than anything before. This is a step that even the Biden administration was reluctant to take because of the potential impact on oil prices, as we see today. So this is potentially a change in strategy for the U.S.
OK, Bloomberg's news desk editor Balazs Pence out of Hong Kong. We thank you so much for that detail. Now to some breaking news, and this is that Airbus, Leonardo and Thales have signed a memorandum of understanding for a space and satellite player. Now this is a story that had been speculated about earlier in the week. We had Leonardo's board meeting on Tuesday, but it looks like they have reached an agreement on this merger of their space businesses, as I say, to create a space and satellite player. So that story just breaking across the terminal. You can see the gains for all of those stocks so far this year. We'll keep an eye on those in particular at the open. But turning back to geopolitics now, President Donald Trump is ratcheting up pressure also on his Chinese counterpart, Xi Jinping, ahead of their expected meeting. Now, the US is considering export restrictions that would bar China from buying a swathe of critical software. Treasury Secretary Scott Bessent says that everything is on the table. Now, Winnie Xu joins us for more detail out of Hong Kong. And Winnie, I wonder how damaging these restrictions are going to be for China, potentially.
Yeah, morning. Interestingly, that we are seeing actually quite limited impact when it comes to the direct impact on China. When you look at just the markets, how the markets are doing today, you see that stocks in Hong Kong actually fluctuating with the CSI 300 slightly to the downside. And it is really how people are seeing this more of a negotiation tactic ahead of the potential meeting between Trump and Xi. And actually, we are seeing, interestingly, that these software stocks in China, we see two examples on the screen here, both in the green. So that's really also showing how investors see that there are more potentials positioning into these domestic alternatives and expecting more adoptions there. So we take a kind of zooming out and looking at how the broader Asian market is trading here today. Still under a bit of a pressure. It is that ongoing tension between U.S. and China, but also the global unwinding of momentum playing out here. And interestingly, we are seeing actually Indian stocks up slightly. It's a bit of a catch up from a holiday yesterday, but also sentiment still capped because Prime Minister Modi actually said that he will not be attending the ASEAN summit, which also means that he might not be meeting Donald Trump. Now, let's take a look at what's going on in Japanese market, because the Nikkei 225 is actually the biggest drag here in the region today, with the benchmark down more than 8%. So it's still a bit of that profit taking from the Takaichi trade, and also the yen is down, is weakening for a fifth session.
All right, Winnie Xu out of Hong Kong, we thank you so much. And just continuing that theme on momentum, equities sliding on Wall Street in trading yesterday. Perhaps a sign that earnings season isn't going quite so well for everybody. We can get detail now from Bloomberg's Valerie Teitel. And Val, as we just heard from Winnie, momentum seems to be unwinding.
Well, it could be, Lizzie, that we've just gotten some new information. And the lack of U.S. data, we are relying on earnings for a guide on how the U.S. economy is doing. And Netflix sinking 10% by the end of the session yesterday, I think just shows that the market is getting a bit more wary that this tech round of results next week might not be as stellar as we hope. So we did see a slide when it comes to NASDAQ futures by the end of the session yesterday, down around 1%. Now, some of that weakness was also added to by what Winnie was just talking there, the U.S. threatening software curbs on China, but also the continued fall in gold. This is another example of a momentum trade, a trade that's performed very well, seeing some decent profit taking ahead of that U.S. CPI report on Friday in a busy, very busy week of monetary policy decisions next week. So gold continues its decline. It's down now for 3 days in a row, dropped 6% in that time frame. And Lizzie, we're eyeing that 4,000 level yet again. Now, there is some interesting things going on here with the gold market. We are starting to see ETF outflows. So that kind of momentum outflows out of ETFs is going to be hard to see gold rally without those inflows coming back. But I mentioned it has been maybe a weaker than expected earnings a week, at least for tech. We did have IBM out after hours yesterday. The shares sunk nearly 6.5% in post-market trade. Now, Lizzie, this one had to do with the fact that IBM's more AI-related cloud service unit called Red Hat saw a slowdown in sales growth. So there's some skepticism now on whether IBM is best able to capture the AI enthusiasm trade with that slowdown.
All right, Valerie Teitel, we thank you so much. And I want to stay with earnings because, as you say, Tesla's profit plunging as rising costs undercut a record quarter of vehicle sales. Shares dropped in extended trading, with analysts saying there's not much to inspire investors and questioning the timeline to develop new businesses like AI and robots. Now, despite the concerns, the chief executive Elon Musk ended the call by pleading with investors to ratify his upcoming $1 trillion pay package.
The point is, I just like that there needs to be enough voting control to give a strong influence, but not so much that I can't be fired if I go insane.
Well, Bloomberg Tech Asia anchor Annabelle Drewlers has more for us. Morning, Annabelle. Just talk to us about how much of Tesla's woes come back to Donald Trump's policies.
Yeah, well, actually, that's got quite a lot to do with it, really. I mean, in the numbers, we saw revenue coming in better than expected. Margin was better than expected as well for the latest period. But the big thing that really surprised investors to the downside was operating profit. And there was a 40% drop in that number. What is driving that, or what's behind that in large part, is the impact of US tariffs, what they're having on the business, because we saw them taking a $400 million hit in that period from those US extra duties alone. So it did have a big bearing on the business, and you really saw that underscored in that aftermarket trading activity because it slumped nearly 4%. And really as well underscored the concern that people have as well that Tesla isn't very clear on what are the near-term growth drivers and how they're planning to revive this EV business. But as you said, to your point, I mean, we heard it during the call as well. Elon Musk really making this pitch at the end that he needs this remuneration package, that $1 trillion pay package at the maximum if he meets the milestones approved. And he also wants to have a 25% stake, or at least a 25% stake in the business. So he has a say in the direction of the business as well.
All right, Bloomberg's Annabelle Drewlers, we thank you so much. Well, coming up on the programme, we're going to stay with earnings. Volvo Cars reporting a big beat on third quarter operating income, and I'll be speaking to the CEO next. Plus, could EU regulations kill Europe's gaming industry? We'll be speaking to the CEO of the company behind Candy Crush and Clash of Clans. They say that they're an existential threat. So that conversation coming up as well later in the show. Stay with us. This is Bloomberg. Volvo Cars' third quarter profit rose as the automaker benefited from the effects of its $1.9 billion cost-saving program. That's even as Volvo Cars' sales are down 8% this year through September. So to bring it all together, I'm pleased to welcome the automaker's CEO, Håkan Samuelsson, to the program. Good morning, Håkan. Thank you so much for making time for us. As I say, you've done well on profit here, but sales less rosy. Are you concerned about demand? How's your outlook change going forward?
Now I'm quite confident because we know really why we were down in sales. We had very high sales of our smallest electric car last year, and that was made in China, and then we need to move it to Europe and localize it in Belgium, and then we lost production capacity. But now we are back producing that car, so I'm not too nervous about the volume. I'm more concerned that we continue with our actions on profitability, coming back to a solid cash flow. That's my number one priorities.
Well, yeah, you hint at the fact that you're more exposed to US tariffs than many European rivals. You've moved some production already. Is there going to be more of that, more moving production?
Yes. I don't think you should call it moving production, but we will increase the utilization in the factory in Charleston. We need to introduce more cars, but they will be new cars, so they will not be moved from Europe. But we need to really utilize the factory to a much higher degree than we do today. And then that's really a very important part of our turnaround in America as well. We need to be industrially present. We need to be an American company in producing closer to our customers.
But of course, you do have a Chinese owner, and I believe you're waiting for feedback from the US Commerce Department on whether you'll be allowed to sell future models into the US. Have you heard anything back yet from the Commerce Department?
Now, there is a constant dialogue with our legal expert and with the people in the department, and there is no urgency. I think this is for model year 27 or something, but there is a process going on, and I must say I'm not too nervous about that. We have been in the U.S. for 70 years, and we will continue being present in the U.S.
OK, not too nervous, but you're fully confident, are you, that the administration is going to grant you this exemption?
I think you can never be fully confident about anything these days, but that's not what keeps me awake in nights.
So what does keep you awake at night then, Håkan?
No, I'm too old for that, so I sleep rather well. I'm quite confident about the future of our company, and I'm really glad to be back. And I think with our result of 7.4, I think hopefully that is still a sign of a turnaround of the company. Maybe it's too early to say, but it's still very positive, combined with also positive signals on the sales side. September was the first month where we are back into growth.
Well, we've also been reading about how Europe's auto industry is exposed to chip disruptions potentially from China because of the new export restrictions on China-made semiconductors from Dutch chipmaker Nexperia. Has that affected Volvo Cars at all?
No, but not yet. But we are, of course, this will affect our suppliers. So it's not supplied directly to us, but we are monitoring this very closely. And I think this is almost coming back in time to the pandemic, where we had a similar situation. And I think we learned then to really be hands-on and really together with our suppliers looking into exactly how the supply of the ships are coming in. So we are monitoring it, and very difficult to say anything more today. This is a problem the whole industry is facing, so we're definitely not alone with it.
Okay, really great to talk to you this morning. Håkan Samuelsson, the CEO of Volvo Cars, off the back of their results. Thank you so much for making time for Daybreak Europe this morning. Well, we also have earnings from SAP, third quarter earnings of Europe's most valuable software company, missing estimates. So we're going to talk through those numbers coming up next. This is Bloomberg.
Earnings season is here. European earnings in focus. We'll break down the results. Bloomberg is first to break the numbers.
And we bring you some earnings that are coming through Nordea Bank.
LVMH reporting a surprising return.
And BP.
The earnings story, I think, is really fascinating.
There's just so much news.
With the smartest insights.
It has been a record half-year result. We are committed to capital return. We were even able to increase our outlook. It's very good news, I think, for our shareholders.
Continuing coverage on Bloomberg.
Welcome back to Bloomberg Daybreak Europe. We are in the thick of earnings season, but let's get you some of our top corporate stories this morning. The Gucci owner Kering reporting third quarter sales that fell less than expected as demand in North America improved. Comparable revenue fell 5% as analysts had been expecting a drop of almost 9%. Kering's ADRs jumped on the results, which come just weeks after Luca De Meo took over as CEO. Elsewhere, Google says that it's made a breakthrough in its quantum computing chip called Willow. The company says it ran an algorithm on the chip that can be repeated on similar platforms, outperforming classical supercomputers. Google says that the advances point to a broad range of potential uses in medicine and materials science too. And shares in Beyond Meat erased gains of as much as 112% to end yesterday's session 1% lower. It's been a dizzying week for the stock, which rose 600% in 3 days, having been swept up in a revival of the meme stock frenzy. The rally, which began on Friday, gathered steam on Monday on reports that a trader was touting the stock on social media. And Wall Street analysts remain sceptical, with 6 sell equivalent recommendations, 5 holds and no buys. Well, those are some of our top corporate stories this morning. Let's just take you through the risk events on the horizon for today. It's quite a busy one. We've got at 1:30 p.m. London time, US state-level jobless claims numbers. Then at 3 p.m. we have Euro area consumer confidence data. And then aftermarket, more earnings coming from Intel and Ford as well. Checking in on your broader markets, at the moment we have futures pointing a touch higher, and I really mean it when I say a touch. We're just flat to the upside when it comes to S&P E-minis and Nasdaq futures, and it's about the same to the other direction when it comes to European futures. So Euro Stoxx 50 futures down 2 basis points, FTSE 100 futures down 5 basis points. We really are treading water this morning in the futures picture, although when you look at the Asian session already, the MSCI Asia Pacific Index down 0.6%. Of course, we're factoring in the tariff story we were discussing earlier with Winnie, the ratcheting up of pressure on China's President Xi Jinping by President Trump ahead of their expected meeting. The US considering these export restrictions that would bar China from buying a swathe of critical software. So you're looking at the MSCI Pacific Index down 0.6% there. And in fact, the CSI 300 is one of the underperformers, but the Nikkei 225 down 1.5% at the moment. Well, coming up on the programme, we'll take a broader look at the markets and taking all the fun out of the games. We're going to speak to the Supercell CEO about proposed EU gaming laws. Next, Candy Crush fans, don't go anywhere. That's next. This is Bloomberg. Good morning. This is Bloomberg Daybreak Europe. I'm Lizzie Verdon in London, and these are the stories that set your agenda. Oil jumps as the US sanctions Russia's two biggest producers. The Trump administration says Moscow is not serious about ending the war in Ukraine. And Asian stocks fall after a volatile session on Wall Street, and gold extends declines as the momentum trade unwinds further. Plus, Tesla's profit tumbles and SAP's revenue misses. We'll bring you third quarter earnings from Volvo Cars next. We've got a raft of earnings to bring you this morning, and we kick off the show with Nokia earnings. Third quarter net sales coming in at 4.83 billion euros. The estimate was for 4.63 billion euros. So a beat there for Nokia. The currency headwinds and US tariffs have been a bit of an obstacle when it comes to demand and profitability. And yet Nokia saying that they're tracking towards the midpoint when it comes to the operating profit outlook range. They see full year adjusted operating profit of 1.7 billion to 2.2 billion euros. The estimate had been for 1.8 billion euros. So really covering their bases. They're very much around the estimate, and the CEO saying that they're on track to achieve their full year outlook. Now, next we turn over to France for ST Micro. Of course, it's especially exposed to tariff risks because it doesn't have a US manufacturing base despite their heavy reliance on US customers. They're saying they see full year gross margin of about 33.8%. The estimate had been for 33.9%, so very much in line there. When it comes to gross margin, 35% is what they have for the fourth quarter. The estimate was for 34.9%. Net revenue coming in at $3.19 billion. The estimate was for $3.17 billion. So, again, a beat there. Overall, they're seeing net revenue of $3.28 billion. Estimates were $3.35 billion. So a bit of a miss when it comes to fourth quarter net revenue. Now, I also want to look over at Volvo Cars, not trucks, in Sweden, of course. And the fact that the company is controlled by China's Geely means that Volvo Cars, again, is one of the more tariff-exposed passenger vehicle brands with US operations. They say that the US-EU tariff deal does offer much-needed clarity. They see the market to be increasingly challenging, though, and they have third quarter revenue at 86.4 billion Swedish krona. The estimate was for 83.4 billion Swedish krona. So quite a beat there, actually. Third quarter retail sales, though, dropping 7%. We're going to be speaking to the CEO, Håkan Samuelsson, of Volvo Cars CEO, in about 5 to 10 minutes. So really looking forward to that conversation. He, of course, was brought back in April by the Geely owner to turn the company around. So really looking forward to hearing how that is going. Next up, we go to pharma, and we're in Switzerland now with Roche. The shares up about 10% year to date. They have raised their 2025 core EPS outlook, going red across your terminal as we speak. And they're seeing an increase in group sales in the mid-single digit range, but core EPS in the high single to low double digit range. Their outlook, as I say, for 2025 earnings raised. They have pharma sales here just slightly missing estimates, in fact, but the latest from Roche when it comes to pharma. And so really a raft of earnings this morning, the highlights at least when it comes to results in Europe this morning. But let's check in on how these broader markets are faring at the moment. We have futures pointing higher, actually, stateside. S&P E-minis up about 0.1%. Euro Stoxx 50 futures, though, as well as FTSE 100 futures, flat to the downside. We've had a choppy session on Wall Street yesterday after that Tesla earnings miss, and the sentiment seeming to continue into the Asia session. Traders also, of course, minding President Trump's trade threats on China. We'll dive into all of this throughout the programme, but not a lot of movement in either direction when it comes to the transatlantic futures picture so far. Now let's flip over to the cross-asset picture as well. We have the 10-year Treasury yield up a basis point at 3.95%. We had quite a strong 20-year auction yesterday, paving the way for a flatter curve into CPI tomorrow, the first meaningful data print, of course, in weeks. But euro-dollar currently weaker, a 0.1% at a 115 handle. Gold down for a third straight session. And again, we ask, has the rally run out of steam? It seems like the question on gold isn't where's the ceiling anymore, but where's the floor? So $4,090 a troy ounce is where we trade right now. But oil higher today at $64 a barrel after the US announced sanctions on Russia's biggest producers, ramping up the pressure on Putin to end the war in Ukraine. So let's take a closer look at those sanctions now. The US stepping up that pressure by targeting Russia's biggest oil producers, including Rosneft and Lukoil. This move really a U-turn for US President Donald Trump.
We canceled the meeting with President Putin. It didn't feel right to me. It didn't feel like we were going to get to the place we have to get, so I canceled it. But we'll do it in the future.
Mr. President, can you tell us a little bit about why you're elevating sanctions against Russia right now?
I just felt it was time. We've waited a long time. I thought that we'd go long before the Middle East. And Mark, as you know, we did the Middle East plus 7, so we did 7 different wars.
Well, will they be worth the wait? Bloomberg's Balazs Pence joins us now with some more details, our new desk editor. Balazs, we know that sanctions work slowly. We know they haven't much deterred Putin in the past. Is President Trump's aim simply to bring him to the negotiating table?
Well, he's trying to get Putin to budge, which he hasn't been able to do with his previous strategy, where he was holding off on sanctions. There were some threats sometimes. There were a lot of meetings, and as the president said, they had a lot of very nice conversations, and then seemingly nothing happened. Russia just went back to bombing Ukraine, even stepping up its assault on Ukraine. So now it took this very substantial step of targeting Russia's biggest oil companies, Rosneft and Lukoil, which together account for 50% of Russian oil exports, in the hopes of changing Russia's calculus on the war economy, really targeting Russia's revenue, the commodities revenue, which is so key to keep the Russian economy going. We know that the Russian economy has been under pressure, and now the question is whether this does change how the Kremlin sees the war. We know that just hours after the announcement, there was a phone call between Marco Rubio and Sergei Lavrov. So it does seem like the U.S. was able to get the Kremlin's attention. What was discussed in those calls, we don't know, and how far they are able to push the Kremlin in terms of coming back to the negotiating table. It also remains to be seen. But this is a step that goes further than anything before. This is a step that even the Biden administration was reluctant to take because of the potential impact on oil prices, as we see today. So this is potentially a change in strategy for the U.S.
OK, Bloomberg's news desk editor Balazs Pence out of Hong Kong. We thank you so much for that detail. Now to some breaking news, and this is that Airbus, Leonardo and Thales have signed a memorandum of understanding for a space and satellite player. Now this is a story that had been speculated about earlier in the week. We had Leonardo's board meeting on Tuesday, but it looks like they have reached an agreement on this merger of their space businesses, as I say, to create a space and satellite player. So that story just breaking across the terminal. You can see the gains for all of those stocks so far this year. We'll keep an eye on those in particular at the open. But turning back to geopolitics now, President Donald Trump is ratcheting up pressure also on his Chinese counterpart, Xi Jinping, ahead of their expected meeting. Now, the US is considering export restrictions that would bar China from buying a swathe of critical software. Treasury Secretary Scott Bessent says that everything is on the table. Now, Winnie Xu joins us for more detail out of Hong Kong. And Winnie, I wonder how damaging these restrictions are going to be for China, potentially.
Yeah, morning. Interestingly, that we are seeing actually quite limited impact when it comes to the direct impact on China. When you look at just the markets, how the markets are doing today, you see that stocks in Hong Kong actually fluctuating with the CSI 300 slightly to the downside. And it is really how people are seeing this more of a negotiation tactic ahead of the potential meeting between Trump and Xi. And actually, we are seeing, interestingly, that these software stocks in China, we see two examples on the screen here, both in the green. So that's really also showing how investors see that there are more potentials positioning into these domestic alternatives and expecting more adoptions there. So we take a kind of zooming out and looking at how the broader Asian market is trading here today. Still under a bit of a pressure. It is that ongoing tension between U.S. and China, but also the global unwinding of momentum playing out here. And interestingly, we are seeing actually Indian stocks up slightly. It's a bit of a catch up from a holiday yesterday, but also sentiment still capped because Prime Minister Modi actually said that he will not be attending the ASEAN summit, which also means that he might not be meeting Donald Trump. Now, let's take a look at what's going on in Japanese market, because the Nikkei 225 is actually the biggest drag here in the region today, with the benchmark down more than 8%. So it's still a bit of that profit taking from the Takaichi trade, and also the yen is down, is weakening for a fifth session.
All right, Winnie Xu out of Hong Kong, we thank you so much. And just continuing that theme on momentum, equities sliding on Wall Street in trading yesterday. Perhaps a sign that earnings season isn't going quite so well for everybody. We can get detail now from Bloomberg's Valerie Teitel. And Val, as we just heard from Winnie, momentum seems to be unwinding.
Well, it could be, Lizzie, that we've just gotten some new information. And the lack of U.S. data, we are relying on earnings for a guide on how the U.S. economy is doing. And Netflix sinking 10% by the end of the session yesterday, I think just shows that the market is getting a bit more wary that this tech round of results next week might not be as stellar as we hope. So we did see a slide when it came to NASDAQ futures by the end of the session yesterday, down around 1%. Now, some of that weakness was also